Into, like I said, the final countdown. We'll see if that shows up in the markets. Of course, energy is a key focus. This week alone, that sector has been in and out of the green, a real rotation. We'll see how it ends the week today, Guy.
Yeah, there's a couple of conflicting factors in that oil market that we need to pay attention to. We'll get a take on that in a few minutes' time. But for now, it is Friday. It is time for the opening trade here in Europe. Equities get going. Let's see the kind of numbers that we're going to post. We are expecting a positive start to the day. Remember, we've been hitting records this week. We're breaking out of ranges. Are we going to continue with that momentum? The FTSE 100 maybe a little bit of a laggard today. Remember, driven earlier on this week by some of the pharmaceutical stocks as well, which had a very kind of good midweek. Today, though, it could be defense names. We're going to keep an eye on what's happening with the oil trade as well. How significant is that going to be? Credit IBEX is up by 0.6%. We're watching Spanish banks very carefully following the interview yesterday. So the Spanish market, a little bit of outperformance coming through early on in that story. The DAX clearly has nothing to talk about today because it's out early in terms of posting a number. We're up by 0.4% there. The CAC is up by 0.4%. Europe pushes on. We're going to get some PMIs over the next hour as well. Pay attention to those. What are they going to tell us about the Spanish and the Italian economy as well? Fresh data coming from those markets. We'll watch that very carefully. Kriti, sectors, stocks, what are we watching there?
Well, to me, on the surface, green on the screen on the index level, but on the surface, the rotation, I think, is interesting. The outperformers of this week have been healthcare. Today, they are on the back foot. You're looking at from an index contribution perspective, Novo Nordisk, GSK, I'm looking at Roche, Novartis. They are all in the red at the moment. Your outperformers, your index contributors to the upside, is the banking sector. I'd like to take credit for that as the exclusives on BBVA Sabadell, but I think there's more to it because we're looking at HSBC, Santander, UBS, of course, dealing with the capital rules requirements as well. They are all in the green. But again, on the surface, this feels like a rotation from some of the price action we saw earlier this week.
Absolutely. Tech is a little weaker, so ASM Holdings is the biggest drag that we are watching, which is interesting because you did see a little bit of a rollover in tech in Asia hours as well. Boba's had an incredible week in terms of the performance that we've seen there. Is that something that we're going to be continuing? But yeah, banks look like they're very much on the front foot. Banks have been the driver this year. We talk about European performance. That's where it's come from. The banking sector has been a huge part of that narrative.
Buybacks, dividends, it's kind of the Wall Street playbook, and it's kind of this kind of cycle, this self-fulfilling
Are we getting to the end of that narrative, though? Like, how much more money is going to continue to flow back, and therefore are we going to see maybe that narrative beginning to come to a conclusion?
Yeah, we should mention as some of the defense stocks are higher as well. I'm looking at over 3% move for Saab and some of the others. So very clearly geopolitics, the defense story showing up in this market. Let's see a little bit more analysis this morning. Banu Buweja, the chief strategist over at UBS Investment Bank, joins us around the table. Lovely to see you, as always. We've got a bear on the set for a day where all the markets are in the green. How do you explain that?
I think the data in the U.S. has actually held up better than we would have thought, right? About 2 months back, we thought the next 4 quarters are going to give us basically flat growth. Instead, growth we now think is going to be about 1.4%. So spending in the U.S. has held up, despite the fact that the labor market is very clearly weakening, right? You look at all the leading indicators in PMIs, NFIB, most of the surveys, the labor market is weakening. So there is a gap opening up between spending, which remains very strong, CapEx, also top-end consumer spending, and the labor market. So I think the key question is whether the labor market catches up to spending or spending catches down. We think it still catches down. Spending catches down to the labor market. And then the secondary question is whether tech is going to be acyclical. It hasn't been historically. It has not at all been historically acyclical, but we do seem to be in a situation in the market where we're in sort of the final throes at a time when you're getting more and more linkages between companies, M&A has picked up, and so therefore the market is carrying on putting very high multiples as well, right? So the earnings expectations, 12.9% over the next 12 months at 23 times multiples. So things are heating up a little bit. I think the economy has held up better than we expected, but the market is also putting a very high number on the earnings.
I know, guys, just jumping, ready to talk about tech, and I'm going to let him after we talk about margin compression, because we're not seeing that. The dynamics you're talking about, these jitters are very much in this market, but you don't see that in the margin compression. And I think a lot of folks would have said, it's October of 2025. It's been 6 months since Liberation Day. Where is the effect of not just tariffs, but inflation, of the volatility? Where does it show up in these numbers, or is it just getting absorbed by really rich balance sheets? Where's the pain?
I do think it's a little bit early for that, because again, if you think about inflation, it hasn't really come through, right? Neither the inflation nor margin compression have come through so far, but I think both will come through in that as these tariffs begin to hit the consumer, you'll see OER is going to start, OER, which is the rental part, which has been completely countervailing the impact of goods prices going up. I think that's going to begin to trough out in terms of how low it can go. And that's where in the next 6 months, sort of the average change in core CPI is going to be in the mid-30s, which means it's going to annualize close to 4%. That will tell on real disposable income. That will tell on margins as well. So I'm not sure you're going to see a lot of this in the Q3 reporting season, but beyond that, I think you will begin to see margin compression as well. Margins are at sort of 95 percentile.
Let's talk a little bit about this tech trade and try and get a bit of more understanding of kind of where we are within it. At the moment, it feels like we're where the funnel is wide, and we've got a lot of runners and riders, and ultimately there's going to be a few horses that are going to win the race. At what point are we going to know which ones are going to win the race? Because everybody's spending galactic amounts of money at the moment because they want to be the winner. But I don't know who's going to be the winner yet. Do we have any visibility on that at this point?
I mean, the question is going to be whether or not this CapEx spending in technology is going to lead to a big pickup in productivity, right? We need to see whether...
Hasn't yet.
Well, productivity has been in line with long-term averages. It hasn't led to a very big increase in productivity. And remember, in the 1990s, which is what people compare it to, Greenspan said, the data doesn't tell you that we are seeing much higher productivity, but I can tell you that there's a productivity miracle on the way. So sometimes the data does lag, right? However, I will say that if you start comparing it to the 1990s, the degree of CapEx, although there's some hyperscalers where the CapEx is very, very high and the CapEx to sales ratio is getting to worrying levels, if you look at overall tech, if you look at information processing, if you look at software, if you look at research and development, actually the growth in CapEx spending is a fraction of what it was in the 1990s. Right? And you don't have the same degree of consumer strength either. So I think when we compare this to the 1990s, and often people ask the question, are we 1996 or are we 1998 or are we getting close to 2000 already? It actually doesn't compare to the 1990s. So we don't think we are in such a large productivity boom. So to go back to your question, I think the answer really is, at what point do you start seeing non-tech sectors? So if the news is not on Hitachi, not on Fujitsu, not on OpenAI, but which healthcare company starts telling you that there are significant reductions in its COGS or significant increases in its revenues as a result of AI? I think the market has been very patient with that, much too patient. And I think through the course of this year, in Q4 earnings season, if you don't begin to see in the real world monetizable AI, I'm not saying AI is not relevant. AI is very relevant over the medium term. But by the end of this year, early next year, if you don't see AI being monetized in non-tech sectors, that's when I think the market runs out of patience.
Okay, so when the market runs out of patience, the key question then is how much leverage is there within that trade? Because leverage is what undoes these things.
Leverage is what compromises the balance sheet guy, right? So, but because we have
to write it down.
Sure, but you don't need a balance sheet crisis. A balance sheet crisis is a sufficient condition for the market to go down, not a necessary condition. In that you could have income statement problems. You could have, first, a lot of the leverage, both in credit and in equity in this cycle, is on the private side, which is why you have not seen many publicly traded companies trade poorly. So you look at high yield spreads. They're absolutely fine. You look at equities, they continue to go up. To Krithi's point, you keep getting the inflows all the time. The valuations go up all the time. So it's on the private side, and that's why the visibility of there is leverage. The visibility of that leverage in recorded data, I think, is our profits, which is not the same NEPA as national accounts, overall economy, which is not the same thing as NASDAQ, not the same thing as S&P. They have begun to come down, right? And that will lead profits in the S&P also hitting a little bit of a headwind. And I think that's when the private companies are going to start telling you that things are not as strong as you thought. Publicly trading companies will probably feel it even after that.
Let's bring the story here to Europe. It's a very clear AI tech case in the States. In Europe, there's been a conversation about the fact that whereas the innovation is happening in the States and arguably in Asia as well, the adoption process is faster in Europe. And you're seeing that anecdotally from some of the banks, from some of the financial institutions, from even some of the healthcare names as well. When you're trading the AI story in Europe, is there an adoption premium? Should there be?
I think it's a bit early to say that. I mean, I think the story in Europe, historically, European equities could not get off the ground if the value trade was not doing well, right? And so what has done well historically in the last 3 or 4 years has been quality, has been momentum, has been growth, right? And this is one of the reasons why Europe has lagged. Now, is Europe going to become a leader because it adopts the AI story quicker? I doubt it, right? I think the story is going to be simpler. You guys were discussing defense, and you guys were discussing banks earlier. I think those are going to be the stories in Europe, particularly banks. I actually do think that banks have further to run because so far their valuations have gone from very cheap to reasonable. And also banks is one sector which is not impacted by tariffs. Yeah. And this is why incremental European money, if not US money, is going to continue to go into these sectors. I think their valuations will pick up. Are they going to go up because AI is going to lead to their profitability going significantly higher? It's not clear to me that there is enough. You said there's anecdotal evidence of that. It's not clear to me that there's enough evidence that productivity in Europe is picking up directly as a result of that. So I don't think so. I don't think AI adoption is going to lead Europe to become a winner.
Can I switch gears? I want to talk about the dollar. I'm hearing a lot about emerging markets at the moment. People are telling me that's a dollar trade extension, that I should shift money into emerging markets. Dollar's going down. Does the dollar continue to go down in the scenario that you're kind of painting a picture of? And if so, what is the logical trade from that? What's the derivative trade of a weaker dollar?
Yeah, so it's a great question. So I think when most people think about the dollar, they just think dollar down, buy EM, right? Yeah. We really have to ask ourselves, why is the dollar down? And more importantly, is the dollar down in a world which is a good world where volatility is compressing? Or is the dollar down in a world where volatility is rising? So, you're beginning to worry about risk premia rising. Because if it's the latter, and we think it's going to be the latter, because we think the dollar is going to go down, euro goes to 123, yen goes towards 135, because you get weaker U.S. growth, right? Because U.S. growth weakens. So that's a world in which VIX is higher. That's a world in which high yield spreads are higher.
Pretty low at the moment,
So, indeed. And so that's not a world in which you're running for carry. That's not a world in which you're running into Mexican peso or Brazilian real or Turkish lira, because vol is the mirror image. It's the opposite of carry.
Yeah.
So it's not a world in which you run into emerging markets. It is a world in which you run into safe havens. So gold...
Well, that's where I was going to take you. Yeah. Is gold the new VIX? Like, are people buying gold because... people aren't buying the VIX as they're kind of...
Gold serves many purposes, right? So gold is an inflation hedge. It is an uncertainty hedge. As you say, it's a volatility hedge. But also, gold, more fundamentally, gold's life changed the day Russia invaded Ukraine, because that's when many central banks, many supranationals sat around a table and asked themselves a fundamental question: what is money? If treasuries, gilts, bunds, all of that can be sanctioned, what is money? And none of them have a good answer, but all of them allocated more incrementally into gold. That's one of the reasons why gold is here. And gold's relationship with its single most important driver, which is real interest rates, completely upended that day. So that's the one place where you could continue to see further upside.
The traditional metrics don't work anymore when it comes to gold.
Indeed, they absolutely don't. But even today, you're not in a state of froth in precious metals. Silver is not massively outperforming gold. When you get froth in precious metals, silver goes bananas and significantly outperforms gold. It's very sedate. So I do think that we are still in a sort of a stage where gold can go even further. I think that's the cleanest anti-dollar trade, not the EM trade.
Great to see you. Thanks for stopping by to see us. I could, that went by in a heartbeat.
We need like 3 days for this conversation.
Whole show. Barnaby Wager, Chief Strategist at UBS Investment Bank. Thank you very much indeed. Core 6 looks like this. Barnaby mentioning what's happening with the defence trade. Let's take a quick look at what Rheinmetall is doing. And as you can see, it is the standout story this morning. It is up when most are down. Novo, LVMH, ASML, Nestle, all softer this morning. The defence trade is on the front foot, and that is where Chloe Melly is starting.
Good morning, guys. So, yeah, let's start with some positive movements across that defense sector, as you just mentioned, with Rheinmetall, Hensoldt, Leonardo, and Saab all up this morning on the back of those growing tensions in Europe. We had flight suspensions in Munich because of drone incursions. We had Poland telling a Russian ship to leave its waters, and Zelensky also saying that he expects Ukraine to secure longer-range weapons from the US. So we've got all of those stories about those growing tensions in Europe, and that is really driving the shares across that defense industry this morning. Moving on to France, where Legrand is up. Legrand provides cooling equipment, electrical equipment, data centers, and it just made a big acquisition over in the US to expand those capabilities in that market. So this is part of this ongoing M&A strategy for Legrand, and that is driving the stock this morning. Let's move over to a couple of new ratings. So Nemetschek is a company that provides software solutions to the real estate market, and it got upgraded to a buy at Berenberg. That is driving the stock up 2.6% this morning. And we also had a double upgrade from RBC for Diploma, which is a supplier of building components. And RBC said that it was one of the safest growth names in that sector, and that is driving the stock almost 3% this morning. And finally, let's end on Raiffeisen Bank in Austria. It is up as the EU is preparing to lift sanctions on assets linked to a Russian oligarch to essentially help compensate Raiffeisen for damages it had to pay in Russia, and that is driving the stock 5.4% this morning for Raiffeisen.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. As she was speaking, we did get some data crossing the wire, this time from Spain. I'm just going to run through these numbers here. The composite PMI rising to about 53.8. The forecast was 53.3. The services PMI rising as well to 54.3. The forecast was 53.3. So a slight increase. I wouldn't call it a massive.
No, but these are good numbers compared with the rest of Europe. This is the thing. The Spanish economy continues to do very well. The tourism industry, I think, circa 14-15% is a big driver of that, but it's more broad than that. And you are continuing to see the service sector as being the outperformer. Like, there's a sharp rise in new business volumes in the service sector, according to market PMI. Positive market demand. Firms also more upbeat in their assessment of the outlook. They're adding staff accordingly. Pipeline cost pressures are there, but they are underpinned by increased labour expenses, which is interesting. So what does that tell you about kind of spending within that economy too? But yeah, these are strong numbers for an economy compared with what we're seeing in the rest of Europe. So we'll come back to that. Not much movement in euro-dollar, which is trading 117 at the moment, 117.23. When we come back, we need to talk about what's happening in the oil story. There's a number of different kind of factors that we need to fold in. You've got that OPEC Plus meeting we need to talk about. You've also got a big Chevron refinery fire in LA, I think. It supplies 20% of all motor fuel in the United States, 40% of jet fuel consumed in Southern California, which is obviously a huge market as well. You're looking at pictures coming from California as we watch that fire erupt, and the implications of it, I think, are probably still to be factored in. We'll talk about it all next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back, 20 past the hour. This is what European markets look like. It's nice to have the Germans with us today. Remember, it is Reunification Day in Germany. There's a national holiday, but the markets are still open. Broadly across the piece, we're up by 0.3%. European markets pushing on. We're seeing defence stocks and banks firmly in focus this morning. Let's talk about what is happening. Ikri's had her time this morning. We're going to move on now. We're not going to talk about Spanish banks. We're going to talk about what is happening in the aviation world and figure out what is happening there.
This is a fun show. We both get to do what we want to do today.
Little kind of subsections going on.
Yeah.
I want to start off with what's been going on in Munich. So flights from Munich airport have been suspended over the last 24 hours as a result of drone sightings. Now, we've seen this with other airports around Europe. It feels like this is a further expansion of the Ukrainian conflict into European airspace. Bloomberg's transport reporter, Danny Lee, is in London. Nice to see you in London. So that's the first thing to say. What happened here, and is it different? Are there similarities to what we've seen in terms of other airports in Denmark and in some of the other Nordics?
I think this is what officials will be trying to piece together now, not just in Germany, but across Europe, because this is now the third such airport, and particularly a major air transport hub.
This is one of Germany's biggest hubs.
Precisely. And so I think, whilst getting back to normal now, but this is a key question, is are there going to be others affected? And also, how do they prevent these kind of drone, obviously, great they see these drones, but how do they prevent them from getting anywhere near not just airports, but other critical infrastructure? And so, therefore, I think it's going to be a question for the authorities of who do they really see as the actor involved in this, and then how do they combat it? Because, whilst it's only disrupted 30-odd flights inbound and outbound, you remember all those years ago what happened at Gatwick with these supposed drone sightings, caused absolute mayhem for travellers. And obviously, as Germany heads into this holiday, people would have been getting away early for the weekend.
And we still haven't confirmed that they're actually Russian drones at the end of the day. Is that right? So we are still waiting for it. But the speculation is.
I think you're never going to know
there.
the answer to that question.
I suppose that's a fair point. Let's talk about another story in the aviation space when it comes to Boeing's new 777. Is that right? 777, 777. That's the way you do it. See, this is how you know you're a novice to the aviation space. They're facing a significant delay. Can you just walk us through the impact of that? Guy was telling us earlier that this is the people who need it really, really need it. Is that fair?
Yeah, for airlines who bought into this plane, the previous decade, they were expecting this plane, this new long-haul wide-body jet, to be delivered by Boeing in 2020. So this will be a delay that now stretches into 7 years. And for Boeing, the implications are that whilst customers are continually unhappy that Boeing can't deliver, For Boeing, there could be another non-cash accounting charge, potentially between $2.5 and $4 billion. That's going to impact them. And already this program has racked up charges of $11 billion. So this is poor news for Kelly Berg, but he has been.
Is it worse for Carsten Spohr or for Tim Clark? The airlines that need them. Tim Clark is refurbishing his 380s. Is he able to carry on at Emirates with that program while he doesn't get the 777X? Because this is a huge airplane that's going to take a lot of capacity.
I think for the airlines who are getting this 777X first, they've already accounted for this delay, and I suspect, given the non-delivery of Boeing in the recent past and the failure to deliver, they have been extending the older aircraft. So I suspect they have got enough room to bridge that gap until Boeing actually delivers.
All right, Bloomberg's Dana Lee walking us through those dynamics. We thank you so much. Another story we have our eye firmly on is oil. Higher this morning, but crude heading for a decline on the week. This, of course, comes ahead of the weekend's OPEC Plus meeting. Bloomberg's Stephen Sepchinsky joins us from Singapore. Stephen, just walk us through what's at stake here. Is this just another output hike for all of us on the agenda?
Yeah, I think every time we go into these meetings, there's a question as to, are they going to increase output, or are they going to increase output more than they did previously? And that's the question today, right? So there's discussion around how much will they increase. Last month, so for October, this month rather, they increased about 137,000 barrels per day. There are reports from Bloomberg and others that there's discussions of them increasing for November 500,000 barrels a day. So that'll be a ratcheting up. Now, the OPEC has come out and said that nothing has been decided yet, but the fact of the matter is the market is closely watching and they're positioning themselves. If you look at oil prices, yeah, we're up about 1% today, but we're down about 7% for the week. That's the biggest weekly drop since June. And I think it's mostly traders positioning in the sense that, hey, there might be a larger than expected increase. Analysts surveyed by Bloomberg were expecting a smaller increase, about 137,000 barrels a day. So if they do go to the 500K, then that is bearish for the market. Analysts say that we could fall below the $60 level for Brent. We're around $65 right now.
Stephen, there's two other stories floating around in the oil market, one of which is this refinery fire we've got in California. The other one is the fact that the French have taken a Russian tanker out of the dark fleet. Neither of these two look like they're moving the market at the moment. Is the glut just so big that even factors like this aren't having an impact?
I think that's precisely it. Right, I think if we were 2 years ago when the oil market was tighter and Brent were closer to $100, if you saw a boarding and an arrest of a captain from a shadow fleet ship, which is clearly a ratcheting up against the shadow fleet, a tightening of control over what Russia and other ships can send around the world, Iran included, then that does indicate that would be a bullish indication, and you would probably see prices spike to a degree, but it was very subdued this morning. Same with the refinery fire. Whenever you see big shock and awe, one refinery out, while it is a major and one of the largest refineries in the United States and a big supplier for Southern California, a refinery fire does tend to lead to knee-jerk reactions, and you would sort of see prices swing one way or the other, but we're not quite seeing that exactly either. So I think it does show that the market is facing a glut, and that is something that traders are looking at quite closely.
Stephen, thank you for the coverage. We're grateful, greatly appreciate it. We'll follow that story into the weekend. Up next, Hugh Van Steenis of Oliver Wyman's going to be joining us. That's next. This is Bloomberg.
Said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to the opening trade. 30 minutes into today's session. It's a party. Friday feeling in these markets. Green on the screen across the board. Outperformance in France, which I think is interesting. I would say maybe at the start of the open, we would have thought that Germany would have shown up. The defense trade very much a focus in this market. That's not what's leading, though. It's the CAC Iran, higher by 0.4%. We should make the point, though, that this week, that's where the underperformance has been. So, Guy, it feels like a little bit of a rotation theme in this market.
Absolutely. Let's talk about the internals and figure out what is happening. There's a lot of stocks higher today in Europe. Is Europe breaking out? 426 to the upside, 153 to the downside. The volume is quite high this morning. I'm told it's because of Telecom Italia. A lot of volume going through Telecom Italia this morning, and that is what is driving the high volume today versus the 20-day average. Telecom Italia making some announcement relating to AI. That is giving the stock a huge boost. They're going to be building some extra capacity, some extra data centers, and that is the narrative that is driving that stock to the upside at the moment, and that is why we're seeing it as one of the 52-week highs today, up by over 4%. The Italian market feels like it's very much driving things at the moment. Leonardo in the Italian market as well, in the defense space as well, is also doing fairly well too. It's up by 1.4%. Hensoldt, 52 high in the defense space, up by 2.4%. It feels like the perimeter of this conflict is getting bigger and bigger and is pushing further into Europe. The fact that Munich airport has had drone incidents tells you that this is getting into the kind of core of Europe. The conflict is broadening out, and that is why the defense stocks maybe are reacting in the way that they are this morning, Chrissy.
Absolutely, lots to walk through. Let's walk through some of the other stories you need to know this morning. The all-important U.S. jobs print has been hit by the federal government shutdown. Today's non-farm payrolls report and factory orders data both set to be delayed. It all comes as President Trump vows thousands of job cuts, ramping up pressure on Democrats to end the impasse. In the Spanish banking space, the BBVA chairman and Sabadell CEO have clashed in exclusive Bloomberg interviews. A 17 billion euro takeover deal would create a new Spanish banking giant and push BBVA closer in size to the country's biggest lender, Banco Santander. We'll bring you more of the interviews throughout the morning. And Bloomberg understands that Bridgewater's flagship macro fund climbed 26.4% in the first 9 months of this year as tariff-fueled market uncertainty boosted the firm as well as its peers. Sources saying the hedge fund is on track for its biggest gain since 2010. The 50-year-old firm has been in reboot mode since Nir Bardea became sole CEO in 2023, making sweeping personnel changes and cutting assets in a bid to boost performance. Guy.
Let's talk about what else we're watching this morning. AI continues to be a significant theme. You've only got to watch what is happening this morning with Telecom Italia making some announcements relating to what is happening with its infrastructure push and the market rewarding it in significant fashion. Bloomberg has also learned that Global Infrastructure Partners is in advanced talks to acquire Macquarie-backed Aligned Data Centers. Sources say that Aligned could be valued at around $40 billion in this transaction. Bloomberg's Manuel Bagori, who leads our deals coverage in Asia, joins us now. What do we know? Another massive number attached to an AI deal.
Definitely another mega deal on the horizon. This one seems to be just in the final stretch, and potentially we might see an announcement over the coming days. And definitely AI and AI-related infrastructure, digital infrastructure, data centers in particular has been a hot topic for deal making, not only in the US, but even here in Asia and globally. We've seen an increase in the number of deals, some of them really large, in the billions. The reality is GIP, now owned by BlackRock, they've been in the hunt for large transactions, and they've also had a really impressive track record when it comes to infrastructure investments over the years. So it remains to be seen how this one will get done, but it appears to be one of the top deals in 2025 for sure.
All right, Bloomberg's Manuel Bagori walking us through the deal environment, specifically when it comes to the infrastructure story. We thank you so much. There's a through line there to our next guest. Hugh Van Steen is vice chair over at Oliver Wyman, joins us around the table. We were just talking to a reporter about the deal-making environment. You have your ear to the ground on all of that, but there are some jitters in this market. On the one hand, people are saying deals are back in the private markets and the public. Others are saying, well, actually, maybe for the next 3.5 years, we should all just be in the private markets. Where do you stand on that?
Well, thanks for having me on, Chrissy. Look, I think that it's a very wide and deep market, so you can't just give one theme. I mean, there's definitely a cyclical uptick, and we see this from our conversations with the leaders of the banks. They're very excited about the M&A pipeline, probably more strategic than private in some cases. And I think there's sort of two vectors. One is the strategics wanting to sort of take part, but also, as you saw with the GIP news you're running with, the role of insurance money, wanting to put money to work in infrastructure and data centers is huge. Something like 60% of the new money which came to private credit last year came from insurers. That structurally lowered the cost of capital for private credit. So they're spending way more time looking at infra, data centers, and other asset-backed lending, and much less on leveraged loans, which may be going through a slightly tougher period.
Well, that was also one of the concerns around the latest AXA BNP tie-up there, and that a lot of this insurance money, to your point, is suddenly being put to work in a firm that is being thought of as potentially systematically important. Is that a concern, that tie-up, that things are getting a little bit more complicated?
Yeah, well, so we've just put out a report with Morgan Stanley, sort of our annual State of the Nation, and I think our thesis is there is going to be a wave of consolidation across asset management because it's a bit tougher for that squeeze middle. It's the pressure from privates, it's the pressure from ETFs, but also the pressure from investing in tech and AI. And so that squeezed middle, if you're some of the deals in Europe, managers which were less than $1 trillion, is really struggling. And also the stock performance has been very disappointing. I mean, you were talking about European banks just now, Chrissy. They're up 58, 59% in the last 12 months. European asset managers are about up 2 or 3%. So I think the pressure is unrelenting. The challenge is, deals require personalities and numbers to work, and that's the tricky piece here.
Hugh, can I just come back to something you mentioned a moment ago, which is the fact that the AI infrastructure trade is kind of rescuing the private credit kind of side of things, because you don't want to put money over here, so there's an opportunity to put money over here. Everybody's flooding that way. What are the long-term implications of that? How much of this is leverage? How much leverage is going into this trade right now? What do you see the risks around that trade? Like, if everybody is kind of looking for a lifeline, is everybody going to get hold of it?
Well, look, it's a great question, Guy. I think there's two sides to it. On the positive side, there is a capex boom. There is an extraordinary need for capital. Depending on who you look at, 1 to 2 trillion in the next 5 years. And obviously, it's the single largest source of growth for putting capital to work. So I think on one side, it is actually very positive. On the other side, the private credit firms are looking to deploy. One of the most interesting things I've come across is that it's almost in every sleeve. There's the infrastructure funds looking at data centers. Yep. The real estate funds are looking at data centers. Exactly. The asset-backed lending, they're looking at data centers. Now, depending on who is the sponsor, the one very good one of the themes you've been debating in the last few weeks is this like 99? One of the big differences one of the managers said to me was, unlike in 99 where it was cable and telcos with cuspy investment grade ratings, now it's the superscalers, all of which are incredibly strong credit rating players who want to put money to work. But you're right. There's I wouldn't say a frenzy, but there's an extraordinary race to finance.
But the difference, I would argue, as well, is that when you put cable in the ground, if you don't use it for 5 years, it's still there.
Yeah.
If you build a data center and somebody doesn't renew their lease, that's a stranded asset. And what is the risk of all this money flooding in, as you say, from pretty much everywhere at the moment, into an area where we're not sure? Yeah, kind of what happens further down the road. Our lease is going to be renewed. Is everybody going to take up the capacity? Yes, at the moment it feels like everybody's racing towards it and there's big numbers being talked about. But kind of, what is this vintage going to look like in a few years' time?
It's a great question. So what you also start to see in some of the deal structures is actually trying to put in very long-dated leases to actually... Yeah. So to get the cost of capital down to an infrastructure cost rather than a more speculative property, you do need to then say it's got a 10-year lease. And from a superscaler, that's a very good credit. So I think you're right that there is that tension, but that's why they're trying to get, as best they can, get the terms of the trade to be longer. But you're right, there's going to be, every loan involves risk. At the moment, they look very low risk, but obviously that's the challenge.
You talk about the pieces of the financial infrastructure that are trying to build this out. What about the client flows and the fund flows that are interested in the people that are investing in this? In other words, where is that interest coming from when it comes to actually wanting exposure to some of these private credit funds?
It's a great question, Chrissy. So for me, there's two big themes. So the first we've discussed is insurance. So actually, even over the last 3.5 years, insurers have been the single biggest source of money for the private credit firms, something like close to 60% of the flows. But the second is the growth of wealth. And this is probably, aside from crypto, the single fastest growing area in the market. This time last year, $1 in $9 raised by private credit firms came from the wealthy. This year it's 1 in 6. And if you look at the way they're putting them together to try and access a broader range of wealthy clients, they're coming in evergreen funds. So like a semi-liquid fund, that space is growing about 40% annualized at the moment. So it's probably the single fastest growing area of the market, and hence why everyone is trying to get a piece of the action.
It's fascinating because it feels like it's a moment in time that's really suiting the private credit folks. And I say this in the broader macro sphere as well. As you're familiar, there's a lot of worries around sovereign debt right now on both sides of the Atlantic. In the corporate credit space, we've talked a lot about how some of the fund flows that maybe would have ordinarily been allocated to that are moving to corporate credit. The second derivative of that conversation, though, is that it might be moving to private credit. Is there evidence of that this early in the stage?
I think there's some. I mean, I've just come from an asset allocator conference this week in London, and I think that, one thing we've spoken about before is that flows are sort of barbelling. So actually some endowments still feel overweight private assets, haven't got the cash back, and actually want liquidity. So they're putting money much more in very liquid fixed income funds. But the other end, if you want to get yield, unless you buy financial credit, which has still got decent yield, you do need to move into private or to structured credit. So you're seeing that polarization going through in asset allocation, and you definitely see private credit firms benefiting from that.
Hugh, you know how the plumbing works. The financial system is epically good at hiding leverage and hiding the connections between the various parts of the financial system to that leverage. What do you see, right? You talk about the insurance money. This should be the safest money in the market, but it's finding its way into areas that maybe aren't the safest place in the market. Where's the leverage? When you look at into the darkest corners of the financial system, what are you seeing at the moment, and what are you seeing in terms of the kind of the connections that exist around the system?
It's a great question, and I think this is the first question every central banker asks me at the moment as well. Look, so can I just say there's one positive here. If a loan is coming off a bank's balance sheet and a bank is 10 times levered, and it's moving to a fund which is 1 times levered, or to an insurer which may be 5 to 6 times levered, the system as a whole has got less leverage. But what you're asking is obviously, what are the connections? How do the points get joined up?
Bank?
Well, no, it depends. So depends on the loan. If it's a risky loan, the bank is very happy to pass the riskiest piece to private credit and then lend a senior. I think I've discussed this question before. It's like this is where private credit is the Ozempic to the financial industry. It's letting the bank shed weight, and it takes the more senior risk. But on the high quality loans, there is a battle to be had, and so there is a little bit of leverage injecting. The area that you want to chase down would be fund leverage. So it's not just much where an individual is taking credit or loan, it's then is there leverage on leverage, and that's the piece which is very opaque.
Do you see leverage going? How much leverage is in the system at the moment? Leverage tends to undo kind of everything, because you have to mark when it goes wrong. You have to mark it down. How much leverage do you see in the system? Is leverage something I need to be concerned about at the moment?
So given this trend to insurers and the wealthy, which are less levered than maybe the more opportunistic, it strikes me that the overall level of leverage in the system has been coming down. But fund leverage is the piece where you want to be digging around to understand, has someone taken a position and then levered it up twice with their private bank or levered it up elsewhere? So
when you talk to central bankers, are they worried that they don't have the visibility?
It's the opacity. Yeah, it's that. They want more data. They want to. They feel that in the past they had their finger on the credit pulse. Now, whether they did or not is a debatable. Well, but they certainly thought they had.
2008.
I was about to say that's right. Exactly. But they don't feel they have that sense of where the flows are going, and so they'd love to get more data. You just saw actually in Australia 2 weeks ago, the regulators now demanding more data from the private market industry, and I think that's going to be a theme we're going to start to see play out stateside and in Europe potentially as well.
Hugh, it's always great to see you. Thank you very much for stopping by, shared some of your thoughts with us. Hugh Van Steenis, Vice Chair over at Oliver Wyman. Coming up, Prime Minister Sébastien Lecornu scrambles for allies to push through a budget and keep his government on track. We're going to get the latest on that story next. We'll take you to Paris. This is Bloomberg.
Estava sitiada. Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back. We are 47 minutes into the trading of European equities this morning. This is what the session looks like. Volume is actually fairly decent. A lot of that's coming out of Italy. Spanish market definitely on the front foot. The banks there are driving that narrative, and that is why we're seeing some outperformance coming through from that market. We've come up. We're kind of now bumping along the route sideways. We would be normally waiting for non-farm payroll data, but we're not going to have it. So there are other things that we need to be focusing on. Denmark security chief saying that Russia is leading a hybrid war in Europe and the risk of further such attacks is rising. This comes as Poland's Prime Minister Donald Tusk warns of an increase in the number of incidents in the Baltic Sea involving Moscow. European nations are dealing with a series of airspace incursions. The latest incident involving drone sightings near Munich airport, which caused a number of flights to be cancelled and diverted. Feels like the perimeter of the Ukrainian conflict is getting bigger and bigger. Ben Sills, our managing editor for the European Economy and Government, joining us now. Ben, Poland saying that Europe is already effectively at war with Russia, and every day it feels like that is increasingly true. The latest incidents just pushing the perimeter of this conflict out further and further. Is that where we now are?
Yeah, I think that's a fair summary. This confrontation, it's not a war yet, but it's definitely a confrontation, has been going on at a low level for a while, and we've definitely seen an uptick in the number of incidents over the last few weeks, and that really, I think, it's reflected in the rhetoric you're hearing from people like Tusk and the Danish Prime Minister Mette Frederiksen. It's also part of their thinking is they need to try to persuade European voters that this is real and this is a threat, because they're spending a lot of money on trying to address this, and that brings all sorts of difficult decisions down the track.
What do we actually look at when it comes to some of these incursions here? From a broader perspective, does it bolster the case in Washington, in Brussels, to have the conversation of longer-term missiles or longer-term striking missiles that does actually have access to within Russia? That was such a sticking point earlier this year, and it feels like there's more consensus on that.
Yeah, there's definitely movement, that's for sure. You know, as you alluded to at the tail end of the Biden administration, Zelensky was really clamoring to be given permission to strike further inside Russia using U.S. weapons. Biden gave him some leeway on that score. He is now pushing the Trump administration to sell him cruise missiles, which would be another incremental but significant expansion of Ukraine's ability to hit inside Russia. And you know, at the same time, the Ukrainians domestically have been developing their own industrial capabilities to produce weapons of that nature. So, and you can see the war now is as much about the strikes behind the Russian front lines in the supply and the energy infrastructure on both sides, as it is about this kind of incremental creeping forwards of the front line on the battlefield.
Can I just talk about another aspect of this conflict, and that is the fact that the French have seized a Russian tanker, part of its shadow fleet, in international waters. Vladimir Putin has called this piracy. What is the response likely to be to this? Is there anything the Russians can do? Is there a response that they can deliver?
There is I think that if you look across the suite of kind of options that the Russians have, and indeed that the Europeans have in what is, effectively like a full spectrum confrontation now. There was a really interesting story from our colleagues who cover the Russian government this week, in which they talked about there's a new Russian law which has come in which makes it easier for them to sell off assets that they have confiscated. And we were hearing from our sources close to the Kremlin that they envisage that as a way to make it more straightforward for them to seize assets of European companies that are still held in Russia and then sell them off So that's one way that Putin could actually exert leverage, as well, of course, as just simply like increasing the attacks on civilians in Ukraine and turning up the heat on Ukraine, which we've been seeing for the last few weeks, really since that summit in Alaska.
Ben Sills, our managing editor for European Economy and Government, walking us through those dynamics. We thank you so much. He was talking there about the French and the impact there. I want to tackle that from a different angle. French Prime Minister Sébastien Lecornu is meeting with lawmakers for crunch talks as he struggles to pass the budget. The talks could determine not only the fate of his government, but also how Europe's second largest economy tackles its mounting deficit. Our Paris Bureau Chief Alan Katz is all over the story and joins the program now. Alan, just walk us through how realistic and how probable Lecornu's chances are of striking a deal.
I really would hesitate to put a number on, his chances. It doesn't look great, I guess, let me put it that way. But that said, in politics, you really never know. I mean, what he's done today is, today he's got these discussions, as you mentioned. He's meeting with the National Rally right now at 10:30 Paris time. He meets with the Socialists, and then he meets with the Greens and the Communists later today. And this is sort of the last chance he has to talk to these people before he tries to actually form a government over the weekend and before Parliament really gets underway next week. It actually started this week, but sort of the main discussion parts for Parliament are next week. And this morning, just before those talks started, he said that he said the government would not use the system that exists in France, which allows you to push through a bill without a vote if you need to. And it's not a concession in and of itself. It's an administrative tool. But by doing so, he does, in theory, empower Parliament to have a lot more control over what is actually in the budget at the end of the day. Whether that's enough to change things, it's really too early to tell. We'll see, I guess, a bit better after these discussions today. But even then, I'm not sure that we'll really know.
Alan, what happens to the budget? We could potentially be heading for a 6% budget deficit. Walk us through what does the next few months look like potentially for this French budget and the possibility of progress?
So, at best, it means that there won't be an immediate, because the threat against Lecornu is that he will immediately be censured, lose a no confidence vote as soon as next week, possibly, and be pushed out of office. So, at best, what will happen is he will not be pushed out of office, and there'll be a big, really noisy and unsteady debate in Parliament over this budget. How you get to some sort of actual majority in both the National Assembly and the Senate on a budget is really difficult to see, actually. And this all has to be done in a pretty tight time frame. As you said, the French's budget needs to be done by December 31st, and so that we're actually already in October, so it's really hard to see how this happens. Now, that said, because you and I were having this discussion earlier today, if there is no budget in France by the end of the year, it doesn't mean that the government shuts down. What it does mean is that France would have to pass what's called a special law to roll over the 2025 budget into 2026. It's what happened last year. And so it's not going to be like the U.S. There won't be a government shutdown, but we are in for, I would say, at best, a very confusing and noisy debate over this budget. And whether it actually leads anywhere is hard to tell.
Great news is we have you to decode it all for us. You're a fantastic team. Thank you very much for doing that. I appreciate the input on that, trying to understand what is happening here. Our Paris Bureau Chief, Alan Katz. The weekend is almost upon us. I know it's only Friday morning, but we don't have non-farm payroll to get through this Friday.
So it's basically the weekend.
So we can focus on other things. I hear there's a new Taylor Swift album. People are talking about it in the newsroom. I have no idea, of course. Paris Fashion Week. There's a lot of sport this weekend, which is good, because I'm going to spend my weekend driving my children around. So you've got the Formula One. I think there's a horse race over in Paris. Chelsea, Liverpool coming up as well. That's my weekend.
Oh, please. The highlight is the new Taylor Swift album, which we both know you're going to listen to.
I'm going to download it. I'm going to listen to it in the car.
You're going to make the references in the morning on Monday morning.
Of course.
That's where this is going.
It won't be a disappointment, I'm sure. Talking of things that won't be a disappointment, Tom McKenzie is going to be speaking with Goldman Sachs CEO David Solomon about the infrastructure impact of AI on banking. That's next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Tehran, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
The all-important U.S. jobs print gets hit by the federal government shutdown. President Trump vows thousands of jobs cut, ramping up pressure on Democrats to end the impasse. The global stock rally extends into a sixth day as optimism over AI lifts equities. Plus, Bloomberg learns Boeing's 777X will not start commercial flights until 2027, in yet another delay for the flagship jet. Now, there's quite a lot going on in the markets, or not. Some people suggesting that it's already the holidays because we don't have the jobs report. Look, it's very clear we're looking at a tech-fueled rally in global stocks. That's continuing as big-ticket artificial intelligence partnerships seem to be stoking yet again fresh optimism. Investors now wagering that billions pouring into the AI sector will translate into profits. S&P futures, you can see, getting some 0.2%. The 10-year at 409. And then I always look at gold because we're seeing almost record on record, 3,863. If you look at the European markets, again, a lot of the focus is on the difference in terms of bond premium between Italy, for example, and France. And then if you look at gold heading for a 7-weekly advance, it's basically a story also about oil on track for its biggest weekly decline since late June, and we're seeing a bit of green for this Friday morning. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in a moment, we'll discuss the markets with Seema Shah, Chief Global Strategist at Principal Asset Management. Before that, we'll, of course, get a status update on the U.S. shutdown with our Stephanie Baker. We'll also talk Boeing and Tesla with our transport reporter, Danny Lee. But first, President Donald Trump is weighing slashing thousands of federal jobs as the White House looks to ratchet up pressure on Democrats to end a government shutdown. So for more on this, we're joined by Stephanie Baker, our senior writer. Stephanie, good morning. So first of all, would layoffs actually be legal, or is this an empty threat?
Well, the layoffs would certainly be unprecedented, and many are arguing that they would be illegal. It would take a while to litigate that, potentially going all the way to the Supreme Court. But the threat is very real, and this shows the real risk of the Democrats blocking the continuing resolution and shutting the government down, that it hands Trump huge leeway to enact his agenda. And remember, Ross Vaught, the OMB, the Office of Management and Budget leader, he worked for Heritage Foundation's Project 2025, so they're going to use this to try to push their agenda as far as they can, not only with layoffs, but potentially cutting funding to Democratic states.
Stephanie, who's blaming who? So is it, are the citizens blaming the Democrats or the Republicans or a bit of both?
I think it's early days, but there was a Washington Post poll that came out yesterday that said the majority of voters blame Trump and the Republicans. Now, that could shift as the shutdown drags out. But for the moment, the Democrats are winning the messaging wars, saying that they are fighting for American citizens' health care. The heart of this debate is the Democrats want to extend these extra subsidies for Obamacare. And without that, they're saying your premiums, your health care costs will double. And so far, they're winning that message. But, it's early days.
Stephanie, thanks so much. Stephanie Baker there with the very latest on the shutdown. Bloomberg has also learned that Boeing, it's a mouthful, especially for a Friday. Bloomberg has learned Boeing's new aircraft is facing a significant delay and is now expected to enter commercial service in 2027 instead of next year. So what's holding up the 777X? It's already 6 years late. And how damaging are the delays for Boeing and its customers? This man will answer everything, of course, on this. Danny, thank you for joining us. Look, what exactly is happening with Boeing? And am I saying it correctly? It's the 777X, not 10, right?
Yeah, 777X.
777X.
It's the newest wide-body jet that Boeing is producing. And I think Kelly Ottberg, the Boeing CEO, kind of alluded last month to certification issues, a mountain of work that Boeing has got to get through in order to then get the ramp-up of production started and then handing over the new jets to customers. And so, therefore, we are going to see this timeline shifting according to our Bloomberg sources. So it's going to be from instead of 2026, it's going to be 2027. Ultimately, even if there's a shift of maybe a couple of months or several months, this could cost Boeing up to $4 billion in extra accounting charges. And this is already a program that has racked up $11 billion of charges. So this is not great news for Kelly Ottberg, who has been brought in to try and get to the bottom of all the range of production, regulatory, financial and operational issues that Boeing has faced. So this is not great considering he's been presiding now over Boeing over the last year and a bit more so.
Danny, when you look at Tesla, this was also the big story yesterday, looking at exactly how Elon Musk is trying to turn the company around. It beat quarterly sales expectations, but the stock was down significantly.
I feel like there is a bit of a divergence between the EV performance, whether Tesla has been delivering record numbers for this particular last quarter. However, it is still against a backdrop of broader weaker sales and a general weaker outlook. And a lot of these sales in that third quarter was brought forward because of the end of this US federal tax credit. And so therefore, when investors look to the end of the year, there's probably not much more in the tank. But then if you're playing the long game, investors are looking towards AI, Optimus, robots and driverless cars. That will really fuel Tesla because it's more than just a car company, as Elon Musk says. This is more about it being this leader in AI and whatnot for the years to come.
Danny, thanks so much. Danny Lee there looking at Tesla and Boeing. Now joining us to talk markets, Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, when you look, thank you for joining us on this Friday, non-jobs day. I mean, how problematic is it actually for traders and markets, but also economists to understand exactly what the economy is looking at?
Hi, thanks for having me on. I think at any time that you're not going to get data, it's going to be a tough time to try and navigate the market dynamics. I think it's probably even worse right now because there's been so much going on. The Federal Reserve, as we know, is already almost struggling with the muddiness of the labour market data, given the various supply dynamics, even trying to consider how AI is coming in and maybe impacting the labour market. So this is unhelpful. It's going to be really important how long this extends for, not in terms of the economic impact, but simply in terms of the data, because we feel like we can get to the October Fed meeting. We think that they are very likely to cut rates even without the near-term data. But of course, as you go beyond that, then they're getting into a very large gap without that kind of data, and then December starts to become, I guess, a more questionable affair.
So, what do you think we're seeing in the U.S. economy, especially when it comes to, this fraught relationship between labor and inflation? Is it true that we shouldn't worry about inflation for the moment?
I think that is to some extent. I mean, when we're looking at the broad economy, we're looking at all the various activity indicators. So aside from the labour market, things look okay. I mean, it's slowing, so we're not we're not seeing an acceleration, but certainly we're not talking about recessionary conditions. And then from a labour market perspective, the labour data, we can clearly see that there's a labour market demand slowdown, and probably more so than what the labour supply dynamics are saying. So there is a slowdown in play. But together, what that means is that the inflation dynamics are probably less, I should say the fundamentals are less important in terms of driving upward pressures. So we do think that right now inflation is almost contained, albeit at that 3% level. But this isn't the end of the fight. And I think from the Fed's perspective, they're going to have to keep a really close eye. We know that from companies' perspectives, they maybe haven't been passing on price increases yet. But of course, as margin pressures become a little bit more impactful, then next year becomes a slightly different story.
Seema, when you look at, for example, how much does it make more sense to go gradually? I don't know how many Fed cuts you're expecting, or why not go big and then see what happens?
Well, I think the thing is that, look, as we said, the data is murky. You now have the shutdown stopping you from getting the labour market, the non-farm payrolls today. But overall, this is a picture where you have, it's a confusing one. You have an economic broad activity picture, which is fairly robust, but you have a labour market slowdown, you have supply dynamics, as I said, you've got the tech. In that kind of situation where you don't really know where you're going, you shouldn't really run head first at the door. You should be maybe treading along. So from our perspective, 3 cuts at least takes you towards neutral. And then it would make sense for the Fed to stop and almost appraise the situation, see if they have any better understanding of what's going on in the labour market. So we would expect to see a couple more rate cuts after into 2026. But in terms of the magnitude, then you also have to consider the politicization of the Fed and what the makeup is going to be once Fed Chair Powell is out.
Seema, when you look at equities, we've had a really good run for a lot of these indices, but is there still more upside to be had? Because again, there's this complicated economy. The Fed is actually going through a difficult time also existentially, but markets are roaring ahead.
They are, and I think what the market is doing is almost looking away from the data to some extent and just saying, well, look, earnings growth at the moment is pretty good. We're not hearing of any really concerning stories from corporates. Corporate spreads are really tight. And then on top of that, we're now getting Fed cuts, which, it's not against a recessionary backdrop. So you're almost giving a little bit more juice to the market. So we do think that there's more gains to be had. They're probably not going to be very significant. And maybe they may be, at least in the near term, a little bit more focused on the tech side because that tech capex trade is, aside from any of the macro conditions, a very macro agnostic. So I think that's what's going to continue to carry the market. And then maybe in later 26, you could see a bit more broadening out into some other sectors as well.
So how do you construct your portfolio?
So at the moment, we're very much risk on. We're still very much risk on US equities. We have been building up a position in small caps. Typically, they will do well in a rate cutting environment, domestic conditions being robust, which pretty much fits the way that we're looking at the broader economy. And we think they could be sustained for a little bit longer as well. But we do think there's pockets outside the US as well. So, we do believe in that long-term tech narrative. So if you believe in that, there are pockets specifically across Asia, which should continue to benefit from that theme. So those are the areas. And then within credit, it's still very much risk on, even verging into the high yield, certainly the EMD side. So there is a lot to be had in this environment, even though valuations are really stretched. You do need to be quite selective.
I mean, are you selective on a regional basis or more like on an industry level?
Well, so I think there's selectivity within the region, but I certainly from our equities team, what they're really focused on is that stock picking, really looking at the bottom up, because at these kind of valuations, it doesn't mean that everything is very expensive. There are going to be opportunities, but you really need to dive pretty deep into the data to try and identify them.
Are there other ways, if you don't have the jobs report and we don't actually know how long the shutdown's for? First, I mean, why is the market not sitting up and listing maybe to how long, or the longer term implications of the shutdown? But also, too, is there other ways of tracking the economy, modeling it in ways because of AI that we hadn't thought about a couple of years ago?
Yeah, well, I mean, so to the first question, historically, you don't really see a very sustained impact on the economy from a shutdown. And if you're not seeing a sustained impact on the economy, you shouldn't see any really fundamental impact on earnings. So overall, from a market perspective, we're almost looking away. But, you're right in saying that the data is really key at this point. There are other ways, and you can see that the market has been really a little bit more focused on the ADP. There were some other private payroll numbers which came out yesterday. They haven't been great indicators in the past of where the employment numbers are going. So, we want to treat that with a pinch of salt. So unfortunately, at the moment, it is almost kind of feeling it out in the blind. on the assumption that this is only going to last for 2 or 3 weeks.
What do you do with dollar right now?
We do think there's a little bit more weakness to go, and I think there's a couple of reasons. One is that, as we've already seen, there's been concerns about the credibility of U.S. institutions. We think the conversations around the Fed is going to continue through 2026, of course, as Powell's term comes up. So that might chip away a little bit further. But the other thing is interest rate differentials. As the Fed is just starting its rate cutting cycle, you're seeing the ECB almost coming to an end. You're seeing the Bank of Japan maybe nearing towards a rate hike. So you are seeing that kind of desynchronization, and that interest rate differential should put a little bit more weakness, at least downward pressure on the dollar. But we're not talking about a spiral. We're not talking about the loss of reserve currency status. This is more of just a continued erosion of that dollar.
Seema, we also had a good conversation with the MPC member, Catherine Mann, and she was talking about actually her worries about inflation, which is sticky, especially in certain parts of the economy. Is it more difficult for the UK right now than other major economies?
Yeah, it is. And I think the difference is that when we're looking at the ECB, when we're looking at the US, these aren't really structural factors. We're almost thinking about the cyclicals. For the UK, they have deeper structural factors, which I think is contributing to that sticky inflation picture. It can't just be resolved by a slight weakening in the labour market. So the Bank of England is unfortunately faced with this very, very difficult dilemma where you do have weakening growth, you have a labour market which is very likely to weaken, you have very sticky inflation with some forecasts showing a continued upward move over the coming months. And then, of course, you have this fiscal issue. So I think that they are very much probably the most difficult position of the major central banks right now.
And so what does that mean for sterling?
We would say that there's still a little bit more weakness to go, depending on how the Bank of England is really going to proceed. We do expect them to cut a little bit more. Even though they've paused for now, we do think they're going to have to cut rates a little bit further. And if you're looking at the broad strength of the UK, it probably doesn't spell great news for sterling.
Seema, thank you so much for joining us. As always, Seema Shah there, Chief Global Strategist at Principal Asset Management. Coming up, the former Chatham House Chief Executive, Robin Niblett, joins us to discuss geopolitics, the U.S. shutdown, and the latest on the EU's response to Russia. That's next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back, everyone. Now, Ukrainian President Volodymyr Zelensky says his country may receive longer-range weapons from the U.S. to counter Russian airstrikes. The comments came after he met with EU leaders in Copenhagen. Ukraine hopes to strengthen its position in any future ceasefire negotiations by conducting longer-range strikes on Russian military targets.
Meeting with President of the United States, yes, we will maybe have something more. I don't know. We'll see.
Flight operations have resumed at Munich Airport after it was shut down temporarily due to several drone sightings. Germany's second-largest airport grounded 17 departing flights last night, affecting around 3,000 passengers, and diverted 15 arrivals to nearby cities. Several airports across Europe have been affected in recent weeks due to unidentified drones. And here in the UK, counter-terrorism police have named a British citizen of Syrian descent as a perpetrator of an attack on a synagogue that killed 2 people. 2 men died and 3 others sustained serious injuries during the assault on the temple in Manchester when worshippers were gathering from Yom Kippur, the holiest day in the Jewish calendar. Police said the attacker drove a vehicle at people outside the synagogue and then attacked them with a knife before being shot dead by officers. Now, for more on all of these stories, we're joined by Robin Niblett, Distinguished Fellow and former Chief Executive at Chatham House. Robin, thank you for joining us. We were just talking about the UK and that horrific act that happened yesterday. Acts in general of terrorism seem to be being more widespread. Is this a very divided society, or should we take a pause, a breath, and actually see exactly what's going on?
Look, I'm not sure if Britain as a whole and the British people are a divided society. I think they're united. The vast majority would absolutely condemn the horrific attack yesterday. But there's no doubt that tensions between the communities, between the Jewish community and obviously the Islamic community as well, have been deepening very sharply in the last 2 years since the terrorist attacks by Hamas on October 7th, 2 years ago. So, it's interesting. You've got a government that is trying to move in both directions simultaneously. There's a potential protest on Saturday in support of defending our juries, spelt Juries, which is in support of trying to overturn the overturn the UK ban on Palestine Action, which has been nominated by the British government as a terrorist organization. Many people don't agree with that. But on the other hand, at the same time, the British government has recognized a Palestinian state, despite really getting much of anything in return for it. So I think on both sides of the debate, those who are most invested in this outcome and most invested in the future are feeling really very unhappy with the government. And the society itself is deeply divided. No doubt there have been doubling of attacks against Jewish people in the United Kingdom over the last year. The BBC has some very clear numbers on this. Rises of Islamophobia on the other side. It's a very, very sad time at the moment. But I think at the moment we have to focus. People should not be murdered just because of their religion. It's just utterly appalling.
Yeah, and Robin, as you say, I mean, the incident is really focusing, the attention on Britain's already strained community relations, its approach to combating terrorism and anti-Semitism. What can the Prime Minister and the government do today?
Well, I think the first thing they have to work out is how can they simultaneously increase the security around synagogues and other places of Jewish worship and Jewish community, while at the same time having to police a large protest in London tomorrow on the other side of the agenda. And actually protests in support of Palestine went ahead in Manchester yesterday evening as well. So the police forces are deeply stretched, and it exposes, I think, the rifts at the heart of British society at the moment. So no, the government is torn. It looks like, this is obviously incredibly early reporting, and I'm not claiming I know this for a fact, but it looks like a relatively, it's one individual, 3 other people have been arrested. It looks like what is described as a kind of self-starter attack. This person was not, apparently, according to news reports, on the prevent watch list. But it just reminds you how deep hate on social media, the kind of language around community relations can then provoke, for some people, this despicable act.
Robin, and this is, of course, something that's being felt in many countries, including the US, including in France, including Germany and others. What does it mean for geopolitical relations?
Look, I don't know. I think in the end, I think this, as I said, is a horrific attack in the United Kingdom. It has its echoes around other parts of Europe. It has its echoes in the United States as well. In the end, I feel it is running in parallel, if I may say so, to the geopolitics of the world. It's ironic that the Middle East is the one part of the world where I'd say both the United States, China, and probably even Russia would like to see progress and don't see it as an area of geopolitical division. So this really is an aspect of domestic politics for the United Kingdom, for the US, for other countries in Europe in particular. And obviously, there's this opportunity potentially out there with the Trump peace plan endorsed by Muslim governments, Arab governments, endorsed by European governments as well, to try to force a ceasefire and actually a plan for the future that is actually quite, you could say, reasonable. It's talking about non-annexation by the Israeli government of Palestinian land. It's talking about no role for Hamas of any sort in future governance of Gaza or of any type of Palestinian entity. Ironically, we have a moment where all of the governments seem to have moved around one particular solution, even the government of Bibi Netanyahu. So I'm hoping that there could be some moment of light in the future. I'm not hugely optimistic, but at least that's a modest step forward.
Robin, talk to me about Ukraine. Has the U.S. effectively given Europe actually more power to deal with Ukraine? And what do you think Russia's playing out with the drones, trying to test the limits of Europe and NATO?
Look, I think it's the reflection of the fact that the United States under the Trump administration is not going to be involved in trying to drive proactively from the front seat a solution to the Russian invasion of Ukraine and the ongoing war there. I think it is interesting, the reports which your clip showed there, Keith Kellogg has noted this as well, that the US government is looking to provide long-range strike capability to the Ukrainian government. That's a big move if this turns out to be true. Tomahawk cruise missiles potentially. This comes at a time when the Ukrainian government, with its own long-range drones, has proved especially successful in the last 2 to 3 weeks in striking not just Russian oil refineries, but also production depots, port terminals. There's been a real drop in domestic access to petrol and refined petroleum products in Russia. There's now a ban on the export of petroleum products. To the end of the year, Russia needs those oil exports to pay for the war. So it's a very interesting moment that to see the US government, in a way, from a distance, trying to help the Ukrainians do what they need to do, and then relying on the Europeans to pay for it. So I think the government of Vladimir Putin knows that the ball is being moved over to the Europeans, and they're trying to increase the pressure. They're saying, if you want to get involved in a long-term war with us, we have ways of making life really difficult for you.
But Robin, do you see actually more economic penalties towards Russia from both the US and the EU?
I'm not sure about the US, because in the end, I think Donald Trump does not believe in sanctions. He's worried the sanctions are reducing the role and the influence of the dollar in the global economy. You can see China trying to build up alternative kind of payment systems and trading arrangements. So in a way, what he's been saying, is, hey, Europe, I'll put sanctions on, like I've done on India, tariffs on India. I'll do tariffs on China for supporting Russia, but you do it too. And the one thing we know is the Europeans are not going to impose tariffs on India, with which they're trying to do a trade deal, or on China, with which they're trying to manage a very complicated relationship of being opposed to Chinese support for Russia on Ukraine, but trying to keep open an economic relationship for exports, for green technology, for renewable energy. So that's not going to happen.
Robin.
The one thing that will happen, if I say very
Robin.
quickly, they are going to sanction them.
Thank you. Robin Niblett there from former Chatham House. This is Blue.
case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs?
How
And
are
you're
the
lowering the
meatballs?
cost of the meatballs.
So I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We're actually running today about 40% of our sales is actually veggie balls and plant balls. And personally, I don't love the veggie balls, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The all-important U.S. jobs print gets hit by the federal government shutdown. President Trump vows thousands of job cuts, ramping up pressure on Democrats to end the impasse. The global stock rally extends into a 6th day as optimism over AI lifts equities. Plus, Bloomberg learns that Boeing's 777X will not start commercial flights until 2027, in yet another delay for the flagship jet. Now, Italy's cabinet has approved a budget with a 3% deficit this year, allowing the premier, Giorgia Meloni's government, to set aside more money for tax cuts and defense. Well, joining us now is our Italy bureau chief, Chiara Albanese. Chiara, as always, thank you. Many guests have told us that France is the new Italy. How much better is it, in a fiscal position is Italy after this budget?
Well, the news of Italy being able to reach 3% of the deficit already this year is great news. It came last night after a late evening cabinet meeting, and it really shows that Italy is on track to achieve the EU rules and meeting them ahead of expected. Well, this is a sign that definitely France and Germany are not in this position to give, and it really is a testament to Giorgia Meloni's ability to reassure investors, to reassure markets, and to deliver cuts in terms of like the deficit and the debt that has been a plague for Italy for several years.
So, Chiara, to what extent do tariffs remain a risk to the Italian economy directly and via the impact on its trading partner, Germany?
Well, there is little to say. Italy has got a mammoth debt load. But what this government has been able to do in this period of higher rates and definitely a positive feedback getting that it got from markets, it has been able to start climbing down this path of reassuring further investors, cutting the deficit level, and also having its spread versus German yields going down and also being narrower than the French one. And this is kind of a vicious circle that has been going around. And definitely, as we were saying, France and its instability have actually gone into a different direction, all kind of helping Italy to attract more capitals and to become a sort of like positive legal safe haven into Southern Europe and Central Europe.
Chiara, thanks so much to the bureau chief there, Chiara Albanese. Now, some news actually just crossing the Bloomberg terminal. Huawei is using advanced components from Asia's largest technology firms in at least some of its leading Ascend AI processors. Now, this is a research firm that discovered this during teardowns, highlighting China's reliance on foreign hardware as it works to boost domestic production of AI semiconductors. So this is according to a Bloomberg story just crossing the terminal. We'll have plenty more when we get it. Now, the French Prime Minister, Sébastien Lecornu, is meeting with lawmakers for crunch talks as he struggles to pass the budget. The talks could determine not only the fate of his government, but also how Europe's second largest economy tackles its mounting deficit. Shortly before those discussions started, Lecornu said his government would exclude use of a constitutional measure that allows it to push through laws. Now, for more, we're joined by Alan Katz, our Paris bureau chief. Alan, thank you for joining us. So how realistic are Lecornu's chances of striking a deal?
That's a really hard bet to make one way or the other. I mean, I guess it's not great. That said, 49.3, this constitutional measure that you just mentioned that France has used to push through a lot of things, budgets mainly, but also the very unpopular increase in the retirement age back in 2023, his announcement that his government would not use that is nevertheless, it's a real step towards some of the opposition parties who've made that sort of one of their rallying calls to not use that kind of measure anymore. What it does is it allows you to push through a law even when you don't have the votes in Parliament. And in theory, it would make parliamentarians much more powerful. Until now, the real power of Parliament has been like either you work with us or we can oust you in a no-confidence motion. This would, in theory, give them a lot more power to actually shape the budget. So we'll have to see with these discussions today if the opposition parties actually, bite on this at all and it progresses a bit, or if they say, actually, you know what, we're not interested, and then it would be much less likely that Lecornu and his government, which is yet to be named, by the way, besides him, would survive, very much longer.
So, Alan, if Lecornu actually fails to secure enough support, what are the immediate risks for France's budget process?
So the immediate risk is that you just don't get a budget. So if this doesn't sort of go anywhere and Lecornu is ousted in the end, whether it's next week or sometime down the road, but then you'll have to sort of start from the beginning on a budget. And the way that the system works in France is that there are certain minimum amounts of time that a budget has to be debated in Parliament. So basically, to have a budget by the end of the year, it has to be submitted to Parliament by October 13th. And if Lecornu forms a government this weekend as expected, and if that government survives, at least initially, then you can start to have that debate. If it doesn't, then that October 13th date will certainly be missed. Now, I want to bear in mind, or want to make clear, since you mentioned the U.S. government shutdown earlier, the French system is a little bit different. So if there is no budget by the end of the year, there probably almost certainly will not be a shutdown. The French can pass something called a special law, which would roll over the 2025 budget into 2026, and that would keep all government services continuing to operate. And so it's not quite the same stakes at play as in the United States, but nevertheless, the goal is at least to have a budget by the end of the year.
Alan, thanks so much. Bloomberg Paris bureau chief Alan Katz. Now, a huge fire has erupted after an explosion at a Chevron oil refinery near Los Angeles, producing towering flames and plumes of smoke, which could be seen for miles. Chevron have accounted for all personnel, confirming there were no injuries at its El Segundo facility. It's not yet clear what caused the blaze. Now, the chairman of BBVA and the chief executive of Sabadell are seeking to sway investors their way during the final days of a takeover battle that has lasted 17 months. Now, the potential deal is an all-cash transaction that offers one BBVA share for just over 4.8 shares of Sabadell, marking a 10% increase from the original offer. Now, Sabadell's board has declined the offer. It's now in the hands of shareholders. I think we can cross over now to Turin, where, of course, our Tom McKenzie is speaking to David Solomon, the interview of the day. Here it is.
Given the geopolitical strains, given now as well the shutdown in the US. David, does the US economy weather the current political standoff in Washington? And does that resilience that we've seen this year continue into 2026?
Well, first, thank you for having me here. Delighted to be here. The U.S. economy is in pretty good shape. And there are some very, very strong tailwinds that have really had a profound effect. And there are also some things going on that are creating headwinds and are probably leading the economy to, underperform its expectation at this time. But I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026. The big structural issue that's kept the U.S. economy going so well is the U.S., and by the way, other developed economies around the world, are running very aggressive fiscal stimulus plays. Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds. Second big macro phenomenon that's affecting the U.S. economy is all of the AI infrastructure build, all the capital spending, all that's going into the ground to support the deployment, the development, the continued growth of AI infrastructure into the enterprise, and that's a big tailwind too. That's balanced on the other side by the implementation of the trade policies, which are still getting absorbed. I think we're seeing, some of the effects from trade, but there's still more to go in terms of really understanding how the trade policy is fully implemented and how it balances growth. And then obviously the world's a little bit more geopolitically fragile, and that has an impact on growth and kind of confidence. But when you balance it all, you saw the third quarter reading was quite strong. But year over year, from last December to this December, the overall growth trajectory will probably be a little bit less than 2%. And so that's slightly below trend, but still in pretty good shape.
And an acceleration into 2026?
I think that as the trade policies are absorbed and you have the continued stimulus and the continued kind of tech spend, you've got a pretty good tailwind. I hear as I talk to CEOs that would kind of have their finger on the pulse. Certainly the upper end of the economy is still spending quite strongly, a little bit more constraint on the downside, on the lower part of the economy. But I think the things you have to watch labor. There's no question labor short is a little bit softer, and the Fed's watching labor carefully. And, I think you've also got to watch inflation and whether or not the impact of trade is just a one-time price movement or there's something, more significant that comes through, and it's too early to know.
And you touched on labor. How would you characterize the health of the U.S. job market right now?
It's a little bit softer. And I think you can step back and you can understand why. When you think about big enterprises and what's going on with technology, people are pausing hiring to really kind of evaluate how, as they bring this technology into the enterprise, they can automate, create efficiencies, reinvest. And so, I think at the moment that's slowed hiring, and as a result, the labor numbers are a little bit softer.
The Federal Reserve cut interest rates for the first time this year in September, last month. The markets are expecting another approximately 4 cuts between now and this time next year, another 1 percentage point of cuts, with inflation remaining above the target for the Fed. Does that seem reasonable to you?
I think it's in the distribution of outcomes. I think we'll have to watch. I know there's a great parlor game of people kind of predicting what the world's going to look like 6 months, 12 months out. If you think about what the world looked like in April and where markets were in April and think about where they are today, I'd just be cautious. I think that I think that we've got competing forces between labor and inflation, and how they balance, which is still a little bit uncertain, will have an impact on whether we get one more cut or we get 2 or 3 more cuts.
Global stocks at record highs. US stocks at record highs. The S&P 500 is up about 15% year to date. Nvidia's market cap is around $4.5 trillion. That's more than the entire market caps of France, UK, Germany, Italy combined. Does the market rally? Does this bull market, are you comfortable with this bull market given some of the concerns you flagged?
Am I comfortable? Yeah, I sleep very well. I'm not, I'm not going to bed every night worried about what will happen next. But markets run in cycles, and whenever we've historically had a significant acceleration in a new technology that creates a lot of capital formation and therefore lots of interesting new companies around it, you generally see the market run ahead of the potential because they're going to be winners and losers. They're going to be winners and losers. If you go back and you think about the internet, pick on Amazon. Amazon was one of many companies that was prosecuting that kind of opportunity. Many of the companies went away. Amazon became an incredible company. You're going to see a similar phenomenon here. I wouldn't be surprised if in the next 12 to 24 months we see a drawdown with respect to equity markets, but that shouldn't be surprising given the run we've had. But generally speaking, I think what's super exciting is the technology is expanding, new companies are being formed, and the potential of this technology deployed into the enterprise can be very, very powerful. And so it's an exciting time in the market. The market looks forward.
What does that mean for deal making? You've seen a pickup in deal making. What is the scale of the pickup that you expect to see, and what are you seeing in Europe?
The pickup in deal making broadly is meaningful, but it's particularly accelerated in the U.S. And what's driving the pickup in deal making is a changed regulatory environment. So if you were thinking strategically and you wanted to really expand your scale or your competitive position in almost any industry, for the last 4 years in the United States, the answer was no from a regulatory perspective. It really wasn't what's the question, what could the answer be? The answer was no. And I think CEOs at this point imagine they're in an environment where you actually can get strategic transactions done to expand your competitive position. And so we obviously inside Goldman Sachs, we have an early look at that activity in those dialogues. And I would say it's accelerated very significantly. If you just look at the facts in terms of what's public, we've obviously had a very significant M&A quarter. We had a $1 trillion M&A volume quarter this past quarter. And if you look at large cap M&A, meaning M&A for companies that are $10 billion or larger, it's up 100% year over year. So there is real momentum in the deal-making environment. I think you're going to see an acceleration of that into 26 for sure. And increasingly, CEOs are testing what the bounds are of their ability to enhance their competitive position or improve their scale and their lead, where they have a leading position in a variety of industries. Okay. And I think the regulatory environment's going to permit that at the moment. Okay, so it sounds like you're going to be very busy, you and the team, on deal making in 2026. What are your priorities, David, for Goldman and the franchise next year? Well, we don't really think about it, next year. Our priorities always start with the way we face and serve our clients. But in 2019, 2020, we laid a strategic plan out for the firm, and we've been executing against it for the last 6 or 7 years. And as you highlighted earlier in the discussion, we've created a lot of value because we've grown the firm. At the end of the day, as a public company, we have to grow. We might be a big, mature public company, but we have to grow. We have to grow. We have to grow our earnings. And to do that, you have to have a cogent plan where you're investing in different parts of the business. We have 2 big principal businesses, our investment banking and trading business, where I think there's little debate about our leadership position. It's an extraordinary business, very big business. We've been investing and adding more resources to that business over the last 5-6 years. We've increased our market shares very meaningfully in that business. Our market shares are up about 350 basis points over the last 5 years in that business. And then separately, we have the 5th or 6th, 7th, depending on how you look at it, largest active asset manager in the world. We manage about $3.4 trillion through our asset and wealth management platform. That business is growing high single digits is what we've put out publicly. It's actually been growing faster than that. And we continue to invest in a variety of aspects of that business where we see real growth. We can grow our wealth business, which is an ultra high net worth wealth business. We can continue to grow our alternatives platforms, private capital formation. And we have a very flexible solutions business where really for big institutional capital allocators, we have an ability to really create and customize what they need from an investment perspective. There's been a lot of discussion here at Italian Tech Week about how to get globally significant generational businesses, tech businesses, built out of Europe, $100 billion plus. What is your prescription for that? I mean, my prescription for that is savings in Europe and capital in Europe needs to come into the risk economy in Europe. You just don't have the scale and scope of the available savings here getting deployed into the tech risk ecosystem at the pace that it should when you compare and you look to the way things are deployed in the United States. And in fact, one of the things that happens here is capital from here looks over there. And so there are enormously smart, talented people here, lots of great ideas, capital formation, and a real focus on risk-taking. Stuff's going to go right, stuff's going to go wrong, but you got to take risk, you've got to deploy capital. This really has to become a bigger center of capital deployment. And also, the more we can get the European Union to be operating as an economic union and taking advantage of the 400+ million people that are here, as opposed to the individual states, for lack of a better term, the more we can get the tech economy working that way, I think the better chance we have of reaching your goal, which I think would be a very noble goal for the world. So I mean, the more innovation over here, the better for the world. Yeah. So Ursula von der Leyen will be here. So your one message to the European Commission President would be centralizing or capital markets? Well, certainly. Are you seeing the urgency? you know, I'm feeling more urgency when I'm over here, but still, you know, the regulatory process in Europe is slow. Capital Markets Union for sure, you know, more encouragement of risk-taking in capital markets, trying to bring it all together, consolidation in the banking system instead of national champions in every market, consolidation in the exchange system instead of champions in every market. You know, those are all things that will make capital formation easier, risk capital formation better, and will allow the acceleration of great companies here in these markets.
You have lent into tech and into AI. Your team were telling me you have 12,000 engineers across Goldman Sachs. You have an AI, the Goldman Sachs AI assistant. You have an AI developer. What parts of the business, and you've talked about some of them, whether it's wealth or asset management or trading or the consumer, what parts of the business at Goldman are going to be most transformed by AI?
Well, I think, you know, the business of work is getting transformed by AI broadly. And, you know, we are, at our heart, we're a professional services firm. If you think about Goldman Sachs and the value it brings to its clients, its value is deployed really among three different things: people, capital, technology. And so if you think about AI, you know, AI really allows smart, talented, driven, sophisticated people to be more productive, to touch more people, to have better information at their disposal, better analysis. I mean, this is a journey we've been on. You know, this technology accelerates it, but when I started 42 years ago and I wanted to look at 5 different companies and think about how to compare the trading in 5 different companies, I had to go to the library, I had to go to the microfiche, I had to spend hours really thinking about how to put that comparison together. Obviously today, you can do it in a fraction of a second speaking into your phone. So this journey in providing tools to super productive people and giving them more capacity to serve their clients and to be more productive is obvious, and we've been working on all those tools as most enterprises have. I think the more interesting thing for enterprises broadly, and this isn't unique to Goldman Sachs, because the world is underpinned by technology. Coding is time-consuming, but this technology allows you to code with greater productivity and efficiency. So one great coder now, with a tool such as Cognition Labs Devon, for example, you know, really creates massive coding capacity for one coder, as opposed to, you know, having 10, 20 people sit around for a few days. So big productivity there. And then, of course, when you think about operational systems in any business, the ability to accelerate automation and therefore drive more productivity, it's not just a cost exercise. It's actually about taking that productivity and having more capacity to reinvest in growth in your business. You know, we'll spend, you know, $6 billion on technology this year. I would have liked to spend $8, but I can't afford it because I've got to deliver returns.
Yeah.
But with this technology, my ability to spend more and invest more in growth and accelerate things that can grow our enterprise, it's more available to us.
5, 10 years' time, fewer jobs in banking as a result of AI?
I don't think that's the right lens. I think there are places where the number of jobs, the actual jobs, will come down. But the lens I look at it is, you know, I think we can continue to grow Goldman Sachs. I think we can continue to serve a wider slice of clients with these tools and these capabilities being integrated into the firm, changing our processes. The question, you know, the way I would answer the question, if the firm was the same size and it didn't grow, we would certainly be operating with fewer people. But if the firm grows and you expand and you can invest in other areas for growth, we'll wind up with more jobs 10 years from now than we have today. Just as, by the way, we have in every step along the journey for the last 40 years, as technology has made us more productive. I don't think it's different this time.
So to be clear, you foresee more headcount in 5, 10 years' time?
That's because I think we're going to be running a much bigger enterprise.
Okay.
Yeah.
Do you worry about there's been some hand-wringing in terms of the investment? We've seen the hyperscalers, $350 billion in terms of capex and data centers and infrastructure, and the concern that the return on investment isn't being matched. That's not matching the revenue on the other side. Does that concern you, that mismatch?
Well, sure. It concerns anybody that's deploying capital, but I think the journey is pretty clear, even though, you know, we're at the beginning of the movie, not the end of the movie. I guarantee you at the end of the movie, there'll be a bunch of winners and there'll be a bunch of losers. There'll be a bunch of capital that was deployed that ultimately delivered very attractive returns, and there'll be a lot of capital that was deployed that did not deliver returns. And you can go back in any super tech cycle or any big investment cycle, and that is the pattern you'll see. It's not different this time. We just don't know how that will play out. But it's very exciting to see these technologies get deployed. and the impact it's going to have, it allows productive people and productive businesses to be even more productive. And so people get very caught in this question of more or less. And, you know, I prefer a lens that says there are obviously things where we're going to have a lot fewer people, but I'd love to have the capacity to go get more people to spend time with clients. I'd love to have the capacity to invest in new businesses where I think we can affect clients, and we need people to do those things. So it's a give and take, and nobody stands still.
To be clear, you're not worried about an AI bubble?
You know, an AI bubble. I think that there will be a lot of capital that's deployed that will turn out to not deliver returns. And when that happens, okay, people won't feel good. Okay, if you know, I'm not going to use the word bubble because I don't know what the path will be, but I do know people are out on the risk curve because they're excited. And when they're excited, they tend to think about the good things that can go right, and they diminish the things you should be skeptical about that can go wrong. We're in one of those environments where people are out on the risk curve, and there'll be a reset. There'll be a check at some point. There'll be a drawdown. The extent of that will depend on how long this goes. By the way, if we were having this conversation in 1988, you would have been asking the same. 1998, you would have been asking the same question. Yet the environment went on for another 3 years until there was then a significant check in 2001 and 2002. So I'm not smart enough to know. I think it's going to go on for a while. I think the opportunities are great. I think they're very exciting. But I also see complacency around risk-taking. And when that happens, ultimately, there'll be some speed bumps or some drawdowns.
David Solomon, Chairman and CEO of Goldman Sachs. Thank you so much.
Thank you.
Fantastic.
Appreciate it.
Thank you, David.
Thank you. Appreciate it.
What a wonderful conversation. Also with, I have to say, a spinning set, not something that you see every day. Tom McKenzie there speaking with the Goldman Sachs Chief Executive David Solomon at Time Tech Week. They talked about the Fed, they talked about tech, and some of course, the things that we should be watching out for. It's Friday, but we don't have jobs today. This is because of the U.S. government shutdown. Still great to look at the markets as always. A lot of the focus is, of course, on tech and the tech rally that we saw over the last couple of days. Now, the stocks rally seems to be hand in hand with what's going on with AI. This tech-fueled rally in global stocks continued as big-ticket artificial intelligence partnerships seem to be stoking more and more fresh optimism. It's also very clear that if you look at the directional pull of markets, investors wagering that billions pouring into the AI sector will translate into profits and extend gains in tech shares. I'm looking at the S&P futures are gaining some 0.2%. If you look at a gauge for Asian technology stocks, for example, they definitely led their charge with a new record as Hitachi teaming up with OpenAI on energy and related infrastructure, while Fujitsu, for example, expanded its collaboration with NVIDIA. Euro dollar 117.44, and then gold. I love looking at gold because it's usually very symptomatic of what exactly is going on. 3,864. Remember, it's headed for a 7th weekly advance. Oil also on track for its biggest weekly decline since late June. Let's also look at what's happening in Europe and quickly maybe U.S. futures. Europe is really following the direction of what happened in Asia and probably then what's happening in the U.S. later today. And then if you look at what we heard from the Treasury Secretary, Scott Bessent, he predicted a pretty big breakthrough in the next round of trade talks with China. So that's also something that we really need to keep an eye on. S&P futures, NASDAQ, the big ones to watch out for, getting some 0.3%. Up next, it's a Bloomberg Brief with Vonnie Quinn. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
to understand what are the technologies that are part of our portfolio for the future and scaling those technologies so that we can meet our demand with clean energy.
Resiliency is just not an operational response to what is happening out there. Resiliency could and will be a strategic advantage that companies will start to look at.
There is still hope to actually get back down to something of a livable world if we get our act together.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Tech euphoria, stock futures extending the rally after indices notched fresh records. Gold set for its 7th weekly gain. The AI spending boom alive and well. Global Infrastructure Partners is said to be nearing a $40 billion deal to buy aligned data centers. And a data vacuum. No monthly payrolls report today as a U.S. government shutdown enters day 3. As Commerce Bank officially puts it, the data have gone missing. But it doesn't seem to matter. We do get S&P PMIs later on, and we're also going to get more private data. But this market doesn't even seem to need the data as long as it has partnerships. Fujitsu and Hitachi, the latest to make partnerships with OpenAI and NVIDIA. We're up 1.5% on the Nasdaq 100 already just this week, and it looks like futures are going to power us even higher. The S&P is up 1% week to date, and futures there also higher. Same with the Russell 2000. Let's take a look at yields. We're down about a basis point across the board. The 2-year yield now at 3.55, the 10-year below 4.10. We'll see what happens throughout the day as those data roll in, 9:45 and 10 a.m. Eastern for those data. And also what this tech continued rally does to this market. Again, we mentioned gold having 7 weeks of inflows. Not at its record, but close to it. And then, of course, there are cryptocurrencies to think about. We've had that rally in Bitcoin, 17.1% it's averaged of a rally the last 7 years. So if October is anything to go by, we might see even more gains there. Well, let's get to some individual stocks to watch now for the session. Over to London, I'm Chloe Melly. Chloe.
Good morning, Bonnie. Let's start with Applied Materials, which is weaker this morning after the semiconductor equipment maker said that it expects a $600 million hit to revenue from new U.S. export restrictions. So this comes right after the Trump administration dramatically expanded sanctions to capture more subsidiaries of blacklisted companies. And that will have an impact on revenue and earnings for Applied Materials, and that is driving the stock lower this morning. Moving over to Tesla, which is actually rebounding in pre-market trading after shares fell yesterday. The automaker said that it expects, there were record sales this quarter, but investors were worried that this would be difficult to be replicating going forward, but this is still rebounding. And then finally, Rumble AI, there's an AI partnership from Rumble. Rumble is an online video platform. There's a new partnership with Perplexity, and that is driving the stock higher this morning. A lot of investor enthusiasm around this new deal.
Chloe Melly in London there for us. Thank you so much. And later in the hour, we're going to be catching up with Veronica Clark, U.S. economist at Citi. AI optimism then continuing to push stocks higher as a deal spree rolls on. Shares in Hitachi, for example, surging in Japanese trading earlier. That's after the company announced a tie-up with OpenAI. That collaboration driving broader tech higher in Asia, Fujitsu as well. Let's go to Bloomberg tech reporter Newly Purnell in Hong Kong for more detail. Newly, what do we know about this collaboration? What are they collaborating on, for example?
Yeah, OpenAI, of course, much in the news following our great scoop on their new $500 billion valuation. Hitachi, brand name, tech name in Japan. They're going to be collaborating, we understand, on energy, tie-up related to energy and power grid operations, cooling equipment, storage, and Hitachi's digital services hub. So we see, again, OpenAI, so much interest in its huge valuation, seen to be a key player in this new world of AI. And it seems to be any corporation that seems to touch with these partnerships, investors seem to be liking what they're seeing.
Yes, it's these legacy companies that we haven't really been speaking about in the US for a very long time. Fujitsu, another one, NVIDIA announcing that they'll be expanding their so-called strategic partnership. What are the details there?
That's right. Well, Fujitsu, they're talking about collaborating on full stack AI infrastructure, and they're talking about agentic AI. So this is the idea, agentic AI, that instead of simply an LLM where you input text and it spits results back at you, there may be these new systems that you ask agents to go out as if you would ask an assistant to go out and actually do things online or in the real world. So here, another new wave we're talking about in the world of AI, these actual agents, and that would be the tie-up with Fujitsu.
Newly, thank you so much. Powering this market ahead, that is Newly Parnell there. The U.S. into its third day of a government shutdown, the Trump administration continuing to signal mass federal layoffs are coming, with Press Secretary Carolyn Leavitt describing that the number of workers fired will be in the thousands.
It's likely going to be in the thousands. It's a very good question, and that's something that the Office of Management and Budget and the entire team at the White House here, again, is unfortunately having to work on today. These discussions and these conversations, these meetings would not be happening if the Democrats had voted to keep the government open.
For more, let's bring in Bloomberg's Kasia Klimaszinska, who leads our breaking news coverage in Washington. Kasia, we're still waiting on details on these proposed layoffs. What are we seeing around this shutdown and who it's affecting so far?
Unfortunately, we are expecting this announcement at a time now. Caroline Leavitt, the White House press secretary, is having a press briefing today, so we might find out exactly how many people will lose their jobs. As she said yesterday, it will be in the thousands, and President Trump was supposed to have a meeting yesterday with his OMB director to go agency by agency and decide who can be dismissed, perhaps permanently, even as there are some legal experts who say it actually shouldn't be that way. You shouldn't use any money during shutdowns to organize any permanent layoffs. But it could happen, especially given that there are really no talks between the two sides, between Republicans and Democrats. Senate is back today, and there will be votes, but I think there will be the votes on the same bills that have already failed, so the partisan bills. And so most likely we'll see no progress, and then lawmakers will break up again for the weekend and come back next week.
Kasia, the Wall Street Journal also reporting that the government is exploring a $10 billion bailout for farmers. What do we know about this?
Even as the government is shut down, the tariffs are being collected. The White House said specifically that the tariff collection operations will continue. So this money is flowing. And President Trump said earlier this week that he plans to use some of this funding to compensate farmers, especially soybean farmers who lost their key customer, China. China is the biggest buyer of soybeans around the world and hasn't bought any from the U.S. This year. So especially those soybean farmers need some funding to buy equipment. Equipment is getting even ever more expensive. President Trump will also talk to his Chinese counterpart, President Xi, later this month. So maybe there will be a purchase agreement there, and this, let's say, bailout will not be needed. But it could also come as early as next week, the announcement of some additional help, additional funding for the U.S. farmers.
Kasia, thank you so much for all the context. That is Bloomberg's Kasia Klimaszinska, who leads our breaking news coverage out of Washington, D.C. Well, Boeing's shares are a little volatile this morning. The move coming after Bloomberg has learned Boeing's new 777X aircraft is facing a significant delay and is now expected to enter commercial service in 2027 instead of next year. For more, I'm joined by Bloomberg aviation and transport reporter Danny Lee. Danny, this plane, it's literally already 6 years late, and now we're adding at least another year on top of that. What's going on?
Yeah, Bonnie, good morning. So we are likely to see more delays based on certification delays that Boeing CEO Kelly Ottberg had flagged just last month. And according to Bloomberg sources, this means that these delays that Boeing have not specifically outlined will mean that a shifting timeline from 2026 into 2027. And it's a blow to airlines who've been waiting since 2020 for this Boeing's new long-range, long-haul aircraft. So it's frustrating, and all this means is for Boeing, this could add up to yet more charges it has to take account for this delay, potentially up to $4 billion, according to analysts. And this is an aircraft that has already racked up charges of $11 billion. So this is not a great situation for Boeing or Kelly Ottberg to be in, given that it's facing potentially yet another delay to its new marquee jet.
Yeah, $11 billion in cost overruns already, and that's not including, as you said, the potential $4 billion more. How does this happen? How can Airbus do it if Boeing can't, for example?
Well, I think for any new commercial jet, these are always going to be really tricky investments that, plane makers don't take lightly. And so, given we have seen, particularly high scrutiny, more high standards, and make sure that these new jets come out of the box fighting fit. This is obviously going to be it's a challenge that someone like Boeing, I'm sure Airbus in the future as well, will all have to contend with when it comes to producing these new top-of-the-range jets. And so I think just this latest delay was something that is not a surprise, I'm sure, for most airlines, and they'll have to mitigate that for keeping their older planes for longer.
Yeah, I mean, we're talking Lufthansa, Emirates, and so many more. Is there a possibility that they'll get frustrated and cancel orders? Can they even do that?
I think for the airlines, they've pretty much accepted the fact that they will have to wait just a little bit longer, perhaps, maybe several months more. We know some airlines have pushed out some of their deliveries. We don't see necessarily airlines looking to cancel, given there's so much they've poured financially into this. So I think it's just a wait and see, and potentially for Boeing to confirm maybe by their third quarter earnings just how big of a delay and what kind of charges it takes.
I mean, it's so funny, coming literally almost the same week that Boeing announces a new single-aisle airplane to succeed the 737 MAX, or at least according to the Wall Street Journal. Danny, thank you so much. That is Danny Lee, aviation reporter for us there. Now, to other top stories trending on the terminal this morning. BlackRock's Global Infrastructure Partners is said to be in advanced talks to acquire Aligned data centers. Aligned could be valued at about $40 billion. The deal would be one of the biggest for the year. A spokesperson for BlackRock declined to comment. Funds under UBS are facing more than $500 million of exposure to bankrupt auto parts supplier First Brands. UBS Hedge Fund Solutions is the largest unsecured creditor with a $233.7 million claim, while O'Connor has a similar claim for $116.1 million. A Syrian-born British citizen was named by police as the man who killed 2 and injured 3 at a Manchester synagogue. Police say the attacker drove a vehicle at people outside the synagogue and then attacked them with a knife. UK Prime Minister Keir Starmer warned against rising hatred and anti-Semitism. Coming up, Goldman Sachs will spend $6 billion on tech this year. That and more from our interview with CEO David Solomon. That's next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Goldman Sachs CEO David Solomon is forecasting an acceleration in the U.S. economy into 2026, thanks to tailwinds like tech and stimulus. He spoke to Bloomberg's Tom McKenzie at Italian Tech Week in Turin earlier. Take a listen.
The U.S. economy is in pretty good shape, and there are some very, very strong tailwinds that have really had a profound effect, and there are also some things going on that are creating headwinds and are probably leading the economy to underperform its expectation at this time, but I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026. The big structural issue that's kept the U.S. economy going so well is the U.S., and by the way, other developed economies around the world, are running very aggressive fiscal stimulus plays. Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds. Second big macro phenomenon that's affecting the U.S. economy is all of the AI infrastructure build, all the capital spending, all that's going into the ground to support the deployment, the development, the continued growth of AI infrastructure into the enterprise, and that's a big tailwind too. That's balanced on the other side by the implementation of the trade policies, which are still getting absorbed. I think we're seeing, some of the effects from trade, but there's still more to go in terms of really understanding how the trade policy is fully implemented and how it balances growth. And then obviously the world's a little bit more geopolitically fragile, and that has an impact on growth and kind of confidence. But when you balance it all, and you saw the third quarter reading was quite strong, but year over year, from last December to this December, the overall growth trajectory will probably be a little bit less than 2%. And so that's slightly below trend, but still in pretty good shape.
And an acceleration into 2026?
I think that as the trade policies are absorbed and you have the continued stimulus and the continued kind of tech spend, you've got a pretty good tailwind. I hear as I talk to CEOs that would kind of have their finger on the pulse. Certainly the upper end of the economy is still spending quite strongly, a little bit more constraint on the downside, on the lower part of the economy. But I think the things you have to watch labor. There's no question labor short is a little bit softer, and the Fed's watching labor carefully. And, I think you've also got to watch inflation and whether or not the impact of trade is just a one-time price movement or there's something, more significant that comes through, and it's too early to know.
That was Goldman Sachs CEO and Chairman David Solomon speaking with Bloomberg's Tom McKenzie at Italian Tech Week. Coming up, a fire erupts at a Chevron refinery. Also a look at what else is making headlines in your front page news. That's next. This is Bloomberg.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets. It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. BBVA is in the final days of its $20 billion takeover attempt of rival Sabadell, having set 50% of shares as a minimum level to declare the takeover successful. Bloomberg's Kriti Gupta spoke exclusively to Sabadell's CEO about whether there's the possibility of that threshold being lowered.
I think there's a high probability that they will, but of course that it's only for them to say. But their persistence, sometimes beyond what was expected in terms of continuing with this deal, tends to show that it might take them to make the decision even if they are in the low 30s, if that would happen in terms of acceptance. And the 50 is unattainable for a very simple reason. 40% to begin with. This is the major argument. There are others. More than 40% are retail. If you wanted to know the acceptance level up to today, it's below 1%. And those don't do it the last day. They do it in a gradual manner, and they have been doing it into a gradual manner over the course of the days, and they remain still below 1%. The 80% of which we have knowledge, which are at the same time our customers, and at the same time our shareholders with more than 15 years of average tenure of our shares. And those are not going to tender. And then, of course, we all know the composition, and we are sharing it with the market, and the market has come to the conviction that reaching the 50% is impossible. Furthermore, they said that they would never go below 50, and now they have opened lately that possibility, and they acknowledge that reaching the 50 is very difficult just by their own actions. They have lowered the threshold to 30.
They have said that that is a possibility. They haven't actually made that change just yet. At the moment, the threshold is still 50. But to your point, they do have the legal ability to do so. Let's explore the hypothetical scenario that were they to move that threshold lower to 30%, include that second takeover offer, is there a price in mind of what that second takeover offer would be?
There's a huge discussion. What there is certainty is that there is uncertainty of what that price would be. What the chairman of the CNMV, which has the ultimate word, has said is that it will be equal or superior to the first offer. Therefore, waiting has a tremendous incentive, even for those who wanted to tender, because they would have not only a potentially higher price, but furthermore, they would have what in financial terms we call a put, which is the ability to tender in the course of 3 or 4 months at a fixed price. So if the price goes down, they will all tender if the second option occurred, and if the price of Sabadell shares went up, no one would tender. So that means that they would even end up at the low end of the 30s and then have to move through in order to get a potentially higher shareholding, which adds even more risk, or that they might have to put on the table up to 12 billion in cash. That's a ton of money.
Is that a figure coming from the CNMV?
No, the figure of the 12 billion comes from the difference between the amount, the maximum amount that they could come, that they would need.
Increase.
Because if the share price of Sabadell and the market in general, if there was a slight downturn, everybody would have the option to tender at a fixed price. And that would require up to 12 billion of cash disbursement from BBVA. That's a ton of money. Carlos has said that it is impossible that they would require a capital increase. On the contrary, they have reserves on which they can detract the future dividends for their shareholders, but it's not enough. So on top of reducing the dividends, they will have to do a share issue to cover the rest.
Have you spoken to the CNMV about that possibility?
About the possibility of how to set the price, yes. About the other possibility, no, because it is not in their domain. That is more a risk that the ECB would have to consider.
When you talk to the CNMV, about setting the price, have they given an indication of whether it would be at the current level or above?
It is very complex, and they acknowledge themselves, and they haven't decided yet. And they haven't decided yet because the law is very clear. It has to be at the date of the transmission of the shares. That is not the 10th of October, which is the last day of the tender, because then the shares would not have been transmitted. That, in principle, should be the settlement date, which is expected to be around the 21st of October. That is what the direct interpretation of the law would say. And the CNMV is still analyzing what is the best alternative for the market.
That was our exclusive interview with the Sabadell CEO. Let's take a look at how we're shaping up this morning. S&P futures pointed higher even after the index rose more than 1% this week. A little weight to the US dollar index and yields down about a basis point across the curve. The 10-year there at 409. No data today beyond the private data out of S&P and ISM. I do want to mention that oil is slightly higher even as the market expects OPEC Plus to return more idled capacity to the market at its decision this weekend. Coming up, Veronica Clark of Citi.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Tech euphoria, stock futures extending the rally after indices notched fresh records. Gold set for its 7th weekly gain. The AI spending boom is alive and well. Global Infrastructure Partners is said to be nearing a $40 billion deal to buy aligned data centers. And a data vacuum. No monthly payrolls report today as the U.S. government shutdown enters day 3. Gone missing, as Commerce Bank says. This morning, that's the official data it's referring to. Doesn't matter to this market. Look at that. Futures pointing to gains once again this Friday, even after an already 1% gain for the S&P this week and 1.5% gain for the Nasdaq this week. This all on partnerships and tech enthusiasm. Fresh records once again. More partnerships overnight. NVIDIA pairing with Fujitsu, OpenAI with Hitachi. We do have yields ever so slightly lower, down about a basis point across the board. Perhaps the bond market is eyeing this shutdown a little more closely. I do want to point out oil as well, slightly higher today, even as the market expects OPEC to return more idle capacity. Macquarie is predicting punishing oversupply, but let's face it, oil is pretty much in the doldrums already. We also have a potential deal with China. Scott Bessent has been predicting a big breakthrough in the next round of China talks. So there's a lot to watch for. Let's get to some individual stocks that we should be watching now. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. Let's start with Applied Materials, which was weaker in pre-market trading today after the company said that it expects a $600 million hit to revenue due to U.S. export restrictions. So these sanctions, these restrictions will have an impact on the revenue and the earnings for this semiconductor equipment maker and is driving the shares lower this morning. Moving on to Tesla, which is actually rebounding this morning after the shares fell yesterday. So yesterday, Tesla reported really good quarterly sales, but investors were worried that this would be difficult to be replicated now that EV subsidies are expiring. But there's now a reversal in that sentiment this morning for the market, and therefore Tesla is up this morning in pre-market trading. And finally, Rumble, the online video platform, has struck a partnership with Perplexity that will see it integrate its AI, the Perplexity's AI-powered tools into the platform. And this is a deal that that investors seem to be really happy about. And Rumble is up 13% in pre-market trading on the back of this new partnership with Perplexity this morning.
It's all about partnership these days, it seems, Chloe. Thank you so much. That's Chloe Melly there in London. Citi's Veronica Clark weighing in on the impact of this data vacuum, saying it will cause the Fed to hew to its median dot. She suggests 25 basis point cuts in October and December based on this, and writes, quote, the economic drag should be limited, but would become more significant if the shutdown lasts more than 2 weeks, or if a large number of federal workers are permanently laid off. I'm pleased to say Veronica joins us now. She's U.S. economist at Citi. What is your best estimate as to what any layoffs will do to the unemployment rate, Veronica?
Yeah, I mean, we're still waiting, of course, on clarity on how many workers might actually permanently lose their jobs from the shutdown. Of course, that's really abnormal. We usually don't see that in shutdowns. If it's in the order of something like a couple tens of thousands, it's probably not a huge impact on the unemployment rate, but in an economy and a labor market that is already slowing and people are already struggling to find work, anything is going to add to that increase in the unemployment rate.
So the best estimate at the moment for furloughed workers, at least 750,000. What's that going to do to GDP per week, assuming that they will get back pay?
Yeah. So usually you don't see a big economic drag from shutdowns, especially maybe early in the quarter when you still have time time to make it up during the quarter. But as people start to miss paychecks, which they haven't yet, they will in a couple weeks, that does mean you're at risk of spending cutting back, even if they're being back paid. Certainly if some people are maybe not being back paid, if we get some of those more permanent layoffs, this will weigh on activity over time, maybe something in the order of a tenth or so for Q4.
Veronica, if the Fed doesn't know how quickly the labor market is becoming more fragile or deteriorating, should it overcompensate? Is there, an argument for getting ahead of anything that could hit them in the eyes in the future?
Yeah, I think that's a fair argument. I think the way that the Fed is looking at this right now is, of course, there's a lot of conflicting signals. There's a lot of dispersion among Fed officials themselves about what should we focus on, inflation risks or employment risks. But if we don't have any data, which it's always frustrating when we don't have data on the economy, but maybe especially now, I think you act based on what you last knew. And what they last knew at the September meeting, the median officials still did want to cut more this year. We had seen, much weaker job growth. We were less worried about the inflation risk. So I think that keeps them acting on that path, and that's a cut in October.
Still, they're data dependent, and you can't be data dependent on 2-month-old data. Will they look to the private sector data that we're getting and make some decisions based on that? Have they had to do that in the past?
Yeah, I'm sure they'll rely more on some of this private sector data. It is also probably the case that if this shutdown really does last so long that we're not getting any of that data before October, a month-long shutdown in itself is going to be a drag on activity. But yeah, we'll be watching the private sector data. Of course, the surveys, ISM we'll get this morning. ADP employment, maybe the Fed would put a bit more weight on that maybe than I would. But certainly we saw weaker job growth in ADP this week. I think all of that would suggest that, yeah, they're cutting in October.
And meantime, we're getting more announcements on more tariffs coming online all the time. And if this shutdown continues to last, we won't get that CPI data in less than 2 weeks. And that will be really damaging, right?
Yeah. So we won't know that September data. And in terms of CPI, I'm actually even a bit more worried about the October data that we were supposed to get in November. The September data, the quality of it necessarily shouldn't be impacted by the shutdown. But we do get into issues of if BLS workers are not working in October, you can't go out into the field and collect that October CPI data. So we do run into maybe some data quality issues there. We just have to live with what we will eventually have. And so far, the story has been one that you're seeing maybe some slight tariff pass-through, but it's not been nearly as much as people were expecting a couple months ago.
Is there any argument at all for the Fed to do nothing, given that it doesn't have any data to back up what it's doing to the economy by, cutting 25, cutting 50, or,
Yeah, I mean, certainly some officials, there is this group of officials who maybe don't want to cut any more this year, want to go, proceed a lot more, cautiously, are worried about the inflation side of things. Maybe they'll be looking more towards, some of the price surveys, which we actually did see. ISM prices earlier this week were actually a bit softer. But I think, as markets are pricing essentially a full 25 basis point cut, I think that's the right move.
What do you do if you're at Treasury? I mean, there's so many products that are priced off of CPI, right? I'm thinking of the tips market in particular. What happens to all of those products?
Yeah, I mean, I think we will still have some data collection going on. We will still have numbers to be able to calculate. CPI does use maybe some third-party data in certain categories. But yeah, this is a frustrating scenario and one that we really haven't had to deal with before. The last time we had a full government shutdown in 2013, it was really just a couple weeks, and we were still able to collect some more CPI data. So if this does last a whole month, this might be somewhat uncharted territory.
Now, we have big auctions planned for next week, but is there a possibility that going forward, depending on how long this lasts and how many people are fired, that those auction sizes won't even need to be as large?
So I would think that essential functions are going to continue as is. It would be surprising to change anything. So yeah, all of that should stay pretty much unchanged. But it's not really like the government is necessarily saving a whole lot of money in this shutdown, especially because the expectation is that you do back pay workers. Obviously waiting to see though if some of those workers could be more permanently laid off, but that would be a very small dent in what would need to be borrowed.
David Solomon just told us at Italian Tech Week that he sees the U.S. economy accelerating into 2026 thanks to fiscal stimulus and also just tech and this tech enthusiasm overall. Do you see anything putting a prick in that in the next couple of months?
Yeah, Yeah, I think I would be a little bit less optimistic. We certainly have that strong AI investment tech story. We've seen that for a lot of this year. That can continue, but I would be worried about the rest of the economy, of course, particularly consumption and the labor market. Consumption is still 70% of GDP growth, and we have seen a softening labor market. And I don't think I buy the argument so much that this was just a temporary slowdown over the summer because of uncertainty. This is a weakening labor market that we've seen for 2 years. This has been hiring that has been slowly falling for 2 years, and that really has not changed. And I think it's a reflection of rates being restrictive, and over time that weighs on growth. And at some point you are worried about the next step in that weakening labor demand is larger layoffs. We don't necessarily expect that or see that right now, but that risk is still there.
All right, Veronica, thank you so much for joining us this morning, even without the NFP to look forward to. That is Veronica Clark of Citi. Now to other top stories trending on the terminal this morning. A Syrian-born British citizen was named by police as the man who killed 2 and injured 3 at a Manchester synagogue. Police say the attacker drove a vehicle at people outside the synagogue and then attacked them with a knife. UK Prime Minister Keir Starmer warned against rising hatred and anti-Semitism. Funds under UBS are facing more than $500 million of exposure to bankrupt auto parts supplier First Brands. UBS Hedge Fund Solutions is the largest unsecured creditor with a nearly $234 million claim. And a fresh setback for Boeing. Sources say the plane maker's 777X is slated to fly commercially for the first time in early 2027 now, instead of next year. The delay could result in billions of dollars in accounting charges. Analysts estimate those charges could run from $2.5 billion to as much as $4 billion. Coming up, shutdown day 3. President Trump turns up the pressure on Democrats by threatening to fire federal workers. Details next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it. Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's likely going to be in the thousands. It's a very good question, and that's something that the Office of Management and Budget and the entire team at the White House here, again, is unfortunately having to work on today. These discussions and these conversations, these meetings would not be happening if the Democrats had voted to keep the government open.
That was White House Press Secretary Carolyn Levitt speaking to reporters yesterday. It's now day 3 of the U.S. government shutdown. Let's go to Bloomberg's Kasia Kimishinska, who leads our breaking news coverage in Washington. Kasia, she mentioned thousands. We're still waiting on details. What else are we seeing regarding this process?
Hello, Caroline Levitt is briefing today, and she might give more details about exactly who will lose their jobs in this shutdown. We already know that according to the CBO estimates, 750,000 people are furloughed at a daily cost of about $400 million in lost compensation. Of course, some of those people maybe will be paid back, but as President Trump is implying, some of those layoffs may be permanent, especially at the agencies where he says their mission is not aligned with the values of the current administration. As we know, the economic data, for example, is delayed, so we will not see the jobs numbers today. Senate is back, but there are really no negotiations between the two parties, between Republicans and Democrats. Democrats insist that they want the subsidies for Affordable Care Act insurance extended, while Republicans say they want first the government to be funded, and then they can sit down and negotiate about the health care costs. What we did get yesterday was the recent poll that showed, at least according to the Washington Post, that more people blame Republicans and the Trump administration for this shutdown than they do Democrats.
All right, we'll wait for more details throughout the day, as I'm sure all of D.C. and federal contractors countrywide will be doing as well. I wanted to ask you about this deal, this bailout for farmers potentially. Kasia, the Wall Street Journal reporting the government is exploring it. What details do we know?
Treasury Secretary Scott Bessent said that this deal might be announced as early as next week, perhaps on Tuesday, and then Wall Street Journal, as you mentioned, has the reporting that it could be anything between $10 billion and $14 billion for farmers, especially for soybean farmers who used to be selling to China. China is the biggest buyer of soybeans worldwide, but lately has been looking to purchase more from Latin America, from Brazil or Argentina, for example. So the American farmers are at a loss here, and President Trump says that some of the tariff revenue that keeps flowing can be sent to farmers to compensate them for those lost sales.
Kasia, I want to go back to something that might be related to the shutdown as well and the negotiations that are not happening. Health leaders are sounding the alarm on affordable care. Can you tell us more?
So that's really what's at stake here. Democrats insist that they need to see the Affordable Care Act subsidies extended. Otherwise, the health insurance premiums will go up for a lot of Americans across the U.S. And when they see those higher premiums, they will decide that the health care is not affordable. The health care insurance is not affordable for them altogether, and they will walk away losing health insurance for next year. So Democrats insist that this is the urgent issue, that it needs to be looked at and it needs to be dealt with before they agree to extend the funding for federal government.
All right, Kasia, thank you so much for covering all this. Kasia Kimishinska leads our breaking news coverage in D.C. Now to a Bloomberg scoop. BlackRock's Global Infrastructure Partners is said to be nearing a $40 billion deal to acquire aligned data centers. This could be one of the year's biggest deals as AI spending rolls on. For more, Bloomberg's Manuel Maigori joins us now. Manuel, a $40 billion deal. What is Align, and how much does it actually have?
Definitely, it's a big deal, right? And
Companies that provide infrastructure, critical digital infrastructure these days for the rollout of AI, that probably were little known until right after now. A $40 billion transaction coming up in the coming days based on our reporting. And GIP, the platform owned now by BlackRock, is on an acquisition spree. They are deploying capital. They have a very good track record in infrastructure investments, and obviously there is a lot of interest from global investors in anything that has to do with digital infrastructure. Data centers, particularly hot, not only in the US, but also here in Asia. We've seen a number of transactions where infrastructure-focused funds and some strategic players are really going all out and trying to build up, trying to gain scale. I mean, these businesses typically need a lot of investment, and this definitely one of the hottest areas for deal making these days.
And it's interesting, it does have competitors. I'm just looking now, Equinix, NTT, Global Data Centers, and I'm sure, hundreds more potentially. Will there be a bidding war for some others? And what about the likes of NVIDIA? Would it not want to perhaps buy some of these instead of doing the partnerships that it's doing?
Definitely, it's a very good point. I mean, we're seeing a lot of consolidation in the industry. It's been ongoing for a while. I would say the last 2-3 years, perhaps even more. It's been just skyrocketing. It's become really hot. There is some concerns about valuations too, whether some investors are starting to overpay for some of these assets because it's such a hot space, right? But at the same time, we continue to see more. It's a matter of scale. So there's probably more to come in this space, especially when infrastructure funds with lots of dry powder ready to deploy as well. But obviously, I think valuation will come to the center of the question and the debate going forward as well.
Manuel, thank you so much. That is Manuel Baigorri there. Now, to another Bloomberg scoop. TSMC's U.S. shares getting a boost as Bloomberg learns that Huawei used advanced components from the chip maker in at least some of its AI processors. Let's bring in Bloomberg's Peter Elstrom, executive editor for Global Tech, for more. So, Peter, what are the consequences of this reveal? Give us some details.
Yeah, so Huawei is the Chinese tech giant that has jumped to the forefront of the country's efforts to be able to build its own AI chips. There, of course, has been this longstanding debate between Washington and Beijing about whether NVIDIA, the leader in this space, will be able to sell its chips into China. There have been restrictions first on the U.S. side, and now Beijing is pushing back on that front. So Huawei is really the great hope for China to be able to get domestic supply. What we found out through this teardown of a Huawei processor is that, in fact, they're using components from a few companies that they're not supposed to have access to right now. That includes TSMC chips that they're using within their own processors. They're also getting access to HBM memory from a couple of Korean companies, Samsung and SK Hynix in particular. The big questions around this teardown is, how is Huawei still getting access to these devices? It's possible that they purchased them before they were blacklisted by the U.S. government, before they were supposed to be cut off. But at least at this point, it looks like they're still getting access to these chips. TSMC has talked a little bit about this in the past, that somehow an intermediary was able to buy some of its components and then ship them to Huawei afterwards. They've talked with the U.S. government about that, and they've since cut off that intermediary. But what we found is they're still putting chips on the market that have these components within them.
Yeah, and it sort of might change our thinking on how China is faring AI-wise, right? Does this mean that maybe China isn't as advanced as we had thought after DeepMind?
That's a very good question. Yeah, after DeepSeek's emergence this year, certainly there are concerns about their progress in AI in particular, and Huawei has been able to back that up with supplying some of these components. I guess the question you're getting to, which is very, very important, is that if they're still dependent on TSMC and Korean manufacturers that are no longer shipping new components to Huawei can't get access to them, will they at some point run out, or will they be able to turn to domestic suppliers for some of these additional components? We don't know the answer to that question so far, but at least at this this point, they're still getting access to the HBM in particular. It's worth saying that HBM is the memory that you pair with the AI accelerators to be able to process all this data. That's very, very important. They have an older generation, HBM2E, and now they've moved on. The market has moved on to HBM3, HBM3E, and soon HBM4. So they're a little bit behind on that front, but they are still getting access to these chips.
It's a fascinating development, Peter. Thank you so much. A great scoop. Peter Elstrom there for us. Coming up, no Labour Department jobs report, but we have other data to watch. We'll get you set up for your trading day next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Now a look at what's ahead today. No non-farm payrolls, of course, this morning, but we do get S&P PMI data at 9:45 Eastern, ISM services data at 10 a.m. Eastern time. And a slew of Fed speak throughout the day, starting with the New York Fed's John Williams speaking in a few minutes, Lori Logan and Philip Jefferson also speaking. Plus, don't miss our interview with Fed Governor Stephen Myron. That's at 9:30 Eastern. Let's take a look at some pre-market movers. TSMC moving on a Bloomberg report that Huawei has been using components from the Taiwanese chipmaker for its AI chips. Applied Material lower on warnings that expansions of restrictions on exports to China will take another chunk out of its revenue. And Tesla bouncing back. Its sales records yesterday started off pleasing the market, but it ended the session down 5%. That's it for Bloomberg Brief. This is Bloomberg.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
This is an unfamiliar political situation in just so many respects.
It's very difficult to look at the data without having the data.
The less data that come out, the less of a reason the Fed would have to deviate from the dot plot.
Earnings season is going to take on even more importance if we have a lack of government data.
Companies are going to operate through fog.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into payrolls Friday without the payrolls. Division in Washington leading to a delay in the monthly jobs report as the government shutdown enters day 3 with little sign of ending. Investors are looking through the noise, sending equities back to record highs. The S&P on a 5-day winning streak.
And the jobs report today is MIA. So basically, we need to wait until the government reopens. And Jonathan, right now, what's happening in Washington, D.C., even though they're going to put the clean resolution back on the Senate floor this morning for a 4th time at some point today, it's not going to pass. So lawmakers go home for the weekend, and we do this all again on Monday, which means we are going to get a delayed jobs report. And what is starting to get people a little bit more nervous is not so much this report, but if this goes on for another week or two, what does that mean for the October print we're supposed to get in November?
We've seen this movie before. We just haven't watched this movie for quite a while. You've got to go back to 2013, 16-day delay. Ultimately, a 2-week delay to the jobs report, 16-day shutdown. This feels different, though. It feels like the Federal Reserve is at some kind of inflection point, trying to decide whether this slowdown in the jobs market is the real deal. And that Federal Reserve decision is only a little more than 3 weeks away.
Yep, the Federal Reserve decision at the end of the month, October 28th and 29th, and then we're supposed to get CPI on October 15th, and obviously we would have had jobs today. So there's potential that the Fed is going into the next meeting blind when it comes to the official government data, and they're going to have to work off things like ADP and what other people would call second-tier data. But we already know at this moment they have a bias, as you've said a lot of times, given what Jay Powell has said and what they did at the last month's meeting, they have a bias to this weakening labor market.
The senator from Massachusetts has things to say. Had things to say to CNN, saying this: let's be clear, the jobs data scheduled to come out this Friday has undoubtedly been collected and the president must release it. Do we know that for a fact?
That he must release it? We don't know that for a fact because BLS already told us what their plans are, which is they will cease all economic data given the shutdown. The president, though, could essentially deem some people at BLS essential, and they can go in, put the internet on, as Henrietta Trey says, and push the button and release the jobs report. That's not happening right now. I do have an ask into the White House to know whether or not the standard operating procedure of Thursday evening, the NEC director would get the jobs report and brief the president on it. Did that happen or not? That is going to be a question, because a lot of people are going to start really paying attention to Trump's truths today if they think that that happened.
There's a different kind of feel to the first Friday of this month. Equity futures on the S&P up by 0.3. Following a 5-day winning streak, it could become day 6. Chris Verone of Strategas joins us in just a moment with stocks at all-time highs. Dan Ives of Wedbush on the room to run for the AI rally, and Sarah House of Wells Fargo on gauging the economy without a payrolls print. We begin this hour with stocks on their longest winning streak since July. Chris Verone of Strategas, a Baird company, staying bullish, writing the fourth quarter is one of the few examples in our work without any significant autocorrelation. It just tends to be good from about mid-October forward. Chris joins us now for more. Chris, good morning.
Good morning.
Any reason it's different this time?
I don't think so. Of course, kind of we'll evaluate as the facts come in here, but one of the unique things about 4Q is what preceded it almost has no bearing on what happens. Whether the first 9 months of the year were weak or whether they were strong, 4Q, just as we write here, tends to be pretty good. What I think is more important, though, is we enter this period with, you know, trends generally pretty good. About 65% of the S&P is above the 200-day moving average. That's pretty good under the surface. Leadership has generally been pro-cyclical. So, you know, as we've worked our way through summer and through September, I don't see much of a change to the leadership fabric of the market that would get us particularly worried about what's in front of us here into the final few months of the year.
There was a great phrase in your recent research: attitude follows price. Attitude follows price. What did you mean by that?
You know, one of the undefeated rules of Wall Street is what you think is merely a function of what has happened, right? Flows follow performance, not the other way around. And what we were really talking about is how the tone on China has begun to change here. Not because there's been any grand change to the macro, but because the stock prices have gone up. We've been very bullish China for 2 years. We thought ultimately this would happen, where the prices would ultimately force investors to capitulate to the tape, right? The market goes up long enough. I think the Hang Seng's up 90% over the last 2 years. There comes a point where you can no longer use the, quote, uninvestable moniker that became so popular. So we think it's part of this sentiment process where attitudes are ultimately shaped by the price action.
What tone on China are you talking about? How investors feel about it, or the policy discussions?
I think how investors, for the, you know, how many years now, the term was uninvestable. I think anytime you hear that phrase, your antenna should go up and start doing some work. And that was our approach 2 years ago there. We began to see all the momentum signals that we generally see at the start of a big turn. And, you know, here we are today. Chinese financials act pretty well. Chinese discretionary acts very well. I think, interestingly, Chinese materials have started to turn up here. We've seen copper break out. We've seen some of the Euro basic resources turn. And, you know, don't discount the fact that Nike turning up here, LVMH turning up here. I think all those are part of this positive China tone.
So you think China is actually changing within?
I think the market wants to go up, as it has. I'll leave the longer fundamental call up to someone.
Well, if LVMH is doing well, maybe consumers are going out and spending more.
I think the tone on China was so negative for so many years that even incremental improvement is being reflected in European luxury names, in U.S. apparel, in global basic resource stocks. I think we're still relatively early in that shift. And, you know, watch this copper here. London copper through 10,000 is a really big breakout.
This raises questions about where leadership's going to come from. Yeah. If you're looking for a cyclical upturn abroad, do you want to play it through various proxies? Or do you just want to stay at home and play the AI theme in America? Lots of questions about leadership this year. The leadership has come from abroad. You've seen the outperformance there, but the bulk of it came in the first quarter. Mike Pyle of BlackRock talked about this recently, and he said that since the middle of April, you've seen US leadership basically get back in a driving seat led by AI, which is kind of odd that that was a few days after April 2nd. How are you thinking about leadership and where it comes from now?
Well, let's make a couple observations here. You know, the main European indices peaked in March. And then they consolidated all spring, all summer, and then this week they broke out again, right? So this 5-6 month pause resolved higher. You saw new highs in Euro stocks. CAC is right there. DAX is doing it as well on the back of Rheinmetall and Siemens Energy and all those big, you know, defense or energy names. When you look globally, Kospi strong, Japan strong, China strong. So I don't really have a lot of sympathy for the idea that this is 10 stocks in the U.S. leading this whole thing. This has been very, very well participated. when you look around the world. When you take the domestic picture here, yes, the leadership has come from a select group of AI or AI-adjacent type names, but the equal weight S&P is also at new highs here. Russell 2000 made a new high a week ago. So again, I don't have a lot of sympathy for all the breath bears out there. This has been broader than I think people have given it credit for.
When you say Kospi in Korea, I think of international trade. Yeah. When I'm looking at the move in copper, gold as well, I'm not thinking disinflation, quite the opposite. That's where there's some tension at the moment. Got a Federal Reserve very preoccupied with a downturn in the cycle and downside risk to employment. And when you look through the market and what it's telling you right now, it's offering a very different picture about the future. How do we resolve that tension in the months to come?
Well, I think it's funny that we're all alarmed that the Fed is blind without the payroll data. They're not particularly good when they have the data, so I'm not convinced it's that big of a deal. I've been of the view that the Fed is likely cutting into a reacceleration here. I think that's been the message of the market. I think that's been the message of the cyclicals. I do think, John, there's probably some level on yields down where I would have to question that, right? If we're sitting here and 10-year yields are sub 375 or some number, I think they bottomed about 384 on April, 4th, 5th, 6th. Anything under that, you begin to wonder, is the market actually sending a different message about the trajectory of growth here? But I generally think we're okay. When I look at the messages globally, it seems more consistent with growth repicking up than deteriorating from here.
So even though we know the bias is to cut, you don't think they actually should?
No, I want to be clear on one thing. It's funny, we always joke in our work, what is the value of the Fed or Fed speakers when you have the 2-year yield? And the 2-year yield at 350 today would say we need 3 cuts to get back to neutral. I don't think bringing Fed funds from 4.25 to 350 is some big overt easing. I think it's a recognition that the policy rate and the market rate are pretty divorced here, and we ought to get those back in line before we do have a problem down the line.
So you're on Governor Myron's team?
I think the 0% neutral rate is a bit aggressive. I think when you look at where the market is set, somewhere between 3 to 3.5, I think is an appropriate, quote, neutral rate.
That sounds like Team Besson, that you believe the inversion at the very front end of the curve does offer a signal. And that should drive the Fed.
Yeah, and our whole approach this year, we've kind of revised Marty's Wags, don't fight the Fed to don't fight the Treasury. And I think the market's been pretty clear in listening to that message as well.
Your point in the jobs market is a point well taken, even when we have the payrolls report. Yeah. Look how much has been revised over the last 12 months. Look how much that's caught this Federal Reserve offside. Just in the last 2-3 months, Chairman Powell has had to flip from one story to another.
It almost feels like the payrolls report was already canceled in the figurative form by the president, and now it's literally being canceled because of the government shutdown, and that is why the market is looking through it. But there will become a problem if this shutdown prolongs, and then you have an issue with data collection going forward, and it's going to put the BLS behind by a number of weeks.
Chris, one final point, please. Let's wrap it all up. Conviction trade right now. What do you really, really like? What are you super comfortable with that you're still maybe getting a bit of pushback from clients, which maybe makes you more confident about where this is going?
Yeah, I'm really leaning into copper here. I think something has changed in base metals over the last number of weeks. I know you could point to the Freeport mine closure in Indonesia, but a lot of this improvement predates that. So something's happening there. I think it demands our attention.
Chris, it's got our attention. After speaking to you. Thank you, sir. Appreciate it. Thank you. Chris Verone there of Strategas. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. Well, we're in the 3rd day of a government shutdown. The Senate is expected to hold another vote today on a stopgap spending bill to reopen the government into mid-November. Democrats are holding firm on demands to extend healthcare subsidies. President Trump is threatening to slash jobs at what he calls Democrat agencies that don't align with his agenda. Applied Materials trading lower in the pre-market. The largest U.S. maker of machinery used to manufacture semiconductors says an expansion of rules that restrict the export of its products to China will take another chunk out of its revenue. The company expects it will have $600 million in lost revenue in fiscal 2026, which runs through next October. A large fire has broken out at a Chevron refinery in Los Angeles County. Firefighters responded after multiple reports of an explosion at the El Segundo operation south of the Los Angeles airport. According to the company's website, the refinery, built in 1911, supplies 20% of all motor vehicle fuels and 40% of the jet fuel consumed in Southern California. That is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. An unimpressed AMH. Where's the Yankee trap?
Yeah.
Where's the story? Where's the sports update?
Team. I walked in today with all my Yankees gear, and I said, make sure it's in every brief. I think, you know, we have some haters in the control room. That's what this comes down to.
I didn't know
Yeah,
that.
we do.
Okay, who do they support?
Actually, a lot. They know who they support. Okay. Why do you think Lisa's off today?
Oh, right. This is like a day of rest after what happened with the baseball.
Yeah.
Wasn't aware of that. Haters in the control room. Brutal. Up next on the program, a data delay.
Probably this report is not coming out. The less data that come out, the less of a reason the Fed would have to deviate from the dot plot.
We'll get into that in just a moment. Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It is Payrolls Friday without the payrolls. If you want the estimates anyway, the median in our survey was 53K. The range was pretty wide. This is a guessing game. The low was -20, the high was 109. The 3-month average, huge step down from the start of the year when we were looking at 200K. The 3-month average now around 29,000. The equity market doesn't really care. It's higher by 0.3% on the S&P, following a 5-day winning streak, the longest since late July. Can we make it day 6? On the Nasdaq, higher by 0.3%. The S&P, the Nasdaq, the Russell, all up on the week. 2-year bond yields down on the week. Check out this in the bond market. 2-year at the moment, trading at around 355. Yields higher on the session by around a basis point on 10s, up by not even a basis point, around 4.1%. The data so far this week has not been great. Weaker than expected data across the board. The ADP, the worst since 23. ISM manufacturing soft. The quits rate, I think the lows of the year. Consumer confidence, 5-month low. It's not been a great picture, even without the payrolls report. That picture's not been fantastic.
The picture hasn't been fantastic, which is why the market is basically saying the Fed already knew that the data was coming in weaker than expected, especially off of the numerous labor reports we had over the summer, which is why they're looking through this and saying, does the Fed actually need the jobs data in order to continue on this cutting cycle by the end of the month? And then you brought up a great point, Jonathan. Before the data was literally canceled today because of the government shutdown, it was figuratively canceled by this administration that cast a ton of doubt on it. And then the market has been talking about the fact that they do want crisper, more accurate data, and they want a revised BLS to take this on hand to try to get more up-to-speed data, and then you don't see all these revisions.
It's the main focus for us this morning, under surveillance this morning, a data delay.
probably this report is not coming out, and it's certainly why we think the BLS said that all data collection will cease. The less data that come out, the less of a reason the Fed would have to deviate from the dot plot, meaning the more likely it is that they will cut exactly 25 basis points in October. Hard to really say that they won't go ahead and carry out what they had signaled in mid-September under that situation.
So here's the latest this morning. The release of key economic data in jeopardy as the US government shutdown drags into its third day. Bloomberg's Mike McKee tracking the story closely. He joins us now. Good morning, Mike.
Good morning, John. I think the market is telling us that if we could only have payrolls Friday, if we could only have one of those things, we'd rather have Friday than payrolls. But it looks like we're going to have to wait a while to get payrolls anyway. And the big question as we go forward now is, are we going to get the CPI on October 15th? Because that's going to be key to the Fed. We have seen some evidence of strength in the economy in terms of retail sales and overall spending. And if the inflation rate is not going down, or if it should tick up, then it makes it harder for the Fed to at least do anything in December. They might, as Emery was saying, go ahead and cut in October because the Fed said they would. But at this point, we don't know where we are, flying blind in a cloud, as was said. So we're relying on alternate data. The alternate data don't look as bad, except for ADP, as people think. The Revilio people who have this new report out say we got 60,000 jobs during the month. The Chicago Fed estimates unemployment at 4.3%. The Atlanta Fed wages at 4.1% year over year. So that would be considered we don't really need to think about cutting rates report if that's what we got. We just have to wait and see if we can get it. And the other big thing that we have to watch for is if this is not settled by 3 weeks into the month, then the unemployment report and the CPI report for October are threatened because they won't be able to collect the data.
There are consequences. Mike McKee, thank you, sir. Stay close. Mike McKee's going to be a key feature of this program this morning, walking you through where to look and get additional data to get a read on what's happening in this economy. Ed Mills of Raymond James joins us now for more. Ed, we're in day 3, probably going to go into day 4, 5, 6. I just wonder how long do you think this is going to go on for?
Yeah, John, I think most people here in D.C. put the over-under about 2 weeks in, kind of miss a first paycheck and pressure builds. The outer bound, people are willing to say, is once we get towards the end of the month when rent and mortgages and kind of all the bills are due. But the traditional playbook is not kind of assigned to this shutdown. So really the kind of honest answer is no one knows exactly how long this is going to last. There is an off-ramp to kind of reopen this government. It is a CR to open the government, but is negotiations enough, or do Democrats actually need a deal to reopen this government on the ACA subsidies and other health care programs? That's the big question for me.
Ed, this might be a bit granular, but do you think the BLS gave the NEC the jobs report last night as they normally do, standard operating procedure, and that the president actually knows what the report is?
Yeah, Amory, I got a lot of questions about that at Raymond James, because one of the conspiracy theories out there was, if this jobs data was not very good, why release it? And if it was actually good, would President Trump say, hey, maybe we should kind of get this out? You do have to remember that there are a lot of federal employees that were set to lose their jobs on October 1st, regardless of the government shutdown, those who took out the early out, the Musk out. And so to the extent that this might be a weaker jobs report than what they'd like to show, certainly convenient not to have this released this Jobs Friday.
Well, we'll be paying close attention to any truths he has today regarding the non-report we're not expecting anymore. The White House yesterday...
Yeah, we've gotten that in the past.
Yeah, the White House yesterday, the president was talking about how he had this meeting with Russ Vought. What's come of it? Are they going to make these layoffs permanent?
I think they're going to attempt to do that, Amory. I think that this is kind of the playbook that I've seen from President Trump time and time again. President Trump doesn't spend a lot of time on the defensive. He always wants to go on the offensive. He wants to kind of increase the heat, increase the pressure, increase the cost on congressional Democrats for them not providing the votes to pass that clean CR. I do think that actually might extend out the overall government shutdown, because I think once you start permanently attempting to fire people, Democrats put that on their kind of #1 list in terms of what it takes to turn this government back on. This is certainly something that the administration has wanted to do. So far, the unions are standing with Democrats and saying this is just kind of an inevitable step. And so if we can pull this forward and maybe get a protection in a restarting of this government, they're open to that. But yeah, they're absolutely moving forward with these firings, and they're going to see how far the courts allow them to go.
Where are the firings going to come from?
Well, at first, it seems like from independent agencies, but I think it is going to be the agencies that Project 2025 identified. They are saying that if you do not have a explicit appropriation, then that is going to be the reason why the president has discretion not to keep that. So looking at kind of Department of Energy, looking at Department of Education, disfavored agencies out there are probably going to see the proportionate number. And then this fight about independent agencies, what is their constitutional role? Because they're in this kind of quasi executive branch, non-executive branch role. They certainly sought to exert more power over there by firing a number of heads of executive agencies that were appointed by President Biden, approved by the Senate, but were not the preferred pick anymore of President Trump. So that push of executive power is going to be once again tested.
Just 3 days in, who at the moment do you see the public blaming for the shutdown?
Yeah, so Anne-Marie, all of the polls show so far Republicans getting a disproportionate amount of the blame. One thing that we're looking at is a lot of the polling says, do you blame Democrats or President Trump and congressional Republicans? Is it the kind of fact that they add President Trump to this that is skewing this? But it is really important, I'm glad you asked about polling, because it is probably polling that will determine who kind of blinks first. Back in 2018, there were polls out that showed 90% of the American people were blaming Republicans. That turned the government back on. If Democrats continue to get an advantage in polling, they are going to continue to push. If that switches around, that's where the pressure builds. That's where they think that they might have to capitulate. And they will also be looking at these November elections, gubernatorial, statewide elections in New Jersey, Virginia, elsewhere, as a kind of warning sign. If they are getting blamed, those are kind of gubernatorial seats they absolutely want to keep and pick up. If they feel as if that's at risk, I think that also potentially changes the calculus.
Ed, as you know well, we all know, unlike us, people have lives. I wonder how many people are actually even aware the government's shut down. When do they start to realize that? When does it get real for the country?
Yeah, so we have seen it get real for the country when TSA agents who are kind of government employees stop showing up to work or kind of call in sick because they're not getting paid. If airport lines kind of get longer, people get frustrated, but that's still just a segment of the population. I think that they will see stories about military personnel not getting their paycheck. They put their lives on the line for the country. If they're not able to pay their rent, if they're not able to pay their mortgage, if they're not able to kind of put food on the table, those type of stories kind of break through. But the reality is in a partial government shutdown, essential employees still go to work. And so the essential services of the U.S. government continue to work. So for the vast majority of Americans, a government shutdown is just a headline coming out of D.C.
Ed, thank you, sir. Appreciate the perspective. Ed Mills there of Raymond James. You talked about the significance of the airports. Also, just the idea of standing behind something that means that military personnel aren't being paid. That should make everyone uncomfortable in Washington.
Yeah, and the next pay date for them is October 15th. And certainly they're going to hear from their constituents and military personnel, people that say, no, wrap this up. These people need to get paid.
If you are just joining us, welcome to the program. Equity futures this morning, positive by 0.3. Coming up, we'll catch up with Dan Ives of Wedbush as Tesla posts record quarterly sales.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Five-day winning run on the S&P 500, up every single day this week and some. The longest winning run going back to late July. We had some weight to the rally this morning, up by 0.25% on the S&P. On the Nasdaq 100, higher by 0.3. On the week so far, we're positive on the S&P, the Nasdaq, and the Russell too. In the bond market, two-year bond yields lower on the week by around 10 basis points, up this morning by a single basis point. We're back up to, let's call it 355. The data we have seen so far this week has been weaker than expected, particularly from ADP, and ISM manufacturing wasn't tremendous. Later on this morning, we will get some data. Won't be payrolls in 2 hours' time. We're not expecting that, but we are expecting ISM services. That's a key data point going into the weekend. Going into the weekend, let's sit on this. Switch up the board. Gold. Gold is up for the 7th consecutive week, the longest run since February. It's higher again this morning by 0.2%. All these estimates, 4K sounded mental 12 months ago. We're very close to 4K already.
Yeah, and the next estimate, of course, is going to be 5K. I think giving gold a little bit of extra oomph this week is, of course, the government shutdown. But what we've seen from gold consistently more than 40% this year is the fact that risk on, buy gold. Risk off, buy gold. It is this perfect hedge in this environment. And there's a lot of geopolitical factors as well that are shaping into why gold is perfect right now for this environment, because central banks are buying it.
This morning, we're buying gold, 38.63, very close to 38.64. 3 hours away from the opening bout. Some single names for you, some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. This morning, we are not buying Applied Materials. Shares are down this morning after filing from the company yesterday. It makes equipment that makes chips and says that the U.S. Commerce Department has expanded their restrictions of what can be sold to China. They said the hit for them for fiscal 2026, which runs through next October, would be $600 million. So shares down 2.5%. Elsewhere, Rumble, this is an online video sharing platform, signed a deal with the AI company Perplexity. They say that this is going to help basically serve better videos to its users and at the same time help content creators reach exactly the audience that they wanted. So you sign an AI pact or you just talk about AI in this environment, and there you go. Shares are up 14%. Also looking at a rebound in Tesla shares this morning. They fell 5% yesterday. We haven't quite made that up, but they fell 5% after record orders, record new vehicle sales for them. But it was a sugar rush. At least that was the consensus, that there had been that expiring $7,500 tax credit for EVs, so consumers rushed in to buy before that. So shares fell, but they're up about 1 1/3% this morning, John.
Danny, thank you. More from Danny in the next hour. We'll catch up with Dan out of Wedbush as well in a few minutes' time. Let's get you up to speed on some of our top stories. On our radar this morning, the crucial September payrolls report expected to be delayed by the ongoing government shutdown. Gridlock on Capitol Hill threatening collection of data for future reports, including CPI and PPI, due later this month. Elsewhere, the president, Donald Trump, weighing on aid package for U.S. farmers of up to $14 billion. The Wall Street Journal reporting the money is expected to come from tariff revenue as Trump plans to urge Chinese leader Xi Jinping to increase purchases of U.S. soybeans. And finally, research firm Tech Insights finding Huawei's advanced Ascend AI chips are still relying on foreign tech, despite China's push for domestic production. Components from giants like TSMC and Samsung were found in multiple samples of Huawei's chips.
I think there's 2 points to take from this. One is that China is still reliant on U.S. technology, foreign firms' technology. They are not doing this all homegrown as they want to do. Second point, Huawei has been on the entity list since Trump's first administration. So some of this tech that should it be getting to Huawei is potentially getting to Huawei. And I think this is going to be a big concern for Washington, especially as they're in the middle of these trade negotiations with China, and maybe it's another chip they can play.
So positions, leveraging. This is how we're positioning going into these talks. You've got the Chinese ultimately dependent on foreign tech. Got that. You've got US farmers dependent on Chinese purchases. They're not getting that right now. Is that going to be the deal in a month's time? What kind of deal is that? Chips for soybeans?
Yeah, that's going to potentially unnerve some of the Chinese hawks in the administration. But right now, this is going to be politically uncomfortable for this administration. And by the way, the Wall Street Journal is talking about $14 billion for a bailout. It was $23 billion that was spent for the farmers in Trump 1.0. And they've been talking about this for months because they knew this was going to bite. They're going to have to do something for the farmers because these are red states, these are supporters, and right now, China is not buying cargoes. Potentially, we will get some purchasing at the end of the month when the president sits down with Xi Jinping. But the key question, as you're asking, is what for? What is the bar? Where is the bar going to be? Is it going to be for high advanced technology chips?
Yeah, there's a lot of crossover in all these stories at the moment. Tracking Argentina as well. I believe there's a meeting today taking place. Argentina's filling in the gaps. China needs soybeans, is getting it from Brazil, been leaning heavily on Brazil, filling in the gaps coming from Argentina, and Argentina wants the help of the US government.
Exactly, and this is why you're seeing these two heads butt in terms of Secretary Brooke Rollins and Secretary Scott Bessent. Treasury Secretary Scott Bessent, I was with him when he met with Milei in April. They are talking about trying to give Argentina this swap line to make sure that they can help Argentina when you have a run on their currency and a run on their stocks. Meanwhile, Argentina just basically opened up the floodgates in sending their soybeans to China. They're filling some of the gap that China has right now because China's not buying from the United States. So this is going to be another politically uncomfortable moment for this administration. Do you want to make America great again, or do you want to make Argentina great again?
Look out for those talks taking place a little bit later between Argentina and the Treasury. Let's get to Tesla. I promised you an update. Shares recovering this morning, higher by a little more than 1% following yesterday's slide, which followed the company reporting record third-quarter deliveries. Dan Ives of Wedbush maintaining his outperform rating and writing the following: with Musk now driving Tesla into its next stage of growth as wartime CEO, we estimate the AI and autonomous opportunity is worth at least $1 trillion alone. Dan joins us now for more. Dan, welcome. Let's just start with yesterday's move, then we'll get to the future and all that great stuff. How much of that story with the deliveries was just a massive pull forward in demand?
Oh, I think probably about 30% of it was maybe a pull forward, relative to the incremental beat. But look, the demand story is stabilizing. And now I think you're starting to see that turnaround happen. But as we've talked about, that's just the appetizer. The main event, it's the AI revolution coming to Tesla with the autonomous and then the robotics piece. I mean, I think this is going to be a $3 trillion market cap. That's why I think $600 is almost a base case for where we see it.
So, Dan, you understand the tension well. I feel like we've covered this together a million times, but it's the tension between the near-term fundamentals and the long-term hope and dreams. The fundamentals at the moment, when you say the demand story is stabilizing demand is not the kind of story we'd associate with a multiple like the one on Tesla right now. Now, Dan, how are we going to resolve those issues? Do we just keep the faith in the multiple and the stock and the hopes and dreams, or at some point do we have to reconcile these issues?
Yeah, it's a great point. Look, you're going to have 10 million Teslas, on the road, when you think about it since the beginning. The autonomous value, as you start to see robo-taxis deployed 30, 35 cities, you see full self-driving get to 40, 50% of the actual Teslas out there. That's the game changer. Because ultimately, I think they're going to own 80, 90% of the autonomous world over the coming years as we get to true, what I view as level 4. Look, I think that's the reality. I think investors are looking, autonomous is truly what I view as really, the Goldilocks scenario for Tesla, because AI, physical AI, there's two great physical, phenomenal AI plays out there. It's NVIDIA and it's Tesla when it comes to physical AI.
When it comes to EVs for Tesla, one of the biggest competitors is BYD, which is absolutely crushing them in Europe. When it comes to autonomous, who is going to be their biggest competitor? Is it coming from China?
Look, I think it comes from China. Ultimately, when you think about all the technology, innovations that we've seen there, but globally, no one has the scale and scope of Tesla.
Not BYD?
That's why, look, I think BYD is obviously going to be the main competition. But when I think about scale and scope globally, especially not just in the U.S., but what we see around the world, I think Tesla continues to win that battle. But we don't view this as one where there's just one winner. And I think when you think about autonomous and you think about this next wave of AI, from the chips to the software to the ripple effect, it speaks to our view. Like this AI revolution, we're still in the second inning of a 9-inning game, and ultimately the Yankees end up winning that game.
Don't encourage it, Dan. We'll get to that later. Dan, let's say you're right. Let's find some common ground. The autonomous opportunity is massive. Driverless vehicles, all of that stuff. I think a lot of people can get on board with that. But I want to understand why you think the Tesla path, that road, is the road to success. So they're using cameras. Waymo's using LiDAR. What kind of technology do you ultimately think wins out?
Look, I think it's ultimately Tesla. From a data perspective, when you look at the AI engineers and you look at all the improvements that they're going to make on these next,
So Dan, let's just give me a second. What data are you looking at? Because I can go off the weekly trips that Waymo's doing at the moment, and that kind of data looks pretty decent. What are you stacking that up against?
I look at it as Waymo, they're $200,000 cars in essentially 5 cities. The scale and scope that Tesla has, given the millions and millions of miles driven and the 10 million vehicles on the road and everything that they're doing in Musk as being wartime CEO, that's where I think we sit here 6 months from now. The breakthroughs will happen, and ultimately when it comes to scale, especially when you look at robotaxi and cybercabs, no one's going to be able to match Tesla. I view that as just basically almost fact as it plays out.
So, Dan, when it comes to deliveries, they don't even matter anymore because everyone's so focused on what's going to happen in the future?
Look, they matter in terms of just, we'll call it, I guess, a signal from a stabilization perspective, especially after what we've seen over the last 6-9 months. But I think from an investor perspective, it's all about, like, to what Farrell's talking about, just like, give me marks on autonomous. Show me the technology innovations on the AI story. Show me that we're going to get to full scale and Optimus. Show me in November at the shareholder meeting that they're going to have a big piece of XAI. I mean, that's why you see Musk, it's a different mode now. It's that wartime CEO that we're seeing. Those are the marks. And that's how we're going to be looking at 600, 700, and ultimately, a stock, I think, $3 trillion.
That's a lot to play for the road ahead. Dan, before we leave here, the baseball, you want to finish there? Yankees win, getting it done. Who do you think gets this all done? World Series later this year.
Look, I mean, I think Yankees obviously have a great shot to go. I think they're going to surprise many out there. I think this could be their year. And look, Emery there obviously is a good luck charm, so we got to see how it all plays out.
Have we given up on Penn State, Dan? Are we done with that now?
No, look, I'm here in Pasadena, UCLA, the bounce back starts. That's another one. Penn State Yankees at the end. They'll be holding that trophy.
We'll see. Dan, it's good to see you. Thank you, sir. Dan Ives of Wedbush.
We're set to advance. We have the game coming up this Saturday with the Blue Jays. It's going to be challenging, but I agree with Dan. I mean, this pitcher yesterday, this 24-year-old, who I just found out is actually from Boston, this kid Cam, was unbelievable. And it's like he came out of nowhere at the perfect time.
Taking down the Red Sox. That's your latest sports segment, with a bit of Tesla sprinkled in between. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. A British citizen of Syrian descent was named by police as the attacker on a Manchester synagogue during Yom Kippur services. 2 people were killed, one by an accidental police bullet. 3 others were injured. UK Prime Minister Keir Starmer warned against rising hatred and anti-Semitism, calling the killings a terrorist attack that attacked Jews because they are Jews. Suspensions of flights at Germany's Munich airport are now easing. Several drone sightings prompted diversions of more than 30 flights from the country's second-largest hub. This comes as several drone incidents across Europe temporarily forced closures and large-scale diversions at major hubs. And you've been saying it, the MLB wildcard round finished up last night with the New York Yankees shutting out their rival Boston Red Sox 4-0. Yankees rookie starter Cam Schlittler struck out 12 batters and got some key help from his defense to send New York to the division series. Elsewhere, the Chicago Cubs and Detroit Tigers both won their Game 3 matchups to advance to the next round, which starts Saturday. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate the update. Another update on the Yankees. We're done now.
There's another play that everyone needs to watch when the third baseman ran to catch a foul ball and tumbled, literally somersaulted into the Red Sox bullpen. You have to watch it. It's incredible.
I apologize to our friends in Boston this morning. Good morning to you. Up next on the program, payrolls on pause.
We have this shutdown dynamics right now, and it's very difficult to look at the data without having the data.
So the other private sources of data will be more important. With some of the government data delay, I don't think that the Fed is going to just, totally go on pause.
Up next, we'll catch up with Sarah House of Wells Fargo, live from New York City. You're watching Bloomberg TV.
In case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs?
How
and
are
you're
the
lowering the cost of the meatballs, too.
I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We actually are running today about 40% of our sales is actually vegetables and plant balls. And personally, I don't love the vegetables, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The Federal Reserve's worried about growth. Markets focused on something else. This came from Torsten Slok earlier this week from Apollo. The US economy remains remarkably resilient. Upside risk to inflation are growing, particularly if the Fed continues to cut interest rates. And based on recent commentary, they will. And there seems to be a difference between what the Federal Reserve is concerned about, downside risk to employment, and what this market is focused on. This came from Ian Lingen of BMO. Thanks, Mike McKee, for sending this over. He basically asked his readers, are you more concerned about the Fed missing on the inflation or employment side of its dual mandate in the near term? A, inflation, 63% of respondents. B, employment,
37% of respondents. That's the divide, and it's obvious what the Fed's bias is right now, and the market gets it.
Right. The Fed's bias right now is to the jobs report, not what these individuals are concerned about in this survey, which is inflation, which, by the way, how many years has it been now? They've been continuously missing on their inflation target.
Losing count.
Yes. And at the same time, we could have inflation at 3%, and this Fed potentially could still want to have this bias to cutting because they're concerned what's going on in the labor market. At some point, you have to think about what Governor Myron's been talking about and what Mohamed El-Erian's been talking about for years. Maybe you just need to capitulate and accept you're not getting back to 2%, and you're going to have to target a range between 2 to 3%.
Will they deviate from the dot plot? Nomura thinks they ultimately won't. We'll get into that story in just a moment. If you're just joining us and want some price action, it's still positive, up by 0.2% on the S&P, following 5 days of gains on the Nasdaq, up by 0.24 on the small caps. The Russell this morning higher by 0.37. And the surveillance this morning, it's payrolls on pause.
We have this shutdown dynamics right now, and it's very difficult to look at the data without having the data.
I think it's going to be weeks, not days. This means we're flying blind in a highly foggy environment.
So the other private sources of data will be more important. With some of the government data delay, I don't think that the Fed is going to just, totally go on pause.
So here's the latest this morning. Investors digesting alternative economic data suggesting the labour market stalled in September with the payrolls report delayed by the government shutdown. Joining us now to discuss is Sarah House of Wells Fargo. Sarah, welcome to the programme. Nomura thinks that given the data delay, this Fed ultimately won't deviate from the dot plot. Would you agree with that?
I think that's generally right, but we still could get this payroll report before their next meeting on October 29th. But I think absent this most familiar and persuasive piece of labor market data and potentially inflation data as well, it's hard to really see Fed officials adjusting their prior view. So I do think that keeps them on track for another cut here in October.
Sarah, I'd rather have the jobs report than not have one. You, I imagine, would agree. But ultimately, over the last few months, the last few years, it hasn't exactly been reliable, has it? How useful is that jobs report to this Federal Reserve?
Yeah, I think overall it's still a very informative picture of the jobs market. So we've obviously had some issue with payrolls being pretty consistently overstated, but you still have a lot of information coming from the household survey, some of the ratios there that are particularly helpful. But at least when it comes to the labor market, we still have a lot of alternative data, some of which has been around for a year. So we're still able to fill in some of the picture. I think the issue right now is that some of those secondary reports, they're not all painting a consistent picture. So we're not getting necessarily a clear signal from them. So it's of limited help right now, I think, to the Federal Reserve.
What are you relying on mostly when it comes to the second-tier reports?
Yeah, so I think there's a number of indicators that we've been using for years. We understand how this works with the overall jobs market. So one is what we're seeing in terms of the NFIB hiring plan. So that's one of the bright spots we're seeing in the jobs market right now. So we saw that come out for September yesterday. That's been up for 4 straight months, highest since January. And then the other part that we use a lot are what's happening with the PMIs. So both the ISM employment components, but also the regional Fed ones. And there the story isn't as sanguine. So if you look at the regional Fed services PMIs on average, those hit their second lowest reading of the year in September. So pointing to that mixed messages where we're not seeing an obvious firming, but also not necessarily clear downtrend when we look across the major data points right now.
When does this start to become very uncomfortable for you? If we have a prolonged shutdown, and what if we don't get the October print as well?
Yeah, so I think where probably it gets a little hairier is if you see that shutdown last probably about 2, maybe even 3 weeks, because then again, you're probably not going to see that before the next Fed meeting. I think also that starts to potentially influence the October data. So we saw in the 2013 shutdown that from the employment perspective, response rates were in their normal ranges, so the BLS was able to kind of make up that period. But where it was a bigger problem was in the inflation picture. So back in October 2013, the BLS only had about 75% of the observations. This is, of course, coming at a time when they're already having to impute more data, cut coverage in some cities. And so I think the bigger concern in a prolonged shutdown is the quality of that inflation data that we get in October at what still is, of course, a very tricky time for the Fed in its inflation fight.
Could a very prolonged shutdown put the Fed on hold at any point?
It would have to, I think, be pretty prolonged. So again, I think for now it keeps Fed officials in really what they're in their prior expectations path. And we saw that the majority of officials were still looking for 2 more cuts before the end of the year. If you think about who's voting this year, I think that the bias is even more so towards those 2 cuts. So I think it's really hard to see them altering that path in terms of forcing them to actually be on hold at this point. But this has been a pretty strange year in terms of what's happening in the policy sphere. So we'll see what happens.
Sarah, we will get some data. We'll get ISM services. Earlier this week, we had ISM manufacturing. How instructive have those indicators been, particularly at a time when this market is positioning for a pickup in economic activity?
Yeah, so less so in the past few years than I think they were prior to the pandemic, but still a decent barometer on overall activity. I think we have to be a little bit careful with what's happening with some of the supplier delivery components of that, where once again, with some of the tariffs, you're still getting some gummed up supply chain issues. So longer delivery times, not necessarily a positive sign for activity there. But with the services number today, I think we'll be looking closely at, does the pop that we saw in new orders hold, or do we get some give back the way that some of the regional Fed PMIs are indicating that maybe that momentum isn't turning around quite as much as what was previously indicated.
Sarah, just before you go, in the commercial break, I was reading a note from Jordan Rochester of Mizuho, and in it he was reflecting on the pandemic. And as you mentioned the pandemic, I think it's worthy of conversation. In that time, we got really used to looking at alternative data. I remember people coming on and talking about open table data, looking for that high-frequency pulse of what was happening in real time. How useful was it then, and do we return to that now?
So I think it was pretty useful then, just to help us gauge the magnitude of changes in some of the more traditional data. Right now, where we've seen activity kind of get to at least a more normal pace, I think it's a little bit less informative. And then the issue there is a lot of that alternative data, it doesn't have a long time series, and so it doesn't necessarily help as much in terms of turning points in the economy, or at least potential turning points, which we could be at now. So it's helpful, but I don't necessarily think it's a panacea for missing this long-standing government data.
Hey, Sarah, appreciate it. Sarah House of Wells Fargo. We'll do our best to fill in the gaps as we wait for a payrolls report, and we don't have a clue when that payrolls report is coming out.
We don't know because the government is still shut down until they open it up. Then we'll know whether or not they're going to release it in 2 or 3 days. Because remember, this payrolls report is pretty much ready to go. They need to get the press release together, and then they go and ship it out. I believe in 2013, when they reopened, the payrolls report came out 3 days later. After the shutdown. So we will get it soon, but they have to reopen. And this is the question. If this is prolonged, okay, we're not going to get September, and then October's data is going to be a lot rougher to collect, and that's going to be delayed.
We are in day 3, and the jobs report is most likely delayed. Equity futures positive by 0.2%. Looking through the noise down in Washington, D.C. Up next, we'll catch up with Priya Misra of JP Morgan, Jeanette Lowe of Strategas, Francis Donald of RBC, Mike Collins of PGIM Fixed Income. From New York City, the second hour of Bloomberg Surveillance is just around the corner.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Positioning today, despite the run-up in the market, is a source of upside.
Nothing really phases these markets.
AI has been fueling this rally.
We've seen a considerable broadening of the rally. The remainder of this year and into the first half of next year, we feel pretty good about the market conditions.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores are shaping up as follows. Equity futures on the S&P 500 firmer by 0.2%, following and building on a 5-day winning streak on the S&P 500. It looks like day 6, and today it won't be dependent on what happens at 8:30 Eastern time, because we are not getting payrolls. In the bond market, 2-year, 10-year, 30-year bond yields shaping up as follows. Your 2-year just about unchanged at 354.50 with yields down on the week. The data we have had so far this week has not been great. The data we will get looks like this. ISM services coming later on this morning is really the main event. Without payrolls, we'll all be looking to ISM.
Absolutely, and you mentioned Jordan Rochester, and he was talking about how we're basically entering a data desert, and how long that lasts is going to be how long the government shutdown lasts. And today we might get some clues. We're going to hear from Speaker Johnson, we're going to hear from Majority Leader Thune. They're going to have another vote on the Clean CR. It's not passing, but potentially does a pressure start to build. Remember, people are going to be furloughed, they're not going to get paid. You have 4 Democratic senators sitting in Maryland and Virginia, where a lot of these people live and work, and that work for the U.S. government. And potentially those are going to be the individuals who start to put pressure on Chuck Schumer to start negotiating and wrap it up.
So Ed Mills of Raymond James was great a little bit earlier on this morning. We talked about when America starts to feel this. At the moment, it's just a headline. And for a lot of people, it's a headline they're not paying any attention to. He said it gets real when we reach 2 points. 1, when the military aren't being paid, because that is a very uncomfortable thing to stand behind. And 2, when the airports start getting messy and busy and your everyday traveler starts to see it for real.
So middle of October, the military is supposed to get paid. Everyone in America is going to want to see men and women of service getting their paychecks. That's one, he's absolutely right. And that's why people think this can only last 2 weeks, right? Because then that would be crazy. Second, there is historical evidence that when people start to get annoyed at the airport, when you have the FAA coming out and saying we're going to basically limit air traffic into things like LaGuardia and Orlando, then we need to wrap it up. On January 25th, 2019, this is what happened. And guess what happened that same exact day? Trump agreed to a temporary government funding measure. Curmudgeon travelers, people take to Twitter. They are angry. Open the government. Why are you doing this to us? That's when it starts to hit.
Are we going to see a repeat of that? At the moment, the market's looking right through the noise. Equity futures on the S&P positive by 0.2%. Coming up this hour, we'll catch up with Priya Misra of JP Morgan, with investors extending a record rally. Jeanette Lowe of Strategas as the Senate holds another shutdown vote. And Francis Donald of RBC seeing data delays leading to a Fed pause. We begin this hour with stocks hitting fresh highs, unfazed by Washington's funding impasse. Priya Misra of JP Morgan writing, the markets seem to be ignoring the shutdown for now, but if we get permanent government layoffs, that can have a bigger impact. Priya joins us now for more. Priya, good morning.
Morning.
I've asked this question about 10 different ways this week. Is it different this time? Do you think it might be?
It might be. There are some differences. Now, we know historically shutdowns have not mattered. What's different this time? The Congress has passed not a single appropriation bill, so this is a full shutdown. And we have the president talking about permanent layoffs, which is, I mean, remember, this was the Doge year. So, the administration did come in saying there's a lot of, excess spending by the government. Do they use this opportunity to start to cut people, Democrat programs? And does that result in the pickup in layoffs? I mean, we've been in this low hire, low fire labor market. We were actually looking more at the private sector. Do layoffs start as companies try and protect margins? What if it starts from the government side? Now, I don't know, maybe it's just a negotiating ploy. That's, I think, where the market is. That's our base case. But if it starts to actually, there are layoffs here, I think we have to start thinking that the labor market's much weaker. We're already a little fragile. So I'm not saying it's our base case, but I wouldn't just say because historically it hasn't mattered, this shutdown may not matter.
Is there the demand in the private sector to basically take those layoffs if they become permanent?
No, great point, because the labor market is stagnant. I mean, if you have a job, you're not getting laid off, you're not getting paid a lot more. So that's my signal of slack is building up. So wages are not picking up. Trying to find a job right now in the private sector, even without the government potential workers, is difficult. You add more labor supply, I think it's going to be hard, and that's what's going to make the unemployment rate start to pick up. Now, we may be in a shutdown, so we may not know it, but we're going to look at other ways to see, is that slack starting to
Do you have any thinking behind what kind of numbers we could see in these type of federal layoffs that maybe become permanent?
That's the tricky part. I mean, Doge came in much lower than what they had come in with. Do they try and get back to like million? I mean, we're estimating about 300,000 voluntary retirements have already happened. And you're going to see that in the data when we get the data in the next few months. That's a hard one. I think we just have to watch the president. I'm still hoping it's a negotiating tactic. It's to put pressure on the Democrats. But if not, we'll just have to react to what those numbers are. But I look at valuation. Nobody's really expecting a pickup in layoffs. Look at the stock market at highs. Yep. Bonds are not pricing in a big slowdown. They're just pricing in moving to neutral. So I think the market will react to this.
So, Priya, that's the tough one for you, really, for market participants. Economists just have to go through one stage. You have to go through two. Guess the data, then guess how the market responds to it. So at the moment and over the past few months, ever since we got that July payrolls report in August, things started to look weak, fragile. Then we had all these revisions, massive step down in payrolls growth. But the market kept on climbing. Both equities and credit pricing in a re-acceleration, an expansion. Do you think maybe that weak data starts to become bad news for this market?
I think weak data is always bad news, unless the Fed is super aggressive, taking rates to zero or below neutral, and we're not pricing that in. So if you get really weak data, I think, to some extent, the re-acceleration is a narrative that's trying to fit price action. So I look below the hood, and I'm not saying you're doing that.
Not at all. I can take it, Priya. Carry on, please.
There is a view that we're re-accelerating. Where in the data do you see the re-acceleration? So the stock market, credit spreads, I get that. The stock market, let's look under the hood. It's really an AI story. GDP, you strip out AI from investment, GDP is about 0 to 1%, depending on how much you want to strip out AI or how you calculate that. We're not re-accelerating. Now, you go out 6 months, and the one big beautiful bill provides some fiscal stimulus. And if we get certainty, remember, I know we don't want to talk about tariffs, but we're still seeing tariff announcements every week. And so if you get certainty on tariffs, this is the trade deal. Now, as a company, I can figure out what supply chains are. Maybe you get that re-acceleration. So I'm not negative long term, but right now, we don't see signs of re-acceleration. We see signs of soft landing, sub-trend growth is what bond people call it, where you're growing between 1 and 2%. Inflation, a big fear after Liberation Day, has not really materialized. So the Fed is saying, okay, we were worried about those risks. Now we're looking at the labor market. Maybe we start to take rates down to neutral. And that's why I don't think there's a very big disconnect. I think every market is pricing in this AI structural theme, and then some cyclical slowdown, which is allowing the Fed to take rates down. But if you start to see the cyclical side accelerate, to your question on if you start to see bad news on, you know, we don't have payrolls, but something, or claims, or something else, then I think the market's going to say, okay, maybe this is slowing down, and what will a couple of rate cuts do? I think that question then starts to unwind some of the spread.
Allow me to put it another way. Some tension between corporate earnings and the labour market. That's real. That really is real. Do you think that tension can persist?
I think that is the trillion-dollar question. So how did corporates deal with tariffs? They stopped hiring. I think we were looking at, do they pass on the cost or do they absorb it in margins? Margins have stayed strong. One of the reasons why corporate spreads are tight is fundamentals of company balance sheets are strong. Do they continue? I do think the tariff rate today is higher than it was a few months ago. So will companies take the margin hit? Some might, but overall, I think companies might continue to keep hiring low. That's why the labor market is weak, because hiring is low. Now, if they're able to pass on costs, I don't think the consumer can take it. I mean, at the margin, certain areas they can pass on prices. So I guess a long-winded way of saying that tension may not be able to last for too long. I don't know about second quarter, third quarter earnings. Maybe it's an early next year phenomena. But at what point do companies say, I'm facing higher tariffs, I'm going to actually have to lay off people? I think that's the tail risk scenario. And if the layoffs start, I think then we're talking about the Fed needs to cut well through neutral. We can debate what neutral is, but at least below 3%. And then I think you get a bigger move in rates. And then the equity market has to figure out, you know, how much of it is AI versus everything else. But that tension, I think companies have tried to do more with less and tried to pay for tariffs through lower hiring.
What would be the catalyst for the firings? Just they can't absorb the higher costs anymore?
And they can't pass it on. If they have a view that the consumer is not willing to pay, I'm sure they'll try and take some in margins. They'll try productivity, other productivity increases. But the other way would be, well, maybe I just, you know, so far I have not hired. Maybe I now start to cut costs by laying off. That's what American companies do. We have a dynamic labor market. Historically, slowdowns have happened when companies say, I'm going to have to cut costs here. And this is the fastest way to cut costs, is actually lay off people. I should say that is not our base case. We're hoping that companies can be innovative and not have to lay off people. Maybe they find some AI way to raise productivity. I think that is the big question. We've seen all the AI investment. Do we get the AI productivity that allows companies to keep the people, not have to lay off people, absorb the tariffs, and get the productivity increase through automation?
Was this an argument to extend duration?
Absolutely. And this is very different from where we were April 2nd, when I was saying, stay away from the long end, because there's a lot of this. Sell America, there's the deficit. Number one, the deficit's better today. We're raising a lot in tariff revenues. That's going to improve the deficit. Not long term, but at least over this year. The market's pricing in that. The other question about the long end is, what are we pricing in? We're pricing in the Fed cutting to 3% and staying there, and then term premium, which is what we define. How much extra compensation are you getting for extending out the curve? That has gone up. So I think extending from the 5-year to the 10-year makes sense. For the 30-year, I still want to see something from the US Treasury. I think they need to cut supply in the long end. There just isn't a global, and it's a global question, demand for duration. So I don't know about extending all the way to the 30-year, but the 10-year, I think at 4%, our view has been in a soft landing, 3.75 to 4.25. But there's asymmetry to that. If there's a slowdown, I think rates will go much lower, and that's when you want some duration.
Just quickly, if the Fed paused balance sheet roll-off, would that make any kind of incremental difference to you?
At the margin, it's a little less supply if they stop QT. QT is running at a low rate. I do think it's good news, because the front end then can calm down. We've seen some pressure in SOFR, some pressure in Fed funds. So I do think in the end, we're watching the minutes for that. I'm pretty sure there was some discussion around QT, and maybe they'll signal that in the next meeting or two, they're going to cut QT. At the margin, it's positive for duration. It's also positive for risk, because it prevents that deleveraging. Remember September 19 when repo rates spiked? It takes that tail risk off if they were to stop QT, but it's a smaller.
Always odd when they're allowing balance sheet roll-off and reducing interest rates simultaneously. I've always found that.
Well, if you're going from restrictive to neutral, you can continue balance sheet runoff in the background. If you go below neutral, now you're accommodative. It makes no sense to be doing QT, but that's how the Fed can still reconcile doing QT. It's in the background. We're just taking rates from, we're taking the balance sheet from excess reserves, or their term of abundant to ample. But we're just, and I think that's the theme. We're just taking restriction out. So October, I think the Fed's cutting, even if the shutdown lasts for a while, because in their mind, they're just taking some restriction out of the market. I don't know about next year. If this shutdown lasts for longer, I think that's when it gets harder.
Well, then we've got a new leadership story at the Federal Reserve and a much longer conversation. Priya, it's good to see you. Thanks for dropping by. Thank you. Priya Misra of JP Morgan. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Chinese tech giant Huawei was found to have used foreign hardware in its AI processors. Semiconductor watchdog Tech Insights discovered gear from Taiwan's TSMC, along with Samsung and SK Hynix, in multiple samples of its chips. Huawei didn't respond to a request for comment during a week-long holiday in China. Apple's App Store removed IceBlock and other applications used to report and track sightings of U.S. immigration and customs enforcement agents. This after Attorney General Pam Bondi urged the iPhone maker to remove the software. IceBlock's developer maintains it's not different from other software that relies on crowdsources data. BlackRock's global infrastructure partners is said to be in advanced talks to acquire Aligned data centers. Aligned could be valued at about $40 billion. The deal would be one of the biggest for the year. A spokesperson for BlackRock declined to comment. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, ending the government shutdown.
We have conversations, and I'm assuming we'll have more. Back in tomorrow, we'll have another opportunity to vote to end the shutdown tomorrow.
Leader Schumer and myself haven't gotten a single phone call as it relates to a follow-up conversation.
That conversation up next with Jeanette Lowe, our strategist, live from New York City this morning. Good morning.
Going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Equity futures on the S&P positive here by 0.2% on the S&P 500. On the NASDAQ, up by 0.2% also. Typically, I'd sit here and say 1 hour, 13 minutes away from the payrolls report, but we're probably not going to get
You
one
miss
unless
a countdown,
someone...
don't you?
I love a countdown. Unless someone springs a surprise on us.
This is true. I mean, I don't want to go into the conspiracy theories, but there is a theory out there that...
But the NEC's got the number.
The NEC director has the number, and then he would have briefed the president last night or this morning. So if the president does have the number, does he do his own payrolls report release at 8:30 on Truth Social? Stay tuned.
Can you imagine?
That would be something.
That
we
would be something.
We would cross a Rubicon in this country.
Let's just put it this way. That's not the base case this morning. The base case is we're not expecting a jobs report at 8:30 Eastern Time. Under surveillance this morning, ending the government shutdown.
We have conversations, and I'm assuming we'll have more. Back in tomorrow, we'll have another opportunity to vote to end the shutdown tomorrow.
Leader Schumer and myself haven't gotten a single phone call as it relates to a follow-up conversation.
The issue set is pretty straightforward. I don't know that, a negotiation is going to accomplish a lot.
We need credible partners on the other side of the aisle.
So here's the latest this morning. The U.S. government shutdown entering its third day. The Senate preparing to hold a vote on a stopgap spending bill to reopen the government. Bloomberg's Laura Davison joins us now from Washington for more. Laura, you've tracked the story all week for us. What's the update? It's day 3. What's going to break this deal ultimately on day 4, 5, 6, 7, 8? It's going to take 10, 15, 30 days? I've got no idea.
The thing to watch here are what are moderate Democrats in the Senate doing. Leaders Schumer and Jeffries are not talking with Johnson and Thune. There is essentially no progress 3 days in. The question is how much pressure does Trump and the White House put on Democrats? They've threatened these firings. They've threatened to cut more spending. That has not yet materialized, but that could very well come later today. The other question is lawmakers are going to vote again and then go home for the weekend. What kind of pressure are they getting from constituents? We will basically start next week. They'll come back to the Capitol Monday night, and we may very well be in the same place we are now. There is no progress, and you start to see some of these moderate members who are worried about their reelection come next year say, "Hey, we need to get something started. We need to move our position, talk about healthcare, talk about kind of what sort of things we could take, whether that be a future vote or other options, because this is not a politically tenable situation."
Laura, what is incentivizing those moderate Democrats at the moment?
Right now, they believe that once these notices start going out, informing people that their premiums are going to increase, that public sentiment will be on their side. That's the gamble that Schumer has put out. We'll see if that materializes. But if they start to see that, sort of anger and frustration over healthcare costs, are dwarfed by anger and frustration over the government shutdown and services not being available, and people just feeling generally, frustrated that Washington isn't working, those are the two things they're weighing, and how much a shutdown will affect the midterm. Right now, they're betting that people care more about healthcare when the midterms are a year away versus, sort of a little bit of chaos in Washington for a week or two.
Laura, thanks for the update, and thanks for covering the story for us through this week. I imagine we'll be talking to you again on Monday. Laura Davison there of Bloomberg down in Washington, D.C. Jeanette Lowe of Strategas joins us now for more. Jeanette, as you know, as is often the case, this is won or lost in the court of public opinion. Who's winning and losing right now?
Yeah, I mean, right now, I think if you look at the polls, you do see that Republicans are getting a little bit more blame than Democrats are currently, but both parties are getting a hit from this. And in general, we do see that both parties generally do get some backlash for a government shutdown. The same thing happened in 2013 with President Obama getting some of the blame, even though Republicans kind of put the government into a shutdown. So both parties may ultimately suffer from this, and that's how they kind of have to figure out who's suffering more, is where the pain point may be to actually get the government to reopen.
Jeanette, what do you see as the off-ramp?
So this is going to be kind of a difficult situation. So the parties are kind of far apart right now. The Republicans do agree that probably something does need to be done to extend the ACA subsidies, probably a short-term extension, maybe a year with some amendments, some reforms to the process. And so the Democrats are pushing for that, but the Republicans are also saying that they can't do anything until the government is reopened, while the Democrats are nervous that the Republicans will not hold their word on this. So what we're thinking thinking is that probably what you're going to have to see is either some major political pressure coming in, which would mean we're seeing missed paychecks in the middle of the month for our military members, for congressional staff, which will also put pressure. But then also, do the moderate members come together to figure out how they can figure out some sort of agreement to get us out of this shutdown? It probably will have to be in some form around the ACA subsidies. The longer this goes on, this could last 2 to 3 weeks, just depending if we don't see any momentum towards a deal. As we get later into the month, you have the missed paychecks. That adds pressure. You start to maybe get some of these premium increase announces. That will add pressure, and that could be where we see the ultimate solution.
Well, the Republicans already picked up 3 votes in terms of the Democrats willing to vote for the clean stopgap funding measure. Who else should we be looking at?
Yeah, I think you look at retiring members, so members like Senator Shaheen from New Hampshire, Senator Peters from Michigan, also watching the Virginia senators, since they have a significant portion of the federal workforce in their constituencies. Those will also be key members to watch. So we would want to see if they have a vote today. Do more Democratic senators join on to the clean CR, or do we go into the weekend and have no movement at all? If we do see more Democratic senators join, then obviously that would be showing a sign that there is more pressure to get to a deal at some point. But if we don't, this could definitely start to linger a lot longer into next week and potentially even the following week.
And how are you thinking about the president's meeting with Russ Vought yesterday and whether or not he was going to be making layoffs that usually historically are just furloughs and those individuals come back to their job permanent?
Yeah, I mean, this is obviously at least a threat. So this is something that they think the administration would like to do, and they see this as an opportunity. This is one of the reasons the Democrats were actually worried about having a government shutdown in the first place, because they thought that this could be a tactic that the administration would use. But then at the same time, you're also seeing Democrats getting some support among federal worker unions saying it's okay that you're doing the shutdown because we know we're under attack anyways from this administration. So there's a little bit of, we could probably definitely see some layoffs, some permanent layoffs, but then they also may be challenged by the courts. And that also could play into public opinion as well. So that also could be something that, depending on how these play out, that could be key to which side actually gets more blame and where the pressure ends up being longer term.
Jeanette, appreciate you jumping on this morning. Busy one for you, I'm sure, going into the weekend. Jeanette Lowe there of Strategas with the latest down in Washington, D.C. Just got a message from a Bloomberg subscriber. Aren't people numb to this in this country, given the chaos, the disarray in Washington, their opinion of Congress already?
Shutdowns, debt ceilings, the opinion of Congress and how low people rank what goes on in Washington, D.C., yes, but it also does matter. Jeanette, what she said, Ed Mills, what they said, middle of the month, when those paychecks are set to go out to service members, that's going to be a big deal if those paychecks do not go out. If your flights continuously get delayed, that's going to be a big deal. If the FAA is saying, we just don't have the staff and we can't keep up with this traffic because we have furloughs, this is when it starts to really bite.
This can cascade through the economy pretty quickly, and the question we've got to ask following the economy and ultimately financial markets, is it economic activity delayed or derailed? We're going to ask that question next. We'll catch up with Francis Donald of RBC as the data delay threatens interest rate cuts from the Federal Reserve when they get around the table together for a 2-day meeting at the end of this month. No payrolls report this morning, most likely. Will we get it in a few weeks' time before they meet? Plus, we'll get some morning movers for you. Danny's going to join us. Taiwan Semi rising on a new connection with Huawei. Their stock is up by 2%. Live from New York, you're watching Bloomberg TV.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
5-day winning streak on the S&P 500. Looks like day 6, at least for now, positive by 0.1%. In the bond market, switch on the board, we'll turn to fixed income briefly. 2-year, 10-year and 30-year bond yield just about unchanged. 2s are down on the week, though, because the data hasn't been great. 354.50, particularly ADP, but that's all we've got to go on. Then we're looking for payrolls. We're not going to get that. You're going to get the ISM a little bit later this morning. That's the next stop. 10 a.m. Eastern Time for a read on ISM services. That's the state of things right now as we count you down to the open, about 2 hours away. Let's get you some single names, some stock movers. Here's Danny with more. Hey, Danny.
Hey, John. TSMC, the U.S. ADR, rallying this morning after a tear down by one company from Canada on the latest Huawei chips. It shows that they use basically all Asian suppliers, from SK Hynix to Samsung, and yes, TSMC chips are included in that, so rallying off the back of that about 2% higher. Also, a rebound this morning for Tesla. Shares fell 5% yesterday, even though they came out with record sales. The issue is it seemed like consumers were rushing to buy Tesla to get ahead of the expiry of the $7,500 tax credit for EVs. Of course, the Trump administration phasing that out. So was it just a temporary sugar rush? Shares fall, and we're buying that dip this morning, only up by 1.1%. Meanwhile, we are looking at another rare earth mineral company rallying this morning. That's USA Rare Earth Inc. A CNBC report that they've been in talks with the Trump administration and were specifically asked whether they'd want to do a deal with the Trump administration. This follows off the back of the administration looking at other deals with other rare earth mineral companies. So those shares up 2.4%, John.
Danny, thank you. More from Danny in the next hour, about 60 minutes from now. On a radar this morning, some of our top stories. The government shutdown delaying the release of September payrolls. Many economists are leaning on alternative data, and some predicting U.S. job growth is slowing. Elsewhere, Bridgewater Associates' flagship macro fund climbing 26% this year with a boost from tariff-fueled market uncertainty. Sources telling us here at Bloomberg the hedge fund is on track for its biggest gain since 2010. And finally, this story right here, potentially quite controversial. Argentina's economy minister and central bank president traveling to Washington today to negotiate a proposed $20 billion FX swap. Treasury Secretary Scott Bessent saying the U.S. supports President Javier Milei, but the aid is not an outright U.S. investment.
So they're trying to give an olive branch to Argentina through this FX swap, which, by the way, wasn't on the table when I sat down for the Treasury Secretary in Argentina in April. It's now on the table, and it comes at a time when Argentina is sending soybeans to China, and China is not buying any cargoes from the United States. And this is why this has become politically a ton of tension within this administration between Secretary of Agriculture Brooke Rollins and the Treasury Secretary Scott Bessent. I said it last hour, I'll say it again. For this president, this might become a problem. He wants to make America great again. At this moment, people are viewing this as making Argentina great again and their ability to fill the U.S. gap and sending soybeans to China.
So some tension in the cabinet. So let's talk about where the president stands on this. The president at the moment is talking about bailing out the farmers who aren't getting those soybean purchases. In the negotiations with the Chinese later on this month, he's going to have a conversation about boosting those purchases, maybe returning back to the purchase program. The agreement of the president's first term. What's he saying about what's happening with Argentina? Have we had a response from him? Have we had a response from the Treasury Secretary?
Well, the Treasury Secretary is saying that this isn't outright money. So they're trying to say, like, look, this is a financial instrument to help them. This isn't outright money. And they're going to have this conversation today with the finance minister in Washington. This is going to become a little bit more challenging for the president when Javier Milei is in Washington, according to reports, in about 2 weeks' time, alongside the IMF World Bank meetings. And if the government is still shut down and they haven't given those bailout yet, the Wall Street Journal is talking about $10 to $14 billion to the farmers, then potentially the heat is going to be turned on.
At the moment, the government is shut down. It's day 3, which means we're not getting that payrolls report in about 60 minutes from now. Francis Donald of RBC has this to say: the timing of the government shutdown is not ideal for the Federal Reserve. Limited visibility into the September data increases the probability of an October pause. Francis joins us now for more. Francis, good morning. It's good to see you. Good morning. So this is a slightly different take because we've had a guest come on the programme and say they're not going to deviate from the dot plot. Ultimately, they're expecting a rate cut still in October. Why would this lead to a pause?
Well, let's remember Chair Powell has talked a lot in the past. When you're walking in a room and it goes dark, you go more slowly. You don't necessarily speed up. And at the end of the day, we have to remember this shutdown is compounding an existing problem, which is that our data is being substantially distorted by tariff developments, front-loading, inventories. We know that companies, clients that we talk to and others are finding ways to navigate around that using things like bonded warehouses, for example, or changing the timing of their purchases. And then on top of that, now we're going to miss probably a month of solid evidence as to what actually happened in there. So from our point of view, just like a company or a consumer at the end of the day is maybe going to say, let's be a little bit more cautious, to us, this is going to raise more questions than it is make it very clear what the definitive path ahead should be.
So Anne-Marie was talking about this earlier on this morning. The data itself has been a problem. How dependable is the data anyway for this Federal Reserve?
Well, this is the thing for economists right now, is there is already a giant question mark around what data should we be using? Are there biases within the data? Were there? Will there be on a go-forward basis? We've already for years been dealing with low response rates, and we know that the economy is operating in a way that changes the way we need to use data. Confidence data, for example, in our view, is still very valuable. It explains how consumers are feeling, but if the top 10% of consumers are spending 50% of all of the consumption, then confidence data is not the same valuable tool it was in the past. Layer on top of that tariffs, and we've been really in a dark place with respect to how we can read visibly. And that's why, in a way, John, I'm not that upset that we're going to miss a month of data, because I think there's so much obsession over this month to month, in part driven by the Fed, that's highly data dependent. We need to focus on some of the bigger trends, and the bigger trends are clear. This is a labor market that is structurally very different. We don't need the same amount of job growth as we did before. We only believe that this economy needs to create 40,000 jobs a month for the unemployment rate to stay stable. We know growth is slowing off the back of tariffs and some price pressures that are coming through, and we know inflation is likely to reaccelerate into year end. And I could, for a month, go dark on data and tell you that I'm still fairly confident that will be the story 30 days from now. But when, of course, we're hypersensitive and we're in an environment where policymakers are really trying to move month to month, of course the market is going to feel a little more uncomfortable with that lack of visibility.
Are you saying the Fed is too data dependent?
Well, no, what we're saying is that the month-to-month variability in data, this has always been true, sometimes leads us in the wrong directions. And I think what's really challenging right now is that that tariff distortion is very much still in play. We hear all the time, oh, tariffs are not inflationary. That may turn out to be true. It's not our view, but we won't know that till the middle of 2026. So the issue with data dependence right now isn't data dependence in and of itself. It's data dependence in an environment where we don't have good reads, and our month-to-month data is not telling us the true story of the American economy or the American consumer.
So what do you look at on a day like today? You're not getting the jobs report. What's your North Star in terms of directing you towards these trends?
Well, today's not actually the problem. So any economist would have released their estimate for where jobs would be last week and everybody's week ahead. Our estimate was 52,000. The problem will be next month when we don't have the aggregate amount of data that helps us forecast what happens next. At the end of the day, we tell clients, focus on the trend. We think the unemployment rate will rise gradually to 4.5%, 4.6%, but we've been through a few cycles, all of us at this table, if I may say that. We know that 4.6% unemployment is still very low, very tight labor market underneath the surface. So we are doing what we've been doing for the last year. Much more bottom-up work, much more sector focus. Look at your actual end consumer. Which one are you servicing? Which one are you investing in? And look at their individual stories. And then, of course, we have a table of all the indicators that we look at, from WARN notices to LinkedIn postings, that help us get a little bit more of a month-to-month gauge. But the message here is actually one of relief. Focus on the big picture. That's probably going to guide you towards better investment decisions and better operating decisions if you're running a business.
You'll forgive me for bringing up the shutdown then, but we do have to talk about it just a little bit. The government shutdown in Washington, it can have implications for the economy. Typically, we know how the movie goes. Economy has a bit of a blip, then we accelerate, we pick up again, and we look through the whole thing. And that's ultimately how markets play this story too. Do you see it as delayed, deferred activity, or are we at this point where things are a little bit more fragile, where things could be somewhat derailed?
Well, I watch your show in the mornings, and I'll repeat what just about every economist has told you. Our traditional rule of thumb is the shutdown is worth about 0.1 percentage points of GDP each week that it goes on, and then it becomes nonlinear, likely around the middle of the month. The longer it's out, the more it bleeds for the economy. We're focused on some of the things related to contract workers as well. So all the economy that circulates around the government that may see a pause. At the end of the day, you know, I talk about the shutdown being emblematic of larger trends, and there's two that sort of worry us. This economy was already slowing down. So these additional bumps, they exacerbate the problem, they exacerbate the uncertainty component. But under the surface, we've also in the past year, again, we're thinking about how this relates to the bigger trends, been much more focused on the fiscal side of the picture, the policy side of the picture, than the monetary policy side of the picture. And that's largely because this economy is becoming less sensitive to the Fed's next move and much more sensitive to what's happening in Washington. We see this in the yield curve, we see this at the long end of the curve, but many Americans are leveraged to the belly and the long end of the yield curve, with the Fed is not successfully being able to influence at this point of view. So acrimonious Washington, to me, is not necessarily about the GDP impact for September and October. It's about this transformation where we move away from monetary policy being the core driver of the business cycle and realize that if we really want to know where are we have to watch fiscal spending, the deficit, and the path for that ahead.
Is this shutdown different, though, if Trump decides to make these furloughs permanent?
Oh, absolutely. And so when we look at the numbers, for example, if we were to see, and this is the extreme example, this wouldn't happen, but if by October 17th, that'll be the reference week for next month's jobs number, if we haven't seen folks come back, you could see the unemployment rate jump to 4.8%. Now, our estimate is that it would then come back down, but these are the types of numbers that begin to skew the story to a certain extent.
I'm saying if he decides to say, I actually want to move more people into the private sector and I'm getting rid of these offices, these jobs, isn't that more of a permanent effect?
Absolutely, that would be more permanent, but that number is ultimately probably going to be quite small. But the most extreme thing, let's say every person would be laid off, which is not going to happen, you would see that number jump to 4.8. Again, this is emblematic of the bigger picture, which is job growth is slowing. We are going to see less job creation on a go-forward basis, with the exception of healthcare. Healthcare is going to continue to be fairly robust there. So this is the trend continuing: slower job growth, slower overall growth, less confidence in the economy, and reduced data visibility. It is, as we say, stagflation light.
Francis, you're one of the best. Appreciate it. Absolute clinic as always. Francis Donald there of RBC, and the jobs report we won't be getting, and the trends you need to focus on. Equity futures right now in the S&P 500 positive by 0.2%, with an update on stories worldwide. With your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Goldman Sachs CEO David Solomon is bullish on the U.S. economy. Speaking to Bloomberg's Tom McKenzie earlier in Italy, Solomon said he sees tailwinds such as tech spending helping the United States.
The U.S. economy is in pretty good shape, and there are some very, very strong tailwinds that have really had a profound effect. I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026.
Just last month, Solomon warned President Trump's trade policies were weighing on growth. Another setback for Boeing. Sources telling us here at Bloomberg the company's 777X jet will fly commercially in 2027 instead of next year. The delay could result in potentially billions of dollars in accounting charges. The jet is already 6 years late and has major strategic and financial importance to Boeing. Are you ready for it, Swifties? Taylor Swift's highly anticipated 12th studio album, The Life of a Showgirl, is out now. The album features 12 tracks, with the title track featuring Sabrina Carpenter. Swift's latest album is the most pre-saved in Spotify history, surpassing 5 million pre-saves. We'll have to keep an eye on shares of Spotify later. That's your Bloomberg Brief, John.
Bonnie, thank you. Appreciate the update. Thank you very much. Up next on the programme, divisions remaining at the Fed.
We're going to go off of what the data we have. It suggests that the unemployment rate was unchanged. I think it indicates some steadiness in the labor market, and I think the underlying economy is still growing pretty solidly.
Up next, Mike Collins of PGM, live from New York. You're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Equities are positive, higher by 0.2% on the S&P 500. On the Nasdaq 100, up by 0.2% also. 5-day winning run on the S&P. Looks like day 6 already the longest daily winning streak since the end of July. A lot of bulls have come on this program, but a lot of people have come on the show so far this week and really explained why this is such a risk-friendly moment. Krishna Gua of Evercore saying because of this growth-labor divergence, it looks like the growth side is fine. The labor side is perhaps weakening more. The Fed is taking its cue from the labor side. And that's why this is so risk-friendly. And Mike Powell of BlackRock was saying something similar. Strong growth environment with labor market weakness giving the Fed more room to cut. That's a positive backdrop for risk assets.
And you just heard from Frances Dunlon. What is she talking about? The trend. It doesn't matter to her if we have this entire month off when it comes to data, because also everyone thinks the Fed maybe is a little bit too obsessed with month-to-month data. She's looking at the trends, and the trends are showing you that we potentially are going to have a higher unemployment rate, and there is some weakening in this economy. It's just so difficult when you wake up and you're talking about trillion-dollar companies and the CapEx boom we're seeing when it comes to artificial intelligence in the top companies on the S&P 500.
Delivering fantastic profits. That divergence between corporate earnings, great, and the labour market, not so great. The Fed's responding to one and not the other, and the market is focused on both. We get the rate cuts and the earnings. Stocks are at all-time highs. In the bond market, two-year bond yields at the front end of the curve around 350 now. Repricing lower this week, down by around 10 basis points off the back of weaker than expected economic data, 353.88. Under surveillance this morning, divisions remaining at the Federal Reserve.
If we don't get the official unemployment rate, we're going to go off of what the data we have. If we released it today, it suggests that the unemployment rate was unchanged for this month from last month. I think it indicates some steadiness in the labor market, and I think the underlying economy is still growing pretty solidly.
So here's the latest this morning. The Chicago Fed President Austin Goolsbee leaning on alternative data, saying the labor market remains stable. Mike Collins of PGIM calling his macro base case a muddle through, writing, while downside tails remain and there is a chance of a mild recession, we see limited crash risk. Mike joins us now for more. Mike, welcome to the program, sir. It's an odd one, isn't it? No payrolls report in 42 minutes expected. But let's go with the language from Austin Goolsbee. He seems to think the labor market is solid. Would you call it solid? Would you say things are stable?
Yeah, the labor market is a conundrum, Jonathan, just like a lot of the economic data and like the Fed outlook. And what you're seeing in the labor market is the supply of labor is coming down fast, right? Plans for companies to hire is kind of in a free fall, right? But the one outlier within the data is the firing, right? We're really not seeing any layoffs. It's just kind of a flat as a pancake in terms of companies laying people off, firings. So maybe companies are really just holding on to the people they have, trying to maintain their margins through other means, right? But I think you are seeing this kind of sneaky weakness in the job market. I would say if you look at the whole, data set of the labor market, it definitely looks like it's weakening to us. Typically, the last thing to happen, right, is companies lay off people. So maybe that's the last shoe to drop.
Yeah, Mike, that's what I want to get into here. You've seen it all. For a long time, you've been one of my favorites in fixed income. You know that. I can say it loud and proud right here on TV. Mike, it's very strange to see such a strong corporate earnings profile at the same time we see such muted hiring intentions. When you start to see that, does it typically break one way or the other?
Yeah, one chart I was looking at yesterday, Jonathan, if you look at the stock market, right, it's going straight up. And then you look at the growth rate of the labor market, new jobs, it's going straight down. Typically, those things are highly correlated, right? So something's got to give. And I would guess it's the ebullient, real bullish fever we have out there in asset prices and in markets and maybe even in earnings, right? Earnings expectations, as you know, Jonathan, for the next 2 years are still in the low teens year-over-year growth. Now, granted, a lot of that is concentrated in a relatively small amount of companies, but you are seeing earnings breadth in the stock market really expand a little bit here, which is very encouraging. Why you're seeing things like the Russell 2000 small companies actually start to outperform a little bit here, or at least catch up, which is nice. So it is a real challenging environment for an economist, for an analyst, for a data scientist, for the Fed. To parse all this data and figure out, you talked about in your opening, our muddle through. The muddle through is our base case, meaning growth is going to be in the ones, inflation is going to be in the high twos, right? The labor market is weakening, but isn't going to fall apart. That's like the base case. But wow, the tails, Jonathan, are pretty big. And the downside tail is recession, obviously. And it seems to me like that risk is actually increasing, albeit it would be a mild one. But the upside tail risk, where earnings continue to boom, the stock market continues to boom, AI CapEx continues to boom, the wealth effect continues to drive the economy. That's a big risk, right? And the problem is, so that's the bubble scenario, right? You have the recession scenario and the bubble scenario as your tails, and they both end badly, right? So that's really where you're trying to thread the needle here in the bond market, and when you're managing money to try to really rely on that base case and not blow up in the tails.
Mike, putting these two stories together, how does the Federal Reserve address higher unemployment because AI is taking those jobs and AI is doing so well because the CapEx you're seeing at these companies.
Yeah, I mean, productivity, right? I mean, that is the upside story, Anne-Marie, right? It's the AI, it's the productivity boom, it's the resilience of this economy, which has been largely driven by this really powerful wealth effect, which does have legs. And there is a trickle-down component, right? I mean, the stats you see are, 10% of the wealthiest people in this country are driving 50% of GDP. Unfortunately, the other 50% of GDP, as you've reported, is coming from AI CapEx, right? So you have this really kind of bifurcated, economy running on these two small, powerful engines. And I do worry about the breadth of the economy and the other 90% of the people who are really struggling. And you are seeing personal bankruptcies go up. You're seeing weakness among even corporations in some cases. You're seeing, distressed debt situations start to percolate more frequently. So typical late cycle signs are starting to emerge, and I think you have to really be cognizant of that.
You mentioned potential recession. Could we have a shutdown-induced recession?
I don't think so. I mean, when we looked at the last time we did this, Anne-Marie, it was 35 days, right? And we did the math on the actual impact to GDP. It was 1 basis point, right? So if GDP goes from, it was at 2, it went to 1.99, right?
But Mike, hold on. This time could be different if we get permanent layoffs at the U.S. government.
Yeah, I still think it's a little bit of a rounding error, and it's really the big private sector that we worry about in terms of the impact on GDP, and the private sector writ large is actually doing really well here. They're continuing to be creative and come up with new ways to generate earnings, generate sales, maintain margins, which has been one of the biggest shocks. You look at profit margins, right? I mean, I've been saying for years now that they're going to come down, and they really haven't. Maybe the layoffs are the next, like I said, shoe to drop to preserve margins, but the private sector has done really great here.
So, Mike, does all of that justify where spreads are right now?
Yeah, credit spreads, I know, Jonathan. Everybody talks about how tight they are, and I know this is a little inside baseball, right? If you look at corporate yields, they're up here. Treasury yields are here. Swap yields, like interest rate swaps, are way down here, right? So part of me thinks, you're looking at credit spreads relative to treasuries, might be a little bit of a mismeasurement issue, right? Treasuries are kind of the things that are cheap, right? They've sold off relative to other fixed income assets, including interest rate swaps, which is a risk-free asset, and corporate debt, which is increasingly pretty safe, right? Fundamentals in corporate credit, high yield credit, the big publicly traded credit markets are really, really good, right? So maybe it's justified, and maybe it's the treasury yield that's cheap because of all the supply, all the concerns about the fiscal, and all these auctions that we have to, find a level to clear the markets with.
True. Mike, is a smart way of thinking about things. Thank you, sir. Important final point. Mike Collins there of PGIM, fixed income. No jobs guest today because we're not expecting a jobs report in about 34 minutes' time. And typically I'll just sit here. First question, what's your job guess?
I know.
8:30 Eastern time. What's your job guess?
I mean, I guess you could still guess. We're not going to know whether or not it was right or wrong for who knows what. TBD.
You put it really well, Anne-Marie. The jobs report has been less dependable anyway so far this year.
It's been cancelled already.
Maybe taking a break isn't such a bad thing. Up next, the third hour of Bloomberg Surveillance.
A cidade estava sitiada.
Nisso eu começo, eu também não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
should I like it?
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
This is an unfamiliar political situation in just so many respects.
It's very difficult to look at the data without having the data.
The less data that come out, the less of a reason the Fed would have to deviate from the dot plot.
Earnings season is going to take on even more importance if we have a lack of government data.
Companies are going to operate through fog.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
We should do this more often, just Fridays. First Friday of the month without the payrolls report.
Shouldn't we just go home?
Just way more chill, isn't it? Going into the weekend. From New York City this morning, good morning to you all. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your equity market at all-time highs on a 5-day winning streak, adding some weight to the rally. Equity futures this morning, positive across the board, up by 1/10% on the S&P. On the NASDAQ 100, up by 1/10%. Also, some outperformance, just a little bit. Over on the Russell, the small caps up by 0.4%. In the bond market, focused on the 2-year, we have had a repricing lower on the week so far off the back of the data we have had, which has been weaker than expected. 354.29 on 2s at the moment. As for the week ahead, the day ahead going into the weekend, you do get some data. Probably not getting payrolls at 8:30 unless something spectacular happens. ISM services, though, want to watch at 10 a.m. Eastern Time.
So we do get something in this data desert, as Jordan Rochester called it, but we're not getting the big one, the one that the Fed really cares about. But I love what Francis said the last hour. She's actually happy about this because the Fed is almost too tethered to every single month's data dependency. And Trump already months ago threw cold water on the data, saying you can't really take it at what face value because of the massive revisions. People in the market were like, yeah, we've been saying this for a while. We don't love the data collection. The revisions haven't been great. We still want the data, but it would be better if it was more prime time, if it was more accurate. So the jobs report has already been canceled. Now it's basically officially canceled. And the question everyone is when are we going to get it? When the government opens? We're day 3 of the shutdown. Likely it's going to go through the weekend. We're here for at least another few days.
The CPI, arguably the bigger one in a few weeks' time, is that going to be delayed Does this shutdown basically delay the next payrolls report as well because of data collection issues? Let's just run with what we've had so far this week. Hasn't been great. Factory activity shrinking for a 7-month. No new information there. That's been a shaky story for a while. Consumer confidence, 5-month low. ADP, weakest since 2023. You put that all together, if you wanted a picture of the economy right now, based on the data we have had, it hasn't been tremendous.
That is what a lot of economists have been arguing, like Francis. The trend is already set. You don't need today's jobs report, which we're not going to get, it's MIA, to basically tell the Fed that they should be looking at what's happening in a weakening labor market and cutting again. We know that's where the Fed's bias is right now. The issue a lot of people are starting to have, though, is that by mid of next year, some economists think the tariffs will actually start to bite. Is that going to mean more potentially inflation, or is that going to be mass layoffs because corporations can't just eat the tariffs anymore and they actually need to start making up some of this on the margins?
27 minutes away from staring into space, waiting to see if something crazy happens. Mike McKee's going to join us.
Look at Truth Social.
Later on this morning at 8:30 Eastern Time. Maybe the president's got the number. Perhaps he'll release it. No one really knows. Equity futures on the S&P 500 up by about 0.1%. Coming up this hour, Nadia Lovell of UBS, as stocks trade near all-time highs. Becky Frankowitz of Manpower Group as we break down the health of the labour market. And Seth Carpenter of Morgan Stanley warning that tariff impacts are still ahead. We begin this hour with stocks shaking off the political division in Washington. Nadia Lovell of UBS writing, we expect the market to stay steady despite the government shutdown, with temporary macro data delays unlikely to stop further Fed rate cuts. Nadia joins us now for more. Nadia, good morning.
Good morning.
Is this delay to the data, not the suspension of it, but the delay of releasing it, is it a reason not to take risk in any way, shape or form?
Absolutely not. You're seeing it today in the market. I mean, the economists might have less to do today, but the equity market still has a lot to do, and investors still have a lot to do. When you think about it, it feels like the chase is on, Jonathan, right? The sort of the seasonal weakness that some were looking for in September didn't materialize. And that's because the corporate commentary has been pretty sanguine, right? You also have the AI story that's still very much alive. So we think that the ingredients are coming together for a melt-up into year-end. And so there's a lot to do in that equity market, despite the fact that our government is shut down and we hope it reopens soon to be able to pay its employees.
It sounds like it doesn't make a difference to you. So let's go with that phrase, melt-up. What does that phrase mean to you? Just help define that just a little bit. If the chase is on, what's a melt-up look like?
Well, when you think about it, you have a market that's up a lot since the April lows, up 14% year to date. But reality is, not everyone has participated in that. And so there's some performance that needs to be made up by the time we get to year end. And reality is, we do know that from a seasonal standpoint, fourth quarter tends to be a pretty solid quarter, especially when you've had a solid year to date. And then when you look into the Q3 earnings season, I think that is going to be a good one. You know, consensus right now is looking for about 7% EPS growth. We could get to high single digits to low double digits. And the fact is, the spending continues in AI. So you could see this market that continues to move higher, another 3, 4, 5% into year end. Now, that's not to say, even if you get a small pullback, it's going to be bought, in our view.
Who hasn't participated that you're looking to participate?
Some of the long onlys haven't participated. A lot of this has been driven by corporate buyback. It has been driven by the retail investors, also some of the systematic. But you do have some long onlys that have been sitting on the sideline. You know, the drawdown in April was sharp, fast, and the rebound has been also fast, and some have missed out on that.
What are you looking for in 2026? Because you're thinking a melt-up going in. Does it at some point, there's a catalyst for it to bust?
Look, don't think that there's a bust coming. You know, yes, there's chatter about, you know, potentially being in an AI bubble. And the fact that we're debating it suggests to me that we're probably at, if we are in one, which we don't think that we are, that we're probably at the start of one, much closer to the start of one than towards the end of one. And when you think about it, the AI cap stories continue to pick up. We think that you could see $500 billion or so global AI spending next year. Now, there's this question about monetization, but even that is starting to show some signs of pickup. We're seeing improvement. I mean, look at the slew of deals that have been announced in partnership in the last couple of weeks, and even like the amount of product launches that you've had from someone that's in the center of this, OpenAI, this week. And so it does suggest that you could start to see us move into that monetization phase in a more meaningful way in 2026. And then reality is, ahead of midterms, I think this administration will be focused on growth.
You've just said something important about people not participating, and I just want to sit on that for a beat longer. why they haven't participated. 6 months since April 2nd, and a lot of people were scared out of this market. Then people started to chase it. To the extent that people didn't participate, this is what Torsten Slok's got to say on the issue right now regarding the pandemic, regarding Liberation Day, rather, which felt like the pandemic at the time. The US economy remains remarkably resilient, and it's becoming increasingly difficult to argue that we're still waiting for the delayed negative effects of what happened 6 months ago. How many people do you speak to are still being held back, waiting in fear about seeing the consequences of what happened 6 months ago?
I think it's sort of contingent to what Anne-Marie's question was, does it come in 2026? I think people are now saying, does this come in 2026? But there's some level of capitulation that's starting to happen now, because you're just not seeing, you're not hearing it from the companies. And we know that the government data, we're not sure if we can trust it, right? So you now have to listen even more to the corporate side, which is what we've always been saying. And when you look at the conference season, in September, corporates were, saying that things are okay. You're not seeing huge pressures on the consumer, nothing incremental. The lower end consumer, we've known for a long time, has been weak. But the middle to upper income consumer, still has a lot of cash and this wealth effect, right? That they can be able to sustain some of the price increases that we do think will come in a more gradual way. But we don't think that that's going to be any sort of meaningful pullback from those kind of consumers.
As they capitulate, where are they going? Is this all concentrated in tech, or are you starting to see moves elsewhere?
You are seeing a broader now. I do think that from an investment standpoint, it continues to flow into tech, but you're seeing your small cap also pick up. And also, we think a sector that might be interesting for a catch-up here is healthcare, especially after this week. You're getting a lot more clarity on the policy front standpoint with this deal between the administration and Pfizer. Does it serve as a blueprint for more deals? The fact is that most favored nation, right? There was concerns that that could be a broad-based policy. Now it looks like it's mostly concentrated in Medicaid. So that could be a positive for the overall healthcare industry. And the fact is that, valuations are quite suppressed. We've talked about elevated valuation. Healthcare, 25% discount valuation to the S&P.
Nadia, do you take a look at lists like pharmaceuticals, companies that are important for U.S. national security and defense, and start thinking about maybe people should get long on these because the U.S. government might take an outright stake in these companies?
We'll see if that extends to healthcare. So far, it hasn't. But we think about things from a structural growth standpoint, and that's why we do think that healthcare and that national security sort of played in that. Healthcare is also part of that story. Eventually you are going to see from a longevity standpoint. At the end of the day, we have a population that's getting older. We have innovation that could come even in healthcare through AI in terms of drugs discovery, and so we think that there's a structural story happening in healthcare as well. Along with, of course, our most preferred way to pay structural growth is through tech, but we think that healthcare is part of that story too.
When you look at this melt up, some economists are saying, but we can have a higher unemployment rate. Jobs market is weakening. How do you have both? Isn't it so uncomfortable?
We always say, the stock market and the economy are two different things, right? Like, yes, you could have an increase in the unemployment rate. We're not looking at any sort of meaningful increase.
But this administration, basically, their barometer of how well they're doing with the economy is looking at the stock market. Is that a challenge?
Well, if they're looking at the stock market, then they think they're doing great, right? But in all seriousness, from an employment standpoint, we don't think that you're going to see any sort of meaningful pickup in unemployment. And at the end of the day, we know that the Fed is there, right, to help backstop some of that and to help to stimulate the economy. And if we can unlock the housing market, maybe there's a national emergency, I'm hearing, in terms of the housing market. That can also help in terms of, wealth creation, and also to help that cyclical part of the markets and the economy.
Who needs a jobs report? It's good to see you, as always, on a Payrolls Friday without the payrolls. Nadia Lovell of UBS. Let's give you an update on stories worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Well, we are in the third day of a government shutdown. The Senate is expected to hold another vote today on a stopgap spending bill to reopen the government into mid-November. Democrats are holding firm on demands to extend healthcare subsidies. President Trump is threatening to slash jobs at what he calls Democrat agencies that don't align with his agenda. The Trump administration has frozen $2.1 billion in Chicago infrastructure projects. U.S. Budget Chief Ross Vought sharing on X that, quote, the Red Line extension and the Red and Purple modernization project have specifically been put on hold to, quote, ensure funding is not flowing via race-based contracting. The Trump administration has also frozen $18 billion in New York infrastructure funding for, it says, similar reasons. BlackRock's Global Infrastructure Partners is said to be in advanced talks to acquire Aligned data centers. Aligned could be valued at about $40 billion. The deal would be one of the biggest of the year. A spokesperson for BlackRock declined to comment. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, the Morning Calls Plus, Becky Frankowitz of Manpower Group, as we break down the health of the labour market. That conversation up next, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This shutdown is compounding an existing problem, which is that our data is being substantially distorted by tariff developments, front-loading, inventories. On top of that, now we're going to miss probably a month of solid evidence as to what actually happened in there. To us, this is going to raise more questions than it is make it very clear what the definitive path ahead should be.
That was the brilliant Francis Donald of RBC weighing in on what's happening with the jobs market and the broader economy. Going into 8:30 Eastern Time without a payrolls report. A number supposed to drop 15 minutes from now, but of course, not going to drop, not expected to drop because of the government shutdown. Entering day 3 in the equity market. Equity futures positive by 0.1% following 5 days of gains. On the Nasdaq 100 up by 0.14. On the Russell up by 0.45. In the bond market, lots of weak economic data this week, bringing down the 2-year bond yield to the low 350s, 354 right now, just about unchanged on the session. Lower on the week by around 10 basis points. Talked lots about weak data, ADP, the quits rate, manufacturing, the ISM, all of that. But let's talk about strong markets. All-time highs in the equity market, multi-decade tights for investment-grade credit spreads, and we just came off the back of the biggest month of credit issuance for the month of September at least, for corporate debt supply, high yield and investment grade. It's been quite a few months for financial markets, even though we've seen this deterioration start to creep in to the labour market. So that's the price action and the broader economy. Let's get you some single names and some morning calls. First up, UBS, lowering its price target on UPS to 110, saying it's likely on track with prior expectations of a low double-digit decline in domestic volumes. Your second call from Wells Fargo, lowering its price target on Uber to 125, seeing delivery volumes in its Q3 report as key for lowering investor concerns. And finally, Jefferies cutting Apple to underperform, seeing an overly bullish iPhone outlook. A stock is down by 0.8%. Let's turn back to the labour market. The government shutdown halting the release of the payroll data. Becky Frankowitz of Manpower Group, one of the world's leading staffing companies, writes the following. The official jobs report might be on pause, but the labour market keeps moving. And our data shows a market in transition. Becky joins us now for more. Becky, welcome to the show. It's been too long. What are we transitioning from and to what?
Yeah, so first, it's a strange no jobs report, Jobs Friday. So usually we say Happy Jobs Friday, and it is still a Happy Jobs Friday because we see real-time, real-world data. And John, we're watching three trends. First, job hugging is the new job switching. So we're not seeing workers switch jobs anymore. We're seeing them hold on to their jobs. In fact, switching is down 50% in the last 2 years. So workers are staying put. The second big trend that we're seeing is lateral is the new vertical. Employers are holding on to their talent. And so there's this change called micro mobility, where we're seeing people change titles, but not change companies. And the final piece I'd say is growth isn't gone, it's just moved. So we're seeing growth in immediate benefit roles, a lot of growth in the data scientists, database architects, things that are tech forward. And we're seeing some shifts in even manufacturing, where we're seeing blue collar workers like engineers, people who are on the front line in terms of manufacturing starting to grow. Logistics is a little bit soft. Of course, education, retail is showing some strength, but there is still growth. You just have to look harder to find it.
Becky, is there growth in entry-level jobs?
Anne-Marie, it's one of the top things we're watching. So if you said, what are you watching closely? I would tell you impact of AI and entry-level jobs. We are seeing reduced demand for the educated, yet inexperienced. And that is people coming out of college. So employers are prioritizing people who have actual experience because, again, they want immediate impact. Employers aren't hiring to develop people. They're hiring to actually get benefit from their hires today. And that is impacting our entry-level professionals.
Historically, what kind of time can you reckon this back to? When did we see such a weak environment for entry-level jobs?
Yeah, it's been a long time, Anne-Marie. We're not in the 2008 stage yet, which was a huge crisis, but we are seeing a drop of about 6% in terms of the demand for entry-level jobs. And it's coming at the same time. The overall job market is continuing to cool. It's not just cooled, it's continuing to cool. We see total jobs posted. Again, I don't need BLS to tell you this. We look every day. Total jobs posted have dropped under 7 million. It's always been a 7 million mark, under 7 million, to the lowest level in 4 years. And we're seeing this overall slowing in jobs, and we're seeing a change in the kinds of jobs people are hiring entry level. And in part, it's a bit of wait and see on AI. I heard one of your prior guests talk about that. It's a bit of wait and see, but it's also a bit of economic uncertainty causing me to prioritize today versus tomorrow.
Becky, can we just pick up on the AI point? Where are you seeing that? How's it showing up? And how do you draw a distinction between what is driven by AI and what's driven by traditional, broader economic concerns?
Yeah, well, it's hard to break apart, John, if I'm honest, but I'll tell you what the data is showing us. And the data is showing us that tech-forward roles are surging. Again, database scientists, data architects, anything on security is surging today. Of course, we've seen some softening in software developers, but guess what? Back to entry-level roles, it's still one of the top 3 entry-level roles. It's down almost 50% year over year, but it's still in volume one of the top 3. So we're seeing a pretty balanced view on AI right now. Employers are still telling us that if they're more tech forward as an employer, digitizing faster, they're intending to hire more. We're waiting to see that play out. But right now, I would say we're seeing a balanced view on AI, but there is a lot of wait and see on the promise of the impact of what AI can give our economy.
So, Becky, are you seeing any supply side issues? Because the big debate on Wall Street is, yes, we've seen a step down in payrolls growth, but we've also seen a step down in supply. And the economists will come on the program, and some of them disagree with each other. Some might say, this is bad, we need to respond to it. Others might say, well, this is a supply side story. Yes, you've had a step down in payrolls, but you've not had an increase in labor market slack. From your standpoint, is there a supply side issue? Do you see that showing up in the business?
Yeah, we're not seeing significant supply side issues, John. What I would say we're seeing is a bit of, and I'm not using it economically, a bit of stagnation in terms of mobility. People are staying put. And when people stay put, it is harder to free up some of the supply to actually generate this transition that normally underpins our economy. When I tell you that job switching's down 50%, 50 in the last 2 years, that is significant. And that's not having an impact on overall supply, but it is having an impact on mobility, and mobility generally leads to growth in our economy.
Does this mean workers are not asking for higher wages?
Yeah, great question, Anne-Marie. What we're seeing now, again, during the heights of the pandemic, we saw huge bonuses for switching jobs. We're seeing that level has dropped below 7%. So the premium on switching a job in terms of your pay increase traditionally runs around 7%. We've seen that now drop to about 6 3/4. So we're not incenting people to move, and we're seeing an increase in people who stay put. So I'm telling you, this whole idea of job hugging is real from the employee view, and this idea of lateral, not vertical, giving titles and a little bit of pay is real from an employee point of view. So they're coming together in a way that people aren't moving.
Workers that are able, though, to move structurally higher in an organization because they moved an organization, what sectors is that happening in?
Yeah, so Anne-Marie, we're seeing only 2 sectors. We're seeing this increase in switching, if you will. That is construction, and that is in the financial markets. And you've seen the headlines on the financial analysts that are switching all over New York City. So those 2 roles still have quite a bit of agency, and we are seeing switching there. But for the others, we're really seeing people stay put.
So, Becky, we've been in this low churn dynamic in the labour market for a while now. Economists have been talking about it on this programme. You have too. When things break one way or the other, we're always looking for that early indication. Now, correct me if I'm wrong, I think you used to lead Quaker Foods. When you oversaw that business, Becky, what kind of behavioural changes were you always looking out for a leading indicator of which way this economy was about to break?
Yeah, so John, you're taking me in the Wayback Machine now. We would look at number of items in the basket, and so how many goods are people buying, trips to store, average purchase price that you're actually putting in your basket. And I know now from the jobs market report, or what we see in terms of people actually hiring, who's hiring today? It is the cost-conscious consumer companies that are hiring. Domino's is hiring. Lowe's is hiring. So we're not seeing the high-end retailers hiring. We're seeing the more accessible retailers hiring, which tells me, in terms of early indicator, people are still very cost-conscious, uncertain about what's coming, and holding on to their dollars like they're holding on to their jobs.
Becky, this was great. Let's do it again soon. It's good to see you. Who needs the jobs report when you've got Becky Frankowitz of Manpower Group to go through what's happening in this labour market?
Totally agree. And what she's talking about is what we've heard from a lot of people. I just love the term she used in terms of job hugging. That's basically what Neela has been talking about for months at ADP. This idea is it's paralysis in the labour market, low hiring, low firing, and people just want to stay currently in place.
Saw it in the quits rate as well in the job openings report earlier this week. And these things can feed on themselves, that negativity. If you start to feel like that about your job, it can influence the consumer behaviour. The good news so far is we haven't seen a decline in retail sales. In fact, coming out of the summer, retail sales actually picked up. So again, we're in the same point. Which way is this going to break? It's a huge debate about that right now.
Individuals are still going out. They're still going out and spending. I think what's so concerning about the labor market, and Governor Waller has talked about this, is individuals who are graduating college, entering the job market. When I entered the job market and I graduated college, the unemployment rate was 9.2%. And that is a scary place to be. And on top of that, what individuals now are dealing with is this concern that maybe AI is just going to take their job.
It's not where we want to be, that's for sure. Futures are positive by 0.1%. This market keeps grinding higher. Equities at all-time highs. Up next, Seth Carpenter of Morgan Stanley.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Live from New York City, 25 seconds away from the payrolls report. Just so you know, just want to get there and it's not happening. It's not happening. Your scores look like this. Equity futures positive by 0.1% on the S&P, and the Nasdaq up by 0.1. The opening bell about 60 minutes from now. You're still kind of on jobs report watch, aren't you?
Yeah, I keep refreshing
Just
Donald
in
Trump's Truth Social.
I can tell you the estimate's 53K. The previous number was 22, but we're not expecting one because of the government shutdown. We'll see if we actually get one, but not expecting one. As we count you down to the opening bell in about 60 minutes' time, let's get you some single names, some morning movers. It's Danny Berger. Hey, Danny.
Hey, John. This is where the excitement is, maybe. Apple shares declining this morning. A downgrade from Jefferies to underweight. They had it on hold before, saying that there was excessive optimism about the refresh cycle for the new iPhones, that essentially they kept prices as is, which is maybe why they're generating some excitement about it, but also that there would be lower prices in effect for the base 17 model. And all of that is already in the price, but just too much enthusiasm, they say, in the valuation. So shares down 0.8%. Elsewhere, Applied Materials continues to fall this morning. They issued yesterday a filing saying that the Trump administration has, specifically the Commerce Department, has expanded their restrictions on exports to China. They, of course, make the machines that make chip makers. So those shares down 2.3%, just under that, as they expect a $600 million hit to their fiscal 2024. Finally, rounding things out this morning with USA Rare Earths, a CNBC report that they've been in conversations with the Trump administration about a potential deal. So those shares surged 12.8% after a string of other deals with rare earth mineral producers and the Trump administration, John.
Danny, thank you. Appreciate it. Thanks for this morning. More from Danny in about 30 minutes' time, alongside Matt Miller for Bloomberg Open Interest, counting you down to the opening bell about 59 minutes from now. No payroll data so far today. Not expecting any because of the government shutdown. Joining us now to discuss is Bloomberg's Mike McKee. Mike, it's an odd one, isn't it? We haven't done this for a while. I think the last time was 2013, was it, to have a delay like this?
Yeah, because we got the numbers in 2019 when they were shut down. It's kind of weird because Jobs Day and you go to Danny first.
It's not personal.
John, well, we have disappointing news for you in terms of the jobs report. No jobs created or lost because we don't have any data. As you mentioned, the government shutdown. If we had data, it's hard to know exactly what it would have been because the alternative data sources that we look at have very different views. The Bloomberg consensus was for 53,000 jobs. Revelio suggested we'd get 60,000. ADP suggested we'd lose 32,000. So who knows? The Chicago Fed unemployment proxy, 4.3%, would have suggested no change. So if the Fed goes with that, they'll probably be okay. And I want to point out that all this comes from WSLALTE Go on the Bloomberg. That is where you can find a huge long list of alternative data, and everybody's looking at that these days. We do have to worry about going forward where we go from here because everybody has to have something to trade on. The shutdown delays the CPI report on October 15th, maybe. That would not be good for the Fed or for futures trading. And if we go too long into October, the jobs and CPI data collection could be imperiled because we won't be able to collect that data if there is nobody to collect it. We could also see unpaid contractors under the shutdown start widespread layoffs. And of course, we have this threat of Trump firing thousands more federal workers. So the labor market, you could safely say, I think, is in turmoil at this point. Danny said Apple is where the excitement is today, and so go with that because we haven't got it in the labor market at the moment.
Mike, do you think that NEC was given the labor market report, though, yesterday, as they normally are?
No, they wouldn't be under the circumstances because nobody is at the Labor Department or the BLS to give the report to the commissioner. The commissioner gets it on Wednesday, and the government was shut down then, so it would not have been transmitted over to the White House.
Mike, looking forward to your conversation in about an hour from now. I think it's at 9:30 on Bloomberg TV with Governor Myron, the man of the moment on the FOMC. Mike, what have you got in mind for this conversation? And what have we learned so far about how the Fed's going to guide itself towards this big meeting at the end of this month if we don't have this data?
Well, what they're going to have to do is go with their best guess and go with what they think they have learned from talking to CEOs and companies around the country in terms of where we're going. The general feeling in the markets is because there is no data, they don't have a reason to change their view that they were going to cut rates in October. As for Stephen Myron, we'll have to ask if any of this changes his view, especially the idea of a very low neutral rate if the government can't show us what any of the inputs to those models are.
Mike McKee, thank you, sir. Looking forward to the conversation, 9:30 Eastern Time. Michael McKee, alongside the man of the moment on the FOMC, Governor Stephen Myron. Joining us now to discuss, Seth Carpenter of Morgan Stanley. Seth, this is so peculiar to have this conversation on a day without data. Can you describe what your conversations have been like with clients this week?
Yeah, a little bit all over the place, but actually drawing off of what Michael just said, that there are other data sources people could look at, and he characterized the numbers as being all over the place. I agree with him from a negative number for ADP to the positive numbers either for the consensus or the alternate measure he showed. I think, though, if you take all of the numbers that were up on the screen just a couple of minutes ago, none of them is especially strong. And so I think the key thing we do know is that the labor market has slowed down a lot this year. There's no sense in which it's quite strong. And so right now, I think the real key tension, intellectual tension with any of the data that we have and that we know about is that spending data has been holding up. Labor market data has been quite soft, whether it's negative as in the ADP or very slightly positive by the other measures. I think the real tension is how is it going to resolve itself, this very, very soft labor market against persistently resilient spending data. Historically, I would say labor income tends to be a fundamental driver of aggregate spending. And so in our forecast, this tension gets resolved with spending coming down. But that's going to be a really key question for markets, I think, over the next couple months.
Seth, even trying to predict the future, can we talk about how this has happened? Clearly, the economy is not as strong as it was. On the labor market side, people are anxious about their jobs. So we can see that in the data. Consumer confidence is low. They don't think jobs are plentiful. You saw that from the conference board earlier this week. The quits rate has dropped. That speaks to a little bit of anxiety as well about the labor market. But retail sales coming out of the summer, bang, pop. Seth, what explains that?
I think we've just seen lots of swings back and forth in what's going on in the economy, people's confidence in the economy. We know, for example, that immigration restriction has had a meaningful effect, and that's reducing both the supply of labor, but, immigrants are also a source of demand in the economy. And so the net effect, is it more supply or demand that dominates? That's a question for the price outcome. Is it going to be inflationary or not? How inflationary will it be? But in terms of quantities, in terms of economic activity, it's unambiguous. That's got to be negative for overall economic activity. So I think that's part of the slowdown. For spending, though, we have to remember the top end of the income distribution does a disproportionate amount of the overall spending in the economy. And we know that the top end of the income distribution is actually doing quite well. Wealth effects are higher, among other things. And so I think there's definitely some momentum going on there with the consumer, especially at the top end. What remains to be seen is how sustained that can be when we get more and more time in with these tariffs. Remember back in 2018, it took about 2 quarters to 3 quarters before we saw the real drag on the economy from the tariffs. So I think we're still in the early innings with the drag on the economy from the tariffs.
Seth, is it momentum because they have this money to spend, or is it angst because they're worried about prices going up because of the tariffs? And I say this coming from a family that was doing Christmas shopping in May.
Great question. And if I go back through the database of periods of really high inflation over the past 35 years, oh wait, we don't have a lot of experience with this. I think it could be some of everything. And there's no reason for us to choose one versus the other. When there is this disconnect, though, between current spending and the trajectory of the labor market, I think the evidence suggests we should expect the labor income reduction to eventually win. And so that's why we're thinking the strength in spending is temporary, not going to be sustained for the rest of this year and into next year. But it's a real puzzle.
If you don't think it's going to be able to be sustained for the rest of this year, what kind of Christmas sales are we going to be looking at in holiday spending? Are people just going to hit a little bit of pause?
I think that's a real possibility, and we are looking for Q4 of this year and Q1 of next year to be the real slow points in terms of quarter-on-quarter growth. But Christmas, it brings back the same sort of questions that you brought up. Did people front load Christmas shopping, in which case you'd expect weaker spending? Or is it possible instead that with people feeling anxiety, they try to make themselves feel better by having a better Christmas? This is one area where, as macroeconomists, we have much less visibility, and we at Morgan Stanley try to connect with our colleagues in the single name equity research space to try to get a better read from the bottoms up from the actual retailers themselves. So this is going to be a question I guarantee you over the next month or two is going to be absolutely critical for us.
Seth, just before you go, I don't know if you saw the note that came from Torsten Slok of Apollo earlier this week, where he said the economics profession needs to take a long, hard look at itself in the mirror, that this economy has been much more resilient than people thought, and betting against it ultimately has been a fool's errand. He says later on in the note, he talks about waiting for something that happened 6 months ago to see the consequences of it. Do we need to question that a little bit more, Seth? That's what he was alluding to. How are you thinking about this process that you and I have discussed now for 6 months? Are we just waiting for the consequences of something that happened a long time ago, and we'll just be sitting here waiting and waiting? Or are we actually going to start to see real signs of it in the months to come?
No, it's a great question, and Torsten always is very thought-provoking. I've actually known Torsten now, I realize, for 30 years. I looked in the mirror really hard, and I wanted to look more like Jonathan Sparrow, and so here we are. It's a great question. I'm an egg-headed, academically trained economist. I try to look at things through statistical models in addition to lots of other ways. There's the famous saying about monetary policy working with long and variable lags. I think all the estimates there is it takes 2 or 3 quarters before a monetary policy shock hits the economy, and 2 or 3 quarters after that before it hits inflation. We are used to, as a profession, thinking about these long lags. We don't have anywhere near as much experience with tariffs, and so that's why we try to go back to the evidence we have from 2018, 2019. And the evidence there was it did take a couple of quarters, and then the effects were very long-lived. Manufacturing, industrial production data, manufacturing employment in the U.S. got hit when the tariffs were in place in 2018. We saw the fall late in 2018 there, and it continued to contract all of 2019. So it was a very, very, very long-lived process. That's our base case this time around, but could we be wrong? Absolutely. We are trying to use all the available information, but these are very difficult circumstances to forecast in.
Seth, it's good to see you. And just for the record, you wear it so much better than I do. Seth Carpenter of Morgan Stanley. Seth, thank you. Good to see you, buddy, as always. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. A senior Hamas official says the group will respond to President Donald Trump's plan to end the war in Gaza, quote, very soon. The official said Hamas rejects a take-it-or-leave-it approach to the proposal. He added the group will not accept the surrender of the rights of the Palestinian people after all their sacrifices. Bridgewater Associates' flagship macro fund surged 26% in the first 9 months of this year. Sources telling us here at Bloomberg that the hedge fund is on track for its biggest gain since 2010. Overall, hedge funds have seen strong gains this year, driven by surging U.S. share prices and volatility spurred by President Trump's tariffs. A Rolex worn almost a century ago by the first British woman to swim the English Channel will be up for sale. Mercedes Gletzke's Rolex Oyster is considered to be the world's first practical waterproof wristwatch. The watch could fetch over $1.3 million at Sotheby's auction in Geneva, November 9th. That is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, we'll touch base with Jeff Rosenberg of BlackRock from New York City. You're watching Bloomberg TV.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We've been in this low hire, low fire labor market. I wouldn't just say because historically it hasn't mattered. If it starts to actually, there are layoffs here, I think we have to start thinking that the labor market's much weaker. We're already a little fragile.
That was Priya Misra of JP Morgan. Just as equities turn flat and unchanged on the session so far, just about going nowhere. Likewise on the NASDAQ 100, the Russell 2000 just about positive by 0.2%. As we count you down to the open about, it's about 43 minutes away. Your trading diary into the weekend and a sneak peek of next week looks like this. At 9:45 Eastern Time, the PMIs. 15 minutes later, ISM services. That's the big data point really now going into the weekend. Plus then you've got a Senate vote at 1:30 Eastern Time. The government's still shut down, likely to be shut down going into the weekend and coming out the other end next week. Next week, we're looking for the following. I don't know what we will get and won't get, but the trade balance is due on Tuesday. Wednesday, Fed meeting minutes. Thursday, Delta earnings, plus we are due for another round of jobless claims. And on Friday, UMich consumer sentiment into the weekend, and sentiment has been soft.
Sentiment has been soft. I think the only thing really there that's most interesting to look forward to, if we're likely going to be in this shutdown, is the earnings. What is a company like Delta saying in terms of where they are with consumers? We know that the high-end consumers, the business class, they continue to spend. But also, are they seeing issues with the government shutdown? Is the FAA having issues in terms of whether or not these airlines are delayed and how that's working around the country? So I think that's going to be actually the most interesting data point.
Based on the economic data so far, not great. But based on what we've heard from the airlines, things are pretty tremendous, arguably because of what's happening with the upper-income consumer. We heard from United, Delta. Anyone that Bramo speaks to in the airline space at the moment is basically telling her things are pretty good at the high end.
They're pretty good because of the high end. And the high end is basically lifting all boats when it comes to the airlines. The issue is the airlines that are catering to some of the lower-end cohort not doing as well. But the Delta, the American Airlines, JetBlue, they're pretty doomed.
Let's get you to the opening bell. Let's turn back to markets. So the S&P 500 is looking for a 6th consecutive day of gains. It's on a 5-day winning run, the longest streak going back to late July. Jeff Rosenberg of BlackRock has this to say: we believe the current market backdrop masks the high level of dispersion embedded within the economy today. Jeff joins us now for more. Jeff, welcome to the program, sir. No payrolls. We're going to have to get knee-deep in all the other stuff. Jeff, I think that what you just said in that quote kind of builds on what we were discussing with regards to the airlines. How much dispersion are you seeing?
Yeah, this is really about the difference between what you're seeing on the top line and the headline and what's going on underneath. And we've talked about it a lot. You know, when we do have payrolls or when we do have FOMC meetings, when Tom's with us, we talk a lot about the K-shaped recovery, about the differences between something you were just talking about, the top end and the bottom end. And you see that both for consumers, but also within businesses. You have the winners and you have the bottom end that is struggling. And that is the recipe for dispersion. And so when you take away kind of the big headline that we might have been talking about today, which is this good for the economy, bad for the economy, are stocks going up, stocks going down, you go underneath the surface and there's a tremendous amount of churn going on underneath. And that, when you take away kind of beta investing and you focus on alpha investing, has created a tremendous amount of opportunity. And you see that in some of the returns that look at, say, factor returns, stripping out kind of directionality in the markets.
When you joined us in July, you were talking about a tricky environment ahead for the Fed. How tricky is it now that they might miss an entire month of data?
Yeah, so if we shift back to kind of the data problem, it's tricky for the Fed, it's tricky for us in investors. You know, I was going to suggest that, you know, if we wanted to look at, and maybe your producers can do this quickly, the one area that might be benefiting from this lack of data is interest rate uncertainty. So maybe put up a chart of the MOVE index, which has collapsed here. But you look at kind of what we've been talking about this morning around the lack of data, and you have a lot of disagreement. The good news is you've got a lot of alternative data, but kind of the bad news is none of us can agree as to what that alternative data means. A good example is, I saw this morning 2 different estimates from alternative data, one using state filings, the other looking at extrapolating initial claims forecasts off of Challenger layoffs. They came up with completely different conclusions. Another example, in the earlier segment, you were talking to Manpower, talking about switchers and the lack of switching, but you look at the Atlanta Fed wage data and, you know, switching wages actually went up a little bit. So in the cacophony, I think the benefit might accrue to uncertainty, although that doesn't make the Fed's job any easier.
Well, if you had to decide what your top 3 data points were, what would they be?
You know, when we're talking about the payroll data and the lack of payroll data, you know, I'll turn to the wage data and looking at inferences from that. We have the Atlanta Fed wage data. We have a lot of private sources in terms of what you can scrape. I'd like that alternative data. We've used that a lot in terms of both frequency and turning points. So that would be, you know, kind of data point number 1. I think, and Jonathan, you made reference to this earlier about the inflation data and, you know, whether we're going to start to lose some of that. I think the good news there is that with the web scrape data, we have a lot of kind of consistency around what people are looking at in terms of alternative forms of data. People talk about the price stats data. I think that's a good form. And then I think the pivot to the private data that you mentioned, where we hope we'll continue to get that. The survey data, the PMIs, they take on a heightened, importance in this environment of the lack of the government data. We have to caveat that with the notion that the kind of accuracy that we've seen from the survey data, the PMI data, in terms of its importance for this kind of economy, that's really kind of gone down, and we've seen a decrease in the correlation between the PMI data and say the industrial production data in this cycle. So that's sort of a caveat to that third data point.
Jeff, we've talked about 5, 6, 7 minutes about economic data. If I'd given you the payrolls data at the start of the year for the next 9 months, I think you would have traded this market in completely the wrong way. So I just wondered, Jeff, what is the relevant data point right now? Because clearly some data is more important than others.
Yeah, that's absolutely it's absolutely the case, and it's the classical sort of break between kind of growth and inflation, and the pivot as to which one has the focus of the market. And going into before we had the shutdown, the other conversation would have been that this is the pivot away from the inflation concerns towards the growth concerns, and that the kind of top tier data point on payrolls is giving us that read on the growth, and the Fed's pivot towards a focus more on the growth and less on the inflation. And I think that's kind of the read here, in contrast to the beginning of the year where the focus was on inflation, the impact on tariffs and tariff pass-through. We really shifted that focus. And I think that's really the driver behind the directionality here in interest rates, really the fear and the concerns to your earlier conversation with Seth Carpenter. And the lagged effect. Remember, the tariff impact that Seth's talking about is not about the inflation piece, but it's on the real wage piece, that the temporary, even if it is temporary impact in terms of the inflation from tariffs, its impact is on real wage growth, and that's really about the growth side, and that's what's driving the rates markets right now.
Jeff, love catching up with you. It's just a bit odd without payrolls data, isn't it? It's kind of strange.
It is odd. Hopefully we'll get that back soon.
And when we get it back, we'll get you back, sir. Jeff Rosenberg there of BlackRock. Jeff mentioned the MOVE index, bond market volatility getting absolutely crushed. He's trying to produce the show now. The control room can respond. Here's the chart. This is what it looks like. It really has grinded lower as this year has progressed. That's been a steep, steep drop-off ever since the April 2nd Liberation Day story. I cannot believe it's been 6 months since then. I've said that a few times this week. That has been a blur. Think about the summer. July, August, September just zipped by.
Yeah, absolutely. This year has been like 10 decades in 1 year, and the year's not even over yet. And now we're dealing with a fresh amount of uncertainty in terms of, are we going to have a government that is operational, working? Will you be able to get to your flights on time? Will our men in service, women, get paid? These are a lot of questions going into the weekend. 1:30 is going to be interesting. Any Democrats, moderate Democrats, start to flip and vote with the Republicans to just keep the government open?
Has there been enough pay net generated to tip them over the edge, over the line?
Not yet, but I think next week there will be. You have to watch the senators in Virginia and Maryland. This is where the furloughs are coming from. All 8 of them, 4 of them are Democrats, so they have an opportunity there to push this over the edge.
When's the next game?
Saturday.
Saturday.
Blue Jays. Let's
Okay,
go.
all right.
Cheers.
Long weekend for you then, right? We'll see you Tuesday.
Exactly.
Okay, good for you. All right, coming up on Monday, we'll be here. Andrew Sheets of Morgan Stanley will be too. Paul Donovan of UBS, Amanda Lynham of BlackRock, Lindsay Piazza of Stifel. From New York City, thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
In case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs? And you're lowering the cost of the meatballs,
I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We're actually running today about 40% of our sales is actually vegetables and plant balls. And personally, I don't love the vegetables, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Another rally on our hands to end the week. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, the global stock rally continues, a 6th consecutive day as another round of big-ticket AI deals and partnerships stokes fresh optimism.
Goldman CEO David Solomon adds to that optimism. He tells Bloomberg that the U.S. economy will accelerate next year as the tech spending picks up.
And the view from the Federal Reserve. Fed Governor Stephen Myron joins us live here in the studio at 731 Lexington Avenue as the government shutdown enters day 3.
A conversation you don't want to miss, again, to your point, happens in about 30 minutes time. But ahead of that, we do have some stocks on the move this morning, Matt. Applied Materials being one of them, down 2% in the pre-market trade. They're warning that U.S.-China trade restrictions will cost the company in the coming quarters. Specifically, they said it's going to lead to a $600 million hole in their fiscal 2026 revenue. Of course, Matt, they make the machines that make chips, hence why there's some restrictions on what they can sell to China.
All right, well, one company that doesn't have those restrictions is Tesla. They want to sell as much to China as they can. The shares are rebounding after actually closing down more than 5% yesterday. Remember, third quarter deliveries blew past estimates, but traders are concerned about future demand and perhaps the China concerns playing a role in that as well. Nonetheless, we have the shares back up more than 1% in the pre-market at 441, Danny.
Still, it is a day, another day, I should say. Every day feels like a day where there's some sort of AI deal happening. BlackRock's global infrastructure partner is in advanced talks to acquire Aligned Data Centers, which could be valued at $40 billion. Goldman Sachs CEO David Solomon says that these announcements are driving the U.S. economy.
Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds. Second big macro phenomenon that's affecting the U.S. economy is all of the AI infrastructure build, all the capital spending, all that's going into the ground to support the deployment, the development, the continued growth of AI infrastructure into the enterprise, and that's a big tailwind too.
Jeff Bezos also weighed in on the AI spending. He says what's happening right now is an industrial bubble akin to the biotech bubble in the 1990s. He thinks it will ultimately pay off, and, quote, the benefit to society from AI are going to be gigantic. Joining us now is Bloomberg Tech co-host Ed Ludlow. I'm not sure if Bezos knows what a bubble is, if he says
also,
it's going to be a
isn't
good
Jeff
bubble.
Bezos and Amazon like one of the biggest builders of all this stuff? I don't really understand that. Sorry, keep going.
Well,
I was
maybe,
like, what?
I think his assumption is that Amazon's not a loser, but everyone else is. But there has been day after day
I'll run
deals.
some checks on that. I don't know. But, you know, like the BlackRock GIP story is really important, and the specifics of it too. So they would acquire this entity with a $40 billion valuation, but look at the people that in parallel would take a stake, which is basically the same characters that keep coming up from the UAE in this case. They've also already taken quite significant investment from Macquarie. What Aligned does is it does the building and location and management of the building of a data center. Like when I say the building, I mean literally the box, right? And the thing that we need to understand about this story is that there are all these forecasts. The one you might be familiar with is $4 trillion market, but that's just for the compute over the next sort of 4 or 5 years. If you include the concrete, the materials, the labor, the electricity supply, the cooling, the water, that's another $3 trillion. And this story is a clear example of Wall Street and legacy finance kind of moving to be ready for the non-compute part of the story.
I think Jeff Bezos does know what a bubble is. I'm looking at the stock right now from 1999 and the 95% drop into 2001.
Yeah. Ouch.
I mean, he was there for the first internet bubble, right? He was a survivor. Amazon's definitely a survivor and a winner. But there was a circular spending problem then as well. You know, there was an overinvestment problem then as well. We paid way too much to lay fiber, which wasn't really utilized for the internet boom until years later.
Also, analogous, debt was a big part of that story with fiber. Debt's quite a big part of the story now with data center.
Right. So do you hear people drawing parallels to the 1999 internet bubble with this sort of AI build-out?
Spoiler, my newsletter on Monday is about this, you know, and I think what's so interesting is that the only argument is that whether or not you believe top-line growth at software companies, the end customers of all of the AI development, justifies the initial investment or the debt levels. And there are loads that are sanguine about it and would say yes, yeah.
There's a lot of complications, though, in trying to figure out who the winners are. Also because just chip making in general, chip makers have done so well, but there still is exposure to the geopolitics, and Applied Materials underscored this last night. It's still a difficult environment to navigate who does well and who doesn't, and who's subject to policy and who's not.
So the story here, through a regulatory filing, is Applied Materials telling us that the Commerce Department and BIS has expanded the export restrictions, catching more of Applied Materials business, and it will have a $6 million impact to net revenue. When you manufacture a semiconductor in a clean room, all of these companies represent a different stage of the process. Applied Materials is right at the beginning with the wafer layer when you're trying to layer it up, and right at the end when you're polishing it. And then in between, you've got ASML, Lam Research, etc. The Commerce Department's argument is that if Applied Materials is able to go into China, then a SMIC or a domestic manufacturer fab will be more successful. So they want to restrict that technology. I would note that, like the downward pressure on the stock, Applied Materials has had a string of quite disappointing announcements that the street's getting a little bit fed up with. But I just think it's worth understanding, like, where Applied Materials sits in the process of building a chip. It's really core to it. And it's America's biggest chip equipment maker. So this is a policy thing. And the chances of the Commerce Department and BIS changing on that front, you know, who knows?
You don't have to wait until Monday, until his newsletter, to get more from Ed Ludlow. He is the co-host of Bloomberg Tech and will be anchoring one final show from here in New York before he gets into his first-class flight back to San Francisco. Now, large hedge funds are seeing their biggest gains in decades due to the global market rally. Bridgewater's flagship fund is on track for its biggest gain since 2010, up 26% in the first 9 months of the year, crushing the market. Bloomberg's Nishant Kumar covers hedge funds for us here at Bloomberg, joins us at the desk. You visiting from London, great to have you here. I'm so happy that we can talk about a hedge fund that's outperforming even the S&P 500, because normally we have to make all these caveats that that's not their benchmark, right?
Yeah.
But they're doubling it.
Let's still say that that's not the benchmark. Yeah. Of course, Bridgewater, as you said, is having its, or on track to have its best year in 10 years, but it's not only Bridgewater. If you look at our table, which is of course not comprehensive, and these are just the first look within the first 2 days of the month, you have macro fund, you have credit fund, you have a systematic fund, you have multi-strategy. So all sorts of...
And a couple at the bottom who just bought SPYs, right?
Yeah, but all sorts of relevant strategies are firing up, right? So it's in hedge fund, it's never about hot and cold, market for these hedge funds. You go to hedge funds to avoid that temperature differential. It's not about getting burnt or freezing to death. You are looking for a perfect spring throughout the year.
But what has been working? Because you could make the argument that just buying and holding has also been an outstanding strategy this year, whether it be in credit, whether it be in stocks. So what are they doing to add extra alpha when beta already looks fantastic this year?
Yeah, so the bulk of the portfolio for an institution, you can go to beta, but this is about, what happens if the market crashes? What happens if 2008, which has been a very long time, and the history of markets will tell you that this time it has gone for too long, actually. So periodically it happens. What happens during those periods? That's why you buy hedge funds.
Well, and I mean, that will be the more interesting look, right? Seeing them outperform in a good year isn't as impressive as seeing them outperform in a crash. And it doesn't have to be 2008, it can be 2022.
Yeah, absolutely. We'll see. This year has not been easy. Yes, on a net basis, you can say, but there has been a lot of volatility. So you have to look these returns from that angle as well.
Gotta justify the 2 and 20. Nishant, thank you so much.
Not only 2 and 20, now it's passed through, so it's well beyond 2 and 20.
Oh boy. Well, you have even more justifying to do. Nishant, thank you so much for joining. Nishant Kumar visiting us from London. Now, the fallout from First Brand's Chapter 11 bankruptcy filing earlier this week is hitting Swiss banking. UBS faces over $500 million of exposure to the auto parts supplier through various investment strategies. For more, let's get to Bloomberg Finance editor Tom Metcalf, wrong Tom, in London. Tom, we have First Brands filing for bankruptcy, and the players are coming out as to who's exposed. What are we understanding about UBS's exposure?
Yeah, it's really interesting to run through this $500 million exposure. The real big headline there is effectively its hedge fund solutions unit, just going back to what Nishant was just talking about. They're not probably going to have the best quarter because they are sitting on about $233 million unsecured relating to basically supply chain financing they were given to First Brands. So that's the kind of standout for me. Also, the hedge fund unit, O'Connor, is also sitting on, I think it's about $133 million. That's been sold to Cantor Fitzgerald, but again, unsecured. So you'd expect, looking at the headlines, there's going to be some very heavy losses held by those people. And then you go down into the more secured stuff, where it's not quite clear how much will be got back. But for me, the interesting thing is UBS, kind of a bellwether wealth manager, finance manager, and you're expecting quite a few of their wealthy clients have probably been put into this, and they will, I imagine, not be too happy with their relationship managers.
They also, I believe, and correct me if I'm wrong, Tom, are one of the firms that's supplying the lifeline to First Brands. We're going to talk to another one later in the program. How much do they stand to recoup if that lifeline is successful and this company, although it's in Chapter 11, somehow comes back?
Yeah, it will come down to obviously how much they've secured. I think they're part of a group with about 1.1 billion, kind of in secured elements. So that'd be intriguing. And I think that's the thing. They're on all sides of this deal, which again just speaks to just how far these kind of private credit, these kind of off-market deals have sort of extended to now.
All right, Tom, thanks so much for joining us. Tom Metcalf joining us there out of London. In the next hour, by the way, we will speak with Sinjin Boran, portfolio manager at Beach Point Capital Management. Beach Point is another one of the lenders in that group providing a lifeline to First Brands. Coming up, Democrats are ignoring the White House's threats that they're going to make major cuts in government agencies and funds. We'll head to Washington after the break, talk about that. Plus, later this hour, a conversation you do not want to miss. Fed Governor Stephen Myron joins us live in the studio at 9:30 a.m. here in New York, right after the opening bell. This is Bloomberg Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Getting out of high interest, a look at what's making headlines around the world. Apple is getting downgraded to sell at Jefferies, a rare bearish rating on Wall Street. The analyst says the stock price is already baking in a dreamy iPhone story and that the expectations have gotten ahead of reality. In essence, Apple will make a beautiful foldable phone, but how many people are really going to pay $2,000 for it? I assume that's a direct quote from the note. Boeing's flagship 777X jet is facing yet another delay. It's not as expected to fly commercially until 2027. That's at least a year later than planned, and analysts say it could trigger billions of dollars in accounting charges. The setback piles onto more than $11 billion in overruns for a jet seen as critical to Boeing's long-haul flight, I should say fight, for flights with Airbus. And the Trump administration is escalating its shutdown tactics, freezing over $2 billion for Chicago transit projects. The White House budget director says the money for the city's rail lines is on hold, part of a broader push to cut federal spending and block what he called race-based contracting. It follows earlier suspensions of $18 billion for New York City and $8 billion for clean energy projects in Democratic states as the standoff over funding grinds into a third day. Earlier this week, Vice President J.D. Vance denied the moves are politically motivated.
We're not targeting federal agencies based on politics. We're targeting the people's government so that as much as possible of the essential services can continue to function. That is the question the president has asked the entire government.
And probably worth pointing out that President Trump put on Truth Social almost verbatim that he was looking at Democratic agencies to cut. So difference in language there. Let's get the details with Bloomberg editor John Harney in Washington. John, first just an update. Where do we stand? Does it seem like we're any closer to moving past the shutdown?
Well, in a word, no. The Senate plans votes this afternoon on both the House-approved so-called clean temporary funding measure and also a Democratic counterproposal that would address lapses in health care funding, and particularly the subsidies for people who want to get health insurance through the Affordable Care Act or Obamacare. Both these measures, however, are expected to fail, be defeated, and no votes are scheduled for over the weekend. So this is almost certain to drag on until next week. And the House, by the way, has been off this week.
I wonder about the reduction in federal workers. This was a campaign point for President Trump and something that, DOJ attempted to do with limited success. Why not, avoid the politics and don't bother making threats, but take advantage of this situation in order to really reduce federal headcount? Why doesn't President Trump, why doesn't Russ Vought go out and actually do that now rather than continuing to use it as a threat to Democrats?
Yes, and this threat and these ultimatums have only intensified the determination of both sides, Republicans and Democrats, and given them less room to maneuver. Because any sort of concession would be seen as a defeat. Now, as to your question, it's unclear at this point. I mean, there apparently is debate within the administration of just how sweeping any layoffs, dismissals could be or should be, and also the Doge campaign earlier this year was not terribly popular with voters. And, of course, the midterm elections are even closer now than they were, say, in January, February, and March.
All right. John, great to get your take. Really appreciate you joining us from Washington, D.C. John Harney there from Bloomberg Editorial. Now, while official government data is delayed, remember, it is Jobs Day, but we're not getting the non-farm payrolls report. Investors can see the labor market shifting, what looks like the labor market shifting into lower gear. A number of private sector indicators have in recent days pointed to sluggish hiring, limited layoffs, but sluggish hiring, modest pay gains, but easing demand for workers in September. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. So, Mike, we're looking at ADP, we're looking at Challenger, because we're not getting any BLS data, and I guess what we see is not a lot of firing, but also not hiring.
Not a lot of hiring, although there's a very wide band around what's going on. If you look at the alternative data, we saw the Economist survey that Bloomberg conducts predict 53,000 jobs were created in the month for the report that we didn't get today. Revelio, they have a 60,000 gain. ADP, of course, had that negative 32,000 number. So we're all over the lot here. The Chicago Fed puts out an indicator that supposedly matches the unemployment rate. They suggested 4.3%, same thing as the Bloomberg forecast. And Matt, I know you'll join me in the promotion here. You can see all this data on WSL ALTE Go on the Bloomberg, a whole bunch of alternative data that you can parse and try to make your own guesses here. But you bring up a good point about being in the dark here, because we do have things to worry about going forward. One that could be even worse than not getting today's report. We could not get the CPI report on October 15th, and that would really put the Fed behind the 8 ball in trying to figure out what to do at the end of the month. If we go long enough, the October jobs and CPI data collection could be imperiled. Can't go out and collect prices if there's nobody getting paid to go do that. And also, the government has a lot of contractors. They're not getting paid, so they may start some layoffs. And we have this threat hanging over us of Trump firing thousands more federal workers. So there's a lot going on in the labor market that we can't really track right now, which makes it hard to know what's going on. And we'll go Fed speaker by Fed speaker over the next couple of weeks to try to figure out what they're thinking about all of this. Setting you up there for another promo.
Yeah, I love that. And to Michael McKee's point, we will be speaking with Governor Myron in the next about 10 minutes, so stay with us for that, and Mike will join us for that conversation. But to your point, it's not just that the government, the administration is using this as a threat, an excuse to let people go. At the same time, they're freezing funding, $18 billion for infrastructure in New York, $2.1 billion in Chicago, $8 billion of clean energy for Democratic states. At what point, quickly, Mike, does this start to look like an actual fiscal drag?
Well, it could be a fiscal drag almost immediately if all of those jobs are paused and they stop work on them. The New York Times reported yesterday that the work on the tunnel between New Jersey and New York that is supposedly stopped hasn't stopped yet. So if that keeps going, it isn't going to be something you notice, and this could obviously be a negotiating point between the two sides. Bring those things back if we bring the government back.
All right, Mike, thanks very much. You're going to obviously be with us here for the interview of Governor Myron. Bloomberg's Michael McKee, our policy and economics correspondent. Keep it right here, because Federal Reserve Governor Stephen Myron will join our program right after the opening bells. This is Bloomberg.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question. It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Usually we'd be wishing you a happy jobs day in America, but an hour ago we did not get the data, and we will not because the government shut down. What does it matter? We're trading at all-time highs again. We hit the 30th record all-time high yesterday, but Matt, we just barely made it there with a gain of 0.06%. Futures look much like they did yesterday, a gain of less than 0.1%.
Yeah, we've been seeing record after record. Actually, this year we've hit a new record at least every 4 days, or that's the average,
Madness.
right? We have stretched valuations. We have a government shutdown.
Bezos says it's a bubble.
Yeah, there's a Barclays, and he knows a bubble. There's a Barclays index that says we're near exuberance. There's a Bloomberg index that says we're in manic mode. So
we're still buying.
But we're still buying. Less than 4 minutes to go until the opening bell. Remember, we're joined by Fed Governor Stephen Myron. After that, this is Bloomberg.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. It is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Moments away from the start of trading, moments away from the start of another day on which we may get a record close for the S&P 500. This is Bloomberg Open Interest. I'm Matt Miller. We're only up 0.07%, but what did we close up yesterday? Just 0.06%.
Correct. So we're already doing better on that account.
Exactly. So NASDAQ futures up a little higher. Wow, look at the Russell futures up 0.5%. A lot of optimism for Fed rate cuts, and we're going to talk about that with Governor Myron in just a moment. You've got the National Cricket League ringing the bell at the New York Stock Exchange, and they're calm, cool, and relaxed. They're actually going to be there until Wednesday morning, just sipping Pins cups. Down at the NASDAQ, you've got Mount Logan ringing the bell, and they're a provider of insurance solutions that just had a combination, a business combination that allowed them to be publicly traded at the NASDAQ. So let's take a look at some stocks that trade here, and you're starting it out with AMAT.
Yeah, I am, because Applied Materials had a rough pre-market session, and it's looking to translate into a tough cash session. Shares are down nearly 2%. They warned that U.S.-China trade restrictions will be costing the company in coming quarters. They make the machines that make chips, and those chip curbs, they say, will lead to a $600 million hole in their fiscal 2026 revenue, Matt.
All right, Tesla shares are another stock we got our eye on today, rebounding after closing down yesterday more than 5%, which is interesting because yesterday, third quarter deliveries blew past estimates, I think 493,000, but traders are concerned about future demand. It's always about the future. Stocks are a discounting mechanism.
That is true, but they're buying the dip this morning, so at least there's that.
We are going to continue to follow all of the stock market stories for you as we do. Normally at 9 o'clock, we're focused on the markets. You know, surveillance is all about kind of the macro thing. You've got like 4 hours of interest rates and Fed coverage there, so you don't really need it from us.
Sure.
At 9 o'clock, because the market opens then, we cover single stock stories for the most part.
Yes, unless something is such an important conversation that it usurps all of that, Matt.
That's exactly what we're about to get into right this minute, and we're pretty excited about it here on Open Interest. We welcome our Bloomberg TV and radio audience worldwide. I'm Matt Miller alongside Danny Berger. Joining us now is Federal Reserve Governor Stephen Myron here at the desk. We're honored to have you here, along with Michael McKee, our international economics and policy correspondent. Mike, take it away.
Well, good morning, Steve. Thank you for joining us on this non-jobs day, Jobs Day. We get no government primary economic data because of the shutdown right now. So let me start by asking, if that continues, As a member of the Open Market Committee, would you feel comfortable voting for a significant cut in interest rates if you don't have data on employment and on inflation?
Good morning, and thanks for having me. Look, I think it's important to recognize, first of all, that as you're pointing out, access to high-quality data is of utmost importance when making monetary policy decisions. However, it's also the case that we don't make monetary policy decisions every day, right? The FOMC meets to vote once every 6 weeks or so. Now, I think that's a bit longer than most shutdowns have historically lasted, so I'm hopeful that we'll get the data by the time we actually have to make the decision.
Well, despite what the president says, as you well know, inflation is rising. Food prices are up, gasoline prices higher than when he took office. Those are the prices that Americans notice and hate. So isn't it a risk to cut rates significantly in a regime where inflation is rising?
So my view is that policy should be forward-looking, right? I don't necessarily have a forecast that those items are going to continue rising. In fact, I think that a lot of them will actually reverse somewhat, but for my process, what matters most of all is the cost of housing, because that is the single largest component of the inflation process, and it's also one of the things that people notice the most. They notice when their rent surges, they notice when the cost of shelter increases, and that's why it gets the largest weight in the inflation indices. And my expectation is that we've just experienced, the biggest population shocks to both the upside and the downside in my lifetime, and I think in most people's lifetimes. And to me, it would be very surprising if that left no lingering trace on the price of shelter. And so I am expecting a significant disinflation to the services component of the inflation indices driven by shelter, which is affected to an extent by changes in population growth.
Well, we were talking before we came on about your view of R-star, the neutral rate. We've got inflation running at basically 3%. You've got unemployment at 4.3%, which is historically very low. The Atlanta Fed says we're growing 3.8% or grew 3.8% in the third quarter. There's no economic model that I know of that would get you to a near zero neutral rate with those kind of conditions.
Yeah, so first of all, I have seen some folks argue that they think that my conception of the neutral rate is zero. That's not the case. I think that's a misreading of the speech. If you read the speech carefully, you'll notice that I do a weighted average of a model-implied ex-ante and a market-implied ex-ante rate, and it comes to about a half, and that's consistent with the dot that I put down on the statement, on the summary of economic projections. And so I basically thought, sort of going into things last year, there were all these policies that were pushing R-star higher, like the highest population growth we'd seen in decades, the largest sustainable fiscal deficits we'd seen, sustained fiscal deficits we'd seen in a really long time. Those are pushing R-star higher. So last year I really thought it was at the top of the range of where everyone else in the committee thought it was, and I think it's now come down this year to the bottom end of the range of where everyone else thinks it is.
But you can't model that.
What do you mean I can't model that?
The models, if you put in the numbers that we have right now, it wouldn't spit out near zero or 0.5%.
Oh, real rate. Well, no, but what I've done is modeled my expectations for inflation based on the changes that I see happening from housing, as we talked about a moment ago. I've modeled out changes to the output gap that I expect to see from policies that expand the supply side of the economy and therefore expand potential output faster than they would expand actual output. And some policies that we've seen enacted over the course of this year would push out potential and actual by the same amount or bring in potential and actual by the same amount. Other policies would push out one more than the other. And so for an example of one that would push out one more than the other would be deregulation, right? I think that the regulatory state has been being peeled back over the course of this year, and all indications are that will accelerate, particularly as the pace of confirmations of appointees has just picked up as well. That, in my mind, will accelerate the pace of deregulation, too. And when you remove regulations, you expand the potential output of the economy faster than actual output. And so that creates a positive output gap.
I actually, I'm not as deep into this as Mike, and certainly neither of us is as deep into it as you, but I have the Taylor rule function on my Bloomberg terminal. I love to play with it, and I always ask important economists when they come on what variables they would plug into it. I put in 0.5 for you in the neutral rate here, and I put in 4% in the NAIRU. I'm still only getting 3.5 for the Taylor rule estimate. I know this is a very elementary function here on the Bloomberg, but what would you change to get your rate down to where you think it should be, which is even, I think, less than the 3% terminal rate that the market is pricing in.
Yeah, so let me be clear. Monetary policy works with lags, right? And yes, those lags are long and variable, but nevertheless they exist. And so I think it's inappropriate to put in the current backward-looking data as opposed to where you expect those data to be in the near term, right, over the course of the next year to 2 years or so. And so that's why when I work through the calculations that I worked through in the speech, which also used actually a couple of different specifications of the Taylor rule, I put in my expectations for where I think inflation is going to be. I put in my expectations for where I think the output gap is going to be. And so when you look at inflation now on a year-over-year basis, you're including lots of stuff that occurred before the overall policy space shifted. And as I just said a moment ago, we just lived through the largest population growth shocks on both the upside and the downside in very rapid succession to a variable, the structure of the economy, population growth that usually changes only very, very slowly, changed incredibly rapidly in both directions, right? To use backward-looking data that just ignores that shock on the upside and the downside, which was of monumental historical significance to the U.S. economy, I think is deeply misguided. I think it's imperative to use forward-looking forecasts that incorporate something like that.
Well, we can do that with the Taylor rule on the Bloomberg terminal. As I'm sure you know, if you click on the second tab of the function, you can put in your inflation forecast and your unemployment forecast going forward. I won't ask you what all of your variables were, but I will ask about inflation because as a kid who grew up under Ronald Reagan, I've always been skeptical of government policy when it comes to inflation. I've been hearing for so many years that the Fed wants to get it to 2%, but I find it hard to believe, and we've averaged 3% essentially on the core since World War II. Do you think most people feel comfortable with that level, with a 3% level?
Well, you know, I think what you're asking sort of invites a previous question, which is what did Congress assign the Fed to do? And Congress assigned the Fed to pursue stable prices. Now, historically, the Fed has had lots of leeway in how to interpret that, and it's chosen to interpret that as 2% growth in measured personal consumption expenditure inflation, right? The way that you calculate inflation is sort of, you know, it's a very complex thing, and there's lots of methodological choices that get made when you're sort of deciding how the sausage gets made, and it can really affect how things are measured, right? And so when you say, do households have faith that the Fed is pursuing and achieving its inflation mandate? I think that, you know, sort of small changes in measured inflation are difficult for households to detect because they can be, you know, because the way that measured inflation is measured is there's lots of noise in it. And I think that small changes in measured inflation are usually dominated by the noise relative to what households are experiencing. But nevertheless, when you look at inflation expectations, I think that they remain reasonably well anchored, which indicates that households and firms in the United States have faith in the Fed's ability and willingness and future of hitting its inflation target.
Governor Martin, you've been extremely transparent with your view and have been very generous with that. You've always been very transparent with your views. You're probably the most prolific social media poster of anyone that the Fed's ever had. In 2023, I saw you had tweeted something out saying basically the case against adjustment cuts is that financial conditions have eased massively and policy works via financial conditions. Real rates don't exist in a vacuum. Given that view, the fact we have record high stock prices right now, is it a sign of unsustainable froth, of even a bubble that will make bringing down inflation that much more difficult?
Yeah, so that's a great point. Financial conditions are the channel through which monetary policy works, and so they matter when you're thinking about where monetary policy should be set. Now, as we were saying a moment ago, my view is that last year neutral was much higher because immigration was much higher, because fiscal deficits were much higher than I expect them to be going forward. If you look at fiscal deficits this year, in February through August, which are the data that we have available, and that encompass after the policy space changed, they're about $400 billion at an annualized rate below where they were in the comparable period in the previous fiscal year, right? So fiscal deficits are coming in also, and that also helps drive down our STAR. So my view is that policy, even though financial conditions appear to be on some measures loose, policy has actually grown tighter because neutral has migrated down. Now, I do want to be clear that financial conditions can also be driven by a variety of non-monetary factors. There have been substantial changes to the supply side of the economy this year, both through the tax code and through the regulatory code, as well as trade renegotiation, right? All of that can affect financial conditions for non-monetary purposes, through non-monetary channels. And so it can be a little bit of a mistake to look at financial conditions and infer something necessarily about the stance of monetary policy, because they can be driven up by other things. And also, they're not all loose. I mean, you know, housing finance is arguably still a relatively tight
Sure,
channel.
but a lot of this view is incredibly forward-looking, and that's the point, right? That we're not looking at backward data. But is there any data that we could get, Governor Myron, that would change your mind, and would change your mind to have you believe that we should not be pushing towards more rate cuts right now?
Oh, absolutely. Look, my view is that services inflation is the most persistent and sticky part of inflation. A lot of my view about services inflation is driven by the housing sector, as shelter costs are the largest cost for most families. My view about shelter inflation, as I said, is driven by two things, as I said in the speech. One, the fact that average rents have finally caught up to market rents, meaning the catch-up period is done. You know, people don't reset their leases every day. They reset every year, every couple of years. And so that means that a change in market rents takes time to feed through to when it's experienced by households. When you look at the data, it seems to me that that catch-up period is done, which means that I expect shelter rents to come down, CPI rents to come down, bringing shelter inflation down. The second thing is the immigration shock that we talked about. My view is that immigration was pushing rents up in previous years, and now that shock has not only gone to zero, I think it's actually reversed. I think we have negative net migration when it comes to the United States this year, right? So my view is driven by two things. Services are the more persistent and sticky part of inflation. Services are driven in large part by housing, and I expect housing inflation to come down through those channels. If something were to happen that were to tell me that that channel is invalidated, that there's some shock that's going to be pushing rents materially higher, the benign inflation forecast that I have would have to be adjusted as a result. All else equal, right? If nothing else were to change to offset that. But to me, that's the core of my inflation view. And I would want to see something come along and tell me that that channel is wrong and that I'm thinking about it the wrong way.
I want to ask you about something in your speech that has confused a lot of people, including me. You argue that tax cuts are going to help lower the deficit by increasing economic activity, and at the same time you argue that tariffs, which are taxes on the American people, are going to lower the deficit. You have one way raising taxes and the other cutting taxes at the same time lowering the deficit. How does that work?
Yeah, so you know, it's important when you think about economics to think about the elasticities of supply and demand. And when you cut taxes on American production, whether that's labor or whether it's corporate income, you want to think about the elasticities of supply of those activity. And is it going to lead to additional labor supply? Is it going to lead to additional investment, right? And so that's the way that cutting taxes can actually generate economic growth in the United States. When you think about tariffs, again, you think about the elasticities of demand and supply. And in this case, American consumers and firms are the demand, and foreign producers are the supply. Now, the economic evidence is overwhelmingly that the elasticity of the demand in imports is much higher than the elasticity of the supply. Put another way, foreign producers are inelastic, right? You've got a factory in China or somewhere else, and it's stuck in China or wherever it is. It's installed capital. It's inelastic. Whereas American importers can alter their demand patterns. They could import from China, but they also could import from Vietnam, or they could make stuff at home. That flexibility gives them the ability to avoid the burden of the tariff. Now, this is just tax incidence theory in public finance, economics 101. And when you look at it this way, the argument that economists always reach, the conclusion that economists always reach, is that the burden of a tax, a tariff, a subsidy, anything, falls on the more inelastic party, right? Now, the evidence is overwhelmingly that the foreign producers are the more inelastic party because the factory is stuck in place, it can't move, whereas import demand can substitute across borders. So, it is the case that the negative effects of any tariff fall on the more inelastic party, which is overwhelmingly the exporter and not the importer. And so as a result, the positive effects of tax cuts in the United States get felt by production, and they increase economic growth, whereas the negative effects of raising revenue from tariffs get borne by the exporting country.
Well, we haven't seen any evidence in import prices that that's happening.
Well, you know, import prices, as you're pointing, dollar-denominated import prices, as you're pointing out, have been relatively flat. However, people, I think you're alluding to an argument that people make, which is that you would see import prices decline if foreigners were reducing their selling prices. That's the argument you're referring to? Yeah. to me, that logic doesn't follow for two reasons. One, there's an implicit all else equal clause that's not being stated, and all else is not equal because we also had to move down in the dollar this year, which ought to increase import prices by a comparable amount. And so the fact that import prices look relatively flat could just be the increase in import prices from the weaker dollar just offsetting the decrease in dollar prices from the incidence of the tariff being borne by the exporter. The other reason why it doesn't really make sense to me is because I think that a lot of the importers of record are ultimately U.S. subsidiaries of foreign companies, and so you've got a Japanese or German exporter selling to the United States, but the exports are bought by by U.S. subsidiary of them. So Mitsubishi Japan or whoever is selling to Mitsubishi U.S. or whoever, right? And then if this is the case, then what winds up happening is that the incidence ends up falling on the importer of record without necessarily pushing a decline down in import prices. And so I'm not exactly sure on the magnitude of this channel yet. It's something that I'm looking into, but it is a possible disruptor of that argument. But in any case, for sure what we're seeing is not a broad-based increase in consumer inflation as a result of tariffs.
Governor, I want to ask about a piece that Mark Summerlin wrote in the Wall Street Journal today. He, previously of the NEC, under the Bush administration, basically says that the Fed suffers from the same kind of bias inherent in media or academia because it's so focused in the Northeast, right? We have 4 Fed banks between Richmond and Boston and only 1 west of Kansas, right? Only 2 in the South. He says there should be a Fed bank in Miami and Phoenix, which would make sense. He also points out that of the $600,000 donated by Fed staffers in the 2024 election cycle, 92% went to Democratic candidates. I assume that's because they're in the Northeast and they're underpaid relative to Wall Street. So can you make reforms, especially on those 2 issues, while you're at the Fed?
Well, look, reforms to the Federal Reserve, to the structure of the Federal Reserve, are ultimately an issue for Congress to take up and not one for me to address. But I do see part of my job as bringing fresh and out of consensus ideas to what can be, at times a settled way of thinking, and that's what I'm going to continue doing. And so, for example, you think about tariffs and whether they're causing inflation or not. I think there's an attitude among a lot of people, which is that the correct counterfactual for thinking about tariffs is to compare them to pre-trends for what was the trend in those goods before the pandemic. Right? To me, that's the wrong counterfactual because there was so much else different about the structure of the economy when you look at long-term trends before the pandemic. They include, you look at 20-year trends before the pandemic, which is what a lot of people do. It includes the entry of China into the WTO and shipping deflation to the entire world. Is that the correct counterfactual for thinking about the impact of tariffs on the economy today if we're not experiencing the same deflation we experienced in 2004 in goods when China had just entered the WTO? And then attributing all excess inflation relative to that pre-trend to tariffs? I think that's the wrong counterfactual. For me, my mind, the right counterfactual is non-import goods. And that's why the way that I've looked at it is to compare the prices of import-intensive core goods to overall core goods. And I would think that if tariffs are driving inflation, import-intensive core goods would inflate at a materially higher rate than overall core goods, and that is just not the case. That is not what you see in the data. That's the study that I did when I was the CEA chairman, and I asked the Fed staff to replicate it, and they found that when you use this counterfactual, you get the same outcome, right? So the question is, what's the choice of the counterfactual? And that drives the decision, that drives the inference for me. The other counterfactual that I think is appropriate to use is to say, are core goods in the United States inflating at a faster rate, at a noticeably faster rate, or markedly different trend than core goods in other countries? And again, when I run that experiment, I see no discernible substantial difference that would make me think that core goods inflation in the United States had broken away from core goods inflation globally. And so for me, I think that there's a question of how do you think about these things? And I think everyone was thinking about it one way, and I think about it a different way. And I view my job as bringing in new and interesting ideas to try and get people to think about things in different ways.
Can you do that when the ideological heart of the Fed is in New York? It's at Harvard University. It's in the Democratic Party. How do you move it away?
Well, I am also of New York and of Harvard University,
I get that.
And have no trouble saying my view, even when it's wildly out of consensus, and speaking my mind. As long as I believe what I'm saying, I have no problem sort of speaking my mind. and getting my thoughts out there.
Well, Governor Ryan, it's not only the rest of the FOMC you have to convince these markets as well, especially if you are concerned about housing. You were very outspoken last year when the Fed was cutting and long-term rates were going higher. If that were to happen again, would you be a proponent, especially as you see one of the Fed goals should be for moderate long-term rates, that the Fed should be using the balance sheet in order to keep long-term rates lower?
So, two things there. One, last year I was an opponent of the Federal Reserve cutting rates because I thought that neutral was higher and that therefore the Fed was not as restrictive as they thought that they were. And therefore I viewed the accommodation being provided as inappropriate. And I think, as you're pointing out, that long yields moving higher meant that I was actually kind of right. I think that bears that out. This time, thus far, and still early days, the meeting was, 2 weeks ago, 3 weeks ago. It's still early days, but thus far we haven't seen that type of increase in long yields that we saw last year.
What if it were to happen, though?
Well,
Would the Fed be using its balance sheet?
If it were to happen, the first thing I would want to do is ask why, right? Why is it happening? And if I came to the conclusion that it was happening because it was inappropriate to cut rates because my inflation analysis was wrong, or my analysis of neutral or the output gap was wrong, then the first thing to do is probably to reverse course on the front rate. My view is probably not to sort of resort to balance sheet at the first opportunity. That balance sheet is the tool that you use when your more standard tools can't work for the problem at hand.
A couple of lightning round questions here as we're getting a little short on time. Do you think that if you'd taken a sort of less extreme position, not come in arguing for 150 basis points or so of cuts, that you might have more influence on your peers on the Open Market Committee?
I don't think my position is as extreme as you make it sound. My dots for next year and the year after are not so dissimilar from the rest of the committee. All that's different is the fact that I want to get there a little bit faster. I think that most people on the Fed, sort of they operate with in your Taylor rule application, you probably have an inertial parameter, right, where there's a sluggish adjustment. So wherever policy should be set, you sort of phase it in slowly from where you are. So if you're wildly off from where you are now, there would still be a very slow adjustment to where policy should be set. And I think that that's a type of thing that some people sort of default have in their mind, right? That's not my view. My view is that if policy is out of whack, you should adjust at a reasonably brisk pace. In part because if you stay restrictive for too long, you really run the risk of bringing an output gap materially wider that you don't want. And in my mind, we're not at that point yet because policy just became more restrictive because monetary policy just became more restrictive because R-star just moved down. Right? We're not at the point yet where if you sort of keep it there another day, it's a crisis. But if you keep it there for an extra year, yeah, I think you have problems on your hands.
Given the import that the president has attached to the Fed, as a member of the Board of Governors of the Federal Reserve, do you feel like you exercise executive authority?
No, I don't exercise executive authority whatsoever.
Have you talked with the president or anybody at the White House since you came to the Fed?
Well, as I said, I think a week ago, 2 weeks ago, I don't remember. Time runs together for me these days. The president called me after I was sworn in to congratulate me, and that was very generous of him to sort of say congratulations. And he has never asked me to sort of take a specific policy action. He shares his views about where monetary policy should be, but he shares that with the world.
Have you talked to him since that congratulatory call?
No.
One very quick question. Have you had your interview for Fed chair yet?
No, I have not. And personnel decisions are not decisions that I make.
All right. Hey, thank you so much for coming in. It's been a fantastic interview. Really appreciate you being so forthright. Federal Reserve Governor Stephen Myron, as well as Bloomberg's Michael McKee, our policy and economics correspondent. I will add to our terminal clients that we do have an adjustment for policy inertia in the Taylor rule function. You can see it on the terminal typing TAYL, go. Danny, we have a lot coming up in the next hour.
We do indeed. In the next hour, as Matt's alluding to, BlackRock's Rick Reeder will be joining us, as well as Beach Point Capital's St-John Boron and Snap-on CEO Nick Pinchuk and Julie Coronado, a former Fed economist.
this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A fallen rap mogul is about to go before a court for sentencing in New York on his prostitution-related case. Correspondent Jerika Duncan is there.
In a 4-page letter to the judge overseeing his case, Sean Diddy Combs apologized for his actions and begged for leniency. I take full responsibility and accountability for my past wrongs, he wrote, later adding, I ask for mercy today and promising to never commit a crime again.
Prosecutors are asking that Combs be sentenced to at least 11 years, the defense no more than 14 months. That would mean he could be freed before the end of the year. The government shutdown drags on. CBS's Tina Krause is in Washington.
Today, the U.S. Senate is set to hold another round of votes, now 3 days into a shutdown stalemate. Republicans insist the only way forward is to pass the House's short-term spending bill. But Democrats won't drop their demands that the bill include federal health care subsidies and protections for Medicaid.
This morning, the White House budget director announced the administration will withhold $2.1 billion in funding for Chicago infrastructure projects. Today's report on monthly jobs, a victim of the shutdown. CBS's Michael Wallace says economists and investors are getting sometimes conflicting data.
Economists and investors have to look elsewhere for jobs data since the Bureau of Labor Statistics isn't releasing the official government report. They're looking at this week's numbers from the payroll processor ADP, which said the private sector lost 32,000 jobs in September, and Revelio Labs, which estimates the U.S. added 60,000 jobs last month. Some economists are also factoring the number of job openings posted on Indeed.
New details about the deaths of 2 teenage girls in New Jersey killed while they were riding an electric bike Monday. CBS's Lily Luciano says a teenage boy has been charged with murder.
According to law enforcement, after hitting the girls, the suspect did not stop and later ditched his black SUV.
We don't want to bury our children are to bury us.
Parents of the victims released a statement saying the driver had been plotting his attack against Maria for months.
British officials say one of the 2 people killed in yesterday's synagogue attack and one of the wounded were mistakenly shot by police. During a visit to the temple today, Prime Minister Keir Starmer blamed anti-Semitism.
We must be clear. It is a hatred that is rising once again, and Britain must defeat it once again.
Just in from Chicago, police report at least one arrest in clashes between protesters and Illinois state troopers outside the Broadview ICE facility. The Dow is up 193 points. S&P ahead 16. This is CBS News. For the first time in its 500-year history, the Church of England has chosen a woman Archbishop of Canterbury.
In her first address as designated leader of the world's 85 million Anglicans, Sarah Mullally said the Yom Kippur attack on the Manchester synagogue must not, will not divide Jews, Muslims, and Christians.
Hatred and racism of any kind cannot be allowed to tear us apart.
But divisions within the church she's about to lead may have widened because of her appointment, with some congregations within the UK and many Anglican congregations in Africa and Asia still deeply opposed to the ordination of women. Vicki Barker, CBS News, London.
Axios reporting 1,500 churches in the U.S. could close this year, far more than the few thousand expected to open. Denominational reports and church consultants cite unprecedented contraction that is expected to continue over the next decade. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are also streaming live on YouTube as well. Scarlett Fu and Paul Sweeney live here with you for the Bloomberg Intelligence program for the next 2 hours. We got some economic data coming out from ISM. We'll get right to that in just a moment. We're also going to take a chat with Ed Ludlow, BTech co-anchor, talking about BlackRock and doing that big data center deal. Again, another example of more money being thrown at data centers and AI. Margie Patel is going to join us, Senior Portfolio Manager at Allspring. She's up in Boston. We'll get her market views as well. Sid Phillip, Bloomberg Chief Correspondent for Global Aviation. Talk to us about this Boeing story. Just when you think Boeing's out of the woods with their 737, now their 777 said to slide into 2027. That's going to cost them some money. Jody Laurie, Bloomberg Intelligence Credit Analyst. She's going to talk to us about the cruise line business and the cash flows there and how that business is doing. So a lot going on there. But right now, let's get to Steve Miller. He's the chairman of the Institute for Supply Management. The cool kids call it ISM. He's down there in Aledo, Texas. Landman that's the scene of Landman, the TV show I love.
That was Paramount Plus, right?
Yes. ISM Services Index, folks, it did come out because it's not a government institution. Came out with a reading of 50. The consensus was 51.7. Steve, talk to us about some of this ISM data you guys released this morning.
Sure. Thanks for having me back, Paul. The number that we saw this month is what we were expecting last month. We were kind of expecting a continued reduction in the growth rate that we've had really over the last 3 years. Last month, our attribution for why the number was so strong was that people were trying to buy ahead of tariff impacts. And based on where the inventory number moved down, as well as inventory sentiment as saying we still have too much inventory, it looks like that was the case. This is not an unexpected number and just demonstrates that we're still in a very weak growth stage.
Yeah, you look at prices paid, Steve, and that was a read of 69.4, an unexpected increase for the month of September because economists had anticipated a decline to 68. What does that tell you about inflation?
Sure. Our respondents are saying on a more frequent basis, they're seeing the impact of tariffs flow through from suppliers. They're trying to contain that by having multiple suppliers for particular items and then through overall negotiations. However, we saw a jump about 5 months ago up into the high 60s, and it's staying there. The real question on inflation is, will those services companies and industries be able to pass those increases on to consumers, or will they have to eat them in their profit margin?
Steve, new orders came in materially weaker than forecast and weaker than last period. Was that just kind of that front loading we saw maybe from the tariffs?
I believe so from looking at the numbers. The positive signal there, however, is we're seeing a drop in export orders. So that means there's some resiliency in the domestic market, keeping that new order number in a growth and expansion territory versus contraction.
All right, Steve, thanks so much. Appreciate that. As always, Steve Miller, chairman for the Institute for Supply Management, joining us there via Zoom. Market drivers here this morning brought to you by IBKR. Will September 2025 be the warmest September on record? At IBKR Forecast Trader, the yes was recently 11%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is October 10th. Let's get a sense of what's going on out there with those markets. We're joined by Christina Aquino, Bloomberg News. Christine, what are you looking at?
Well, let's take a look at Apple, Paul. I mean, we got some early news before the open about a downgrade, but Apple shares, ticker AAPL, those are actually rebounding nicely now that the cash equity is open, and those shares up just 0.2% at the moment. So yes, earlier we did get a Jefferies downgrade. They downgraded a firm to underperform from hold, and that is one of the few sell equivalent ratings on the Bloomberg system. Fewer than 7% of analysts have that sort of rating. So this is an outlier for sure. But the analysts are saying that their current valuation prices for Apple, it reflects a, quote, overly bullish iPhone outlook. But then Bloomberg Intelligence saying that the 7-day average for iPhone 17 delivery times was 18.9 days versus 13.6 days last year. So that actually means longer waiting times, stronger demand. And they're saying that means that puts it on track in terms of sales for an 8 to 9% gain, which is double the consensus of 4%. So looking optimistic, probably what's being reflected in the share price today.
Let's also talk about Applied Materials. It didn't report earnings, but I guess they gave the equivalent of a profit warning?
Yeah, absolutely, Scarlett. And the shares are paying for it. So Applied Materials, ticker AMAT, those shares are down more than 3% now. So extending losses as the session continues. And that's exactly it. So we got Applied Materials saying that their net revenue for fiscal 2026 set to decrease by $600 million because of the Trump administration's actions to dramatically expand U.S. sanctions to capture subsidiaries of blacklisted companies. What ultimately that means is that they're just going to have a harder time selling to companies in China specifically who don't have a license to go around these sanctions. And Citi analysts saying that this is a big hit to Applied Materials specifically because they're assuming about a 30% of total revenue being derived from China. So that impact, $600 million, that's going to be around 7% to China total revenue in fiscal 2026, which is worse than some of its competitors in this space.
Boeing. What's happening there?
Not good things.
777. I didn't know we had a problem with the 777. I can't keep track.
I know. Well, apparently we do, and we got this Bloomberg exclusive reported yesterday after close. So and that's taking a little bit of a hit on the shares. Not too much though. So ticker BA, shares down just 0.2%. But the news doesn't sound good. So their 777 slated to fly commercially for the first time in early 2027 now instead of next year. So Lufthansa was meant to be the launch customer for this aircraft, and they're already making plans for delays. Meanwhile, Emirates, which is meant to be the biggest customer for the aircraft, are also growing more cautious, and they're looking at entry into service possibly not before 2027. So the estimate from analysts there in terms of non-cash accounting charge, that could run from anywhere from $2.5 billion to as much as $4 billion. So the press is negative. Executives have held meetings with major investors and are now working on damage control messaging.
All right. Well, for Boeing, the good times are few and far between. It feels like every time they just take another hit, it's kind of constant.
But I'm going to stick with my the George Ferguson call out of Bloomberg Intelligence. Focus on the 737 deliverables, because when you deliver the planes, that's when the cash comes in.
Got it.
And you want to be 40, 45 planes a month. That's where they need to get
And the
to.
long-term story is still very much intact. It's a duopoly.
Yes, exactly.
Right? You only have Boeing and Airbus, so no one has any choice.
Yep.
Christina Aquino, thank you so much for our market drivers. For more conversations like this, subscribe to our new Stock Movers reports. You can listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, we've been touting his presence all week. Ed Ludlow, Bloomberg Tech co-host, is here in New York for the week. He's about to take off, but he did agree to speak with us before he does so to talk about the stampede into data centers.
Yeah.
BlackRock's global infrastructure partners, the latest to move in that direction.
This is a really important piece of reporting because it will help a lot of investors and readers understand all the other stuff that's going into this movement outside of just the chips and the compute. BlackRock's GIP partners, Global Infrastructure Partners, is a big player. So what we're reporting, citing sources, is that they would acquire Aligned, which is basically a company that builds data centers, the actual buildings, you know, the metal, the concrete, the sand, the water, the cooling, and then decides on their locations and manages basically a portfolio of them. What's interesting is you see a familiar name, MGX, the investment vehicle backed by the UAE and its other sovereign wealth funds.
That's right.
So the idea here is that BlackRock's GIP acquires it, and in parallel, a separate equity investment from MGX. And what is this signal? It's this idea that we know about the compute demand. So we're basically thinking that there's going to be $4 trillion worth of demand for the chips and the server designs. But if you start to think about the concrete, labor, building materials, energy supply, utilities, water, cooling systems, you can expand that number out to 7 trillion. And this is some really big names making moves to make sure they have the name that can build the actual things and then manage them, you know, as a piece of real estate and as an asset class, I suppose.
You know, I'm looking for tops in this whole AI story. Where's the top? And I'm always like, man, when private equity gets in.
That was a big sigh, Paul.
I don't know. I mean, $40 billion for a real estate company? Is that what we're talking about?
I also want to be honest with you guys in the audience. Like real estate is, I'm not so au fait with real estate. It's not a world that I cover because we've been talking about San Francisco, right?
Yes.
So let me make a sort of weird parallel example. The OpenAI story we did this week on the $500 billion valuation in San Francisco right now. Everyone's like, this is going to create a huge bubble in the housing market. Why? Because you have about several hundred newly minted millionaires from that transaction. Seriously.
Wow.
So like there's a knock-on effect
days.
from the capital flow to individuals and companies. Did you guys see the story that's also out this morning about Jeff Bezos, of all people, saying that the AI spending boom is a bubble?
Oh, really? Interesting. And his company is one of the major spenders.
Thank you.
But he says it's a bubble. He says it's a bubble that will pay off, though.
A bubble that will pay off. And right now the equation for public market investors and debt market investors, and I think the debt part's really important, is they do want to see the evidence that top-line growth is materializing, particularly in software companies. If you're a venture capitalist, you don't care. Like, that's not how that works. Growth at all costs is okay. And so when we think about OpenAI, Anthropic, Perplexity, all these names that we love to talk about, you know, it's the money plowing in, there's less focus on the money coming in out the other side.
Yeah, absolutely. Ed Ludlow, Bloomberg Tech co-host, thank you so much for, joining us and giving us all your insight here. And it's so true. I know people in San Francisco, and when housing prices go up because something big is happening in the tech world, you know, they're always saying, I just can't wait for the bear market to come back. I need things to come back down, for prices to deflate.
The post-pandemic, arguably, no city got hit harder than San Francisco.
Yeah.
So I'm cheering on this news of AI coming back.
But you know what? The suburbs south of San Francisco, they weren't hit as hard.
No, okay.
All the prices stayed pretty lofty there.
We got a red headline across the Bloomberg terminal on the geopolitical front. President Trump says Hamas must agree to a deal by Sunday, 6 p.m. Eastern time. So putting literally a line in the sand, if you will.
And of course, we know that Hamas says it will respond to Trump's Gaza plan very soon. They are considering it, they're looking into it, and they will soon respond.
All right, so we'll keep an eye on that going forward. Coming up, we're going to check in with Margie Patel. She's a senior portfolio manager at Allspring Global Investments. Get her thoughts on these markets. Plus, Sid Phillip, Bloomberg chief correspondent for global aviation, will give us the latest on Boeing and some of the problems they're having with their 777. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We've got stocks, well, right now on the rise. It was supposed to be Jobs Day, but the government shutdown has delayed that. So we have the NASDAQ, little change, up 4 points. The Dow up 0.7%, 343 points. The S&P 500 up 0.2%, or 18 points. We have yields advancing. This is after the Fed's Austin Goolsbee. He repeated his views that officials should proceed carefully with interest rate cuts. The 2-year yield, 3.56%. That's up 2 basis points. The yield on the 10-year, 4.11%, and that's up 2 basis points. With the Bloomberg Dollar Spot Index down about 0.1%. Shares of Applied Materials, that is the largest U.S. maker of machinery used to manufacture semiconductors. They're down nearly 3%. The company said an expansion of rules that restrict those export of its products to China, it's going to cost it $600 million in lost revenue in fiscal 2026. And Bloomberg has learned global infrastructure partners. It's BlackRock's infrastructure arm. It's in advanced talks to acquire Align data centers. And sources saying Align could be valued at about $40 billion in a transaction. And finally, Tech Insights. They discovered that Huawei Technology, they used advanced components from some of Asia's biggest tech firms and at least some of their top AI chips. And that includes gear from Taiwan Semiconductor Manufacturing, Samsung Electronics, and SK Hynix. All those shares are higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Scarlett.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. I want to bring on our next guest, Margie Patel, Senior Portfolio Manager at Allspring Global Investments. And we love talking to Margie. She's got so much experience in these markets. And she's one of those investors that still believes that this year's leaders are going to be technology, data center build-outs. And boy, got some validation today with the other story we were talking about earlier with Ed Ludlow. BlackRock putting $40 billion into buying Align data centers here on another play on the AI play.
The never-ending AI trade.
It's awesome. Margie, thanks so much for joining us here. I'd love to get your updated thoughts on kind of how you're thinking about that broader technology AI play, which has been so important for so many parts of this market.
Well, I think it's still going to continue. I think it's natural to be cautious and say, oh, well, this is a bubble, it's going to burst. But it's really such a huge move. You're seeing so much momentum by the main players making investments in that sector that I think it just simply has more to go until we get to the point where companies look and say, what kind of return are they getting on all this incremental investment in AI? But that's really, I think, a long way away, certainly not this year. We'll see if it's even next year.
Okay, I hear a lot of people explaining the fundamental case, the fundamental bull story behind AI and everything around it. But then you've got other things that kind of show signs of toppiness, right? You've got really tight credit spreads. You've got this massive deal this week, EA going private for $55 billion, the biggest leveraged buyout in history, topping what we saw in 2007 with TXU. And of course, that preceded the global financial crisis. It just kind of creates these very uncomfortable parallels, Margie.
Well, I think those are all symbols of how much liquidity is floating around in the global financial markets. Rates are low. There's a lot of money investing. And these days, money can easily flow. There isn't a way like in the old days where the Fed could cut off flows to one sector, really start a recession. So I think all those things you're saying, narrow spreads, show that there's a lot of liquidity, a lot of money wants to find investments. And fundamentally, the economy is in good shape. Defaults are very low. That's why yield spreads are low and may even, I think, go narrower in the high yield space. And really, companies have spent the last, you might say, decade when we had zero short-term interest rates restructuring their balance sheets. So they really also have tremendous flexibility in making investments if they want to. So, you really have to say this is a pretty optimistic time. You could say, oh, well, PEs are high or rates are too low or whatnot. But basically, there's still this enormous money flow that wants to get invested. So I think that's going to push the market higher over the rest of the year.
Margie, we have another government shutdown. I think investors, while they're not immune to the effects of government shutdowns, and maybe to a certain extent we've become kind of used to it, how do you view it? How does that factor into your outlook, if at all?
Well, I think it's really short-term noise. I'm sure it'll be resolved and won't have any permanent effects on the economy. And of course, we have an enormous deficit. And the question is, will we see by some reductions in employment in the federal government, will that help to reduce the deficit, at least looking out over the next few years? So I think it's just short-term noise. It's like a lot of the news about tariffs, where at the end of the day, it still isn't really clear of companies being really badly hurt. It seems like people are just muddling through, and it's just really not noise, but not really a big deal on the fundamental outlook, which is the economy looks good, earnings look good, profit margins are still high, and look like even with the beginning of the tariffs, it looks like they're going to stay high. So short-term noise, but not really a major negative.
Okay, so the shutdown might be short-term noise, but there are other worrying parts. We saw the bankruptcy of First Brands, for instance, really highlight how the lower income consumer is struggling under the weight of their debt, and the labor market for them may not be holding up as well. How are you thinking about this as we head into earnings season and we expect to get results from the big banks, giving us some indication of what their credit quality looks like, what their concerns or their lending concerns might be?
Yeah. Well, I think that the lowest, say the bottom two quintiles of consumers have been hurt. I think that as the economy expands, even they will get a little lift. But really, it's the top 2 or 3 quintiles that really drive consumer spending and feed into the economy. So I think that's really important. We just saw this week that car sales were 16 million, which is the highest it's been in many, many months. And it's one of my favorite indicators because it's a very timely indicator. It never gets revised. And really, if there are 16 million cars that have sold, even if there's a little pre-buying for tariffs, it says that top 3 quintile is in pretty good shape. So I'm not worried about the consumer in those that have the money to spend.
Margie, thanks so much for joining us. Always appreciate getting a few minutes of your time. Margie Patel, Senior Portfolio Manager at Allspring Global Investments. Another red headline crossing the Bloomberg terminal on the EV space. Rivian to redesign EV door handles to address safety concerns. So trying to make some headway there. We'll have more reporting on that coming up. Boeing back in the news, and after a string of some real positive news items over the past 6 to 12 months, got a little bit of setback here on a 777 plan here. So let's check in with Sid Phillip, Deputy Team Leader for Global Aviation at Bloomberg News. Sid, what's going on with Boeing and the 777 aircraft?
Good morning. So the 777 aircraft has been long delayed. So the aircraft was meant to enter service in 2020, and the latest we heard from Boeing was entry into service in 2026. Now we understand that's going to go to 2027. And that sort of means that for Boeing, it's a massive impact on cash because this aircraft has been years in development and Boeing is looking to sort of convert all those orders into cash flow. And so that just postpones it. And we understand that Boeing is going to be having to take a multi-billion-dollar charge on this program at their next earnings because of the delay and essentially the fact that they can't get cash in through the door for those aircraft.
So this is essentially a profit warning from Boeing before its latest results. Sid, which companies, which airliners are most affected by the delay of this 777?
So the 777X is a brand new aircraft that's meant to replace the older A380, and the 747 is the biggest aircraft that Boeing has worked on. And essentially this would replace those aircraft. And so the airlines like Lufthansa, we've seen Emirates place the biggest customer for this. Qatar Airways has ordered some. And so essentially the airlines that do long-haul services carrying lots of people, those are the ones that are really affected. And essentially that delays their retirements of older aircraft and the introduction of more sort of fuel-efficient brand new aircraft.
Sid, I guess just once more revives kind of the concern about the engineering and production capabilities of Boeing that were highlighted over the last several years. I don't know, is that fair, do you think, or have they kind of put a lot of that behind them here?
They have put a lot behind them, and the indication from Boeing, I mean, the CEO, Kelly Ortberg, sort of flagged these issues, and he sort of said that this was more a paperwork issue rather than an engineering setback issue. But at the same time, this aircraft has been long delayed. I mean, it was slated to enter into service in 2020, and so it's already 5 years late, and now it's possibly going to be 7 years late. And so it does sort of talk about the certification delays that Boeing's got to get through, including on the 737 MAX, where the MAX 7 and the MAX 10, which are the smallest and the largest variants of the MAX, have still to be certified. And that is, again, a very important sort of source of cash for Boeing. And so it is one of the challenges that Kelly Ortberg has to get through as Boeing sort of goes into the next phase of growth and essentially turns the corner on its various challenges it's had in the last couple of years.
So put this into context for us. Where does Airbus stand with the release of its latest versions of its airliners? If Airbus is also being held up by different reasons, then maybe this isn't so bad for Boeing.
Yeah, so Airbus has a different problem. They have issues with production, and so they're unable to produce enough planes. And so while Airbus doesn't have any aircraft currently in certification, I mean, the latest aircraft, the A321XLR, has entered into service. They have a different issue. They have issues with supply of parts, and they can't make those planes fast enough to get them to customers. So the customer is really sort of struggling on both ends, because on one hand, if you've got an Airbus order book, you're waiting on delayed aircraft. If you're a Boeing customer, you're waiting on aircraft that are still to be certified. In both cases, you can't have those planes in your fleet and flying around for you and making money for you. So for the airline, regardless of whether it's a certification delay or whether it's a production delay, it is a delay.
It is a delay, and we keep talking about this duopoly between Boeing and Airbus, but is there any other aircraft manufacturer that could kind of fill the hole in the meantime for these airliners?
Unfortunately not. I mean, the duopoly is here to stay for the conceivable future. And Comac, the Chinese aircraft manufacturer, is talking about building, I mean, they are building the competitor to the 737 and the A320, but they're building in very small numbers, and it's going to be a very long time before they're able to scale up and match the production cadence that Boeing and Airbus have. And they don't have a wide-body aircraft. And similarly, Brazil's Embraer builds smaller regional jets, and so they aren't really a competitor. So at the moment, the only options for airlines, if they want an aircraft, are either Boeing or Airbus, and they're both struggling with order books sold out until the end of the decade, and essentially it's going to be a tough struggle for them.
All right, Sid, thanks so much for joining us. Sid Phillip, Deputy Team Leader for Global Aviation, Bloomberg News, joining us via Zoom here. And I know George Ferguson at one point during Boeing's troubles was pointing out that one of the issues for the airline industry in general is just the lack of qualified workers. That
talent.
they lost a lot of talent during the pandemic. A lot of people either retired, just went out of the business, got left the industry.
No institutional knowledge left.
Yeah, and it's hard to replace those people on the line. He was trying to say it's much more technical and difficult work than, say, constructing an automobile on that assembly line. So you got to almost train up a new generation of people in that. George has been saying for several years is going to take time, and that's impacting your suppliers and as well.
The aviation industry overall is struggling with that.
Yes.
You think about the air flight controllers as well. That's a similar problem, right?
Yeah, but that one, to me, getting people in towers, to me, that's just money. You pay them what you need to pay them to get them in there, but now it's unionized. But I know it's unionized.
There's
but
a
that
reluctance.
one seems like I could fix that if I were in charge. You know, it just seems like that's one I think I could just say.
Put Paul Sweeney in charge.
Exactly. So we'll see how it goes. All right, we're looking at this market. We got a little bit of green on the screen. We're going to have more coming up. This is Bloomberg Intelligence. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Van Eck. Founded in 1955, Van Eck has been guided by conviction, not convention, spotting change early and turning it into opportunity from the very start. Well, the NASDAQ 100 kind of struggling to hold on to earlier gains after setting an all-time high for the third day in a row at the open. So let's look at the markets. The NASDAQ up about 0.2%, 49 points. We have the S&P 500 rising 0.4%. The Dow up 0.9%, 457 points. In the yield space, we have the 2-year 3.56%, and that's up 2 basis points. The yield on the 10-year 4.11%, and that's up 3 basis points. The Bloomberg Dollar Spot Index, that is little change. We may not have received jobs data, but we did get word from ISM that the U.S. service sector had stalled in September. Business activity shrank for the first time since the pandemic. Orders barely expanded. And another setback for Boeing. Sources say its 777X that was scheduled to be commercially debuted next year, well, it's now going to fly. It's not going to fly now until 2027. Now, analysts predict sets off the stage for potentially billions of dollars in accounting charges because of that. And shares of online video platform Rumble, they're up about 18%. It entered into a partnership with Perplexity to develop a new subscription model. It's going to combine the pro features from both platforms. And when it comes to getting your MBA, Harvard Business School still on top. That's according to Bloomberg Business Week's Best B-School survey, with more than 20% of students and alumni naming it as their top choice. Number 2, Stanford Graduate School of Business. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Paul and Scarlett.
All right, thank you so much, Lisa. Have you been on a cruise lately?
Never. I have never been.
Me either.
I don't know if I want
Really?
to.
I am considering it. It's on the consideration
It's on the
phase,
agenda.
yeah.
Okay. I mean, it's very popular with kids, people with young kids,
Sure.
because, they take care of a lot of this stuff, or elder family members as well.
Yes.
Makes things a lot easier. And obviously, there's a lot of visibility into their business because people book out months and years in advance. So investors love it too. Carnival Cruise Line, the stock is up 16% so far this year, just a bit ahead of the S&P 500. But if you look at other measures, there might be some concern. And so let's do that right now with Jody Laurie. She is Bloomberg Intelligence credit analyst on the outlook for this industry. And Jody, you're looking at some alternative data, and the alternative data suggests maybe there's a bit of moderation coming for Carnival and its competitors.
Yes, Scarlett. So we use Alt-D Go, and we look at the cruise lines. And one of the things we like to focus on is new versus returning cruisers. And that data is sort of indicative of how much adaptability there is in the sector. Now, if you remember, cruise lines are only 2 to 3% of the total leisure sector. And so it's still a relatively small percentage, but as you noted in the introduction, people book out way earlier. So you get insight into the psyche of the consumer going into next year and the following year based on how they're booking. We are seeing that returning cruisers are still booking pretty strong. We're seeing that pre-cruise onboard spending is still strong, but I kind of question what that actual onboard spend is going to look like in 26 as the consumer feels their wallet a little bit more strained, as inflation sort of really dips into not just the lowest income consumer, but more of the middle market consumer.
Jody, as a credit analyst, would you rather see one of your cruise companies build a new ship, put a new ship in the water, or pay back debt?
Would I rather see? So I don't think that that's a one or the other situation. Obviously, while they were working through all of their balance sheet upheaval over the past few years, paying down debt was definitely more favorable. But I think that the companies can kind of do both, because what new ships do is they provide additional cash in the door through onboard or through bookings, advanced bookings. And so what that means is that they don't necessarily have to rely on the debt markets to fill those cash gaps the same way that they do when, say, they're not able to cruise. Now, something to note about Carnival and the cruise lines in general is from a capital structure standpoint and from a credit perspective, they've actually done pretty well. And Carnival actually just finally got upgraded to investment grade this week by Fitch. So it's actually been a pretty strong tailwind for the company from the credit perspective that will likely feed into the relative value of the bonds. But in terms of that growth story, that large momentum, that might be stalling a little bit.
So cruise operators want to get a Paul Sweeney or a Lisa Mateo to become a cruiser, and not just a cruiser for the first time, but to become returning cruisers. How expensive is it for them to acquire these kinds of customers?
How expensive is it for them to acquire these customers? I think it really depends. It depends on the cruise line itself. And I think what's so interesting is that we are seeing much of a differentiation in terms of the different brands, to the point that we're now seeing Four Seasons and Ritz-Carlton come into the space in the form of really high-end luxury yachts. We're seeing Viking continue their position as very kid-unfriendly, mostly just older couples wanting to go on ships and having everything included. And Royal Caribbean is finally entering into that space. So when that happens, I'm a little curious to see who decides to go to Celebrity over Viking, and if that creates some sort of cannibalism in the sector. It's more, what's interesting is when you think about it in comparison to Vegas, where you see that slowdown in Vegas, and the fact that a lot of the cruise lines have been structuring their new island locations as this alternative to Vegas. It has a very Vegas vibe, to the swim up bar, to all the sort of activities you can do, all this sort of a la carte situations. Yeah, I mean, that's really where a lot of the cruise lines are spending their money, and whether customers are going to see that as a better alternative to Vegas remains to be seen.
All right, last month, I don't know if I told you this, Judy, I was cruising the Amalfi Coast. And
so you do cruise?
No, we took a little boat from one part to the other Amalfi Coast. Okay. But what I did see is the Ritz yacht. And
it intrigued you?
It was amazing. So, Jody, talk to us about that. What would make a hotel company go into the cruise business? Because that looked pretty cool, that boat.
Yeah, and they only have a few ships. We're talking 3 ships at the moment. And for Marriott, I think they're sort of dipping their toe in the water, no pun intended, just to kind of see the appetite. Because there is a certain customer, if you talk the high-end customer, they don't want to be on a big ship. They don't want to be on the gigantic Icon class ship. That is not their speed. Even the smaller ships are still a little bit too much for them. I mean, why should they, participate with the plebes? But they don't want to have to own a yacht themselves. So it's a nice middle ground for them. So I do think that there is a little bit of an opportunity there. I'm not so sure it's going to get super large in terms of the number of ships that they have, but it definitely creates a different situation.
Yeah, the intimacy, the exclusivity is what makes it appealing, especially to someone like Paul, who was nodding along as you were describing all of that. You talked earlier about onboard spending. Talk to us about the economics of having everything included. So you pay one price and like all your needs are met, versus a la carte pricing, where they're really trying to get you to spend more and splurge for different things, whether it's extra drinks or excursions that you tack onto the cruise itself.
And that, Scarlett, dips into a lot of the data that we looked at through Alt-D. And by that, I mean is that we looked at ticket versus onboard spending data. And what we're seeing is for the brand name ships, so meaning the Royal Caribbean, the Carnival, the Norwegian, the brands, those in particular might be reducing the amount that they gain in terms of ticket price, meaning the amount that they generate in revenue, so that they can get people on the ship and then charge them an onboard spending. And onboard spending, they benefit a little bit from, in terms of cash flows. From a margin perspective, it's pretty attractive. And anytime you can get somebody to open their wallet and spend money is attractive. Now, the big sort of risk of that is if you appeal to a customer that might feel a little bit more strained, they'll be fine spending the ticket price, but they might not want to spend as much on every single excursion that comes their way. They might go for the sort of base ship opportunity. That's becoming less and less attractive. The companies are making it so that that main dining hall experience isn't what you want to do. And so we might be at a little bit of an impasse when you have customers getting on the ship saying, I don't want to spend so much, but the cruise line saying, well, if you really want the good experience, you have to spend more. Right. So we'll see how that plays out into 26.
All right, Jody, fantastic stuff. Jody Laurie, Bloomberg Intelligence credit analyst on the cruise outlook. Of course, Bloomberg Intelligence looking at some alternative data and getting a sense that maybe there's some moderation ahead for some of these cruise line operators. They need to be a little bit more discerning in how they price everything.
While we were in Venice, I saw this ship moored out there, and I thought it might have been an Italian Navy ship. No, it's Michael Jordan's yacht.
Oh, no way.
That's how big it was. Unbelievable.
Did it have 23 and
no, but it's got the same paint scheme that it has on his brand new G6 Gulfstream. So
Black and red?
Yep.
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. And we're streaming live on YouTube as well. How about that? Head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. I want to check in with Drew Redding. He's the home building analyst for Bloomberg Intelligence. He's out with some research saying home builders may face $10,000 in extra costs per home from tariffs. What does that mean for the profit margins there? So Drew Redding joins us, home building analyst at Bloomberg Intelligence. Drew, talk to us about this. How are tariffs impacting home builders out there?
Sure. So just to provide a little bit of context, the U.S. residential construction industry imports about 7% or $13 billion of the $185 billion worth of goods used in residential construction. So if you look at it on a market-by-market basis, China is the largest exporter at about 27%. From there, we're talking about things like appliances, lighting, electrical components, hand tools. The second largest would be Mexico. And from there, we're talking about things primarily drywall from Mexico. And then the third is Canada, and that's really the biggie. As you're probably well aware, we get a lot of our lumber, about 85% of imported lumber comes from Canada. So all these things combined, we think add up to, a roughly $10,000 increase in the average cost to build a new single-family home. Now, you'll see the estimates range around depending on what import exposure you're using, but whether it's 8, 10, or 12,000, I think the point is made that in an environment where affordability is already constrained, adding cost to a new home is more of a challenge.
We know the administration's stance is that they want people to use domestically made products. Is that possible for home builders to source all these things domestically?
Well, let's look at lumber, because I don't think it's any surprise this is one of the most important imports for a home builder. The cost of lumber typically accounts for about 6 to 7% of the average sales price of a home. And as I mentioned, we're importing about 85% of lumber from Canada. The lumber that comes in from Canada represents about 25% of consumption. So the U.S. is producing domestically about 70% of the lumber we need. So to your question, can we shift and source that all domestically? I think in the near term, the answer is no. And the main reason is because it would require significant infrastructure investments. The NAHB had a letter out to the administration, and they think that it could take somewhere around 10 years to fully replace imported lumber to produce it all domestically.
Drew, another pain point potentially for home builders that was called out was on the immigration side, and that if migrant workers were not coming into the U.S., that would be a problem for home builders because they count for a big part of the construction crews. What are the companies telling you these days?
Yeah, so to this point, we haven't really heard much of an impact from the builders that we talk to. But to your point, immigrants account for about 25% of construction workers. And when you look at the skilled trades, that rises to about 30 to 35%. But when you look at particular markets, think about Arizona, Texas, even New York and New Jersey, that percentage rises to over 50%. And there's estimates that undocumented workers within the industry account for 1 in 10. So it's certainly a risk depending on how the administration proceeds with immigration policy. To this point, we haven't seen much of an impact, but to the extent that you start to see more ICE raids, deportations, and things like that, and it starts to hit the builders, what ultimately happens is that you have a group of builders who are fighting over a smaller pool of resources, and ultimately that pushes up labor costs.
So how do you see this all playing out, Drew? These are extra costs for the home builders themselves. I mean, they'll have to figure out how much of it they pass along to their customers, how much of it they'll spread across the supply chain. Is this going to lead to a difference in the way that they market their homes to consumers? Will they have to give fewer discounts? Are they no longer going to buy down rates?
Yeah, it's a great question. To your point, I think particularly when you look at the large publicly traded home builders, you're going to see that them kind of flex their muscle in the supply chain and push back. So they're not going to bear all of the costs in this. I think it does get spread along the supply chain. In terms of their ability to push it to the consumer, that's an interesting question because we already know that net pricing is coming down with base price reductions. As you alluded to, builders are using more incentives than they ever have to buy down mortgage rates. So it's really tough to tell what's getting passed through, but I think at the end of the day, it's just another pain point on net pricing, which we think will continue to be pressured as we look into next year.
Is there any fix to the home affordability problem, Drew? Is it just building more houses?
Yeah, the $1 million question.
Yeah.
In my opinion, I don't think there is any quick fix. The administration, as we know, has floated around some different ideas of improving supply, opening up federal lands, expediting the permitting process so builders can reduce their costs. I think all these things that are talked about can help on the margin. Certainly a reduction in rates helps as well, but when you take a holistic view at affordability, you're talking about home prices that are up 50% from pre-pandemic levels. You're talking about higher property taxes, rising insurance costs. So
yep.
I think there's not a single silver bullet that I think solves this. Ultimately, I think it's the laws of supply and demand. As inventory starts to build,
yep.
You see a little bit of a pullback in prices
Yep.
around the country. So I think it's just going to take time.
All right, Drew, thanks so much for joining us. Drew Redding, home building analyst for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour, Bloomberg Intelligence starts right now with the S&P up 31 points, the Dow up 400, and the NASDAQ up 50 points. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio for hour 2 of the Bloomberg Intelligence radio program. We're also streaming live on YouTube as well. Coming up, we're going to play back an interview Federal Reserve Governor Stephen Myron, who spoke earlier with Bloomberg Television anchors Mike McKee, Matt Miller, and Danny Berger. We'll play back some of those discussion points. Nathan Dean's going to join us down there at Bloomberg Intelligence. He's the senior policy analyst in D.C. Get the latest on the shutdown of this government here. Municipals are in focus. Why? Because it's Friday. We do it every Friday. We talk about the municipal bond market. Eric Kazatsky, Managing Director and Client Portfolio Manager, Mackay Shields, he's going to join us here. He's really smart on all the muni market stuff. So got a lot coming up in this second hour of Bloomberg Intelligence, and let's kick it all off with Charlie Pellet.
I thank very much, Paul Sweeney. Jobs Friday. Without the jobs data, the Dow, the S&P, NASDAQ all pushing higher right now. We're looking at records again on this Friday with the S&P 500 index up 29 right now. That is an advance of 0.4%. Dow Industrial is up 400 even now, up by about 0.9%, while NASDAQ, the composite index, up 42, up 0.2%. The NASDAQ 100 index just about flat on the day, a little bit of green, up by 6 points. The Russell 2000 index of small cap shares ripping higher now by 1.5%. Interestingly, on an update from much of the market, our Mag 7 index is slumping by 0.4%. The 10-year at 4.10%, with the 2-year 3.56%. Gold up another 0.6%, 38.79 the ounce on the precious metal, while West Texas Intermediate crude bouncing back from yesterday's decline, up 1.1%. WTI 61.17 a barrel, and Bitcoin now up 0.2%, just below $121,000 on Bitcoin. So again, recapping here, the Dow, the S&P, NASDAQ, they're all advancing. Briefly, Amazon shares, they are trading higher, up under 0.1%. Chairman Jeff Bezos, by the way, says that spending on AI resembles, quote, an industrial bubble that could lead to lost investment, but will also make society better off. Amazon up by 0.1%. S&P up by 0.4%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. Paul Sweeney and Scarlett Fu here with you on this Friday. This is Bloomberg Intelligence, and we are keeping our eye on the market drivers here. And Nora Melinda, Bloomberg Television Markets correspondent, has our big movers of the hour. And Nora, get us started with the world's biggest asset manager, BlackRock.
Well, some potential M&A action going on here. So BlackRock's Global Infrastructure Partners is allegedly in advanced talks to acquire Align data centers. This could be valued at about $40 billion here in this particular transaction. Of course, we know this is ticker BLK. Really interesting activity going on. In terms of the stock performance right now, up about 0.3%. But they did note in the story here that we have out on the Bloomberg terminal that a spokesperson for BlackRock declined to comment here, but we do know that GIP hasn't reached a final agreement for Align data centers, and some details could potentially change. And as we know, since talks are ongoing, there's no guarantee that this ends in a transaction, but definitely some interesting news percolating here for BlackRock.
All right, how about Baidu over in China?
Yes, Baidu, looking at the ADRs right now, up about 1.3% as we speak, but earlier up as much as 2.7%, which hit its highest intraday level since 2023. And this is some news, of course, coming out of Morgan Stanley raising the price target on the company to 140 from 100, which it had before. They did maintain the equal weight rating there, but they do expect core ads to remain under pressure here for the company, but they've seen bullish sentiment, particularly in AI cloud, driving the stock to re-rate, and particular with its proprietary AI chip value is what the analyst there is talking about. And the new target here is slightly under what we do know the stock hit yesterday, which it closed at about 140.23. So that's getting a bit of a boost here. If you look at shares of Baidu, the ADR up 69% so far year to date.
And Rivian, Bloomberg reporting something not so long ago. The stock is down about 0.9%.
Right. We had automakers largely in focus over the past couple of days. Here in Rivian, ticker RIVN, really in focus today in particular after plans to do a redesign of its door in terms of addressing safety issues in particular. So reworking a key element there of its vehicle doors. And that's what you're seeing, of course, kind of affecting the stock today. Shares are down about 0.7%.
All right, Nora, thank you so much. Appreciate that. Norma Linda, Bloomberg Television Markets correspondent. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Well, Federal Reserve Governor Stephen Myron spoke earlier at Bloomberg Television anchors Mike McKee, Matt Miller, and Danny Berger. In this portion of the conversation, he was first asked about Fed policy moving forward. Let's take a listen.
My view is that policy should be forward-looking, right? I don't necessarily have a forecast that those items are going to continue rising. In fact, I think that a lot of them will actually reverse somewhat. But for my process, what matters most of all is the cost of housing, because that is the single largest component of the inflation process. And it's also one of the things that people notice the most. They notice when their rent surges. They notice when the cost of shelter increases. And that's why it gets the largest weight in the inflation indices. And my expectation is that we've just experienced, the biggest population shocks to both the upside and the downside in my lifetime, and I think in most people's lifetimes. And to me, it would be very surprising if that left no lingering trace on the price of shelter. And so I am expecting a significant disinflation to the services component of the inflation indices driven by shelter, which is affected to an extent by changes in population growth.
Well, we were talking before we came on about your view of R-star, the neutral rate. We've got inflation running at basically 3%. You've got unemployment at 4.3%, which is historically very low. The Atlanta Fed says we're growing 3.8% or grew 3.8% in the third quarter. There's no economic model that I know of that would get you to a near zero neutral rate with those kind of conditions.
Yeah, so first of all, I have seen some folks argue that they think that my conception of the neutral rate is zero. That's not the case. I think that's a misreading of the speech. If you read the speech carefully, you'll notice that I do a weighted average of a model implied ex ante and a market implied ex ante rate, and it comes to about a half. And that's consistent with the dot that I put down on the statement, on the summary of economic projections. And so I basically thought, sort of going into things last year, there were all these policies that were pushing R-star higher, like the highest population growth we'd seen in decades, the largest sustainable fiscal deficits we'd seen, sustained fiscal deficits we'd seen in a really long time. Those are pushing R-star higher. So last year, I really thought it was at the top of the range of where everyone else in the committee thought it was, and I think it's now come down this year to the bottom end of the range of where everyone else thinks it is.
But you can't model that.
What do you mean I can't model that?
The models, if you put in the numbers that we have right now, it wouldn't spit out near zero or 0.5%.
Oh, real rate. Well, no, but what I've done is modeled my expectations for inflation based on the changes that I see happening from housing, as we talked about a moment ago. I've modeled out changes to the output gap that I expect to see from policies that expand the supply side of the economy and therefore expand potential output faster than they would expand actual output. And some policies that we've seen enacted over the course of this year would push out potential and actual by the same amount or bring in potential and actual by the same amount. Other policies would push out one more than the other. And so for an example of one that would push out one more than the other would be deregulation, right? I think that the regulatory state has been being peeled back over the course of this year, and all indications are that will accelerate, particularly as the pace of confirmations of appointees has just picked up as well. That, in my mind, will accelerate the pace of deregulation, too. And when you remove regulations, you expand the potential output of the economy faster than actual output. And so that creates a positive output gap.
Michael McKee there, our senior economics and policy correspondent. And of course, he was one of the folks who was pushing back against what Stephen Myron, the new Fed governor, was saying. So, and Mike is here with us now. Mike, how out of consensus is Myron's view compared to the rest of Wall Street economists?
Very much so. The rest of Wall Street economists are divided between those who think we should cut rates and those who think we should probably hold on because we don't know what's going to happen to inflation. But those who are arguing for a rate cut are looking at maybe 50 basis points for the rest of the year, and maybe another quarter point or two in 2026, not 125 basis points before the end of the year. So he is very much out of consensus.
Well, and I remember we ran this interview this morning live, and he also did say hey, I'm not, if you look out a year or two, I'm not really that far out of consensus. It's just a question of timing. I want to get there sooner rather than maybe the market does. Does that hold water, do you think?
Well, it sort of does, in the sense that he's pushing for this immediate big rate cut, but he has not pushed for a rate cut that would equal what Donald Trump has called for, 300 basis points. So it's true, if you go to the end of 2026, he's sort of in the same ballpark of about a 3% rate. Now, the question is, again, how fast do you get there? He's talking about, and this gets confusing. He and I were talking about before we went on the air about how if we talked a lot about Art Starr, everybody would be turning off the radio. Right. But the argument we were talking about is the nominal rate versus the real rate. His real rate is about 0.5%. And then you add in 2% inflation, and in theory, you'd get 2.5%. So the fact that he's only saying 3% in a year and a half, he's not too far out of consensus there.
Mm-hmm. Does Stephen Miron serve a valuable role on the Fed board? I mean, Neil Dutta of RenMac says that one thing Miron has done that none of the Biden appointees have done is open his mouth and say what's on his mind and happily take questions from the financial press. He's putting his views out there and kind of throwing it out there and willing to debate them, and that provides a fresh perspective.
I would say I give him credit for coming in and for doing this. Now, he's got a motivation to do it because he is the one that's way out of consensus and representing the Trump administration. So he wants to get his arguments out there. I don't think it's fair. I would disagree with Neil's viewpoint that other members of the Open Market Committee don't meet with the press. I mean, I talk to Fed officials all the time, and sometimes off the record, sometimes on the record, but I think I have a pretty good feel for how each one of them feels, and I've debated with them about various aspects. So that part is probably not fair. Does he serve a purpose? I suppose he could, and then he brings up arguments that while they don't agree with them, maybe it gives them a chance to think about something that could, influence their views down the road. And I think that's what Miron is getting at, the down the road part.
Well, he certainly gave you guys a lot of time this morning to kind of ask all your questions. So that was good, certainly. Mike, thanks so much for joining us. Michael McKee, International Economics and Policy reporter there. Now let's get back down to D.C. because what we don't have is a government that is open. We did not get the jobs data today. And so we got to go to our go-to person down there in D.C., Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. Looking at your notes here, Nathan, today is essentially a lost day. What do you mean by that?
Well, I think Senator Thune has already said that, he's planning to send the Senate home for the weekend, and that, with yesterday being Yom Kippur, there really hasn't been much momentum or either party really seeing any desire to come together and having a negotiation. We have heard, Bloomberg News is reporting that there have been, bipartisan talks at the moderate Senate level, not involving leadership, about potentially what to do. But, they're already planning to go home. They're going to come back next week. And the idea here is when they come back next week, they'll figure it out. But I will just say that the Washington Post released some polling today showing that more Americans blame Republicans than Democrats. And so the big question that's going around Washington at the moment is, will President Trump and the director of the OMB embark on these widespread layoffs? And how does that change the political calculus? Because I think that come next week, presuming that there are no layoffs and that the Democrats and Republicans decide to negotiate, I think a deal can get done next week. That's the major question, though, is that, what will OMB do?
You say that very much everyone is still in the blame the other camp mode, where when they come out, it's a way of saying, hey, this is all the other guy's fault. Is that resonating with voters, with consumers, with ordinary people? Do they buy that? How much of it is everyone just splitting along tribal lines here?
So it's tribal lines right now, but the polling suggested that independents are favoring Democrats more than Republicans, partly because of the increased awareness of the Obamacare subsidies expiration debate. At the end of the year, a lot of premiums for Obamacare will go up, or actually sooner rather than that, because these subsidies expire. And with the Democrats focusing on one message, that seemed to be resonating a little bit. However, the Republicans also have a good story to tell in which to say that, look, we are the ones that are trying to keep the government open by offering a clean CR. And so right now, I think both sides are just trying to shore up their base. And then when the House Republicans come back next week, because right now they're out of town, when everybody is back next week, that's when you're going to see negotiations really kick off. What I'm looking for are two things. I'm looking for, what Senator Thune and what Senator Schumer are going to say over the weekend. And I'm also going to look and see what moderate Democrats step forward to say maybe this is something that we should deal with, because two Democrats and an independent that caucuses with the Democrats have already gone against Senator Schumer to vote for the reopening of a government. Let's look at those Virginia, Maryland senators to see what they want to do in terms of OMB, and some of those purple state senators to see if they want to keep the government open.
So, Nathan, in the next hour of Bloomberg Television, I'll be speaking with Jeb Hensarling, who's the former chair of the House Financial Services Committee. And back in 2013, he co-sponsored a government shutdown prevention act that would provide for automatic continuing resolutions to avoid budget standoffs that never made it get past committee. And that didn't go anywhere, so there's no legacy there. But I'm wondering, should Congress revisit that idea of automatic CRs, or is that simply impossible in this current political climate?
You would find very little individuals on the Republican side that would actually vote for that, because then the question is, why should we do budget appropriations in the first place if we just can't come to an agreement, the government stays open? Continuing resolutions are not popular with a significant portion of the Republican Party. In fact, Senator Rand Paul voted against the deal to keep the government open solely because of that. And so when, former Chairman Hensarling proposed that, it came in the idea of this Tea Party, shutdown that occurred at the end of 2013. But I would just note is that even though the Republicans did take a lot of the blame at the time, in 2014, they made significant gains both in the Senate and the House as a course of that. So shutdowns, as much as the American populace hate them, they are political, and they are political for a reason. And for some policymakers, stories and politics can actually be beneficial based off of them.
Nathan, just about 30 seconds. You live down there in D.C. Are your neighbors and friends, are they concerned about their jobs, the ones that work in the government?
Yeah, anecdotally from the flag football fields over this past weekend, that was the #1 question I got. And I will say traffic coming in this morning felt like the Friday before Labor Day. There is a lot of widespread angst over what the OMB is going to do. And what I tell to my clients, and more importantly to my friends, is that I think this weekend you may see a strategic layoff, something that provides noise and gets the Democrats on notice. But I think there's a lot of Republicans out there that are a little uneasy the idea of widespread layoffs.
All right, Nathan, thanks so much. Always appreciate your reporting. Nathan Dean, Senior Policy Analyst from Bloomberg Intelligence down there in D.C. Coming up, it is Friday, which means we talk municipal bonds, baby. You can get some tax equivalent yields in high-tax states that are really, really attractive. So we'll talk to Eric Kazansky. He's in the high. That's coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got the S&P 500 index holding close to session highs. We're trading at a record. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. The Dow, the S&P, NASDAQ all advancing. We're looking at records as big ticket AI deals and partnerships were announced, but gains later chipped away at by a reading on business activity. The S&P 500 index right now is advancing 27 points, as I mentioned, close to session highs at a record 67.42, or up 0.4%. The Dow up 338, up 0.7%. NASDAQ up 63 for the composite index, a gain of 0.3%. The NASDAQ 100 index up 0.1%. Cannot ignore the move in the Russell 2000 index. It is ripping higher now by 1.3%. 10-year at 4.10% on a non-jobs Friday. We've got the 2-year 3.56%. Spot gold is up $27 the ounce, 38.83 on the precious metal. That's an advance now of 0.7%. West Texas Intermediate crude up 1%, 61.05 a barrel on WTI, and Bitcoin up 0.6%, 121,485 on Bitcoin. Earnings news: Applied Materials, which is the largest American maker of machinery used to manufacture semiconductors, said an expansion of rules that restrict the export of its products to China will take another chunk out of its revenue. Shares of Applied Materials, they're down today on an update for the rest of the market. Shares of Applied down by 2.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Let's talk municipal bonds, because why? It's Friday, and that's what we do. Eric Kazatsky, Managing Director and Client Portfolio Manager at Mackay Municipal Managers, joins us here. Eric, September's now in the books. How was it for the muni investor?
Amazing. And I'm really happy to say that. Paul, as you know, I came over to Mackay in June, and I'll be honest, the first 6 weeks, it felt like I was on an apology tour for the municipal asset class. But I think the good news is there's been a huge tone shift in the market, and I'm excited to get on the road and talk to people about how well munis are doing, especially long munis.
Especially long munis. And I guess, you know, it's a surprise given that the first half was not great. What do you attribute the turnaround to?
It's been a couple things, right? If you sort of think about duration, the curve steepened, and that was a big part of it. You know, if you look at the curve at the beginning of the year, Scarlett, we shouldn't have a flat yield curve. It's just abnormal. Shouldn't be like that. You don't get paid for risk or extension. So the curve normalized, and that was painful for a lot of returns. But, you know, more to the point, there was a lack of institutional buying on the long end of the curve. Insurance companies and banks, they just didn't know what their tax rate was going to be. A lot of uncertainty, but that's out of the way now.
So I'm really curious about that last comment you made about insurance companies and their role. How powerful a force are they? I mean, they're clearly a source of a lot of flows. How quickly can they change the shape of the yield curve? How quickly can they change issuance?
Yeah, well, if you sort of look at, let's say, like the value on the long end of the curve, muni treasury ratios, so they got as cheap as about 96% prior to the OBBBA, getting finalized. And so we've seen them tighten to about 88 to 90%. So they have had an influence. Banks and insurance companies, and also a little bit of stronger mutual fund flows, all sort of have combined to help performance be a little bit stronger on that long end.
Flows, how do the flows look? Are flows starting to follow performance?
Yeah, we are actually seeing an uptick in fund flows. Right now, we're about plus 10-ish billion for the year. That's, you know, comparable run rate for last year, which we ended up about 20 billion. Look, certainly not as strong as we want to see it, and money keeps going to the areas that are like cheaper beta, SMAs and ETFs. But look, I think active management still has a case here to be made.
Let me just jump in here. We have a red head crossing the Bloomberg terminal. China is pushing President Trump to drop curbs as it dangles investments. This is according to Bloomberg reporting that China is pushing the White House to roll back these national security restrictions on Chinese deals in the U.S. And they're holding the carrot of a massive investment package as part of this proposal that would really change upend a decade of policy. Again, this is according to Bloomberg reporting. Xi Jinping's negotiators are also demanding lowering tariffs on imported inputs from China used by any, or from the U.S., excuse me, used by any Chinese factories built in the U.S. as a result. So we'll continue to keep you posted on these developments.
Lots of back and forth in that part of the world. Eric, we're speaking with Eric Kazatsky, Municipal Portfolio Manager at Mackay Municipal Managers. Eric, talk to us about the new issuance market. How's it been this year, and what's the outlook for the last couple of months here?
I mean, Paul, if you asked me 5 years ago if our market could sustain 550 billion years and years, I mean, I would say you were crazy. We just weren't set up for that. But I'm happy to be wrong. It's been really orderly. Like I said, the long end of the curve was a little squishy in the beginning of the year, but that's since reversed, and we're on track for another record year. Now, the questions we're getting from clients are, can we keep this pace into next year? And, you know, right now, the pipelines at these investment banking firms, it's still pretty robust. And you know what? They have a backlog of deals that need to get done. So we're not calling for that to be going lower anytime sooner.
Eric, we can't let you go without asking about the government shutdown. We're in day 3 of this shutdown. Is that a problem? Is that an issue for municipal governments, municipal debt at all?
Yeah, I mean, during my career, we've had a bunch of government shutdowns, and every time we get asked about the impact on the muni market, and it's largely been benign. Sure, I think if this is really prolonged and there's lots of joblessness that spikes up, it could impact on the margin state and local credits, but we're just not seeing that as sort of the timeline here for a resolution.
All right, Eric, thanks so much for joining us. Appreciate it, as always. Eric Kazatsky, he's a managing director, and he's a client portfolio manager at Mackay Municipal Managers. Joining us from Princeton, New Jersey via that Zoom thing. We're getting right smack into it, getting into the holiday shopping season. I know it's only the beginning of October, but we're starting to see it. And the question is, what's it going to be like in there, particularly for the toy part of the market? Lindsay Dutch joins us. She's Bloomberg Intelligence Consumer Hardlines Senior Analyst. And here we go. Toy makers face demand uncertainty and risks ahead of holiday buying. Lindsay, talk to us about kind of the toy business as we go into this all-important holiday shopping season.
Hi, Paul. Thanks for having me. I think the outlook for toys is really interesting, and I'm really excited to hear more from management teams when we get the third quarter earnings in late October. The demand picture looks very uncertain. You know, this was supposed to be an up year for toys, but you know, tariffs and just broader economic uncertainty has really weighed on the sector. But I think the bigger issue in particular this year is, you know, because of the tariff announcements in April and lots of uncertainty, big retailers, you're talking Walmart, Target, basically held back on placing their orders, which they would normally place for holiday in the second quarter. They did place the orders. They're receiving them in the third quarter. So we did, you know, get that back. But because of that delay and because these retailers are really looking to sell through their inventory, I think that the opportunity for reorders for some of those like hot holiday toy items is limited. And that's really going to weigh this year on those toy makers.
Is there going to be a shortage of toys that people want to buy? Is that going to be a problem in 2025?
I mean, that could be a possibility. If something is like really, really hot, we could go back to those days where you're like standing at the store door early on a Black Friday morning to get the, you know, one of 20 that Walmart has. There's a possibility for that because I don't really think that there's going to be a lot of reordering. I do think the toy makers are trying to prepare. They are taking on inventory because the other thing that Walmart and Target did is, because of the tariffs, they would have typically imported, you know, in their contract with Mattel or Hasbro, they would have imported the product like direct to their own warehouse. But they kind of switched their plan a little bit. And it's really the toy makers that are importing it to the US and sort of replenishing the Walmart or Target warehouse from like domestically. So there's also a shift in sort of how the order is being placed. And so it just is creating a really uncertain environment in the back half.
Lindsay, what about the closing of the de minimis exemption? Before this, a lot of Americans were buying directly from websites overseas and just getting stuff shipped to them from China, from the UK, from other parts of the world. And now that their consumers will be taxed on it, they face a tariff, that avenue might have been closed off. So that leaves them going to the traditional distributors as a result. How do you see that playing out?
Yeah, I think that could have an effect. I mean, when you think about these big toy makers, Hasbro, Mattel, even Spin Master, which is a little bit on the smaller side, a lot of their product is flowing through big box national retailers. So it might not have a huge impact on them specifically. We could see the consumer, switch avenues a little bit. But Walmart, Target are still, and those big national retailers are still huge and where people do go to shop for toys. I mean, we still also have Toys R Us trying to make a comeback and Macy's stores, and Kohl's also being a bigger push into toys. So you could see a little bit of shift in, I guess, where the consumer shops, but we don't see that having a major impact on these companies.
And are the toy makers viewing tariffs as a one-time thing they have to deal with, or are they thinking that it might be something longer term?
They have been working to diversify supply chains for some time now. It's kind of wild to think about, but when we came into this year, Hasbro and Mattel were 40 to 50% of their toys manufactured in China. That was actually almost half of the broader industry average. And, when you think about toys in general, upwards of 80 to 85% were made in China. There's been a lot of diversification, acceleration of diversification efforts happening this year, redistribution of sourcing, how they're sourcing U.S. sold product. There's also been changes in pricing and, are we going to be able to sell this product in the U.S. or not because of tariffs. So there's been a lot of change this year. We don't have disclosure on exact numbers anymore, but I think that, the companies will continue to try to sort of maximize their efforts. But Hasbro and Mattel have said that tariffs will be about $100 million in 25 in terms of cost. That's even with price increases going into effect, and that cost could be about the same or more in at least 26.
All right, Lindsay, thank you so much. Lindsay Dutch is Consumer Hardlines Senior Analyst for Bloomberg Intelligence. I remember when my brother was younger, he used to look at the back of his G.I. Joe and say, oh, it's made in Hong Kong. And when we went to Hong Kong, he wanted to buy G.I. Joes, thinking he could visit the factory and just get a G.I. Joe, because that makes sense, right?
Made in Hong Kong, yeah, exactly. Now, I'm not sure where they're made.
That is the thing.
Yeah, now that you've got so many people trying to diversify their supply chains to reduce some of that geopolitical risk.
Maybe just the head of the G.I. Joe's made in Hong Kong.
G.I. Joe with the Kung Fu grip. That's always there. S&P 500 up 25 points, a Dow up 340 points, and NASDAQ up 50 points. We've got some green on the screen here today. We're going to have more coming up. This is Bloomberg Intelligence. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the U.S. stock market trading at another record today with the Dow, the S&P, NASDAQ. They're all advancing, stocks touching records as another round of big-ticket AI deals and partnerships that happened before we got that reading on business activity, and that chipped away at the gains. NASDAQ 100 right now is advancing, holding on to an earlier gain. We've got the NASDAQ 100, little change though, up 10 points, up under 0.1%. The S&P 500 index keeping it all in context, up 0.3%, up 23, 67.39 where we stand on the S&P. The Dow at a record up 347, up another 0.7%. The Russell 2000 index of small cap shares, that's the outperformer, up now by 1.2%. Our Mag 7 index is trading lower. That index down now by about 0.4%. Tesla shares are slumping by 1.5%. 10-year, 4.10%, with the 2-year, 3.56%. Gold up $30 the ounce to $38.86, up 0.8%. West Texas Intermediate crude, 61 even a barrel. WTI up by 0.8%. And Bitcoin up now by 0.9%, 121,821 a token on Bitcoin. As for what's going on elsewhere in terms of the economic data, we've got Jobs Friday, but without any numbers. Frances Donald is chief economist at RBC. She was a guest on Bloomberg Surveillance.
This is a labor market that is structurally very different. We don't need the same amount of job growth as we did before. We only believe that this economy needs to create 40,000 jobs a month for the unemployment rate to stay stable. We know growth is slowing off the back of tariffs and some price pressures that are coming through, and we know inflation is likely to reaccelerate into year end. And I could, for a month, go dark on data and tell you that I'm still fairly confident that will be the story 30 days from now.
Frances Donald of RBC. Apple has received a relatively rare bearish analyst rating today as Jefferies warned that expectations surrounding how fast customers will upgrade their iPhones had become excessive. The stock's consensus recommendation, a proxy for the ratio of buy, hold, and sell ratings, now stands at 3.93 out of 5, making Apple the least loved of the Mag 7 except for Tesla. Right now we have got Apple shares. They're gaining. Apple today up by 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio and streaming live on YouTube as well. As Charlie's just reporting more highs for the stock market. I mean, if you're concerned out there, you can certainly cite valuation at or near some high valuation levels for sure. But if you're bullish, you're saying, hey, that's because the earnings are out there to support it. The courage to be into the market, as Tom Keene would call it. Let's see what the pros are doing these days. Kathy Entwistle, Morgan Stanley Managing Director in the Private Wealth Advisor Group. She's up there in lovely Ridgewood, New Jersey. Kathy, what are the conversations you're having with your clients these days to the extent that they are maybe concerned about how far and how quickly this market has moved high?
Absolutely. Great to be here, Paul. Thank you for having me. We have been having lots of conversations. There's a lot of information. Things are changing, day to day, really. And at the end of the day, we're looking to make sure clients are comfortable with the allocation that we have put them in, and that they understand that the money that is invested is for long term, and we have to go through these ups and downs that are short term and take advantage of pullbacks when they come. We haven't really had that recently, of course. So it's more about legging in cash slowly into the markets and areas that we really like.
Yeah, I'm glad you amended that because I was thinking ups and downs. Yes, there's ups, but I haven't seen a whole lot of downs lately. The S&P and the NASDAQ both at record highs. The Russell actually outperforming today. So if your clients wanted to start a new position, is now the time to do that?
We do have clients that do, are newer clients with cash, and we are starting to invest them and leg them into the market as well. The easy ones are, the fixed income, municipal bonds. It's easy to go into municipal bonds right now with new cash and get that position full. In that respect, it's also easy to look at alternative investments and do some alternative investments full on. And the equity side, we're legging into the market. There's just no other way to do it. And taking advantage where we can. But, obviously right now there's no taking advantage. So we just have a systemized process going on. And if for some reason we get a big pullback, we're going to take that future cash flow that was going in and just put it right in right away.
Kathy, what's the discussion with your clients these days about alternative investments? There's so much in the press about the growth of private credit, for example, and private equity has always been out there. Hedge funds have always been out there. What's your conversation about alts like?
Yeah, well, we're always looking for non-correlated assets, and alternatives are definitely a non-correlated asset to the markets. We're not necessarily going to see them go up as high when equities go up or, as low as when they go down. And it just adds a different layer to their portfolio. I would say most clients now are looking at, 10 to 20%, some more, depending on their specifics, to keep into the alternative markets. And if you think about it, if you're looking at credit, you're just thinking about fixed income, but in a different structure. Or if you're thinking about private equity, you're thinking about like the equity market, but a different structure. So it's more about also infrastructure is a really interesting area right now that we really like, and it provides some growth and some yield. And we also like commodities in general. So those are areas that clients can look at, as well as these newer evergreen alternatives that are designed to be more amenable to individual investors versus institutions and endowments.
When you talk about commodities, does that include gold, which seems to scale new heights every day? And how do your customers think about that versus your clients think about that versus, say, cryptocurrencies like Bitcoin?
Yeah, Morgan Stanley's position on cryptocurrency is to have access to that if it's in your risk tolerance, but really not to have too much of your portfolio there. 1%, which is not a large amount at all, is the percentage that we're recommending to clients if they're going to dip their toes in cryptocurrencies. And we also underline that it's very volatile asset class, and we've certainly seen a big run, so it makes it more interesting and exciting to be involved in that, but it can come down just as fast and hard as it went up. So we just want clients to be aware of what they're investing in and if it's something that is worth that risk to them.
Kathy, what's your position towards cash these days?
Yeah, well, cash is still important. Look, the Fed cut rates, obviously, just last week or the week prior, and 25 basis points. So all of the, high yield money markets have cut by 25 basis points for the most part as well. So the trend is down at the moment. So we do want to use cash for opportunities, but it's still short term when we're holding cash. And if we have cash that we were saving for long term, you definitely want to get into the fixed income, high grade corporates or munis, depending on your personal situation. But you want to get your cash longer invested, more intermediate term, not short term.
High grade has had an incredible September. High yield has had an incredible September in terms of issuance. There's a lot of supply out there, but there's been a lot of demand for it as well. How worried are you about the tightness of spreads?
Yeah, I am a little concerned. When you think about it, you're not really getting paid for the risk. And I think we really haven't seen that risk in high yields in a while, and people have a short memory. But there is risk there, and the tightened credit now, you don't get paid for that risk. So I say, stick to the high grade versus high yield right now.
Kathy, thank you so much for joining us. We always appreciate getting a few minutes of your time. Kathy Entwistle. She's Morgan Stanley Managing Director and the Private Wealth Advisor based in Ridgewood, New Jersey. And again, you're looking at the markets here. It's another pretty solid day here for these markets as we grind higher, as Tom Keene
Yeah, we don't have any data to trade off of, but it doesn't seem to matter. You do have some big AI deals, the latest of which is BlackRock making this big push towards data centers. The Global Infrastructure Partners advanced talks to acquire Align Data Centers for some massive amount of money that could value that company at about $40 billion, give or take.
I know, and I was just reading Brooke Sutherland, Bloomberg Boston Bureau Chief. She's coming up next. I was just reading her newsletter, and she's like, hey, my industrial companies are kind of unloved here. I mean, if you don't have an AI play, and even real estate is an AI play, utilities are an
I'm sure
AI
we could
play.
come up with an AI play for those guys.
Yeah, it seems like you kind of need to. So we're talking to Brooke Sutherland coming up in the next segment. We'll see what's happening in the world of industrials. Think Danaher, think General Electric, all that kind of good stuff. That's all going to be coming up in just a moment. S&P 500 up 28 points. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well, so check us out there. You know, it seems like over the last 2 or 3 years, this is a market that has been dominated by AI. First started with NVIDIA and then branching out to other names that may have exposure to what may be a once-in-a-lifetime type of investment cycle here. And that's leaving a lot of other companies, maybe some industrial companies, out of the, kind of in the shadows a little bit. And our next guest is going to talk to us about that. Brooke Sutherland. She's a Boston Bureau Chief and author of the Industrial Strength newsletter at Bloomberg News. She's up there in Boston. So, Brooke, I know your coverage of industrial companies, I'm thinking, the Donahers of the world, the General Electric, some of those big industrial companies, they're not necessarily getting the benefit of the AI kind of tailwinds, if you will. Talk to us about that.
It depends on what kind of industrial company you're talking about, because there are some industrial companies that are very much riding this AI wave, along with the likes of NVIDIA and some of the data center real estate companies. So if you think about suppliers of electrical equipment, of gas power turbines, of cooling systems that are really important for data centers, those companies are seeing way more demand from that data center side of the economy than they can keep up with. Really, you're seeing a huge rush to add capacity. But then you have, sort of your more traditional industrial companies, which are really grappling with the fallout from Trump's tariffs and the the investment lull that has caused, as well as rising costs and just sort of a general sluggishness in the industrial economy. And so you're really sort of seeing this AI split between industrial companies that really cater toward that AI theme and those who really don't.
You talked to us in your most recent column about M&A compounders. What's an M&A compounder in your mind?
Sure. So this is a model that, is really best known with companies like Danaher and Roper and IDEX and Ametek. And these companies built themselves through a series of acquisitions. And they really targeted well-run companies, but that could perhaps be run a little bit more efficiently under their mantle, and primarily companies that threw off a lot of cash. And then the idea would be that they would then take that cash and compound it by reinvesting it in the next acquisition. And this is a model that worked very, very well for these companies, and they were really the darlings of the industrial world for much of that post-financial crisis period of low interest rates. And now the model is not broken. You're just not seeing investors really flock to it in the way that they were before, partly because you are seeing so much growth on that AI side of the industrial economy that there's not as much of an attraction toward that acquired growth that the M&A compounders offered.
In your kind of industrial world, broadly defined, Brooke, what's the kind of what's the feeling these days about tariffs and kind of the impact on industrial America? Do you have to go company by company, or are you starting to see some themes here?
I mean, I think the most common theme that you hear is that there's just a pullback in spending as companies wait to see how tariffs are going to shake out. And what I hear from a lot of CEOs is that the actual rates don't matter as much as just having some certainty, some sense of these are all the tariffs that there are going to be, and this is what it's going to look like going forward. And instead, what you've seen from the Trump administration is continual announcements of new tariffs. Just recently, we had tariffs on furniture, lumber. They made some announcements regarding the 232 tariffs as it relates to derivative products of aluminum and steel, which will hit the industrial sector really hard. And so it's very difficult to move forward with investments when you don't know what things are going to cost and you don't know what the playing field is going to look like at the point when you might actually be building these things. Just remember, these are very long processes, and so you want to have sort of all of your data points squared away before you move forward. And I just think that uncertainty is really crippling, and I think that's what you're seeing the most, from industrial companies, that there's this like sort of moment of hesitancy right now because of all the uncertainty.
Well, certainly one policy pillar of the Trump administration is to kind of bring more manufacturing back to the United States, reshoring a lot of those industries that maybe had left for other parts of the world and lower costs. Are you seeing that? Is it still in the discussion phase? Or announcements being made, investments being made?
We're seeing a lot of announcements. It's way too early to see shovels going in the ground in any kind of new reshoring wave. Even in the best case scenario, again, these two are long-term projects, but we are seeing a lot of announcements. There's a lot of enthusiasm, that there will be a reshoring wave, that there will be, a lot of investments in factory capacity. I do think there's a lot of issues that need to be dealt with before we get to that point, including who's going to work at these factories. We have, 400,000 job openings in manufacturing as it is, and companies constantly complain that they cannot find enough people to work in the facilities that they have. And so I think there's a big question of, how are you actually going to build all of this stuff? Because the construction labor market is also very tight, especially as you're trying to build a bunch of data centers at the same time. And then also who's going to work in the factories? And the answer is probably more automation. But for a lot of smaller companies, that can be very expensive. That's not that straightforward. It's not that easy to do. It can be a very pricey endeavor. And the Trump administration is also looking at tariffs on robotics and certain kinds of industrial machinery that may also make that calculus much harder.
All right, Brooke, there's a lot of cross currents out there for sure in the industrial world, as there is in the broader economy. Brooke Sutherland, she is the Boston Bureau Chief and author of the Industrial Strength newsletter at Bloomberg News, and she's up there in Boston. We appreciate getting a few minutes of her time here. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. We got the S&P up 33 points. That's 0.5%. The Dow's up a solid 455 points. That's 1% higher. And the NASDAQ up 64 points. That's 0.3% higher. As Charlie Pellet was calling out just before, I'm going to call that out as well. The small cap stocks are really doing well today. The Russell 2000 is up 35 points. That's about 1.5%. So that's the best performance out there. The 10-year Treasury yield 4.10%. That's up 2 basis points. WTI crude oil, $61 a barrel. Gold higher yet again. All right, that does it for Scarlett and myself. More Bloomberg Radio coming up. This is Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
And prosecutors and attorneys for Sean Diddy Combs are getting their last words in with a judge in New York just before he sentences the music mogul on prostitution-related charges. CBS's Anna Schechter.
The prosecution, the government is arguing why they believe 11 years is what is required here. They're describing years of misconduct that they're characterizing, those freak-offs that occurred over years, abuse and violence that happened within these long-term relationships that we learned about during the trial.
President Trump has given Hamas a Sunday deadline to sign on to the latest peace plan. CBS's Michael Wallace.
In a social media post, Trump says if an agreement is not reached, all hell like no one has ever seen before will break out against Hamas. He says there will be peace in the Middle East one way or another. When Trump unveiled the proposal earlier this week, Hamas said it would study it. The plan would place Gaza under a temporary governing committee led by Trump. Hamas fighters would be allowed to leave Gaza. The group would disarm and release all remaining hostages.
The White House says it will withhold just over $2 billion for Chicago infrastructure projects, expanding funding battles that have targeted Democratic areas during the government shutdown. Senate GOP leader John Thune.
We will have a vote, and it'll be the fourth time that Democrats will have an opportunity to vote to keep the government open. Now, at some point, reason, good sense, common sense has to take effect here.
The government shutdown prevented release of jobs data that was set for this morning. Constance Hunter is with The Economist.
The tricky thing about taking a snapshot of the economy at this time is that the conditions are very possibly about to change due to shocks to the economy, such as tariffs.
The U.S. Supreme Court says it will consider overturning a Hawaii law that imposes strict regulations on where people can carry guns. Protests going on today at an ice processing facility in Broadview, Illinois, just outside Chicago. Reporter Nancy Hardy of affiliate WBBM is on hand.
Protesters are here, many wearing helmets and have respirators in case and goggles in case there is tear gas or those pepper balls that send up pepper spray throughout the air that we have seen in the last couple of weeks.
A statue depicting Donald Trump holding hands with Jeffrey Epstein has reappeared in Washington, D.C. near the Capitol. Authorities removed it last week. Wall Street, right now the Dow is up 446 points. This is CBS News. Done. 30 years ago today, O.J. Simpson was found not guilty of murdering his ex-wife, Nicole Brown Simpson, and a friend, Ron Goldman.
The nation watched the trial of the century on cable news from beginning to end, riveted as Simpson's powerhouse dream team of lawyers, including Robert Kardashian, F. Lee Bailey, Robert Shapiro, and Johnny Cochran, fought the prosecution at every turn.
If it doesn't fit,
You must acquit. In the end, the defense overpowered prosecutors Marcia Clark and Christopher Darden and got the verdict they'd been fighting for.
We, the jury, in the above entitled action, find the defendant, Orenthal James Simpson, not guilty of the crime of murder.
The former NFL powerhouse, charismatic actor, spokesperson, and broadcaster was set free. Christopher Cruz, CBS News.
Balin Miller, a 23-year-old climber who had gained international attention, died this week in a fall from Yosemite National Park's El Capitan. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Day 3 of the shutdown. Welcome to the Friday edition as the Senate prepares to vote once again on stopgap funding bills that are once again expected to fail. We'll get the latest from Jack Fitzpatrick. He's live on Capitol Hill, and we'll have insights from Republican strategist Maura Gillespie, who navigated the Obamacare shutdown with then Speaker John Boehner. And as President Trump halts infrastructure spending in another blue state, we're going to have analysis from our panel today. They're both with us. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis. With the government still dark, we turn to Wall Street to set the baseline, and Charlie Pellet has the latest for us on the markets. The Friday trade. Charlie, how's it going?
Thank you very much, Joe Matthew. A Friday, a jobs Friday without any jobs data. We've got stocks so pushing higher. In fact, just about the best level of the day right now with the S&P up 34, 67.49 where we stand. That is a gain of 0.5%. The Dow up 473 now, higher by 1%. Dow Industrials at 46,993 on the Dow. NASDAQ up by 68 points. That is a gain of 0.3%. The Bloomberg Mag 7 index on an up day for the rest of the market is trading lower, down by 0.2%. Tesla shares, they're down by 1.5%. Your 10-year, 4.10%, with the 2-year, 3.56%. Gold ripping higher again today, up another $31, closing in on $3,900, $38.87 right now on the precious metal. That is a gain of 0.8%. And West Texas Intermediate crude just above $61 a barrel, up now by 1%. Bitcoin up 1.9% at 122,980 on a Bitcoin. So stocks at records amid the big ticket artificial intelligence deals and partnerships. Again, the S&P 500 index up now by 0.5%. Sources tell Bloomberg Rivian Automotive is reworking a key element of its vehicle doors after employees and customers raise concerns over potential safety issues with the current design. Those sources say Rivian plans to incorporate a manual release that is more clearly visible. Bloomberg reported last month on issues with Tesla's doors, and U.S. auto safety regulators subsequently opened an investigation into the company over that matter. Tesla shares, they're down now by 1.5%. Rivian, lower little change, down under 0.1%. So again, recapping, stocks are at records, specifically the Dow, the S&P, NASDAQ, and the NASDAQ 100 index. S&P now up by 0.5%. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, great to see you. Happy Friday, my friend. Live from New York, Charlie Pellet will have more on the markets in about 15 minutes. We do it every day like this here on Balance of Power. I'm glad you came along on Bloomberg Radio, on the satellite radio, Sirius XM channel 121. We're always live on YouTube. Search Bloomberg Business News Live to catch all of our shows up and down the Amtrak corridor and beyond, for that matter. It's the coolest thing we've got going. You can pause it, rewind it. Did I hear that right? Yes, on YouTube, Bloomberg Business News Live. So it's day 3. Yeah, welcome to the threshold of the weekend. Does it feel like day 3? This has been another 2 weeks in one, right? Everyone's exhausted. Everyone's feeling a little hungover around Washington when it comes, of course, to policy, because no one is getting along. As we heard from earlier today, the 2 Republican leaders on Capitol Hill came together, Speaker Mike Johnson and Senate Leader John Thune, to call out Democrats once again, because we're going to be voting once again today, the 2 bills, the Republican version and the Democratic version, the 2 CRs that keep failing are going to fail again. Here are the 2 leaders.
They did it 13 times during the Biden administration in the previous 4 years, but suddenly they won't do it. So everybody has to ask themselves why. It has nothing to do with health care, the subsidies that they're saying is the issue is not the issue. That is an issue for the end of the year.
They have an opportunity, a fourth opportunity, fourth time today, fourth time to vote, to open up the government and to allow us to do the rest of the work that the American people expects us to do. They have taken hostage the federal government and by extension the American people.
Isn't it funny how we do this? We know it's going to fail, but we're going to do it anyway. And I guess there is a purpose here, right? The Republican leadership is trying to not only call out Democrats, but get them on the record so you can say in a campaign spot or in an interview here on Bloomberg, they voted to keep the government closed 4 times. And by the way, there'll probably be more. They're going to go home this weekend, but they'll be back Monday. And we're going to keep doing this process until they either pick off enough Democrats or there's some kind of a deal. And that's nowhere in sight right now when it comes to extending Obamacare subsidies. We turn to the king of Capitol Hill. He's there right now. And if you're on YouTube, you'll see what I'm talking about. It's a beautiful day in Washington. Jack Fitzpatrick outside the Capitol with us, Bloomberg Government's congressional reporter. And Jack, you must feel like it's deja vu, Groundhog Day. What's going to happen next couple hours?
Well, we're on take 4. You're right. It's a beautiful day outside in Washington, but it's just pressure building in this building, pressure and anger and resentment building as the shutdown goes on, and we go to our 4th series of votes on measures that have already failed to end the shutdown and fund the government. There have been conversations among members, but no real negotiations. There's not a core group of negotiators who have said, put us in charge, instead of the congressional leaders and the president who have not really gotten anywhere. Really, this is a matter of waiting for one side to break, and neither side has broken, neither side has shifted their position. So we're still 5 Democratic votes short of passing the Republican proposal in the Senate and 13 Republican votes short of passing the Democratic proposal. It looks like these will fail again today, and then we'll be back Monday with more votes on the same exact measures that have failed already.
Pressure, anger, and resentment, says Jack Fitzpatrick. That pretty much encapsulates where we are. Now they're going to go home this weekend. Jack, what do you make of that decision by John Thune to let everybody go home and stew?
That's part of the rhetorical debate here. Is you'll hear some members say, why don't we stay in town? Why don't we keep doing this? The Republican position is there are no negotiations to be had. You let us know when you're going to vote for our bill that has passed the House and has a majority in the Senate. It's got 55 votes. That's 5 short of the 60 necessary. So again, there's pressure building, there's anger, but there's no movement in Congress. I will say the actions by Russell Vought, the budget director for the White House, to block funding that's supposed to go to Democratic states, that has the potential to rile people up. If there's going to be something breaking, that's kind of the action happening here. But that's in the White House. That's not in the Capitol. So here it's still just a waiting game to see if anyone will flinch.
Yeah, boy, you've been through enough of these, Jack. I wonder what you're hearing or what your gut's telling you. Is it more likely that Jeanne Shaheen or somebody puts together a gang of 8 and they have a deal at hand that moves the ball, or that John Thune actually finds 5 more Democrats to vote this bill into action now?
The most direct path and immediate path to ending the shutdown is for Democrats to cave and say, let's keep having these conversations on health care. I will say the likelihood of a very short shutdown seems to be lessening. One, because Russell Vought is consistently antagonizing these Democrats who really want something in writing to rein him in. Aside from the health care demands, they want something to stop him from impounding funds. And 2, we've seen a number of polls come out showing more people are blaming Republicans than Democrats. So it doesn't look like Democrats are about to fold, knowing that President Trump and congressional Republicans are taking more of the blame than they are.
So then we really could be in for a record shutdown here, right? I thought by the time we'd be walking into the weekend, Jack, there'd be news of a negotiating session, maybe a light at the end of the tunnel, but this could be protracted.
Yeah, there's no light at the end of the tunnel. Historically, if you look at the last time Democrats said we need a policy concession in order to vote to fund the government, that was January 2018 when they wanted something on DACA, and they gave up after 2 days. So it's fair to expect that the Democrats might give up on these demands quickly, but things are very different during Trump 2.0 than they were during Trump 1.0. The Democrats are more dug in. They feel there's no carrot compared to the stick. They feel like there's just animosity between them and Russell Vought and President Trump, and they need to make demands to get concessions because simply ending the shutdown isn't going to do much good.
So whose star is rising on the Democratic side? Because it doesn't feel like it's Chuck Schumer. And every time a Republican comes on the air here, Jack, you hear the same thing. They tell me that he's doing this because he's afraid of being primaried by AOC. Is she the one whose stock is rising? And is there some truth to this primary threat?
There are a couple ways to look at that. One, there was frustration with Senator Schumer after the March deal to fund the government when a lot of Democrats thought he gave up too easily. Maybe he should have shut the government down, or maybe he should have gotten more out of it. He has at least sufficiently placated his members and his base. But you're right to point to Alexandria Ocasio-Cortez as someone who is pretty vocal in urging her party's leadership to take a harder stance. You could put all sorts of members in that bucket, whether you're talking about members of the Congressional Progressive Caucus, Pramila Jayapal, et cetera. This is a matter of a lot of Democrats pushing their leadership to take a harder stance.
I love this. I feel like I'm hanging out with Jack with Class Outdoors today. You can call that dog over. I know he wants to meet you. Jack, I want to ask you about what's going on this weekend on Sea Island in Georgia, Sea Island Resort, where the NRSC is getting together for a Tony get-together that will include golf, pickleball, fishing, and shooting, according to an invitation obtained by Playbook. Has that been canceled?
Not to my knowledge yet. They still have that on the schedule for the NRSC, the Senate Republican campaign organization. There is sometimes some pressure in these situations against fundraising. You may have seen some coverage of where John Thune was going out to dinner. There's typically a lot of pressure to remain focused on the negotiations, but as the Republicans have said, there aren't negotiations happening. They are simply waiting on Democrats. It was a little surprising. They're not planning to be here at all this weekend, but if they were here, as things are going on now, there are no negotiations to continue. There are no other measures to vote on. So it's reflective of the unusual nature of this shutdown in particular.
Fascinating. Well, we appreciate this. Appreciate the field trip, Jack. It's great to see you. Stay outside if you can. It's 68 degrees and sunny right now in Washington. Those were real birds and a real dog, by the way. He's not standing in front of a green screen. I'm Joe Matthew in Washington, where, it was apparently Bistro Cacao, where filet mignon goes for $45 a head, and the Cabernet list ranges up to $750 a bottle. That's where Majority Rip John Barrasso and a couple of friends had dinner the other night on Capitol Hill. These are the kind of headlines that wouldn't make news unless, of course, the government was shut down. We'll talk about all of this and a lot more with Maura Gillespie. She knows what it's like to navigate a shutdown from inside the Speaker's office. She did it with John Boehner when the Obamacare shutdown happened in 2011. We'll get down to business with Maura Gillespie coming up right here on the fastest show in politics. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Jobs Friday without the data. Stocks are pushing higher. In fact, right now we are looking at records. We're also looking at just about the best level of the day on the Dow, the S&P, NASDAQ, and the NASDAQ 100 index. The outperformer, though, Russell 2000 index of small cap shares. I begin there. That index up now by 1.5%, keeping it all in context. The S&P right now up 34, up 510, 67.49. The Dow trading above 47,000, up 510 right now on the Dow. That is a gain of 1.1%. We've got NASDAQ up 0.3%, but on an up day for the rest of the market, our Mag 7 index is slumping now by 0.3%. Tesla shares, they're down by 1.7%. The 10-year is currently yielding 4.10%, with the 2-year 3.56%. Gold is up $27 the ounce, 38.83, up 0.7%. And West Texas Intermediate crude up just about 1%, 61.08 a barrel on WTI. Bitcoin surging 2.3% at 123,444 on Bitcoin. BlackRock's Global Infrastructure Partners is in advanced talks to acquire Aligned Data Centers, which could be valued at about $40 billion in a transaction. BlackRock shares are up now by 0.3%. So bottom line here, stocks at records. S&P on this Friday up 33, up by 0.5%. We are on track for a winning week for the S&P 500 index. Right now, that index on the week up by 1.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, many thanks. Looks nice up in New York as well. Beautiful day here in Washington, D.C. As we just learned from Jack Fitzpatrick outside the Capitol, the sun is on the Capitol dome, but not a lot is going to be happening under it. Well, they're going to vote again. I mean, this is truly Groundhog Day at this point, and I guess there's some strategy behind it. With John Thune bringing the continuing resolutions, the D version, the R version to the floor again, knowing that they will fail, and it's part of the point that he has been making as we move along. Just to review, by the way, what we heard from Jack Fitzpatrick, who's a pretty balanced guy. Pressure, anger, and resentment. There's no light at the end of the tunnel. If you are already not feeling great about things, you've got Jack to give you a reality check. And maybe Maura Gillespie will give us one as well, as we are joined in a moment by the Republican strategist. Following a series of conversations that we had this week in the Senate. By the way, we're going back up there this evening. And we'll have the latest for you on what is going to likely be the same story, that these bills keep failing and the government's going to go through the weekend closed. I talked about it with Republican Senator Kevin Cramer, who invoked moral high ground at this stage of the game. Here's what he said.
First of all, we're in such an odd position where the Republicans actually have some moral high ground on a government shutdown, which I've never seen in my life, and I've been here a while, and where Democrats are in a more awkward position than they generally are, to be fair, because funding the government's not that hard generally for Democrats to do, but we have the Trump factor, you have the far left factor with Senator Schumer, which has complicated their situation a little bit.
The gentleman from North Dakota. Pretty honest on that, huh? He's surprised to be sitting in this position where he feels as a Republican like he has the moral high ground, and thus the standoff. Maura Gillespie's been through this from inside the Speaker's office before. You rewind to 2011, remember the Obamacare shutdown? That was John Boehner's problem then. Of course, it's Mike Johnson's problem now. But kind of ironic that we're still chewing on this Obamacare thing around a shutdown, isn't it? Maura is the founder of BlueStack Strategies and joins us now live on Bloomberg. It's great to have you back, Maura. Is the senator right? Do Republicans have the moral high ground?
Well, when you talk about the ACA, the Obamacare bill, and the messaging around it, yes. I mean, the subsidies don't actually expire until the end of the year. So kind of making this has to happen now or millions of people will lose their health care today. You know, they're making it seem so scary and so immediate. And the facts are that the subsidies don't expire until the end of the year. And the subsidies are largely for the insurance companies. You know, so I think there's a bit of a messaging issue for the Democrats because they know that, and Chuck Schumer certainly knows that. But he's getting pressure from the people from the far left of his flank, and because of what happened in March, he had to make this stand, and he knows that it's not a winning strategy, but it's what he has to do to maintain his leadership post.
So, what's your take on the way Speaker Johnson has comported himself? Because he certainly seems to be in lockstep with John Thune, and they are both in lockstep with the White House on this. How important is that bicameral unity, having been in the Speaker's office in a situation like this yourself?
It's very important. It's also critical that they maintain a level of seriousness. I was a little bit disappointed with Speaker Johnson's press conference earlier where he said, you know, they're just having fun over there, but it's not a funny matter. Well, that's a very conflicting message because it's not funny to shut down the government and to cost jobs. And what's happening over at the White House, while yes, the strategy of being in lockstep about the plan, about not negotiating to have this clean CR go through and then have conversations about things like the ACA subsidies, that's a separate matter. But in no shape or form do I think that Thune or Johnson should be, you know, supportive of what President Trump is doing on his social media accounts and J.D. Vance standing by the president. I don't think that that's helpful. I think it's pretty egregious to do so. And so policy-wise, yes, they should be in lockstep, but messaging-wise, I'm concerned.
All right, well, that's a good answer. It has been pretty wild watching the Truth Social feed with the mariachi bands and the rest of it playing around Hakeem Jeffries, who's been doing his own responding on social media to J.D. Vance and others. That's, I guess, the noise around this whole situation. How about the actual business with the White House threatening mass layoffs now? I think you were referring to that just now, and also pulling infrastructure money from some blue states to try to make a point. If you're the Speaker of the House, do you have any input on what money is doled out to where? Should the president be talking with congressional leaders about this? Because it doesn't sound like he is.
I would say yes, but we're not in normal times when we work with President Trump. He doesn't operate by the rules. And the reason being is that he doesn't necessarily have to. Earlier this year, he scored a very big win with the Supreme Court giving him presidential immunity. And he took that and thought, I can do whatever I want, because in reality, he kind of can. And Mike Johnson has lost a lot of the control that he had when he got that gavel. He really gave it over to President Trump. And, you know, and a lot of times we look at the Senate to kind of be the adult in the room. And I do have hope that Senator John Thune will, you know, regain that, you know, responsibility and really hold firm with it. I actually thought during this whole conversation about, you know, the three things the Democrats went into the shutdown or said that they wanted to avoid a shutdown, you know, the Obamacare subsidies, the Medicare issues in the One Big Beautiful Bill, and then the rescissions issues with President Trump. The third one is probably what they should have gone with, because I do think that the senators feel pretty strongly about their role and their responsibility laid out in the Constitution and what their chamber is supposed to be responsible for. And so they could have had a bigger victory in that sense. But it does make me think back to 2013. You know, this is almost in a flip way of when that shutdown was happening. You know, Harry Reid lamented that he wanted a clean CR. President Obama refused to even talk to Republicans because they were threatening the shutdown. And so he refused to negotiate with the threat of the shutdown being there, and refused to take any of their, you know, amendments or additions or revisions into consideration until the shutdown was over. And so I think Democrats know that. And if they look back through history, remember those times, they'll remember that that's how it more or less worked out, was through the Senate.
Fascinating. We heard from Hakeem Jeffries this morning. He has been out there to a limited extent, showed up on MSNBC. Here's what the Democratic leader of the House had to say.
Listen, we'll sit down in good faith. We need to reopen the government in this Trump Republican government shutdown, and we can find a bipartisan path toward a spending agreement. But that spending agreement has to actually meet the needs of the American people in terms of their health, their safety, and their economic well-being, particularly as it relates to driving down the high cost of living and lowering healthcare costs, as opposed to driving millions of Americans into medical bankruptcy because of the Republicans' refusal to extend the Affordable Care Act tax credits.
Maura, I remember Speaker Boehner going head-to-head with Nancy Pelosi, and it was a clash of the titans on a pretty regular basis on Capitol Hill. How's this Democratic leader doing in this stressful moment in dealing with Mike Johnson. He's been at the White House once. It was the only time he's met with Donald Trump. Should that meeting happen again, or doesn't it matter?
I don't know that it's going to necessarily change anything. I do think that the Democrats, and they knew this going into it, they didn't have a plan of how to get out of it. Again, when you have a president that doesn't necessarily care about what happens because he's not impacted by any of it, how do you negotiate with that? How do you negotiate with someone who does not see any issues with making a mockery of you while people are genuinely hurting, while threatening to cut people from the workforce, while relishing in that fact? And Speaker Johnson can say that Rustbot and Donald Trump are not enjoying this. That's inaccurate. Rustbot has wanted to do this for the better part of a decade. And this demonizing of the federal workforce, I take great problem with, because it's not as though being part of the federal government is necessarily a glamorous job. Also, the people who were working for these members, these Senate leaders, Speaker Johnson, President Trump, they are federal workers. And so remembering that they're the ones who are going to hurt from this most immediately. But the longer we keep this government shutdown going, the more it trickles out into hurting everyday Americans, whether you're traveling. There's a whole host of things that we could go into, but I think that they don't have a plan to get out of it. And while their point about the subsidies and the healthcare issues, listen, Obamacare is not a perfect system. It didn't work out the way they hoped it was going to, and that's the reality we're facing. But constantly pushing things to the very end and to the deadlines has got us into these problems more often over the last decade than they should have. And if we just had members of Congress that actually wanted to address these issues in a timelier fashion and not wait until the last minute when your back's up against the wall, then we wouldn't be here. And I think that that's what people should be really harking on is, okay, we have how many weeks until the end of the year? Let's come up with a plan. Let's get out of the shutdown and come up with a plan. Start getting to work.
I don't know if you've been to Sea Island Resort, Maura, but this weekend the NRSC has quite the retreat planned. Golf, pickleball, fishing, shooting, drinking wine. Should that be canceled? Would John Boehner have allowed that? Did we lose Maura? Oh my God, was that convenient? Saved by the internet bell. Let us know your thoughts via email. Maura Gillespie, Blue Stack Strategies. Is she at Sea Island Resort? If you were with us on YouTube, it looked like a pretty nice spot wherever she was. Maybe we can do the show there. I'm Joe Matthew in Washington. That's kind of funny. I mean, what are you going to do in a live situation like this? So we're going to vote again. What is that? About an hour from now, they're planning to do this on the CR, the R and the D version, as we've been saying. We'll let you know when this happens. Be really interesting to see if Republicans pick off at least another Democrat, but no one is predicting that that is going to happen. And it's flyout day today. By the time we get to the late edition, they'll be talking about jet fumes. Everybody's going home. I'm Joe Matthew in Washington. We'll have our panel next. A half hour from now, at the top of our second hour, we introduce Senator Todd Young, the Republican from Indiana, is going to be joining us live from Capitol Hill as he prepares to vote yes on the Republican version. Got a lot more straight ahead here on Balance of Power. I'm Joe Matthew. This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks continuing to push higher. We're looking at records right now with the S&P 500 index up 32, higher by 0.5%. The Dow up 518 points, up 1.1%. NASDAQ now up 50. That's a gain of 0.2%. Stocks touching records amid another round of big-ticket AI deals and partnerships. The Russell 2000 index, a particular standout, up 1.5% as small-cap shares advance. Right now, the Bloomberg Mag 7 index on an up day for the rest of the market is trading lower. It is down now by just about 0.4%. We've got the 10-year currently yielding 4.10%. The 2-year currently yielding 3.56%. And spot gold is up 0.6%, 38.81 the ounce. West Texas Intermediate crude up 1.2%, 61.17 for a barrel of WTI. Bitcoin, meanwhile, up 2.6%, 123,856 on Bitcoin. Well, traders and investors continue to look past the government shutdown and a lack of jobs day to day. Priya Misra is portfolio manager at J.P. Morgan Investment Management. On Bloomberg Surveillance this morning, she was asked about the impact of the shutdown on markets.
So historically, shutdowns have been a bit of political theater. Okay. So the market ignores it. President Trump signed something in law saying that they will, in 2019, saying that people will get back pay. So you don't get paid whether you're working or furloughed, but you will get paid at some point. If it's a short shutdown, I think it's fine for the market to ignore it.
J.P. Morgan's Priya Misra interviewed on Surveillance. You can hear more of that conversation on the Surveillance podcast. Download it wherever you get your podcasts. Headline on the Bloomberg Professional Service, just getting word that the U.S. says it has struck another vessel in waters off the Venezuelan coast. That headline breaking right now. Developing story. Stay with Bloomberg Balance of Power for more on this story. Again, let's repeat the headline here. The U.S. has struck another vessel in waters off of Venezuela's coast. Recapping stocks higher. S&P right now up 32. That's a gain of 0.5%. Back we go to Washington. Balance of Power continues. The Friday edition. We say it every week. What a week it has been. Back we go. Once again, here's your host, Joe Matthew. Indeed we do, Joe.
I'm so predictable. I'm so predictable. Yes, it has been a week. Yeah, well, it must be Friday. Welcome to the threshold of the weekend. Hopefully you're not furloughed, because 750,000 federal workers are facing that reality on what is now day 3 of a government shutdown. And as Charlie just mentioned, yep, we got another one. They got another speedboat. I'm looking at the video right now. Post on Twitter from the Secretary of War, as he calls himself on Twitter, Pete Hegseth, at SecWar. Earlier this morning, on President Trump's orders, I directed a lethal kinetic strike on a narco-trafficking vessel affiliated with designated terrorists in the U.S. Southcom area of responsibility. 4 male narco-terrorists aboard the vessel were killed. You see this speedboat bumping through the water. Wow, there's nothing left of that, huh? How do they know it's going to the U.S. if it's right off the coast of Venezuela? I'm still trying to figure that out. And also understand how we know what's on these boats. Looks like a scene out of Miami Vice. This after Donald Trump, by the way, told Congress that he was up to this. On Truth Social, I'm pleased to advise that I reversed the cuts made to Homeland Security counterterrorism. For New York City and state, it was my honor to do so. Another story that we've been talking about here, with the idea that the president is pulling funding on certain projects from blue states to kind of turn the screws here and increase the pressure. The president apparently is looking for more cowbell as well. Did you see the video on Truth Social? For those who suggest that Russ Vought is not looking to do some cutting here, check this video out. He's been getting a lot of AI-generated videos. Now imagine Donald Trump wearing a black hood playing cowbell over the old tune, Don't Fear the Reaper, but they changed the words up here. Russ Vought is the Reaper. He wields the pen, the funds, and the brain. Here comes the Reaper. J.D. Vance playing drums in the band. It's quite a production. Kathy Hochul doesn't like any of this. The governor of New York is watching funds be pulled from her state. And, of course, we got Chicago now as well. remembering that this was like $18 billion for infrastructure in New York State. Here's what the governor thought about it.
Culture wars over the tens of thousands of jobs that we've created with these infrastructure projects that were literally talked about for decades, that we finally could get moving, create jobs and opportunity, and take care of infrastructure challenges that others were too timid to take on in the past. So that's what a partnership with Washington looks like as we're standing here. We've done our part. We're ready to build.
On to Chicago, where Russ Vought announces the withholding of more than $2 billion for transportation projects in the city. Those put on hold include a red line extension, the red and purple modernization project. Vought citing a need to ensure funding is not flowing through DEI-based hiring. This is where we start with our panel today, because this is real. The government shutdown may not be impacting the economy yet, but these funds were allocated for specific infrastructure projects. And we're joined right now by Bloomberg Politics contributors Jeannie Shanzano and Rick Davis. Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Rick is our Republican strategist partner at Stone Court Capital. How concerned should we be about this, Jeannie? If this becomes the new political weapon, withholding funding from infrastructure projects, Democrats could do the same thing. And bridges are already falling down in this country, I thought, aren't they?
They certainly are. And Joe, where is Taylor Swift? That's why I logged in. Life of a Showgirl is out today. I thought you were going to break the internet with some Taylor. Maybe in the next hour. I think one of the things we know is that somebody described this as, look at what you made me do. Russ Vought is going around telling everybody, with the shutdown Democrats, look what you made me do. But the reality is, that Russ Vought actually has been doing this long before, right? There was the $4 billion cut for California. They have been punishing blue states since they got into office. And he knows this is illegal because that's why he had to say, we're doing it for DEI reasons. He's not saying he's doing it because of the shutdown. He's saying he's doing it for DEI reasons because he knows that in a normal Supreme Court, this would be unconstitutional. So this is a part of a long-term approach and policy by this administration. And I'm just very grateful that the president has now admitted that he has read Project 2025, which Russ Vought helped write, and this is a fulfillment of that. These are long-term plans that they are now pretending Democrats made them do because of the shutdown. And in fact, there's absolutely no reason to tie the two together.
Does this worry you, Rick? Remember when the infrastructure bill passed, that was supposed to be the one bipartisan thing going on in this country? Joe Biden used to talk about how Republicans love showing up for ribbon cuttings because everybody loves infrastructure improvements. D's and R's both drive over bridges, as they say. What's going on here?
Yeah, and Joe, even dial it back a little further, throughout the Trump administration, the first term, he talked about, this is going to be infrastructure week. We're going to get something done on infrastructure. And 4 years of that, nothing got done. So when it finally did get done, as you say, in a bipartisan fashion, everybody kind of wiped their brow and said, wow, thank God that's over. We can get going and build out the America the way it needs to be competitive. I think this is going to have a bad effect on the administration's popularity. There's nothing like a good infrastructure bill to make people feel like their government's finally doing something for them. And the idea to target those things, regardless of whether they're in blue states or not, it is really a big step backwards, right? I mean, there's a lot of chaff we could cut out in order to make, the shutdown not affect you, the American public. No, we're not going to do that. We're actually going to go after you, the American public, and shut down projects that would actually benefit you. And then to pull a heist like they did just now, where the president said, and by the way, I am going to reinstate some funds for my policing powers in New York City, but I'm not going to do anything for those people in New York. Is betraying some success that he had electorally in New York that they're probably not going to see again because of this.
J.B. Pritzker, the governor of Illinois, Jeannie, who's been out front on the National Guard and any number of other issues here trying to raise his profile, presumably as a foil here for Donald Trump, writes, at a time when federal agents are sowing chaos in Chicago, the Trump administration is holding bipartisan funding hostage. It's attempting to score political points, but is instead hurting our economy and the hardworking people who rely on public transit to get to work or school. What do members of Congress, and specifically Republicans, think about this, Jeannie? That's not good for the home district, is it?
It's absolutely not. And I know one of the friends of this show, Mike Lawler, he is a Republican in New York. Yeah. I mean, this impacts people like that in New York, in Illinois, in California, all across the board. And of course, that's how the Republicans got the House, is by winning so many of those purple districts in blue states. And so this is a dangerous game. That said, again, this is a long-term plan by Russ Vought. I mean, I keep saying, Joe, I think Russ Vought has wanted to do this since he was an infant, and he has finally got in his way, and he has been gleeful about it. If you look at the cuts he made before this even occurred, so well before the shutdown, the green energy programs he has cut, all targeted in these blue states, although they will roil over into Republican territory, it is something that he has wanted to do. And this is the price that Donald Trump will play, or the Republicans, because he won't be on the ballot again, electorally, as Republicans begin to feel this. Because let's not forget, there are a lot of Republicans who are building bridges, building infrastructure, own construction companies. All of them will be impacted by these cuts, not to mention the federal workers who they are threatening to fire. They are not all Democrats. There is a lot of Republicans.
Kind of a funny childhood dream, right? I'm going to grow up one day to cut costs. Mike Lee said yesterday he's been wanting to do this since puberty. Rick, I don't know if you saw the video I was referencing on Truth Social here. Remember the old Blue Oyster cult, Don't Fear the Reaper? So there's a bit of a mixed message, because we're hearing from the White House, to your point, Jeannie, don't make me do this. But you've got Russ Vought, while Donald Trump's playing cowbell and JD is playing the drums, Russ Vought walking around town holding a Sith, suggesting that this is very much something that he wants to do. Do you fear the Reaper in this case, Rick? And what do you make of the video?
First of all, I hope we finish this session today with a strong Blue Oyster Cult rendition of the 79 hit.
Not going to let you down.
But two, I'm a little surprised anybody would get away with casting Donald Trump as Will Ferrell in that scene. One, his shirt wasn't anywhere tight enough to be playing cowbells on Blue Oyster Cult. Fear the Reaper, and I hope everyone looks it up, because it's one of the great videos of all time out of Saturday Night Live.
It's pretty weird.
But the end game is, these are the things that get them a step backwards. I mean, Republicans were cringing this morning. I was on a phone with a couple of guys from the House this morning, and they were like, oh my God, you see this thing they put out on the White House? I mean, like, that's the last thing these guys need, is this kind of distraction. Because even though they want to be tough and they want to get, a deal done, and they want to get government reopened, these are the kinds of things that make a discussion, a healthy discussion, a bipartisan discussion, that much more difficult. Me, I loved it. I want to see more Blue Oyster Cult at the White House, but they got to get in the right outfits. It's not Grim Reaper. It's tight polo shirts.
They're still touring in some oldies thing, right, Jeannie? They could maybe play on the South Lawn for the president. I mean, we could joke about this because it is actually funny. He's got a strange obsession with these AI videos. Who's giving him the thumb drive, and who's posting this stuff? It goes up without comment. It's not a repost. It's actually on his feed. Does this blow back on the president, this kind of video, Jeannie, or does everybody just expect this from now on?
Yeah, I mean, the messaging is really hard. We heard Mike Johnson out, and somebody asked him about this, and he said, oh, the administration, the president, they're just joking, just having fun. But this is serious. These are people's lives. These are all of our lives. We all depend on the federal government. I think, the videos can be funny when you look at them, but certainly the situation is not funny. And Joe, I have to say, please go out on Taylor Swift. I love the SNL skit, but it is Taylor's day today. Amanda and I say, so please go out. And
Amanda's
I'm sure
going to be
Haley's
so
watching
disappointed.
too.
God, you know, I thought about Kaylee when I saw that the album dropped. I'm really happy for Kaylee and Amanda. God love you guys. But I'll tell you what, Matt's got this figured out. Blue Oyster Cult is playing Halloween in Vegas. James, they're going to the Golden Nugget. I think we got plans. Hey, Rick, more cowbell. This is what it's all about on a Friday on Balance of Power. Don't fear the Reaper. We still got another hour, and our panel's going to stay with us right here on Bloomberg. How about these two, Rick Davis and Jeannie Shanzano, and the Blue Oyster Cult? What else do you want here? We'll welcome our global television audience coming up, only here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
Here we go again. Welcome to the Friday edition as the Senate prepares to vote once again on stopgap funding bills in an attempt to reopen the government on what is now day 3 of the shutdown. Thanks for being with us. We'll get the latest in just a moment from Bloomberg's Laura Davison here in Washington, and we'll bring you an important conversation with Republican Senator Todd Young of Indiana. His view now on day 3 with votes set for this hour We'll have analysis from our panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us for the hour. And we start, as always, with a look at Wall Street. Let's get into the Friday trade right now with Alexis Christoforous in New York. Alexis, how's it look?
Thanks very much, Joe. New records again across the board on Wall Street for the major indexes, even as the government shutdown drags on. The Dow Jones Industrial Average powering ahead, up 514 points right now. The S&P 500 up 30. The NASDAQ up 38. We've even got the NASDAQ 100 in record territory on a gain of about 8 points. As for the treasuries, yields are higher today with the 10-year yield at 4.11%. We've got the 2-year yield at 3.5%. And gold is also back in record territory, now trading at $38.83. And West Texas Intermediate crude snapping a 4-day losing streak, now at around 61.16 the barrel. And Bitcoin up another 2% today at 123,200. Amazon Chairman Jeff Bezos weighing in on the euphoria around artificial intelligence, telling Italian Tech Week in Turin today that spending on AI resembles what he calls a, quote, industrial bubble that could lead to lost investment. But Bezos adds that the long-term benefits of AI to society will be, quote, gigantic. Shares of NVIDIA are pulling back a little bit today after hitting a record high yesterday. AMD also on the downside, but Broadcom now up about 0.4%. Applied Materials is down nearly 2% after saying an expansion of rules that restrict the export of its products in China will take another chunk out of its revenue. Applied Materials and its peers, we know, have faced increasingly strict rules governing their ability to supply and support customers in China. And the U.S. service sector stalled in September as business activity shrank for the first time since the pandemic. Orders barely expanded. The Institute for Supply Management's Index of Services finding 7 industries contracted, including employment. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Joe Matthew now in Balance of Power.
Alexis, great to have you along. On the Friday edition, thank you for being with us here on Bloomberg TV and radio. We'll have another look at Wall Street with Alexis Christoforous about 20 minutes from right now as we follow the beat here on the last session of the week and what is day 3 of your government shutdown. There's going to be more voting today, but it does not look like that's going to break anything here. In fact, we're going to likely go through the weekend and start things on Monday with the government shutdown. About a half hour from now, we expect voting on the continuing resolutions that you've already seen voting on. We've had 3 rounds. Today is the 4th. And as we heard earlier from the leadership, they don't expect anything to change. Speaker Mike Johnson, Senate Leader John Thune, speaking to reporters earlier today. Let's listen.
They did it 13 times during the Biden administration in the previous 4 years, but suddenly they won't do it. So everybody has to ask themselves why. It has nothing to do with health care. The subsidies that they're saying is the issue is not the issue. That is an issue for the end of the year.
They have an opportunity, a 4th opportunity, 4th time today, 4th time to vote, to open up the government and to allow us to do the rest of the work that the American people expects us to do. They have taken hostage the federal government and by extension the American people.
We're going to see that 4th round before this hour is out together, and we'll have our eyes on the Senate floor. Ahead of our conversation with Senator Todd Young, who's going to join us live from Capitol Hill, our friend Laura Davison is with us, Deputy Bureau Chief here for Bloomberg in Washington. Laura, it's great to see you. The Speaker says this is not about Obamacare subsidies, that's an end-of-year issue. Democrats are telling us, no, open enrollment's begun, notices are going out, this is a now issue. It doesn't sound like we're any closer to a deal.
We are 3 days in, and we are no closer. And it's very likely in 3 more days, we will still be at this very same spot because they're going to go home for the weekend, come back. Monday night is when they actually get back into the Capitol. They'll then start talking. They'll have maybe a little sense how constituents are feeling at home about this. So you may see some Democrats who have a little bit more cold feet. But it's very likely that, this is, this time next week, we'll still be having a similar-ish conversation.
This time next week. So, okay, so we're beyond a week at that point. When does the pressure become too great for Democrats to hold out? We heard references to a jailbreak. I think it was Dan Sullivan who was talking about that the other evening, the Republican from Alaska. They need, what, 5 more? Pick off 5 more Democrats? Is that possible in lieu of a deal?
At some point, that will have to become possible. They'll have to get to some sort of resolution, but whether that is, a week or two, or we're talking something more like a month, that's a very different thing. There's two key indicators to watch here.
Right.
One, what does the polling look like? Right now, the early polls have shown that Republicans are still taking the vast majority, or not the vast majority, but the majority of the heat for this. If that flips and suddenly Democrats are now being blamed, that's going to cause a lot of people to start to wobble. Additionally, is how much is this healthcare issue becoming a thing? Those notices just went out early this week, telling people what their premium spikes were going to be. So that hasn't really trickled down. People haven't really realized if they're the people that are going to be affected. So that will also matter of how much that resonates through those key areas.
No mass layoffs, at least not yet announced formally by the White House. The intention has been displayed in the memo that we've been talking about this week from Russ Vought. Are you surprised we haven't heard from the president? He's got nothing public on the schedule today. He could own this little bit of a news vacuum that we have on a Friday, couldn't he?
He absolutely could. We saw him a little bit earlier, when he truths and said, hey, he wants to have this Gaza deal done by Sunday. But on shutdown, he's been keeping a little bit more of an arm's length here. I think there's some risk, particularly as he moves into mass layoffs or some of these funding cuts. We saw with Doge, job cuts were not popular. So this is something that Russ Vought, he's letting him kind of take the image, as with Doge, he let Elon Musk sort of be there. You've also seen J.D. Vance, the vice president, who's really been out. You've also seen J.D. Vance, the vice president, who's really been out, after that meeting Monday at the White House with congressional leaders. It was Vance out there talking to reporters at the briefing earlier this week. Also Vance. He was on doing the rounds of shows the morning after the shutdown took effect. So you see Trump, sort of recognizing that there may be a political risk here and wants to put other people in those key spots.
I guess as the president of the Senate, there's something to be said for that. And the line from J.D. Vance is, I'll go up there to break a tie as soon as you guys are ready. Let me know. Does that mean his star is rising at this moment?
This is certainly an opportunity for him to show that he can lead. Trump has not come out and said, yes, he is my handpicked successor. He's kind of making Vance work for it. That's what we're seeing here. And if Vance, sort of stumbles and falls, this could, be a data point that Trump then uses when he, in a couple of years, presumably, is going to say, here's my guy that I want to be the candidate in 2028.
I mentioned we're going to talk to Todd Young next. When these votes take place, will they look just like the last one, or could we see a Democrat or two fall in the mix?
It's likely that we'll see those Democrats all move together versus, having one or two and having it be sort of a slow trickle. Never say never. The Senate is a crazy place and stuff happens last minute all the time. If we'll start to know if there's going to be some sort of jailbreak or a mini jailbreak if they keep this vote open for a long time. If there's a bunch of action on the floor, if senators are huddling, that's when we should all start to get excited that there may be at least a little bit of incremental movement.
Great to see you, as always. Thank you so much. Laura Davison, steering our coverage here in Washington in the midst of a government shutdown. And we're on day 3 here. Ahead of the voting, we are joined. It's a pleasure to have Republican Senator Todd Young from Indiana with us just outside the Capitol before he heads back inside the building to get involved here. It's a treat to welcome the senator to Bloomberg TV and radio. Senator Young, I've never had a chance to talk to you, and I appreciate your joining our conversation today. I want to point everybody, before we get to all the politics here, a tweet that you put out there. The federal government is currently shut down, Europe, but my team and I are still working and available to Hoosiers. If you have questions or need assistance, our contact information is below. To what extent, if at all, is this impacting constituent services? Is your staff still intact?
Well, we're still intact, Joe. We're still here to help Hoosiers navigate what is unfortunately a manufactured chaos by the National Democratic Party and their far-left donors and supporters. Chuck Schumer has decided to go with the far left on this rather than with the American people. He wants to shut down our federal government because he's mad at Donald Trump, and he understands that so many other Democrats are mad at Donald Trump. And so it's my job and the job of other Republicans to explain to the American people that whatever substantive issues the Democrats say that they want to work on, those are best worked on when government is funded, when government is still operating, and worked on through what we call regular order, which is a structured conversation so that we can work through substantive disagreements. This is always what the Senate has done at its best moments. Unfortunately, this is one of its worst moments in recent memory.
Well, and God knows we haven't seen actual regular order in a long time. I'm still threatening to break out the regular order T-shirts one of these days here, Senator, so don't give us a reason. But I wonder, I don't know if you heard my conversation with Laura. We're hearing from Democrats that the issue of Obamacare subsidies is not an end-of-year issue, as the Speaker and John Thune have said, but it's a now issue because the open enrollment has begun, the notices are going out, and people might drop off the rolls if they think they can't afford health care. Is that a concern of yours?
Well, it absolutely is. November 1st is, to be precise, when open enrollment begins. So we really only have a few weeks here and realistically a couple of weeks because insurance companies will require a bit of time to prepare the new enrollment packages. So a couple of weeks to make any sort of substantive changes, the very changes that Democrats say they're shutting down the government for. So if indeed this is really why they want to shut down the government, let's come to the table, let's open up government as the polling indicates the American people want, and let's deal with whatever challenges we have like adults.
What's going to happen at the vote coming up here? You're going to be on the floor in a moment. Are you hearing from any of your Democratic colleagues that they might join John Fetterman and others?
Well, I'm not particularly optimistic. I think most of the predictions are that the couple of brave Democrats who decided to vote affirmatively to keep government open yesterday, their numbers won't be increasing. But I hope that's different. I hope they continue to listen to their constituents. I think your previous analyst's assessment that it may take several days before things change and then they could change all at once is probably accurate. In the meantime, myself and others will be taking our case to the American people that this is an entirely manufactured crisis. It was brought to us by Chuck Schumer, and we have to return to a more orderly form of government.
You worried about the potential for cuts that Russ Vought is talking about? The president's up with a video on Truth Social that's don't fear the reaper. He's got Russ Vought up there with the SIF and the whole thing. How concerned are you that you're going to see furloughs turn into permanent layoffs in your state?
Well, listen, Russ Vought and the president have made threats before. I think they have to be taken seriously. I'll continue to do my job, but know that we have some strong personalities. And for those who have concerns about their threats, if the government isn't opened, I think they should take those concerns very seriously. I think Democrats, who have prided themselves over the years as the party of government, should also take those concerns very seriously.
Is Vought weaponizing the shutdown? You could have this thing open, as we've established, in any number of days here with a deal. Why talk about permanent layoffs and closing agencies now?
No, what the Democrats are effectively asking us to do is to undo some commonsensical changes that we made to the One Big Beautiful Bill to our health care in this country. I don't believe that Obamacare is structured in a thoughtful way. I still believe that there are better ways to deliver health care than through highly expensive Obamacare plans. So as it relates to health care, I think we need to deal with root causes. Therefore, I remain very much open to dialogue with my Democrats about how we can come together and affect those sorts of changes. But instead, what they've done here is they're trying to negotiate with Republicans and with the American people effectively under duress. And that's a precedent we don't want to be establishing.
We spent the last couple of evenings up in the Senate, Senator, and spent some time with potential deal makers, including Democratic Senator Jeanne Shaheen. We talked with Tom Cole on the other side. Are we going to see a gang emerge here? Maybe you were part of some of these conversations on the floor, and I realize we're not talking about anything led by Thune or the Speaker, but just some organic conversations that are taking place between Republicans and Democrats to move the needle on this. Is that how this ends?
Well, listen, I'm here to make law. I'm here to affect positive policy changes. I share, I guess you could say, the president's zeal for cutting deals from time to time, but those have to be good deals. And they have to be deals that are arrived at under the right conditions. And what this shutdown situation is all about is a manufactured crisis so that Democrats can get more leverage over policy. And more importantly, they want to send a message. They want to send a message that they're fighting at a time when they effectively have no power because the American people rejected their platform and their candidates last election.
So you're going to go home this weekend, we understand. I don't know if you're literally going home, but you won't be in session and voting this weekend. Is that part of the strategy from Leader Thune here to let people go home, think about this, maybe hear from constituents? What's going to take place Saturday and Sunday?
Yeah, I think what Leader Thune is recognizing is that this is effectively in the hands of Chuck Schumer and his members, and they're going to have to make a decision. In the meantime, we could be observers of this farce and stay around Capitol Hill all weekend as they try and figure out how to restore some measure of order and credibility to Senate operations in the near term, but we think they can make those decisions among their own tribe on their own time. We're going to go out, and many of us go back to our states and take care of other responsibilities.
There's a big story for us here today at Bloomberg, in that we do not have a jobs report because of this shutdown. The BLS data is not out publicly here. I know you're on the Finance Committee, and I'm wondering how concerned you are about the interruption in data collection and data posting here. Senator Elizabeth Warren, for instance, is calling for the release of that data, saying, surely it's been compiled. Why can't we see it? Would you support releasing the jobs report?
Yeah, that sounds reasonable to me. Government, one of the important things we do to ensure that our economy is able to run as smoothly and as efficiently as possible is to produce data. For example, we need to know that we're actually creating enough jobs right now to keep up with the increase in the labor force. So that's one of many things we need to be looking at as people look to deploy capital and make important business decisions. And I think all the more reason that the Democrats should be opening up the government so that that data can be out there.
I guess we're in for a delayed release here. Lastly, Senator, and I appreciate all the time that you've given us today, you're also on the Intel Committee. Right before you joined us, Secretary Pete Hegseth told us that the administration has struck, and we see the video here, the thing is totally destroyed, another boat that they say is being run by narco-terrorists bringing drugs to America. It took place right off the coast of Venezuela. Are you comfortable with this continued action, and would you support strikes against cartels inside Venezuela?
I think Congress needs to get involved in this space. I am a member of the Intelligence Committee. I was formerly a member of the Foreign Relations Committee. That latter committee has jurisdiction over our war powers. I would encourage that committee to hold public hearings about this matter, and if a vote is required, a vote to authorize military force, that's something that falls within Congress's area of responsibility under the Constitution. I've worked with Senator Kaine, who's been perhaps the most visible and thoughtful member on the Democratic side as it relates to these matters, and I understand that in coming days we will be voting on a war powers resolution related to the first strike. So let me be strong on this. I think there's no more fundamental responsibility Congress has than to make sure that their elected representatives can be held accountable for our decisions to go to war.
Well, I know you're speaking as well as a Marine and a graduate of the United States Naval Academy. Thank you for joining us today on Bloomberg. That's Todd Young, the Republican from Indiana, and a pleasure to have you here as part of our conversation today on Balance of Power. I'm Joe Matthew in Washington. We'll have our eyes on the Senate floor for when the voting begins straight ahead, and we'll assemble our panel next. Rick and Jeannie straight ahead right here on Bloomberg.
7:21 on Wall Street. I'm Alexis Christoforous, and investors continue to shrug off the ongoing government shutdown and instead are focusing on AI tie-ups, which have helped to fuel a rally in global stocks. Now, Wall Street would ordinarily be parsing today's release of the September jobs report, but that data is delayed due to the shutdown, leaving Wall Street to pay closer attention to private job market surveys that suggest a labor market that's still expanding, but at a slow pace with sluggish hiring and just modest wage gains. The market has turned mixed here in recent trading. The Dow Jones Industrial Average up 446 points in record territory. The S&P 500 up about 15, also a record there. But the NASDAQ has turned negative, now down about 39 points. Gold back at a record high, and WTI crude snapping a 4-day losing streak. Word of another possible blockbuster deal in the red-hot AI space. Bloomberg's reporting that BlackRock's Global Infrastructure Partners is in talks to buy Aligned Data Centers. It's a deal worth about $40 billion, and it just underscores surging investor interest in data centers that cater to the booming market for artificial intelligence tools. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
Okay, Alexis, thank you so much. We'll have more with Alexis on the markets in about 20 minutes here on Balance of Power. Thanks for spending part of your Friday with us on Bloomberg TV and radio. I'm Joe Matthew in Washington. With a new deadline at hand, we've been counting the days since President Trump gave Hamas, as he said at the time when Benjamin Netanyahu started the week at the White House, he said 3 to 4 days he would wait for Hamas to respond to this offer of a peace deal. Well, peace proposal. Again, an offer. We haven't heard from the other side, and Hamas has said that this is not a take it or leave it. Donald Trump now has set a Sunday evening deadline here, 6 p.m., after announcing the 20-point plan alongside the aforementioned Benjamin Netanyahu. There on Truth Social, the president writes, and it's a long post, Hamas has been a ruthless and violent threat for many years in the Middle East. He goes on to refer to the October 7 massacre, talks about the hostages, of course, and again, makes it clear here, release the hostages, all of them, including the bodies of those that are dead now. An agreement must be reached by Hamas by Sunday evening at 6 p.m. Washington, D.C. time. He refers to it as a last chance agreement. If not reached, all hell, he says, like no one has ever seen before, will break out against Hamas. Let's assemble our panel for more on this. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick is partner at Stone Court Capital, our Republican strategist. Jeannie, our Democratic analyst, democracy visiting fellow at Harvard Kennedy School's Ash Center. What's going to happen at 6 p.m. Sunday, Rick, that hasn't already happened to Hamas if this deal is not accepted?
Yeah, look, I think that, maybe statement out of the White House that says let Bibi Netanyahu do whatever he wants to do, as you point out. I mean, you can't imagine anything else more aggressive than his land invasion of Gaza City. So I'm not exactly sure that's a meaningful outcome to Hamas, because they're already dealing with that even today. But look, I mean, if you were on a taco watch for this 3 to 4 days, that announcement was Monday. It's now Friday, and he's given them till Sunday. So who knows? Maybe that extension happens in Sunday. Oh, we're making good progress with Hamas. I'm going to give them another 48 hours, another 72 hours to sign an agreement. It does seem like all the pressure that is coming to bear around the region and from the United States could get Hamas in the right place. And if that's the case, it's worth whatever extensions or delays might happen, because this is a war that needs to end. People need to be fed. And this needs to be done for the White House in order to be able to show that the president is something more than just taking credit for peace deals that would have otherwise happened without him.
Jeannie, I don't know what your thought on this. Do you look at this as an extension? And what does the threat of all hell matter when Gaza already is hell?
Yeah, if you just take a step back and look at how this was crafted, it was crafted by Donald Trump. It was amended by Netanyahu, Dermer, Kushner, and Witkoff, and a really interesting piece in the New York Times today on Witkoff and his family, as they have benefited from the work that they've been doing. Setting that aside, what role did Hamas play in crafting this plan? The answer is zero. It was presented to them as a take it or leave it. If you leave it, you will be destroyed. So I'm not sure, just looking at the process, how they can come along with it. Now, we do know they are not monolithic. There's certainly more hardliners and people who might be willing to deal. But unless I think Donald Trump is willing to deal, calls himself a big deal man, this is a plan that Hamas simply can't get on board with. There is absolutely nothing in this plan, short or long term, that allows them to have any sort of political or military influence going forward. Every single point of this plan is to the benefit of Israel. And so it was grafted by Israel, and we were told by Netanyahu and Trump in that press conference that you covered that it was take it or we destroy you. But again, what incentive do they have? They're destroyed either way. Either they sign up, look at the 20 points, they're destroyed, or they don't sign up and they're destroyed, apparently. So, you know, it's not like any peace plan I've ever heard of. Negotiations involve two parties, not one. And this one involved the U.S. and Israel hoisting it on Hamas.
Rick, the president also writes in this lengthy post, I'm asking that all innocent Palestinians immediately leave this area of potentially great future death for safer parts of Gaza. He says everyone will be well cared for by those that are waiting to help. Does anyone in Gaza believe that?
It's a tough sell. They've heard evacuation orders by Israel in the past where, you know, they've suffered with lack of shelter and food. But I think it's just part of this campaign that's being waged now out of the White House and around the region to try and force Hamas to a deal. We have to remember that this is an extraordinary agreement. It includes every major country with majority Muslim and Arab populations in the region. Enormous pressure from a neighbor in Egypt to get this done. They are part of this agreement. They have signed on to it. They were part of the negotiation around it. And even the Hamas refuge in Qatar has signed off on this. I mean, this is a real historic achievement to get that region on board with the United States and Israel on a peace agreement. And Jeannie, you're right. There is no turning back. Hamas is a terrorist group pretending to be a government, and the rest of the region and Israel and U.S. has made the decision to ensure that they never get into a governing position again, and that is the deal. And so either they want to continue the violence or they want to end it by releasing the hostages that they've had now for almost 2.5 years and get on with rebuilding Gaza. And there is a pretty significant investment in the effort in the region, including Tony Blair, to come in and try and fix Gaza and create a little better place for Palestinians to live.
We, of course, note that October 7 is next Tuesday. Jeannie, there are reports now that hundreds of thousands of Palestinians are trapped essentially in Gaza City because they don't have the finances or the means to move. Should the U.S. or neighboring Middle Eastern countries provide those logistics?
Well, you know, the U.S. and neighboring countries should address what Israel has been doing in the Gaza Strip. I don't know if we need these people to move out of their home or Israel not to be on the ground engaged in the kind of horror that it's engaged in at this point. You know, this started out as a 21-point plan. It is now a 20-point plan. What was the 21st point? Was Donald Trump's insistence that Israel not try to occupy the West Bank. That was stripped out of the plan that is now 20 points. And speaking of the politics of this thing, you read through the points, and I've read through them carefully. There is no political endgame here. It says at the end that it will be a neo-colonial, yes, Rick is right, Tony Blair, Donald Trump, and some of the Israelis will, and some of the Arab nations will train the Palestinian Authority. And once they are fully trained in the way we want, then they will indeed run that area. But what about self-determination for the Palestinian people? So, you know, yeah, we should help out these people. Absolutely. There's huge humanitarian needs, but we are the leading democracy in the world. What about self-determination for people who have been living in hell? And Hamas, October 7th was horrendous. The absolutely all of these hostages should be released, and they should have been released a long time ago. They never should have been taken. But this is a horror show over there, and this so-called agreement is to the benefit exclusively of Israel, and it will do nothing to bring peace to that region. And maybe Hamas takes it. I'm not sure it matters either way, because it is going to leave the area in the hell and neocolonial trap that it's been in.
Well, I want to hear from Rick on that too, Jeannie, but I'm just curious, do you see the endorsements from foreign ministers of Saudi Arabia, Jordan, UAE, Pakistan, Turkey, Qatar, Egypt adding credibility to this proposal? Because it doesn't sound like it.
You know, no, not that much. You know, the reality is when they were all over here at the UN, they should have talked about the genocide of the Palestinian people that has been going on. That should have been their number one focus. And I mentioned the Witkoff piece. I urge people to read it in the New York Times. There are other elements at play here. And, you know, just because they are Arab nations doesn't make this any better. The Palestinian people have been victimized. The Israeli people have been victimized. But this plan is a plan that benefits completely one side in this equation. And the Palestinian people, it will not give them the self-determination rights that they are going to need at some point as we go forward. And by the way, speaking of the New York Times, look at the latest poll numbers, have got to be very frightening to Israel. Public support in the US and around the world has plummeted when it pertains to Israel.
Rick, we've only got about a minute here. What's going to happen by 6 o'clock then? Does Hamas reject the deal?
Well, you hope they don't. The only thing that's going to actually stop bloodshed in Gaza is if they say yes. And look, I mean, I have no doubt that it is a agreement with a gun at their head. But they've been holding that gun to Israel's head now for 30 years. So at the end of the day, there's one exit to violence and one entrance to relief getting into Gaza for the people of Palestine. And that is for them, the Hamas, to disarm, retreat the battlefield, give up the hostages, and allow there to be a government that actually puts the people of Palestine first.
It's never an easy conversation, but I really do always appreciate your straight talk. Rick Davis and Jeannie Shanzano, I appreciate the insights, as always. Bloomberg Politics contributors for a reason. Rick and Jeannie with us here live on Bloomberg TV and radio. We're going to spend some time coming up with the chairman, Patrick McHenry, straight ahead, only on Bloomberg.
1:40 on Wall Street. I'm Alexis Christoforous. Stocks have turned mixed and are now off their highs of the session as the government shutdown looks headed to last at least through the weekend. The shutdown means an economic data blackout, so no September jobs report today. But that's not stopping the market. The Dow Jones Industrial Average is up better than 440 points to a new all-time high. The S&P 500 up about 15, another fresh high there. The NASDAQ Composite, though reversing an early gain, is now down about 40 points. Gold, though, back in record territory, and Bitcoin about 1% away from an all-time high. Rivian Automotive is reworking a key element of its vehicle doors after employees and customers raised concerns over potential safety issues to the current design. Rivian plans to incorporate a manual release that's more clearly visible in its next generation SUV. Electric handle designs across the automotive industry are in the spotlight following incidents in which people were unable to open vehicle doors due to a loss of power. Bloomberg reported last month on issues with Tesla doors, and U.S. auto safety regulators have since opened an investigation. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back over to Balance of Power now and Joe Matthew.
Alexis, thank you so much. Alexis Christoforous will have more on Wall Street coming up top of the hour, 2 p.m. Eastern Time, Wall Street time, as we consider the politics here in Washington, D.C. It's day 3 of the government shutdown. And just moments from now, it looks like we're going to get our first vote. There's a live view of the Senate floor if you're with us on Bloomberg TV or on YouTube. Everyone seems to know how this is going to end. They expect the vote to be just the same as it was 2 days ago. Not enough Democrats on board, so it will fail. Then they go home for the weekend, knowing that that was a late decision here this week by Leader Thune, the Republican leader in the Senate. Send everybody home. Let them stew. Let them hear from constituents. Think about what you've done here. We talked about this a couple nights ago as we've been in the Senate over the course of this week talking with members about their decisions. Kevin Cramer, the senator from North Dakota, invoking the moral high ground when it comes to this standoff. Listen to what he said.
First of all, we're in such an odd position where the Republicans actually have some moral high ground on a government shutdown, which I've never seen in my life, and I've been here a while, and where Democrats are in a more awkward position than they generally are, to be fair. Because funding the government's not that hard generally for Democrats to do, but we have the Trump factor, you have the far left factor with Senator Schumer, which has complicated their situation a little bit.
That was Wednesday. Yeah, nothing's changed since then. Here we are on Friday, and it's kind of interesting. I didn't know this when I woke up this morning, but the man who's about to join us just reminded me of what today is. If you want to just connect all the dots on passing or not passing a CR, in this case, a Biden CR. It was the 3rd of October, I believe, 2 years ago, Patrick McHenry, that the Speaker of the House was dispatched. That was a day that changed your life.
It was. I was reminded, Speaker McCarthy called me as I was coming into the studio today. He says, you know what this is? And
look at
that's what it is. I'm not as angry as I was that day. But Speaker McCarthy has done quite well since leaving Congress. He's working in the business community. He's got a fabulous life, and remains a dear friend. Even despite the fact that
they're going to keep this loop going on. This is where CC has invoked the video from October 3rd of Chairman, then Speaker Pro Tem McHenry, taking it all out on that gavel. But it's
2 years ago, and McCarthy was vacated by a small group of people led by Matt Gaetz.
Yes, of course.
Small group of Republicans, because he had passed a clean continuing resolution.
Here we are again.
Here we are, 2 years ahead, and it's Republicans that are the responsible party passing a clean continuing resolution. The dynamics have so shifted on this. And today is a fascinating day. So we're going to continue to watch the Senate. The action on Capitol Hill is on the Senate side. The House did its job. They passed a clean continuing resolution. The Senate is going to just wrestle with a date change and continue to vote on this. And Leader Thune, I think, is doing a masterful job of being disciplined as leader and just saying, well, you're going to be accountable on a regular basis, multiple times a week for your words and your actions to his Democratic colleagues. Chuck Schumer and a large enough group to pass it on the Democratic side voted for this same policy back in March. Because of the flack that Leader Schumer got in particular from his Democratic base. he was in a political box. Leader Jeffries has a very different set of circumstances. He just wants to become Speaker of the House. And as minority leader, that's kind of your obligation. Get the majority so you can be relevant. The House is not a relevant thing in this conversation. The action is in the Senate on how the reopening occurs because of the filibuster. And so the filibuster is the vote that they're trying to break right now. They need 60 votes for that, and they need a few more Democrats to participate in it. But this is playing out in a very, very bizarre and different way than previous shutdowns. It's seemingly it hasn't had a dramatic effect here in D.C. It seems like it's much ado about nothing. How it's kind of playing out in the body of politic, which is different than previous shutdowns.
It does feel different, and I will note for the record, Patrick McHenry said the last time you were here, when we said, just wait for October, chaos, you said. You have no idea the insanity that we're in for, and here we are. And that begs the question, are there off-ramps? Are we doing this for weeks? We talked to Gene Shaheen and some other potential deal makers, and I know that the House isn't in the mix right now, but we talked to Tom Cole as well. And I say, like, we're ready to make a deal. We're talking. We're actually not that far apart. Do you see it that way?
Well,
these are very informal talks, by the way.
These are informal talks, not led by the leaders.
This is on the floor. Yeah, this is
not.
Just
you see Hakeem Jeffries having a press conference yesterday saying nobody's called him.
Right.
Which shows he's not relevant to the conversations. Then you see the pack of senators. I think the interesting action is going to be watching the senators have conversations on the Senate floor. There are a couple things that are true. One is I think you will have a clean, reopened vote. I think that will be the case. I think the end of this is Democratic submission to reopen the government. Then I think there is willingness between some Republicans and the White House to extend for a period of time some of the Obamacare provisions that will expire at the end of this year, but not the full policy. I think that's the end point still. That was actually going to be the case regardless of the shutdown, is that there's a reasonableness component within the White House and among congressional Republicans that an extension of these subsidies for another year makes a lot of sense. And that's the Democratic ask, along with a bunch of other things they've added to the list, which don't quite fit. But I think there is a modest deal to be had post-reopen. Even if they didn't have the government shutdown, that would be the end state for the end of the year.
So how do you get to the deal then if they need the deal to reopen the government?
Submission.
So
submission. And how do you get to submission?
To
Pain.
Pain. What does that look like?
Well, it looks like pain on federal employees. I think Russ Vogt has a plan of action that is intense and intensely painful for Democratic senators in particular in Democratic constituencies. He has enormous power as OMB director, and he's going to use it.
So that's not just a threat.
Oh, no, it's not a threat.
Cuts are coming.
It's real, and he has an active imagination and massive power. And together, I think he's going to do things different going into next week that are different than this week.
You see the Russ Vogt is the Reaper video? The president posted last night. He's got the big cloak and the Sith, and doesn't look like that's something that the Democrats are making up.
The memes are amazing, completely amazing of this fight, which takes it to an internet level of craziness and zaniness.
Mariachi bands included.
Oh gosh, but all that is to say the Democratic constituencies are going to feel pain, and Democrat politicians are going to feel pain in order to come to the table to have a clean, reopen vote. That's what happened in 2013 when Republicans shut down the government over what? Healthcare, over Obamacare. Here we are. 12 years later, same issue set, flipped constituencies. It's a really bizarre thing happening right now.
So why wait on the cuts then? Or is John Thune or the leaders saying, hey, give us a minute, White House, because this isn't going to help anybody? If we do see furloughs turn into layoffs, does that make the trust quotient even worse?
I think so, and but it also is a ratcheting effect of pain.
All right,
and frankly, a couple of things that I think are interesting here. One is the power dynamic on Capitol Hill between Schumer and Jeffries, and how that plays out. The second piece is OMB, and I think that's a substantial piece of action and activity. And then the political calculus by the White House on the ways that they can execute pain on their Democratic opposition. Those are the things we're going to see play out, and how they're going to ratchet down the impact on Democrats on Capitol Hill, Democratic senators.
We're seeing some cuts already in terms of funding for blue states. You saw the transit money for Chicago, New York, losing billions of dollars. Tom Tillis, who you know well, from North Carolina, senator, said earlier to Bloomberg, I think that digs us into a deeper hole. I think if you do that, you're going to create a bad faith environment. They need to be very judicious. Would you agree?
They need to be judicious, but the Democrats have made a choice here. And what they have done is argue for years that Donald Trump is an authoritarian, and he will seek to claim power and not respect checks and balances. A government shutdown under operation of law gives enormous authority to the director of OMB to carry out wide-ranging policy decisions. And the law is either on the side of the OMB director or silent. And in that silence, they're going to fill the void. So my Democratic friends are saying an authoritarian, and they're taking actions to give him more enhanced power over the federal workforce and the size and scope of government. It's an extraordinary thing that I don't think they've quite thought through. And I think next week you'll see this discussed more on the Democratic side.
Okay, so that sounds then like you see light at the end of the tunnel. If they're having that conversation next week, are we reopen a week later?
The light at the end of the tunnel could also be a train. So let's be very careful about this. The way these things, these shutdowns work is that, it could end today. It could end in this vote series on Capitol Hill today. And we're going to we have to follow this day by day, hour by hour, because it is that fluid. And could end Monday. It could be Thanksgiving. And yeah, it's as wide ranging as that.
Wow. So you're not going to try to predict anything here. What do you think of the Republican line that we keep hearing that this is all about? And you walked right up to it. Chuck Schumer afraid to be primaried by AOC. It's as you could fit it on a bumper sticker. I hear it from almost every Republican lawmaker that we talk to, and most of them don't know Chuck Schumer very well. Is that just an easy story to tell, or is that what's going on here?
I think there's a serious story to tell on that matter. And we saw how bludgeoned Schumer was coming out of March. We saw the flack that he took.
A lot of people saw a shutdown
we saw the difference between Hakeem Jeffries and Chuck Schumer in that moment, that divide, and they lived like a borough apart, right? An odd thing for them to be separated. Then we see them linked hand in hand with this shutdown now. And you think, well, I think that shows that Schumer is capitulating. The challenge here, though, is that Hakeem Jeffries does not need to be a part of any of the deal-making to reopen the government. Doesn't have to. You saw Speaker Johnson and the leadership team in the House produce a continuing resolution without the need for Democratic votes. In the Senate, because the filibuster, Schumer's going to have to participate in that. So at the end of the day, it's not going to be a good outcome for him. He's picked a fight that he cannot win with his Democratic base. Which is, I think, a political mistake on his part.
This is why the clock is going to be ticking. How do you peel off a couple of more Democrats? We've already seen 3 roll over here. Angus King, who caucuses with Democrats, part of the group. You don't need that many more, and then you don't have to make a deal to reopen the government. Is that possible? Because John Thune have the skill?
No, John Thune has the skill, and he's got the discipline. He and his leadership team have had enormous discipline. And not taking the Democratic bait, and also going out and messaging, continue to talk in a very disciplined way.
Should you meet with Chuck Schumer?
There's no need to.
No need to?
No
Isn't
need
it
to.
good politics, though, just for the picture?
Nope. No, because at that point, the only way you get out of the shutdown is the way Republicans got out of the shutdown with Obama in 2013, which is agree to reopen the government, and then you negotiate thereafter. What happened in 2013, after that we reopened government, there were modest but significant changes to Obamacare as a direct impact, but that was separated in time, optically from the shutdown. And that was the only way you could have the conversation. We're in a similar situation here.
We've got less than a minute. Is Kevin Cramer right? You've got moral high ground, which isn't always the case for Republicans on a shutdown?
Everyone thinks they're winning.
They sure do.
This is the reason why this shutdown is so different. My Democratic friends think that they have the high moral ground. My Republican friends, they think they have the high moral ground. We will see who wins in this thing, but it's more of a wrestling match for submission.
Yeah.
Right? And down for the count. That doesn't make you feel like this is a moral debate.
He told us this was going to happen. Patrick McHenry, former Speaker Pro Tem, the former Chairman, House Financial Services, now Bloomberg Politics contributor. Happy anniversary. It's great to have you back here on Bloomberg TV and radio. This is Bloomberg.
Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon. Happy Friday, everyone. Carol Masser, Tim Stenivek, live across Bloomberg platforms, live at Bloomberg headquarters in New York City. Tim, government shutdown.
Day 3?
Yep.
Okay.
Check, right?
Is that right?
Record high in stocks on this Friday. We've seen that, right?
S&P 500 out of record right now.
Monthly jobs report.
we'd usually be talking about that on this Friday. It is not a Jobs Friday because, of course, the government is shut down, so we're not getting that data. But we are getting some data, Carol.
Yeah, we are. Listen, we are talking to folks, checking out private reports. So without that government release, as expected because of the shutdown, we are leaning on private folks and others to fill the gap, including the chief economist at LinkedIn, including Michael McKee of Bloomberg News, who caught up with the Fed governor. Fed speak matters right now. So we're going to get into that in just a moment.
Also on jobs and the impact of AI on employment, we've got the CEO of Incredible Health joining us in the studio on why it could be a good thing, an update on what she's seeing, especially when it comes to healthcare.
Plus, the old guard and new guard on Wall Street, Goldman's David Solomon on the U.S. economy, and then the firm and individual who is beating the big banks in a key metric. It makes me wonder, is Solomon looking over his shoulders when it comes to this dude? I don't know. We're going to find out in just a moment.
All that and more coming up over the next hour right here on Bloomberg Business Week Daily. First up, though, a check on the day's trade and top business stories. Here she is, Alexis Christoforous, in for Charlie Pellet. Hey, Alexis.
Hey there, Tim and Carol. Yeah, stocks not at their best levels of the day, but we still do have a record for the Dow Jones Industrial Average. We'll see how long that lasts as once again investors shrug their shoulders at this government shutdown, which looks like it's going to last at least through the weekend. The Dow Jones Industrial Average up 289 points, but the S&P and NASDAQ have each reversed course and pulled back. The NASDAQ now down 109. Gold back near a record high, though, at 38.83. West Texas Intermediate snapping that four-day losing streak, up now 1% at 61.16 a barrel. And if you're looking at Bitcoin, it's closing in on another record high at 121,906 right now. Bloomberg reporting that BlackRock's Global Infrastructure Partners is in talks to buy privately held aligned data centers. It's a deal worth $40 billion, and it underscores surging investor interest in data centers that cater to the booming market for artificial intelligence tools. You'll remember just this week, BlackRock's GIP was said to be eyeing a potential acquisition of the power company AES. Checking that stock, it's up now better than 1%. And sticking with AI, SoundHound actually reversing an earlier gain, now down about 1.5% after gaining recognition as a leader in IDC MarketScape's assessment of conversational AI platforms. Analysts say that, along with some strong revenue momentum, has attracted renewed investor interest, at least not this moment, but the stock has been rallying. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Carol and Tim.
All right, Alexis, thank you so much. Alexis, of course, in for Charlie Pellet. Hey, normally we would be talking about this being Jobs Friday. You know that's not the case because of the U.S. government shutdown. So we are leaning on other data points and voices for clues on the labor market, and that includes members of the Federal Reserve, including the newest member of the Fed board, Stephen Myron, who earlier joined Bloomberg TV and radio. One of the things he stressed that he may just be data dependent after all, just like Fed Chair Jay Powell.
So my view is driven by two things. Services are the more persistent and sticky part of inflation. Services are driven in large part by housing, and I expect housing inflation to come down through those channels. If something were to happen that were to tell me that that channel is invalidated, that there's some shock that's going to be pushing rents materially higher, the benign inflation forecast that I have would have to be adjusted as a result.
That's Fed Governor Stephen Myron earlier today on Bloomberg Television, also chair of President Trump's Council on Economic Advisors, on leave, though, from that job. Now Fed Governor, as we mentioned. Michael McKee, part of the team that did that interview, he's with us right now. He's Bloomberg TV and radio international economics and policy correspondent. He joins us here in the Bloomberg Business Week studio. So we're going to talk about him being data dependent in just a second, but I want to stick on this idea of shelter as it relates to the inflationary view. What is his thesis? What is his theory that that part of inflation will start to ease?
Well, the theory is that because they are removing so many undocumented aliens from the United States, it will reduce demand for housing. And that will bring down the price of housing because more houses will be available to those who are still here. It's based on a study that was done in 2003 about the Mariel boat lift in Miami, which found that there was sort of a one-to-one relationship there between removal and prices going down. A lot of economists say that's a tough thing to scale up nationwide and to say is a rule that will apply in the future. But that's his story, and that's what his belief is in terms of bringing down service price inflation and therefore overall inflation.
Well, shelter is such a tricky thing for the Fed to actually affect. And Fed Chair Jay Powell has talked about this for years, Mike. He said, given the tools that we have, we can only do so much when it comes to shelter prices. And in fact, he's talked about that being more of a policy issue in the past than it is about being part of the Fed's dual mandate.
Well, most analysts of the housing industry say that the problem for housing is that there's not enough supply, and a lot of that has to do with zoning regulations in cities. You can always build out in the suburbs. Now you have to go to the exurbs, and you start to get so far away from people's jobs that they don't want to move out there. They'd like housing in the more central areas, which means you need more density, and that's a big fight always. So that is a policy problem. The other problem is that the Fed controls short rates, and so if you are worried about mortgage rates, they're going to be much more closely tied to long treasuries like the 10-year, and that's going to be priced by the markets in what they think of inflation is going to be. So it's another reason why people are dubious about Myron's view on bringing down inflation through housing.
3 or 4 houses for sale on my block, so
Really?
there's definitely some supply that I am seeing. And I remember actually a voice this week on surveillance with Tom and Paul that they talked in the morning about, no, there is plenty of supply out there. So I'm a little confused. I want to move on to another Fed voice, Fed Reserve Vice Chair Philip Jefferson, making some comments and cautioning on risks to inflation and job goals. There are Fed voices that matter more than most, and we know Jay Powell is certainly one of them. What about Mr. Jefferson?
Well, he matters in the sense that as vice chair, he's not going to dissent unless he has some horrible disagreement with Jay Powell. And so if that's where he is, that's where Powell is. And you get the same thing when you're talking about what John Williams thinks is the vice chair of the Open Market Committee. So it tells us that basically the Fed is on board with another rate cut because that's what Powell suggested at the last meeting. The question is it October or December? Most people in the markets think it'll be October, and without data, the general feeling seems to be, well, that doesn't give them a reason to change their mind. Now, it could give them a reason to wait and see what happens. But I think what we have to do is wait until we get closer to the end of the month. The meeting's on the 29th of October, and then start judging what Fed people are saying.
Speaking of changing one's mind, and I do want to go back to Steve Myron for a moment. From the conversation that you had this morning with the team on Bloomberg TV and radio, is it fair to say he is kind of data dependent? Did he kind of come across that way?
Well, he's data dependent to the extent that the data back up what he thinks is going to happen. He's saying that he is looking forward, which is basically more being based more on forecasts than on past data. So it's going to be hard to say he's wrong in the short term because whatever he's predicting hasn't happened yet. But his view is that the economy is going to slow, that the labor market is going to slow, and that inflation is also going to come down, and therefore you could cut rates and you should cut rates more quickly because you don't want the economy to weaken too much. But again, that's all based on forecasts as opposed to prior data.
We know that he's on leave from the job of chair of President Trump's Council of Economic Advisors. You and the team asked about input from the president. What did he tell you when it comes to not just whether or not he's had an interview to be the Fed chair, but if he's ever been asked by the president to actually take a specific policy action?
Well, he gave us the same answer that he has given other people, that he has not heard from the president since the day he was confirmed when Trump gave him a call to congratulate him, but did not ask him to do anything particular. And he says since then, he hasn't heard from Mr. Trump, and that the president has never asked him to take a particular position. On the other hand, you know, if mom told you a couple weeks ago to clean up your room and she's standing there staring at you, you kind of get the message without her having to say it. I think Carol would agree.
I think
Totally.
we can all relate to that in different ways.
Yes, yes. We did get some data. Well, you know, first I want to say, in terms of jobs data that we've gotten so far, you know, I've heard people say we're kind of flying blind without the monthly jobs data or the government shutdown and not getting government data on the U.S. economy. Are we completely flying blind, or do those private reports and the different reports, including ISM that we got today, still help form a fair picture of the U.S. economy?
They give you a sort of pointillist picture of the economy. You know, it's not sharply defined, but there's a lot of private data out there now, more and more all the time. Revelio Labs is a new one out there. They were out today saying 60,000 jobs in the month of September. The economist survey by Bloomberg was 53,000, so they're in that ballpark. ADP was negative 32,000, so they're in a different ballpark. They're playing an away game, different ballpark altogether. But in general, you get the idea that this is what's happening in the economy. And remember that whatever the first jobs report number is, it's going to be revised, and the Fed knows that as well. So they have a lot of their own data sources that they use to try to figure out what's going on.
Well, you guys asked Governor Myron about this, whether or not the lack of data would affect the Fed's job, and he gave an interesting answer. I thought he said the Fed uses that data, but they're not making decisions each and every day. What did you make of that?
Well, the market is always moving rates around because of the latest data or the latest thing that happens to a particular company. And the Fed just every 6 weeks meets. And so they look at what all the data up to that point is. Plus, as I said, they have their own data. They get the ADP data, the raw ADP data, and they manipulate it their own ways statistically. They don't do what ADP does with the Stanford lab to come up with the numbers that we get from them. So they have their own views on what we're seeing. And as I've noted before, right now, given all the problems we've had with data coming out of the pandemic, the Fed officials are leaning much more on their conversations with CEOs and businesses about what's happening to get an idea.
Hey, 20 seconds. One other important indicator. I can't believe we didn't get to it. The Swift measure, as in Taylor Swift, new album. What do we need to know real quickly?
I found it had a good beat and I could dance to it, which is a joke I used before, and Carol got it. She's been around like me for a while. It looks like about 50-50 on the internet. You know, some people like it, some people don't like it, but it's the most streamed album ever, so it tells you that that's going to make some money, which is good for the economy. So we thank Taylor Swift.
And great for the Taylor economy as well.
Yeah.
Michael McKee, thank you so much. All right, we want to stay on the jobs report, the U.S. economy. We want to see what she and her team at LinkedIn are seeing. Let's bring in Karen Kimbrough. She's chief economist at LinkedIn out there in Sunnyvale, California. Karen, you guys have such a great vantage point. You get lots of data on LinkedIn. Tell us what you are seeing on the platform when it comes to the U.S. labor market.
Yeah, so great to be here. Thanks for having me. One of the things we're seeing right now is an incredibly sluggish labor market. Hiring is slow. In fact, by our own data, we're seeing hiring that's down last month 3.5% on the month and nearly 9% on the year. So we continue to see hiring being very anemic. I don't think we're looking at an economic recession, but we're definitely looking at a hiring recession, if you will. Hiring is weak. One of the things that we're also seeing here, not just in hiring, but also just employer demand for taking on workers is just very, very slow. And a lot of that has to do with the fact that workers aren't leaving their jobs. We see that quits by our own measures. People aren't leaving their jobs by as much as they were in the past, but they're applying to more jobs and having less success. So it's a much more competitive and tough labor market out there than it was before.
Can we go so far to say employers are still hoarding workers as well? Karen, can you guys get a feel on that as well? That's something that we've certainly seen out of the pandemic when folks were just, dying to get workers in, and it was a very tight labor force. So they have been a little bit gun shy, if you will, in this environment to kind of let folks go. Do you see signs of that?
I think so. We've been calling it job hugging. So on the one hand, we're not seeing professionals that really want to leave. They're not quitting. They're not rushing for the doors. And on the other side, the employers aren't yet sort of leveraging any kind of layoffs or reductions in force in the private sector, not to any great degree. When you look at the data that's out on JOLTS, or you look at the data that is, in our own labor market data set here at LinkedIn, we don't see elevated layoffs. So I do think employers are kind of holding on to the talent they have. They are definitely looking to refresh it where they can, but they're being very cautious about it.
You know, LinkedIn data only goes back so far, so maybe there isn't a time when we can compare this to, Karen, in recent years, but I'm wondering if what this looks like as far as other parts of the economy or other parts of economic history. Like, is there a historical parallel you could draw as to where we are in the cycle right now?
Well, for us, that's right. We typically like to go back to around 2015, 2016 in our data. That's where we feel confident that we can say something. But when we look at the hiring rate right now, it being so slow, so much lower than even last year, 20% below the pre-pandemic levels, I would say hiring is as low as it's been since like 2013 right now. So it is a really, really kind of slumbering labor market with not a lot of movement. And I think one of the factors is that we just don't have that churn. We're not seeing people quit. We're not seeing people laid off, which is a great thing. I'm glad about that. But it means that when people don't leave their job, there's no vacancy to backfill. And so things are very slow.
You know, I'm curious, Karen, demographic differences, industry differences, geographic differences, any color that you can give us on that?
Demographically speaking, we definitely see that hiring is extremely punishing for those entry-level workers. So young grads who are coming out with a college degree, their hiring rate is twice as slow as everyone else's. So if I told you that on average, entry-level workers, maybe without a college degree, are running a little bit slower than the average worker, those entry-level workers with a college degree are running far, far slower.
Where are people getting jobs and where are they not getting jobs?
So people are definitely getting jobs if they work in the skilled trades. You know, master electrician, plumber, pipe fitter. If you're working in commercial construction, because there's a lot of activity, if you think about the plants that are being built, utilities and electrical grids that are being expanded, there's a lot of demand for construction work there. There's also a lot of hiring, believe it or not, going on in the financial sector. We're seeing it in education. We're seeing it still in healthcare. So there are definitely pockets where people are getting hired. But where we're not seeing as much momentum is sometimes in that middle space of either entry-level workers in the white-collar space, or if you think about you know, some of the tech jobs are starting to rotate away from classic coding requirements and looking for different skills. And so that's causing a change in who's getting hired in tech companies.
Some might say a Harvard trade school maybe makes sense then after all, which certainly relates to a story that we talked about earlier in the week. Karen, so great to get time with you. We look forward to maybe next month or sooner, and maybe we'll actually have a monthly jobs data to also weave into the conversation. Karen Kimbrough, Chief Economist at LinkedIn from Sunnyvale, California. Just do want to mention a headline crossing. 3M is said to be considering selling billions of dollars of assets from its industrials operations as it looks to carve out low-growth businesses, according to people familiar with the matter. We did see a little bump in the share price, up about 1% right now, just down a hair.
I will say Brooke Sutherland out with a great feature about 3M. We spoke to her yesterday on our program. If you missed that conversation, check it out on our podcast feed or at Bloomberg Business Week.
More on the economy when we come back with Goldman CEO David Solomon and a company on Wall Street everybody's watching.
521 on Wall Street. I'm Alexis Christoforous, and it looks like a powerful earlier rally on Wall Street is losing a little bit of steam. We're now mixed as investors continue to shrug off this government shutdown. The Dow Jones Industrial Average still up 344 points, but that's actually off its best level of the day. Still record territory there for the Dow. The S&P 500 gaining about 8.5, again a record there, but the NASDAQ pulling back, now down 67 points. Gold is at a new record high, and crude oil, WTI, now at 61 a barrel, snapping a 4-day losing streak. We've got shares of Apple slightly higher, up about 0.2%. Jefferies downgraded the tech giant to underperform from hold, citing excessive iPhone hopes. Apple is also removing apps from its app store that enable users to track and report sightings of U.S. immigration and customs enforcement agents. That's after the Justice Department said the apps could put law enforcement officers at risk. And just days after Microsoft announced a series of sweeping changes to its Game Pass subscription tiers, GameStop announcing it will continue to offer the service at its original price of $19.99, defying Microsoft and its 50% price hike for Game Pass Ultimate. GameStop coming under pressure, down now more than 3.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
All right, Alexis, thank you so much. Well, big bank earnings just a little more than 1 week away. We will be picking through those releases for clues on the economy, the health of the financial sector, and so much more. We got a little glimpse of what's to come when Goldman Sachs Chairman and CEO David Solomon spoke with Bloomberg's Tom McKenzie at an event in Italy, earlier today.
The U.S. economy is in pretty good shape, and there are some very, very strong tailwinds that have really had a profound effect, and there are also some things going on that are creating headwinds and are probably leading the economy to, underperform its expectation at this time. But I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026. The big structural issue that's kept the U.S. economy going so well is the U.S., and by the way, other developed economies around the world, are running very aggressive fiscal stimulus plays. Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds.
All right, that, of course, Goldman Sachs Chairman and CEO David Solomon speaking with Bloomberg's Tom McKenzie at Italian Tech Week in Turin, Italy, earlier today. Let's get more on this, the big banks, the earnings to come, the mysterious trading billionaire, too, that's smashing records and doing better than Goldman, JP Morgan, and others, which makes me wonder if they're all looking at this dude. Hey, let's get to it. Sri Natarajan is in the house, Bloomberg News chief Wall Street correspondent. All right, Sri, first up, Goldman, like JP Morgan, Wells Fargo, among the big banks that are reporting on October 14th, so a little bit more than a week away. Anything that stood out for you from what David Solomon told Bloomberg's Tom McKenzie on the U.S. economy or other?
I have to start by saying that
you like the spinning?
Well, I certainly like the spinning, but having followed David Solomon for the better part of a decade, or at least the last 10 years, at least his public life at Goldman Sachs since he became co-president, then the CEO, it just feels like he is in the most relaxed, engaging, non-defensive phase of his life. Those would not have been terms you would have associated with David Solomon 5 years back, 3 years back, or even 2 years back. I have to assume that the Goldman Sachs stock at $800 a share probably has a lot to do with that. When he took over, it was around 200. It was a little bit of a circuitous route to get here.
Yeah.
If we remember
there was a period, right, where we talked about his future, his tenure.
Mostly, I would say that it was the Goldman senior partner class that was constantly talking about his future, his tenure, their unhappiness with the place and the consumer banking misadventure. But to their credit, they acknowledged the mistake. David Solomon acknowledged that it wasn't working, cut his losses, and went back to focusing on the things that really work well for Goldman Sachs. And the results are there for everyone to see. This year, the stock's up 40%. It's one of the best performers in the last year, the last 3 years, the last 5 years. It is doing well, and that perhaps is playing a huge role in Mr. Solomon's outward-facing personality, but also look at the underlying commentary from him out in Italy. He talks about the banking environment. He talks about resilience in the U.S. economy. When we talk about pickup in deal-making activity, it is already running hot relative to last year, but most of that gain is coming in North America. According to our numbers, you've seen a roughly 39% year-over-year increase in deals that have been announced. when you think about mega cap deals, and this is a stat that he threw out there, David Solomon, when you think about mega cap deals that are deals bigger than $10 billion, that is Goldman's sweet spot. Those deals are up 100% year over year. And the reason it's Goldman's sweet spot is any company that's thinking about doing a big transformative deal, management would never go wrong, even if the deal goes bust. If they showed up in court, or if they showed up in front of anyone trying to look into why they made such a decision, if they would have raised their hand and said, well, we hired Goldman Sachs to do it because they have the reputation of being the best in the business. And in that segment of the market that's doing so well, it obviously helps Goldman Sachs. So their investment banking performance is great. Volatile markets and generally markets heading up are good for the Goldman trading business. And in the asset management space, they're doing well. So out and out, good year for Goldman Sachs so far.
We're going to hear, as Carol mentioned, from Goldman, JP Morgan, and Wells Fargo on October 14th. Those banks and other competitors to Goldman Sachs, what is Goldman Sachs doing better or has done better, and how have they done it over the last 3 to 5 years?
The key themes in market, the things that have really worked, play to Goldman's strength, right? And they have focused their effort around their investment bank, which involves deal making and the trading businesses, and around the asset management businesses. And these are things where we talk about these trends in the market out there. The biggest players, it's the best in the business. Every business is going to sort of consolidate around the top 5 to 10 players. There might be way too many players out there, especially if you think about the asset management space, and there will be a little bit of a shakeout. Losers will have to, shut down perhaps and fade away. But for players like Goldman Sachs, Blackstone, Apollo, Carlyle, KKR, if you're thinking in the asset management space, BlackRock, they're going to continue to do well. And when you think about an improving deal-making environment and a trading environment where everyone's doing well, Goldman is always going to be part of the mix. And that's why you're seeing it reflected in the stock market as well.
All right, so we kind of teased and kidded that there might be a firm that folks like David Solomon might be watching in the financial sector. And are they, I'm not sure if they technically are on Wall Street. It's not a firm we talk about a lot, although a couple years ago we talked about it a lot in regard to crypto and Samuel Bankman-Fried. This is an incredible story that you wrote, and it's been among the most read on the Bloomberg. Tell us about the individual at Jane Street that is just kind of hitting it out of the park.
Right, for our viewers and listeners, you're obviously talking about Rob Granieri, the last remaining founder at Jane Street. Jane Street has obviously been in the news quite a bit, and you're right, about a year or two ago, this firm was really best known as being this early launch pad for Sam Bankman-Fried's career. Of course, Sam Bankman-Fried then went on to become this global crypto wonder king, now in prison. That's not really great PR for the firm, but when it comes to the plumbing of markets, and again, Jane Street is part of this core group of firms that have sprung up in the last 20 to 30 years in concert with the electronification of markets, in concert with the embrace of exchange-traded funds, the ETF market, that have been able to benefit from their expansive use of technology and technological resources in a way that they are out there outperforming the banks. And part of that reason is capital constraints for the big banks has also forced them to pull out of certain sections of the market, leaving voids where Citadel Securities and Hudson River Trading and Jane Street and the Susquehannas of the world have jumped in. But no one seems to be doing it better than Jane Street. And the numbers are quite stark. 2016,
Let's pull up the numbers for those who are watching on TV and YouTube and Bloomberg Originals. For those on radio, walk us through, Shri, because there's a chart in this story about Jane Street by the numbers, but it in particular looks at the second quarter trading revenue numbers.
Second quarter trading revenues, Jane Street, $10.1 billion. This is the first time ever that they have done better than every other major Wall Street bank and every other competitor that they have in their space. They're much better than Citadel and Hudson River Trading.
I mean, JP Morgan at $8.9 billion.
Yeah, 8.9. That is fortress America when it comes to the biggest U.S. banks. That is Jamie Dimon's bank, and they're doing better than them. That is pretty extraordinary. This has also been a rough year for Jane Street. Let's not gloss over that. The fact that they've been accused in India of goosing the world's largest options market. So they have to deal with that as well. And they're vowed to fight those claims. But while they're dealing with that, there is no denying the numbers they've been putting up. And that's why we decided to focus on the last remaining founder of that firm right now.
We're speaking with Sri Natarajan, Bloomberg News chief Wall Street correspondent. Let's talk about him, Rob Granieri. Like other billionaires, he's got just a portfolio of trophy homes. No, I'm being completely sarcastic here. In your piece, you talk about how He's not like other billionaires, Shri. How is he different?
Oh my God! And talk about a contrast and the shift just from David Solomon, the most buttoned-up, serious CEO on Wall Street. His DJing aside, but in his day job, you go from David Solomon to this man, 53-year-old Rob Granieri, and the contrast is not just in their hairstyles, right? Rob Granieri is a man with long flowing hair. He's got, it's not your typical sharp Wall Street where it's like they see their ethos as a tech firm. You walk into that office and you'll see people in t-shirts and jeans, whether you want to call that schlubby wardrobe or whatever you want. That is the ethos at the firm. But what's interesting about Granieri is he absolutely detests the spotlight. Till earlier this year, when we had this wild story where he was facing this embarrassment of having to publicly acknowledge he was duped, get this, duped into funding a plot for a coup in Africa, in South Sudan in particular. That's when we first started even hearing about him in a meaningful way. And when you dig into the man, he's just eccentric, but in some ways wholesome and earnest, and loves to live in rental homes, does not want to buy his own homes. Is a soft-spoken libertarian. His colleagues describe him as someone with a golly-gee attitude, but whether golly-gee attitude or not, he's atop the firm that is the most lucrative trading house in the world, and just not the man that you would expect to see in that position, and yet he has done extraordinarily well, and his firm clearly has done extraordinarily well.
Does he kind of like being like the top Wall Street firm that no one's heard of, which is how someone described it? Does he like kind of being kind of unknown, if you will?
Not just likes it that way, he would prefer it that way, and he wants it that way, and that is what he would like to tell his people. Do not do anything that would appear in the newspaper.
Did he talk to you guys for this?
He did not speak to us for this story. He would not give us an interview, but that's the man that he is. He just does not want to be known, and that's fascinating. And yet you have this man who's behind a casino in Mississippi.
That's what I wanted to end on, just 20 seconds on the Scarlet Pearl.
Well, the Scarlet Pearl, fantastic name, by the way. That's where the most recent John Travolta heist movie was even shot. That is Rob Granieri's casino. Initially, he was putting in some money because he was helping out a family friend, but turns out he was conned by a former nun. So decided that, at this stage, might as well take the former nun to court, but not give up on this casino, tried to bring in other Wall Streeters, tried to bring in Carl Icahn. That did not work out, ended up pouring lots of millions of dollars into this, and now it's a thriving casino resort in Diabloville, Mississippi. And if you ever want to see Rob Granieri dancing, you have to go down there when they give out their employee awards every year.
Sounds like a road trip for all of us. And also, I got to just say, his yearbook picture from 1990, man. He did look more buttoned up then. And I'm just going to say.
Hair was shorter.
You had to look at the hairstyle of some of his classmates from that Mepacton High yearbook in 1990.
Great stuff. Shri Natarajan, Bloomberg News Chief Wall Street correspondent. We're going to get another read on the U.S. labor market in just a moment. But as we head to a break, we are watching the floor of the U.S. Senate in the nation's capital, a vote happening to vote on a CR, a continuing resolution, which, if agreed upon, we could maybe have that U.S. government shutdown stop and the negotiations could begin once again.
Maybe. We will bring you updates as they come from Washington, D.C. This is Bloomberg.
It's 2:40 on Wall Street. I'm Alexis Christoforous. Well, 2 out of 3 ain't bad. The Dow and S&P each at record highs, but the NASDAQ has turned negative as investors wait to see how long the U.S. government shutdown will last. Historically, shutdowns have not been market-moving events. We've got the Dow Industrials up 318, as I said, in record territory. The S&P 500 up 7 at a fresh all-time high. The NASDAQ, though, down 67. Gold at a record high, and crude oil now at $60.86 the barrel. BlackRock's Global Infrastructure Partners is in talks to buy privately held Align data centers in a deal worth $40 billion. It underscores surging investor interest in data centers that cater to the booming market for artificial intelligence. Shares of BlackRock basically flat. Checking the AI trade, NVIDIA lowered today after hitting a record high in yesterday's session. We've also got AMD pulling back about 3% right now, and Broadcom is just up about 0.7%. Bloomberg is reporting that 3M is considering selling assets from its industrials operations as it looks to carve out low-growth businesses. The maker of Post-it notes and Scotch tape has been speaking with Goldman Sachs as it reviews potential divestments. No final decision has been made. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
All right, Alexis, thank you so much. Alexis Christoforous in there for Charlie Pellet. All right, so as you know, no monthly jobs report. We have talked about that a lot. I will point out, though, in the last monthly jobs report from the government, we did get that out last month, showed hiring in the U.S. healthcare sector looking increasingly shaky, raising a warning flag for the economy given its importance as a key driver of job growth over the last 3 years. Now, Tim, healthcare and social assistance companies added about 47,000 employees to payrolls. That was in August, and that is the last month that we have data for, according to the BLS.
Look, and we just spoke to Karen Kimbrough, a chief economist over at LinkedIn, and she said the same thing, that they're seeing some strength when it comes to some areas, including jobs like construction, jobs like electrician, master plumber, but also in the healthcare sector, still seeing hiring there.
Exactly. So let's get another view when it comes to healthcare jobs, specifically the nursing industry. Back with us is Dr. Iman Abuzaid. She's co-founder and CEO of Incredible Health. It's a career marketplace for connecting hospitals to nursing talent. So she has a good view on all of this. She is here in studio. Nice to have you here. How are you?
I'm doing well. Thank you so much for having me.
It's great to have you here. We are without the latest monthly jobs report, so we're trying to kind of read the tea leaves and talk to lots of folks. Talk to us about supply and demand for nurses in the U.S. What are you seeing?
We're still seeing a strong demand for healthcare hiring. The number of jobs in healthcare are increasing, but it's happening at a lower rate than it was before.
Why?
Like most likely changes to the economy and the macroeconomic changes that we're facing as a country. So the other big reason is the Big Beautiful Bill does have Medicare and Medicaid reductions in it, which has slowed a little bit of hiring in healthcare too.
A lot of healthcare jobs, not necessarily RN, but healthcare jobs are occupied in the U.S. by people who were not born in the U.S. I don't know the data that you have on that on your platform, but I'm curious if you're seeing any of the immigration changes that we've seen during the Trump administration, during the first few months of this administration, affect the workforce on your platform.
Yeah, so 20% of healthcare workers in the U.S. were born outside of the U.S., so they do compose an important part of the healthcare workforce that's already here. To be honest, though, we're still with status quo with immigration. I mean, honestly, since 2016, there's just been a huge slowdown in the number of healthcare workers entering the country as immigrants. And a lot of that is just continues with every administration. We saw it with Biden. We're now seeing it with Trump. And so that just highlights the importance of us needing to take care of our domestic healthcare workforce.
So what's the answer in your view? If it's been slowing down at this point for close to 10 years, then what's the right way to approach this?
The best way to approach this is to keep increasing the number of healthcare workers in the U.S. by encouraging more and more Americans to go into healthcare. We also have to remove the bottlenecks in healthcare, including the nursing school shortages, the technician school shortages, and increasing the training programs that are available for Americans too.
Okay, I've talked to some doctors about this, friends of mine, and they give me these numbers that are just mind-bogglingly small. Like some specialties only graduate like 3 or 4 different residents per year in some schools. And like, it's an incredibly small number. So that seems to be structural. But as you move down from actual MDs, is it easier to increase the number? Because it doesn't seem like it's easy to increase the number of doctors in this country with the way the system is structured.
That's exactly right. The way the system is currently structured is it is very difficult for us as a country to increase the number of healthcare workers that we desperately need. And healthcare still remains the biggest labor shortage in the country, with the demand continuing to increase from patients getting older, but not enough healthcare workers in the system.
Wait, so cost, lack of places to educate folks, or lack of desire for people to want to do it? I mean, I know folks who are doctors, and I think, Tim, you and I talk about this a lot, who don't necessarily love it. And then there is the demographic side, where I know I've had doctors in my life for years who have recently retired, and yet we're scrambling to find new doctors. What is like the key metric that is, or cost? Like, what is it that is really preventing folks from going into the profession?
It's really just the bottlenecks we have in our system. There is a desire from Americans to become healthcare workers. It's a key way to change, your socioeconomic status. But we have bottlenecks on hiring, on educating, and on training the healthcare workers.
Why do we have bottlenecks if we need them?
Yeah, I think honestly, there's a lot of experiences that we need to continue to improve. That's a lot where Incredible Health comes in. We're actually announcing our AI agents. So what we've done is really ushered in a new era of healthcare hiring that can be done with AI agents to really improve the experience of healthcare workers finding their dream jobs and pursuing their dream careers.
So that's on the hiring side. What about on the actual taking care of patients side and technology there? Is there a way to ease the burden on these healthcare professionals using technology?
Absolutely. Healthcare is one industry that is adopting AI technology very fast, almost as fast as other industries, which is unusual, right, in healthcare. We're seeing AI agents be used at the bedside. We're seeing AI scribes being used. So there are...
We've had experience with... have you had a doctor with a scribe? I've had a doctor with an AI scribe.
I'm not sure if I have.
But apart from that, I mean, and that's really helpful to doctors when they're doing their notes. They probably don't have to spend as much time doing notes, and maybe they can spend more time with the patients.
That's right.
But beyond that, is the technology to a place where you can trust it to make decisions that are going to lead to better outcomes for patients?
Yeah, I believe that human connection still matters in healthcare. Both the human connection, the empathy piece. I don't think the jobs are necessarily going to be replaced with AI, but AI is being used to augment and support these healthcare workers who are generally an overworked and burnt out workforce.
Do you see eventually a day, I'm going to just go there, as we continue to see like humanoids and robotics, but a combination of robots with some AI in somehow having a role when it comes to American healthcare?
Absolutely. I mean, we launched 2 AI agents, one named Gail and one named Lind. Gail is a career partner for healthcare workers, a lifelong career partner that helps them generate resumes, that helps them with interview preparation, helps them do mock interviews, and over 90% of nurses give it a thumbs up in terms of having a great experience as well as referring it to their friends. And then also Lynn is another AI agent we have, which is a co-pilot for the hiring teams. And so Lynn is now interviewing healthcare workers and is selling them on the organization, discussing multiple jobs with them, and really sharing what's amazing about specific employers.
But what I really mean, just got about 30 seconds, the idea of an actual robot with AI and learning and in a hospital helping out.
I mean, absolutely. I mean, I think the future, that's where we're all headed, not just in healthcare, probably in other industries too.
Not for journalism,
not for
broadcasting. Good to catch up with you. Thank you so much, and great to have you in studio.
Thank you so much for having me. Appreciate it.
Take care. Dr. Iman Abu-Zaid, she's co-founder, chief executive officer of Incredible Health right here in studio.
Hey, we're watching right now from Washington, D.C., procedural votes that are ongoing in the Senate to see whether or not we will have a final vote on the continuing resolution that was passed by the House. This has to do with reopening the government, Carol. We're keeping an eye on everything happening from Washington.
Yeah, basically it would provide some funding, right? That would once again allow the government to reopen and then go back to negotiations.
Well, speaking of negotiations, some stories catching my eye about the president's negotiating strategy. The president, and near the White House rather, announcing today that it was withholding more than $2 billion for transportation projects in Chicago, also examining ways to reduce federal funding to Portland, Oregon. It's the latest bid to use the shutdown to target political opponents in Democratic strongholds.
All right. Yep. And while all of this is happening, it's been, as you know, a very, very busy week. And right now you've got markets, potentially some records here on Wall Street as we wrap up the trading on this Friday and for the week overall. But right now you've got markets off their best levels, just about a 3-point gain on the S&P 500, down 109 points on the NASDAQ 100. When we come back, we'll check out some stocks on the move. You are listening and watching Bloomberg Business Week Daily.